Very good afternoon, everyone. Welcome back to CA Intermediate Advanced Accounting. And starting today, we'll be doing our marathon revision. The plan for marathon revision is pretty simple. We'll start with introduction to accounting, do AS applicability. Then we'll start doing accounting standards in the order 1, 2, 3, 4, 5, 6 is however not there. Then 7, 8 is however not there. We'll try and do them in the order. So we have it for 2 days. The plan is to do about 14, 15 standards today. And once we do 14 accounting standards, we'll do a couple of topics on accounting today. And in tomorrow's session, again, we'll do the rest of the accounting standards, followed with the remaining accounting standards and the rest of the accounting topics. Hopefully, we should be able to finish. We will not be doing any problems in this 2 days because we don't have enough time to do problems. We'll completely understand the concept that's there in that particular standard. Got it? Come on, let's get started. To start with, we'll do chapter 1, Introduction to Accounting Standards. We need to understand the word generally accepted accounting principles before we jump into the word accounting standards. Whenever there are instances which can be handled in more than one way, and there is both the options available, whichever one you pick to follow is your accounting policy. This is the general meaning. If we have to come down to the definition or more clearer version of the word accounting policy, it is accounting policies, principles, and methods of applying those accounting policies and principles in preparation of financial statements. In this, what is generally followed by everyone is called as generally accepted accounting policies. Over a period of time, by multiple application, if these are standardized, recognized by an accounting body or issued by an accounting body or a governing authority, then it becomes accounting standards. So commonly authoritative standards are accounting standards. What is still commonly accepted, there is no standard issued against it, will continue to be GAAP. And in our country, we have accounting standards which are in two versions. One is accounting standards, second one is Indian accounting standards. Why did two come into picture? This is because of what we have internationally called as IFRS, International Financial Reporting Standards. So IFRS is what globally is accepted, and we did not adopt IFRS, we converged with IFRS, meaning we accepted IFRS with some changes. So Indian version of the IFRS, by making some changes in IFRS, we arrived at our own version of IFRS, and that's called as Ind AS. Right now, accounting standards are applicable for non-corporate entities completely. For corporate entities, in a staged-wise manner, Ind AS is applicable. There are a lot of corporate entities for whom still AS is applicable and Ind AS is not applicable. Talking about applicability of Ind AS, we'll do it towards the end of this unit, and then you will get to it. Now, talking about accounting standards, what do you mean by accounting standards? These are written policy documents. This can be issued by government, for instance, MCA, NFRA, and expert accounting body like our ICI, or any other regulatory body which is so authorized by the government can issue these accounting standards. Whenever they're issuing accounting standards, they keep 3-4 things in mind. The things that they keep in mind is recognition, measurement, presentation, and disclosure with regard to such accounting policies. Some of our accounting standards are only disclosure based standards, whereas some standards talk about recognizing an item, presenting an item, measuring an item, as well as disclosure. So these are the 4 things that should be kept in mind whenever the standard is being issued. What are they? Recognition, measurement, presentation, as well as disclosure. The standard setting process is this way. Whenever there is a problem area, it will be first identified, meaning area where more than one accounting policy is there, area where there is no uniformity, area where there is no reliability, there is no standardization. Different people are following different accounting policies, because of which there is no comparison, there is no reliability, there is no trustworthiness. So there we identify that area first and create one study group. This study group studies the problem as well as the possible solution. They come out with one draft solution which will tell what can be the most likely method of counterfeiting this particular problem and coming out with the solution. This solution is basically reviewed by all the important bodies like SEBI or any other IDBI or several banks or if several institutions, listed companies, stock exchanges will review it. So they'll basically review this. Once they review, they will give their suggestions. Once these suggestions are adopted, if found necessary, then it is let out for public review. Public comments are expected on the same. Based on the comments given by the public, if at all it's found necessary, those changes are made in this, and ultimately and finally the accounting standard is being issued. That's the standard setting process. 1, identifying the area, problem area. 2, constituting the study group. 3rd one, preparing the draft and circulating it. Then ascertaining the views from different bodies. Then you prepare a final exposure draft, consider comments from public. modify the draft and issue the accounting standards. Whatever the problems that was there with accounting policies, that is, there was no uniformity, there is no standardization, there is no reliability, there is no, what do you say, comparison. All of these are the problems of accounting policies. These problems are overcome by accounting standards. Accounting standards help us standardize the accounting policies. Accounting standards bring reliability on the financial statements. Accounting standards make the financial statements comparable. So whatever is the drawbacks of accounting policies will become the objectives and benefits of accounting standards. But the only drawback is, no matter at what point of time what the standard says, standard can never override law. If accounting standard says something and the regulating law says something, what do we follow? We follow the law over the accounting standard. So accounting standard has to work under the jurisdiction of the law. It cannot override law. And as of now, accounting standards are issued by ICAI, Institute of Chartered Accountants of India, for non-corporates. And for corporates, companies, accounting standards are to be issued by MCA, Ministry of Corporate Affairs. MCA has straight away adopted the accounting standards what is issued by ICAI. So there is no difference between standards issued by ICAI and standards issued by MCA for corporate entities. Understood this? Now let's see that Ind AS part a little. So talking about IFRS, which is globally accepted, India, in order to take up their ease of business index and let the entities from the foreign country come do business in India, they told, hey, we don't follow a very different accounting approach. We follow the same thing that you do with small changes. So that Indian version of IFRS is called as what? Ind AS. We call it convergence with IFRS, not adoption of IFRS. And what is the need to bring in uniformity at a global level? Now, when you bring in accounting standards, in the national level, there is uniformity, standardization, reliability. But at international level, different countries have different accounting standards. So there is still no standardization, no uniformity, no reliability. To bring that at global outset, there is IFRS. And how is this happening? IFRS was previously issued by one body called as IASC. What is it called as? International Accounting Standard Committee. This IASC was issuing not IFRS, but it was issuing something called as IAS. IAS is International Accounting Standards. This was done till 31st of March 2001. But from 1st of April 2001, we have something called as IASB. That committee is being reformed into a board now, International Accounting Standard Board. This International Accounting Standard Board will now issue accounting standards which are accepted internationally. These are not called as International Accounting Standards. The new name given to this is called as IFRS, International Financial Reporting Standards. The objective again goes down to be the same, to bring in the global outset and then comparison of everything. And in India, what have we done? I told we made some changes to IFRS. Whatever is not there in IFRS, but we brought it in, is called as carve in. We take IFRS plus carve in. And after that, some things which are there in IFRS, we are not following. We remove it. It's called as carve out. So IFRS plus carve in minus carve out will give you Ind AS. And that's what is followed in our country. How are we implementing Ind AS in India? See, initially, we started with phases. So it's called phase 1 and phase 2. In phase 1, on 1st of April 2015, we have announced it saying that it is voluntarily basis. Any entity which wants to adopt this way of reporting, Ind AS way of reporting, you can adopt it. When is this from? 1st of April 2015. It became mandatory for a selected group of entities from 1st of April 2016. For which entity is it applicable from 1st of April 2016? If in case you are listed or your entity is in the process of getting listed, then whether in India or outside India, and your net worth is greater than 500 crores, or your parent, subsidiary, associate or joint venture is falling in one of the categories, then it is applicable to you. It is not all of these three conditions, it is one of these three. If you are in listed, then you are supposed to follow Ind AS. If you are already listed or in the process of listing, you are not listed, but your net worth is greater than 500 crores, still Ind AS is applicable. You are not listed, you are not in the process of listing, and your net worth is not greater than 500 crores, but you have a parent company which net worth is greater than 500, or that parent company is listed, or that parent company is in the process of listing, then again account Ind AS is applicable to you. The reason being, when you have to do consolidation of that parent entity, you would have to mandatorily follow the same accounting policies, same accounting standards. No, so you are enforced to do to say Ind AS adoption, though you don't fall in 500 crore category and though you are not listed. You get that? Yeah. Then from 1st of April 2017, this limit was brought down. So what did they tell? Same thing again, listed or in the process of listing. But the point is, net worth criteria, which was 500 crores, was brought down to 250 crores. So if you had net worth of 300 crores, Ind AS was not applicable to you in 15 unless you take it upon voluntary basis. Ind AS was not applicable to you in 2016 also, but from 1st of April 2016, 2017, it is mandatorily applicable to you and your entire group companies. I hope you got it. And this entire process, what we're talking now, is not about banks, NBFCs, and insurance companies. For them, Ind AS is not applicable. They still follow AS. However, recently RBI has rolled out a notification where the quarterly reports what the banks have to submit to RBI would have to be as per Ind AS. So very unfortunately, banks nowadays follow Ind AS for interim reporting to RBI, but their annual reporting to every entity, everyone who's dependent on them will be as per accounting standards only. They would have to do both. Fine, that's however not part of our curriculum or syllabus. I hope you understood this part. So this is the entire discussion with regard to introduction to accounting standards. Now let's go to applicability of accounting standards. I think we'll do framework of accounting, framework of preparation and presentation of financial statements, and then go to applicability. The order, chapter 2 and then chapter 3. So chapter 2 of our syllabus talks about framework and presentation and preparation of financial statements. To start with, what do you mean by financial statements? It will include everything: balance sheet, P&L, cash flow statement. And when we say balance sheet only, we'll include consolidated balance sheet also, or significant accounting policy statement, any other notes to accounts that you should disclose, and everything is part of our definition of financial statements. And this financial statement is prepared to help the users take the decision on the company. Who are the users? There are two types of users: one internal, second one external. Internal users can be someone like employees of the company, lenders of the company, suppliers, creditors. External can be government, customers, public, and all of this. So these people are dependent upon your financial statements to decide whether to do business in your entity or not. In the modern day culture, it's become so that if any company offers you a nice job, before you take up the job also, you'll ask them for their balance sheet to check whether they have enough runway to pay salary for next 3-4 months. What if they offer the salary that you want take up, but they don't even have money to pay 1 month salary in the so-called startup culture? So even the employees or prospective employees are interested in the company's financial structure. However, government is anyways interested to check whether you disclosing the right amount of profit or not, and investors are interested whether to invest in your company or not, and lenders to check whether you are financially stable to give the money back or not. So these are the users who are interested in your financial statements. Whenever you prepare financial statements, it is prepared based on 3 fundamental accounting assumptions, which, if not mentioned, is always assumed to be followed by the entity. And this will touch again when we start with accounting standard 1. So what are 3 fundamental accounting assumptions? Number 1, going concern. Number 2, accrual. Number 3, consistency. Going concern says that an organization neither has an intention nor a necessity to close down its operations. The objective of the organization is always to continue the business for foreseeable future. If this is not there, disclosure is required. If going concern is there, disclosure is not required. Same with accrual. Whenever you make accounting, we'll talk about this again when we start with AS9 revenue recognition. The entity should maintain records based on accrual basis, meaning the transactions should be recorded as and when it happens, and not merely when it is affected in cash. Meaning cash system of accounting is prohibited. Should not do accounting based on cash system. If in case you choose to do cash based accounting at certain point, you have to make a very clear disclosure stating that this part of our revenue recognition or this part of accounting has happened based on cash system. It has to be disclosed. However, if you're following accrual, is there a disclosure required? So there is no disclosure required for following accrual. However, there is a separate disclosure required if accrual is not followed. Yeah. And lastly, talking about consistency. The accounting policies what an organization follows in preparing its financial statements should be consistent, meaning it should be same from one accounting period to another accounting period. You are not allowed to change your accounting policies from year to year. However, there are exceptions. We'll talk about it again in AS1, but if I would have to mention right now, the accounting policies of an entity should be consistent. Exceptions for changing accounting policies are three. When the accounting standard all by itself requires you to change, when the law requires you to change, or if the old accounting policy what you're following is incorrect and for the sake of better presentation, you have been asked to change. In these three circumstances, you can change your accounting policy. Otherwise, the accounting policy followed by the entity should be consistent from one accounting year to another accounting year. Got that? Then let's talk about the next thing. We follow this to ensure that the assets are shown at fair value. It's to ensure that the assets are not shown at a higher value, incomes are not overstated, and all of that is fundamentally based upon this fundamental accounting assumptions. Qualitative characteristics are usually ignored of financial statements. These are not taken into consideration, but it should be understandable, meaning all the disclosures should be made at one place. You should make only relevant disclosures. You should not make obvious disclosures by eating up the mind space of the user. And the financial statements have to be prepared at the right time. You have to ensure, go to say, benefit and cost analysis, and you need to prepare one previous year column for the purpose of comparability next to your balance sheet as well as P&L account. And the financial statement should, whatever is prepared, is based on the accounting standards to ensure that it is reliable, trustworthy. Someone can trust on your financial statements. And any item which is presented in the financial statements is based on the quantitative characteristics. Do you agree with me? It's measurable in terms of money. If something cannot be measurable in terms of money, we cannot record it. When we do AS29 provisioning, we will talk about this. We would create provision for an item only and only when it can be measured in terms of money. If we cannot measure an item in terms of money, we won't basically write it in our financial statements. So for the sake of measurement, there are four things that we should consider. Number one, historical cost. Number two, current cost. Number three, realizable value. Last one, present value. Historical cost is the amount that we have spent when we initially entered into that transaction. Long ago, when I bought this laptop, I paid 60,000 rupees. That is historical cost of the item. Second one is current cost. Current cost is today, if the same model of laptop has to be checked out on Amazon, what is the price that I might have to pay? That money becomes my current cost. And third comes realizable value. If in case today I sell this laptop on OLX, how much money will I realize? That is my realizable value. Last one is present value. Using this asset, in the future, I am going to generate cash flows. That future cash flows, what I am going to generate from this asset, if I discount it to today's date using present value factor, what value will I arrive at? That will become my present value. Depending upon the situation, different items will be measured on different things. Certain items are recorded at historical cost, certain items are recorded current cost, certain at realizable value, some at present value. Do you agree with me? If all the four fail, if there is an item which has to be recorded, but you are not able to use any of the valuation principles, then you bring in accounting estimate. Accounting estimate is made based on the past experience and the present situation. You arrive at some value. That is accounting estimate. You get that? We'll come back to that accounting estimate when we do accounting standard 5. Last part in your second chapter, that is capital maintenance. So there are few simple questions on this in your material. I would request you to try them today after class. There are about 3 questions in your ICA study material. Simple to do. It's your accounting equation based questions, but you would have to do that to get to know how to do it. Okay. Capital maintenance. Objective is to ensure that the organization is a going concern. Whenever an entity sells the goods, makes profit, if it eats away its entire revenue, sales money, if it eats away its entire profit, it might not be able to sustain. Point number 1 is very simple. You can utilize profit, but you cannot utilize the sales revenue. Let's say I started selling water bottles and I sold water bottles and I got the money. Sales money, I should not use it for spending as dividend or using for any other purpose. Profit money I can utilize. If in case I use my sales money to distribute it as dividend or for any other purpose, then I won't have enough money to buy the bottles again to sell. That will bring down my scale of operations. That operations, if it should not come down, how much money can I utilize? Firstly, profit can be utilized. The second thing that you should keep in mind is because of inflation, I might be buying bottles at 100 rupees, selling it at 120. And I bought 10 bottles, I sold 10 bottles. So 10 bottles at 100 rupees, I spent 1000 rupees. I sold them at 120 each, I got 1200 rupees. Our common sense says 200 rupees can be utilized. 1000 rupees if I have, I can again buy 10 bottles. But tomorrow, the bottle price in the market might not be 100, it might become 105. So to buy same 10 bottles and maintain the same level of operations, I don't need 1000 now, I need much more than 1000, I need 1050. So out of 200 profit, 50 rupees has to be kept aside as capital. I can utilize only 150. That's what we mean when we say maintenance of capital. Are you getting it? So considering inflation, how much of the profit can be utilized to ensure that the scale of operations will not come down. So read this: dividends not to exceed profits after creating provision for replacement of assets. The dividend that you give should not eat into your capital in such a way that the scale of operations will come down. Closing capital should not be lesser than opening capital. 1000 rupees was my opening capital to buy 10 bottles. My closing capital should be 1000. When will it become less than 1000? If I give dividend more than my profit. But certain times I need to keep in mind, what do you say, the inflation also into picture. If you consider only the opening capital has to be maintained as closing capital, that will become historical cost, meaning at the historical cost each bottle was 100, my scale of operations was 10 bottles, I needed capital of 1000, my opening capital is 1000, closing capital at the end of this year should be 1000. That is historical cost. Purchasing power says that at the end of 1 year, for the second year when I'm doing business, each bottle will not be 100, it will be 105. So I won't need just 1000 rupees, I would need 1050 rupees for doing business in second year. So considering the purchasing power, I would have to take the average price and then maintain higher amount of capital, not to do much bigger business, but to do the same level of business what I used to do in the past, I need to maintain slightly higher amount of capital. That is based on current purchasing power. Based on physical capital maintenance, meaning I will consider the closing market prices of each unit. Based on that, I'll identify how much of it is to be maintained. It is very similar to current purchasing power, but there is slight difference in the way we compute it. So these three, there can be a small MCQ question that can come. There are roughly about 3 questions in your study material on chapter 2. Please do it. You should not be taking more than 5-10 minutes to do this. Got that? So by this we finish chapter 2, which is on our framework of financial statements. Now we'll go to chapter 3, which talks about AS applicability. Can we? We're now doing chapter 3, which talks about applicability of accounting standards. We'll read accounting standards so much in depth in our class that you might be scared at one point to become an entrepreneur and then start business. Why? Doing business is easy. Following so many accounting standards in your business is so difficult. So is all the accounting standards applicable to all the businessmen? Is the question mark. The answer is no. Certain accounting standards are completely applicable. Certain accounting standards are partly applicable. Certain accounting standards, it's not applicable at all. So this depends upon what type of entity you are. And that's what we're going to learn in this unit. And applicability of accounting standards, the legal provisions relating to it is section 129 of Companies Act, which talks about financial statements, says that the financial statements what an entity prepares should be in accordance with accounting standards. And the second thing is section 129 subsection 5, which talks about financial statements, tells that if in case accounting standard says something and you have taken a deviation from accounting standard, meaning you have not followed what's told in accounting standards and you followed what your own thing is, like in that case you need to disclose what is that deviation. You need to make 3 disclosures. Number 1, what is the deviation from the accounting standard? Second one, why? Third one, what is the financial impact, if any, that is arising because of this? I'll repeat, you will learn this in company audit, you will learn this in company law also. You learn it at both the places. Section 129 subsection 5 asks us to make 3 disclosures if in case there is deviation from accounting standards. So if in case you don't follow accounting standards, how many disclosures should you make? Number 1, what is the deviation? Number 2, why is there a deviation? Number 3, what is the financial impact, if any, because of such deviation? If there is no financial impact, tell whether we follow that accounting policy or we follow this accounting policy, there is going to be no financial impact. Disclose that very clearly. And then we'll talk about 133. 133 tells us that accounting standards are to be followed are the accounting standards which are notified under section 133. 133 says that such accounting standards which are notified by NFRA, and same to same. 134 and 143, this talks about duties and responsibilities. Section 134 talks about directors' responsibilities. Section 143 talks about auditors' responsibility. It is directors' responsibility to ensure that whatever financial statements they prepare are in accordance with accounting standards. And it is the responsibility of the auditor to check whether these financial statements are prepared in accordance with accounting standards. So at every instance, there is the financial statements should be prepared as per accounting standards 129 subsection 1. If not, separate disclosure subsection 5. 133 AS which are supposed to be followed is notified. 134 director's responsibility. 143 auditor's responsibility. And it's our responsibility to learn accounting standards so that if we become accountant we follow, if we become auditor we check. Got that? Very good. Then talking about this, no, like I told, there are two entities, two regulated bodies which will put accounting standards into force. One is ICI, Institute of Chartered Accountants of India. Provisions which are issued by ICI, the applicability mentions whatever is made by ICI are applicable for non-corporate entities. For corporate entities, it is MCA. Now, ICI has divided the entities into level 1, level 2, level 3, level 4. Based on that, they'll tell for whom which standard is applicable. And MCA has divided the entities only into two categories: SMC, non-SMC. SMC means small and medium company. Non-SMC means not small and medium company. This is the categorization. Usually you will have two different tables wherever you read it from, whether you take it from the ICA study material or you see both the text separately. I put it all into one table. One single table, if you see, you will totally understand whether it is SMC, non-SMC, or level 1, level 2, level 3, level 4. Everything can be understood in one single table. This table answers all your questions. MCQ based questions for 2 marks on case study can come on this. Now, firstly, like I mentioned, ICI divides the entities into how many categories? 4. Level 1, 2, 3, 4. MCA divides entities into 2. SMC, non-SMC. Non-SMC means large company or big company. That is same as ICI's level 1 categorization. Non-SMC as per MCA, level 1 as per ICI, both are same. Non-SMC as per MCA and level 1 as per ICI, both are same. SMC as per MCA is level 2, 3, 4 as per ICA. Non-SMC as per MCA is level 1 as per ICA. SMC as per MCA is level 2, 3, 4 as per ICA. And why do we classify? Very simple. For this non-SMCs, that is big companies, and level 1 companies, all the accounting standards 1 to 29 except 6 and 8 are fully applicable. No exception of one paragraph also. All the paragraphs, all the lines, all the standards are applicable. From accounting standard 1 to accounting standard 29, exception 6 and 8 which are now removed, everything is applicable to level 1 entities and non-SMCs. If you are SMC or if you are level 2, 3, 4, certain standards are exempt, certain standards are applicable with relaxation. Exempt means what? It is not applicable, you don't have to follow. AS15 is not applicable to level 3 enterprises, whereas certain AS17 is applicable with relaxation. Andre accounting standard 17 will be applicable, in that some paragraph will not be applicable. So exempt means you don't have to follow that accounting standards, you don't have to read that accounting standard. Relaxation means standard is applicable, in that some paragraphs are not applicable. Like MAT provisions might not be applicable to some entities, but DTA, DTL might be applicable. You got it? Sir, do we have to mug up this? What is not applicable? What is relaxed? No one has to mug that up. That is not required. You just have to know level 1 non-SMC same, 2, 3, 4 SMC same. Level 1 all standards are applicable. 2, 3, 4 and non-SMC certain exemptions, certain relaxation. Ishtu ಗೊತ್ತಿದ್ರೆ ಸಾಕು. Do you have to know this? 3, 17, 20, 21, 23, 25, 27 not applicable. 15, 19, 28 and 29 is relaxed for level 2 entities. Should you know that? Not required. Don't mug it up. No one will ask. No one will ask. If they ask, you see this chart and then tell them. You don't have to mug it up for the examination. Now, how do we decide whether it is SMC, non-SMC, whether it is level 1, level 2 or level 3? That's when you come to this chart. Shall we start with this? If an entity is listed or it is in the process of getting listed, then it is always large company or non-SMC. As per ICA, it is level 1. As per MCA, it is non-SMC. When it is listed or in the process of getting listed. For an entity to be medium, that is level 2, level 3, level 4 or non-SMC, what should it be? It should not be listed. It should not be listed. Then if it is doing business of banking, financial institution, or it's doing business of insurance, then it is always large. It is always large, level 1 entity, or it is non-SMC. All the accounting standards are applicable. If you are not doing business of banking, if you are not doing business of insurance, if you are not doing business of financial institutions, then based on other conditions also not being fulfilled, you can be 2, 3, 4 or non-SMC. Are you getting it? What if I am not doing business of banking, but I am listed? Then is it level 1 or level 2? It has to be level 1. It is one of the conditions. If it's fulfilled, you are under that higher category. Always the higher category will be selected. Some category I was in level 2, something I'm in level 1. Some conditions level 2, some conditions level 1. Which one will you take? Level 1. Even if one out of the 4 conditions is satisfied, it will become level 1 entity. Are you getting it? When you talk about banking, cooperative banks are also included. Got it? And when you say financial institutions, NBFCs come under that category. Then talking about turnover based condition. When we say turnover, we are considering previous year turnover. In previous accounting year, turnover is considered. This is excluding other income, interest income, commission income. If you have received anything, it is not your revenue from operations, that is excluded. Excluding all of this, if your turnover is greater than 250 crores, you are level 1 or non-SMC. If it is 250 or lesser than 250, then you are SMC. Then you are SMC. As per MCA, it is SMC. As per ICA, we have to check whether it is level 2, 3 or 4. To check level 2, level 3, level 4, you need to check, is it greater than 50? If the turnover is greater than 50 up to 250, level 2. If it is 50 or lesser than 50 but greater than 10, level 3. If it is less than 10, then it becomes micro, level 4. You got it? So up to 10, 4. 10 or greater than 10 up to 50, 3, 3, 3, 3. Greater than 50 up to 250, 2. Greater than 250, 1. What if it is 250? 2. It is greater than 250. It is not greater than or equal to. If it is greater than 250, level 1. If it is equal to 250 crores turnover, level 2. Got it? So 0 to 10, 4. 10 to 50, 3. Then 50 to 250, 2. Then greater than 250, 1. You get it? What if my revenue from operations is 0, but I am a listed entity? Still I'll become level 1. Got it? And this is not the only condition. Then we have the next condition, borrowings. Unlike revenue, which we see last year's sales, borrowings we again see previous year, but not at the end of the year. We see at any point of time during the previous year. We see it at any point of time during the previous year. As on 31st of March of last year, my borrowings is 0. But in between one single day, I had borrowings of 100 crores. Then I become level 1 entity. For borrowings, if it is more than 50 crores, level 1. If it is 50 or less than 50, but greater than 10, it is level 3. Sorry, level 2. If it is 10 or less than 10, but greater than 2, it becomes 3. If it is 2 or less than 2, it becomes micro, that is level 4. What if my borrowings is up to 2 crores? 4. If it is 2 to 10, 3. If it is 10 to 50, 2. If it is greater than 50, 1. Did you all get that? Very good. This is at any point of time during the previous year. What if my borrowings last year is 50 crores? This year it is 0. Last year my borrowings last year is 50 crores. So I am level 2 last year. This year it is 0. So this year it will become, yeah, won't I become level 4? Once level 2, always level 2. There is no coming down from that. You got what I'm trying? There is only upside. There is no downside. Last year namdu listed it, ivaga not listed. Still continue to follow all accounting standards. You get what I'm trying to tell. Then next thing is holding and subsidiary. If your holding company or a subsidiary company is of higher level than what you are, then you are shifted to higher level. Sir, I am level 1 entity, my subsidiary is level 2, will I become level 2? No, no, no. Your subsidiary will become level 1. Sir, what if I am holding company? I am level 2, but my subsidiary is level 1. You also will become level 1. Any of the group company, if it is at a higher level than what your entity is, your entity also will be shifted to such higher entity, and more accounting standards will be applicable to you, lesser exemptions and lesser relaxations. You got it? And this last category is called as residuary category. By this we complete our applicability of accounting standards.
So everywhere it's only one. Even if one is satisfied, it will be
Yes, if you are not listed, you are not doing banking business, your turnover criteria is also not fulfilled, but your borrowings is greater than 50, you become large. You are not listed, not in the process of listing, you are not in banking business, finance business or insurance business, your turnover is 5 crores, your borrowings is 100 rupees, but your holding company is level 1 entity. Level 1. Any of the condition, it's not all of the conditions. And it's always upside. Got that? Fine. Let's now do accounting standard 1, talking about disclosure of accounting standards, accounting policies. Like I mentioned previously, this is one of the standards which is only based on disclosure. This doesn't tell you any formula, this doesn't ask you to pass any journal entry, it doesn't talk about anything, it only talks about disclosure. What is the disclosure requirements of the policies already followed by the entity? You got that? Now, again, what do you mean by accounting policies? It is significant accounting policies which are followed by the entity in preparation of financial statements. In preparation of your financial statements, what accounting policies have you followed? That is what we mean by accounting policies. Principles as well as policies. What is followed by the entity in preparation of its financial statements? Example is valuation of your inventory. You can follow FIFO, LIFO. Same valuation of investments. You can follow either first in first out or weighted average method. Sorry, I told AS to FIFO, LIFO. You should follow first in first out or weighted average method or specific identification method, that or the cost formula what you use, or valuation policy for your fixed assets. Are you going to do cost method, are you going to do revaluation method, employee benefit scheme, what are you following? All of these become your accounting policy. Or in accounting standard 12, government grant, are you recognizing it, are you adjusting it against the value of the asset and then depreciating, or are you treating that government grant as a separate reserve and depreciating the asset only and transferring the government grant little every year to PL? That's an accounting policy. And there are basically two considerations for determining an accounting policy. Primary consideration is true and fair view. Whichever accounting policy you pick should give true and fair view of your financial statements. Such accounting policy what you pick should not create a kind of chaos in your financial statements, that financial statements are not reliable. So following this will give true and fair view, following this will not give true and fair view. Which one do you pick? The accounting policy which gives true and fair view of the financial statements. This is the primary consideration. Second thing is prudence, substance over form, and materiality. These three will be considered in picking the right accounting policy which better suits your organization. We say no better presentation, whichever gives better presentation. That better presentation is decided based on these three: prudence, substance over form, and materiality. Prudence is with an intention to not overstate your profits and assets and not understate your losses and liabilities, to show such a view which is not overstating profits and assets, which is not understating what to say liabilities and losses, basically keeping in mind conservatism, basically keeping in mind conservative approach. The second one is substance over form. Whenever you're picking accounting policies, pick accounting policies in such a way that the accounting policy what you pick will give more weightage to accounting reality than legality. If it is fight between legality and reality, what should you follow? Reality. For example, accounting standard 19, when you say finance lease, me being a lessor, you are a lessee, I am the owner of the asset, I will transfer the substantial risk and reward of the asset to you, but I remain the owner of the asset. But as per AS19, you call it finance lease and you record depreciation, though I am the legal owner. Who's the legal owner? Me. But who's charging depreciation? You. Why? You are considering substance over legal form. Legally, I am the owner, but in reality, you have the risk of the asset, you are taking the reward of the asset, you are using the asset for the substantial useful life, you are basically taking care of the repairs and maintenance of the asset is customized to your tune. The money that you're paying to me by way of lease rental covers the substantial cost of my asset. And even at the end of the useful life, I am selling the asset to you. And that selling price at which I am giving the asset to you is much lesser than the market price. Then you tell me, isn't it obvious that though I am the legal owner, you are the owner in reality? Are you getting it? Very good. So we need to give such a consideration to ensure, sorry, we need to consider such an accounting policy which will give higher weightage to reality over legality. Going by legality, I should charge depreciation. Going by reality, you should charge depreciation. Which accounting policy did we pick? We picked an accounting policy because of which you charge depreciation. That is substance over form. Lastly, materiality. If the accounting policy what you're going to follow is not going to give necessary disclosure of material information for a user, then you should not follow that. Should pick such an accounting policy what will disclose all the material information that is required for the user to see and know to take his decision. So, what are the considerations for picking an accounting policy? There are two. Number one, primary. Number two, secondary. Primary, true and fair. Secondary, prudence, substance over form, and very good. No, fundamental accounting assumptions. We discussed this in the past. We'll discuss this once again. Fundamental accounting assumptions are what are always assumed that an entity is following in preparation of financial statements. You don't have to tell, I follow going concern, I follow consistency, I am also following accrual. You don't have to tell. There is no separate disclosure required when you are following going concern, accrual, and consistency. However, if these fundamental accounting assumptions are not followed by the entity, then you have to make a separate disclosure. What disclosure should you make? Saying that our entity is not a going concern. ಬರೋ ತಿಂಗಳು ಸಂಬಳ ಕೊಡಕ್ಕೆ ದುಡ್ಡಿಲ್ಲ. You get it? You need to disclose that we don't have enough money to pay salary to the employees in the next year, or we are recording our revenue based on cash basis. Why? People who are purchasing goods from us, ella kallan maklu, they buy goods but they won't give money. Yeah, we won't record that. We will talk in AS19 when there is no certainty on the collection of consideration. You cannot record it. You will record the consideration only when it is significantly certain of collection. You got it? So accrual policy, if it is followed, no disclosure. If it is not followed, you have to make disclosure. Lastly, consistency. You need to be consistent in accounting policies from year to year. If the financial statements don't follow consistency, then comparability is also questioned. No, you write current year column, next to it you write previous year column only when you can compare the figures. When you cannot compare, then what is the point of writing previous year, current year? So you need to compare, so that you need to have consistency. If it is not there, if it is breached, you have to disclose it separately. And lastly, talking about this change in accounting policies, that is breach of consistency. It is allowed in three circumstances. Number one, when it is required by the statute. Number two, when there is change in accounting standard. And lastly, it is appropriate to show the presentation of the financial statements in a better way. This third point, slight focus has to be made on this point. Let's say I am valuing my inventory at first in first out. I am changing my inventory system from first in first out to weighted average method. This is because I am not able to identify the units that is coming in and going out. So basically I am following average method. Am I right? But very unfortunate, this didn't flash to me at that time. What did I do? I followed first in first out. Now I realized I cannot still continue the same thing. Now I am changing it within the policies allowed by AS2. AS2 is not changing. Any law regulating is not changing. AS2 allows me to follow FIFO. AS2 allows me to follow weighted average method. I am changing from FIFO to WAM for better presentation. That's the last point. You got it? When we say better presentation, it is not to show higher profits. If I follow FIFO, profit is 10. If I follow WAM, profit is 12. I am changing it for better presentation. A better anta heladre, not more. Better means what is more what is better applicable for my entities. What is more, what will give better understanding of the financial statements. You got that? That should be the purpose. Last point. This is the most important point actually. All the significant accounting policies followed by the entity have to be disclosed. They should all be disclosed at one place. You cannot say this disclosure I'll make here, that disclosure there, that disclosure there. You cannot disclose them at random places. All the accounting policies have to be disclosed at one place. That is in your significant accounting policies. There is one place called SAP, significant accounting policies. There you will disclose everything. And some questions are there based on this. disclosure is not a remedy. Disclosure is not a remedy. It's like I've disclosed, so I am asking the auditor not to qualify. I have breached some accounting standard. I am not following accounting standard, or there is no consistency. I have disclosed, stating that yes, there is no consistency. And now the auditor is saying that he will qualify the opinion and say, I have only made the disclosure, no, in financial statement. Why do you have to qualify the opinion and again mention in your audit report? You don't have to do that. Is it right on the accountant to tell that? No, the chief accountant is wrong in that case. Disclosure is not a remedy. It's like I go on the street, I kill someone and then come. And then I say, ತಪ್ಪೇನಿಲ್ಲ ನಾನು ಒಪ್ಕೊಂಡೆ ತಾನೆ, I have agreed, no, that it is my mistake. Then why are you again putting me in the jail? Celebrate in a jail. No, you can't tell that. You get it? So mistake is a mistake even if you accept it. Just because you accept that it is a mistake, it will not become not a mistake. It is good that you accepted. There is no burden of proving it on the other party. You become slight good person by accepting it. I don't know, I'm telling here, you become slight good person by accepting it. But just because you accept that there is a material misstatement or there is a deviation doesn't make it good. It is still a mistake. You get it? Yeah. Now Raju uncle also did the same thing. Ramalinga Raju, he told no, completely, yes, I've done the mistake. He told disclose. Just because he disclosed, can you say like, yeah, you disclose, you're a good boy, no, you can go? No, he was put to jail. He was put to jail. Legal prosecution has been taken up against him. So disclosure is mandatory and disclosure is not a remedy, and all the disclosure should happen at one place. Got that? Very good. By this we have successfully completed accounting standard 1. Shall we now go to accounting standard 2? Good. Let's now start with accounting standard. It talks about valuation of inventories. Now, the inventory what we write in our financial statements is very critical. If we don't write the right value of inventory, the profit that we compute will be incorrect. That profit what will be taken to reserves on surplus will make our entire financial statements incorrect. And not just that, that value of inventory will appear in our balance sheet as an asset also, which if it is wrong, again our balance sheet position is also incorrect. So identifying the right value of inventory is important to show true picture of financial statement. Showing inventory at wrong value will show financial performance as well as financial position both at an incorrect value. Now talking about this standard is not applicable for construction contracts. The reason being, we have a separate standard, accounting standard 7, which deals with construction contracts. So there we talk about how to value semi-finished. Now you are a contractor, you're building construction, you're building some buildings, or you're constructing some road or dam. That cannot be considered as an inventory to you. For that we learned AS7, how to recognize the asset which is under construction. And this is not applicable to service contracts. A doctor is doing surgery and in the middle of the surgery he says, this is my WIP, how to treat that surgery in the middle as inventory? No, that is again not to be considered. And if you are a dealer trading with shares and debentures of a company, to you that is like inventory, I agree, but don't follow AS2, follow AS13, current investment valuation. Just because you buy and sell inventory, it doesn't become accounting standard 2 inventory. It has to be valued as per accounting standard 13. For these items, AS2 is not applicable. Further, when you talk about livestock, like let's say you have a farm where you raise chicken, or where you raise sheep, goat, or where you raise pig, or where you raise any cattle farm. When you have livestock or when you have agricultural produce or forest produce, we have a lot of timber trees or bamboo trees or tea estate, or you have any mineral oil or resources. No, these items again accounting standard 2 is not applicable. But para 2 of the standard says these items are not covered under any standard. Every standard says you are out, you are out, you are out. So what to do? AS2 says valuation of inventory is not applicable, but however, if you want to value these items, I can tell you one thing: value them at NRV. Value them at NRV. So is AS2 applicable for forest produce, agricultural produce, livestock? No, no, no. Is AS10 applicable? No. Bearer plants is matra applicable. For others, it's not. But what do they say? AS2 says, however, you can follow NRV method to value these items. Under Ind AS, we have a separate standard called agriculture. Under accounting standards, till date, there is no standard. So we value them at NRV, net realizable value. NRV or net realizable value is sale price minus selling expenses. From the sale price, which is expected, obviously, We deduct the expected selling expenses. Whatever the expenses that we expect to incur when we are about to sell this will be deducted. Okay, if in case you're finding it too bored to sit and listen for so long, start scribbling something in your paper. I am not expecting you to write down the entire notes the way it is, but if you just start scribbling, some part of your body becomes active. That might keep your entire body active and you might not feel drowsy and sleepy. Got that? Then talking about paragraph 3 of the standard, this talks about inventory. There are three variants of inventory what the standard talks about: finished goods, work in progress, raw material. Finished goods is what is kept in the ordinary course of operations for sale. If in case in my ordinary course of operations I'm selling water bottles, water bottle is my finished goods. What is raw material? I buy one metal sheet, that is my raw material. What is my work in progress? I cold press that metal sheet into one round cylinder, then I put one bottom, then I bend the top and then put the cap, that becomes the bottle. So metal steel putties, what I buy is raw material. Water bottle, what I sell is finished goods. Anything in between this is work in progress. What is finished goods? Which is kept in the ordinary course of business for sale. What is raw material? What is purchased and consumed in manufacturing of finished goods. What is work in progress? Which is in the process of production for such sale. Which is in the process. You got it? 1% processed, work in progress. 99% processed is also work in progress. 100% processed, finished goods. 0% processed, raw material. So inventory talks about these three. No, that is under paragraph 3. Paragraph 4 of accounting standard 2 also mentions three items: material supplies, consumables and loose tools. These are not inventory, but these cannot be considered as PPA also. So they say these three also you value it under AS2 only. So what are the three items which are not inventory, which are not PPE, but AS2 is giving them shelter? Okay, you stay under AS2 only. I will tell you how to value them. What are they? Material supplies, consumables and loose tools. Well, I've given these examples in the past. Loose tools is like you use some tools which cannot, like some spanner, some tester, some screwdriver. These items are not good enough to be called as PPE, but you cannot write them off as expense. So what do? You treat them as inventory. Consumables. Now in certain industries, now in automobile industry, you have grease, oil. All of these are consumables. We keep a track of them, but we don't keep a track as how much is taken. This much was there, this much is there. Difference is consumed, charge as materials sold. Now I done service industry. What do? I give service to your automobiles. So I have grease. I have grease in one box. I take grease and then put it to your vehicle in the process of servicing. I don't weigh it and then see how much is grease is consumed in your vehicle repair and then charge it to you in the bill. No. What do? Opening stock of grease is this much. Purchases during the year is this much. End of the year, leftover stock is this much. Difference is what is consumed during the year. I account it like that. Or ink, dye in fabric industry or garment industry, all of those becomes consumables. Are you getting it? Material supplies, consumables and loose tools are not PPE, are not inventory, but they are accounted as per accounting standard 2 only. Usually it will be recorded on consumption basis. Opening balance plus purchase minus closing, whatever difference is there is consumed. It is assumed to be sold. And we don't charge separately. It is taken care with the entire thing. So whenever I do service of your vehicle, service after you leave the garden and you take it, I charge you for the parts I've changed. At the end I charge no consumable spares and tools, service charge, I'll charge 500 rupees. You will ask me, why did you charge 500? Sir, grease, oil, cotton, that cloth that I take to wipe, all of that I would have charged, I would have used, no. I don't know how much is consumed. So I charge some random amount. So that is also taken for as a consideration from you. So that grease is treated like inventory. That consumable oil, that consumable what do you say, cotton, cloth or ink in what do you say, garment industry is all treated like inventory all by itself. Got that? Then talking about measurement, how do you value all of these items? Measurement is given in paragraph 5 of phase 2. This is the most important paragraph. As per accounting standard 2 paragraph 5, how is inventory valued? Inventory is valued at cost or net realizable value, whichever is less. I repeat, inventory is valued at cost or net realizable value, whichever is very good. Now, next discussion is about how to determine cost and how to determine NRV. Lucky you if they straight away give cost NRV and ask you to find whichever is less. But there can be questions on determining cost, there can be questions on determining NRV also. First and foremost point before I jump into details of cost and NRV is, whenever we take cost or NRV, whichever is less, it has to be taken line wise. If there are 4 variants of inventory, 4 costs, 4 NRVs are given. Don't take total cost, total NRV and take whichever is less. No. Each item's cost, each item's NRV, whichever is less has to be taken and then take the total. So remember, the point of cost or NRV, whichever is given, has to be applied item wise and not in total. Now, what all does cost include? Cost will include purchase price. Purchase price means the money that I pay to purchase that material. That is to be included. And in this, would you include duties and taxes, custom duty, GST, CST, whatever you have paid? Should you include it or exclude it? Depends whether input tax credit is available on such item. Let us say you are a registered dealer and you take input credit, meaning whatever GST that you paid on purchase of that item, you will deduct it from the output GST on the sales that you make and only balance is paid. So then ITC is available, then such GST what you paid cannot be included in the purchase price. When you write the journal entry also, you write purchase account debit, input CGST, input SGST to bank or to creditor. So you treat it separately from the purchase price. If in case it is blocked credit item, what item is it? Blocked credit, or the person from whom you purchase is an unregistered dealer, or you are an unregistered dealer, or you are not eligible to take the credit because of something, you get it, or you are making sales to some other people with whom some problem, somewhere some issues there. So then what do? In that case, the GST what you paid on purchase will be included in the value of the inventory, that is inclusive in the cost of the inventory. Are you getting it? Same applies for custom duty also. We're not talking just about GST here. Then talking about freight inwards, any expenditure incurred to bring that goods from the place of purchase to the place of your business like factory is to be included. Freight inwards is included in the cost of inventory. Got that? Then if there is any other directly attributable cost incurred in any other nature, directly attributable cost is expenditure incurred to bring such inventory to its present location and condition, will have to be included in the cost of the inventory. Freight inwards is just an example. Got that? Then if there is trade discount, what do? Trade discount should be eliminated. Trade discount should be eliminated. After that only GST will be added. If in the question there is trade discount adjustment and GST adjustment, don't add GST and then give trade discount. GST ಮೇಲೆ ಡಿಸ್ಕೌಂಟ್ ಕೊಡಕ್ಕೆ ನಿಮಗೆ ಯಾರು ಪರ್ಮಿಷನ್ ಕೊಟ್ಟರು? ಕೊಡ್ತಾರೆ? ನೋ ವೇ. You can't give discount over GST. First, whatever the price there, you do bargain. Let them do bargain. You decide what is the final price. Then bring Nirmala aunty into picture. First Nirmala aunty ಕರ್ಕೊಂಡ್ಬಂದು ಆಮೇಲೆ ನಾನು ಡಿಸ್ಕೌಂಟ್ ಕೊಡ್ತೀನಿ ಅಂದ್ರೆ ಹೊಡಿತಾರೆ. They won't agree. So first you fix up on the price after your trade discount and everything. Post trade discount, whatever is the price, on that GST is to be applied, and GST should not be applied on freight. GST should be applied and then freight is added, because freight is service. Goods ge bere, service ge bere tax. Am I right? If in case you have registered as that service provider also, then GST might be applicable on freight also, but the GST rate on freight and GST rate on goods are different. Usually what would happen is, I only sell goods. If you are in a different state, I am in a different state, or if you are in a different city, you come buy goods from me. You buy the goods from me, I'll send it to your place. For that, I am not giving you service of transportation. I hire some DTDC or Blue Dart or some courier guy, and I will pay the money to him, and I'll ask him to deliver the goods to you. I have paid the transportation expense on your behalf. I'll take reimbursement of transportation expense from you. So I am not giving you transportation services here. So there would be no GST that I will charge on transportation service. How much ever the bill I paid here, same money I recover from you. So it is reimbursement. So there is no GST charged on freight. First purchase price. On that you will do trade discount adjustment. Then GST, then freight. So there are a lot of questions on this. Looks very simple. 4 marks, 5 marks question. You take one item up, one item down. Your marks also will start fluctuating that way. Easy questions, and you should not lose marks. Understood this part? Now let's talk about cost of conversion. If you are a trader who buys the goods and then sells the goods, cost of conversion is not applicable. Cost of conversion is applicable if you are a manufacturer, meaning you buy goods, you add some value to it, you transform them into something else and then sell. See, if I buy water bottle and then sell water bottle, I'm a trader. If I buy a steel putty, make water bottle out of it and then sell, then I'm a manufacturer. If I'm a manufacturer, I have cost of conversion, converting that steel sheets or steel putty into water bottle. So that process may I need to put it into one machine which will make this into one cylinder, paint it, and then put the bottle cap, and then there is conveyor belt. It goes, that entire cost is called cost of conversion. Cost of converting raw material to finished goods. So in this process, let's bring a little bit of your costing. The expenditure can be categorized into two categories: direct, indirect. Direct material, direct labor, direct overhead ಅಂತ ಹೇಳ್ಬಾರ್ದು. Please, your costing teacher will get offended. So there is nothing called direct overhead. So direct expense. So direct material, direct labor, direct expense will be included in the cost. There is no problem. When you talk about indirect expenditure, it is categorized into two: variable and fixed. Variable and fixed, no, you need to treat it slightly different from how you do in your costing. In costing, you have the concept of over absorption, under absorption. Here, over absorb. How can you over absorb? How you tell me how? Works in costing for the purpose of strategical decision making and performance evaluation. But in accounting, there is no concept of over absorption. You get that? You cannot absorb more cost than what you incur. So over absorption, if you observe, it comes because of variance between normal production and actual production. Normally, you expected the capacity to be 10,000. Normally, you expected the capacity of manufacturing to be how much? 10,000. If you produce 8,000 units, what do? Total expenditure, factory rent. Let's say we're talking about fixed overhead. We'll take 1 lakh rupees factory rent. You divide it by 10,000 or 8,000. You divide it by 10,000. You get what I'm trying to tell? I'm talking about costing. In costing, what do? When 1 lakh is the rent, capacity is 10,000, but actually production is only 8,000. Then what do? You divide it by 8,000. Are you getting what I'm trying to tell? If you divide it by 10,000 and then multiply per unit rate and multiply it by 8,000 units, 1 lakh is the factory rent. Capacity is 10,000 units, but you produced only 8,000. 1 lakh divided by 10,000. 10 rupees per unit. You multiply it by 8,000 units. 80,000 is the cost of the factory rent which is allocated to units. 20,000 is called under absorption. You get it? In accounts, there is no concept of under absorption. If in case you manufacture 1,20,000 units, what do? You divide 1 lakh by 10,000 units, you arrive at 10 rupees per unit. You multiply it with 12,000 units and then 1,20,000 is absorbed. Expenditure paid 1 lakh, expenditure absorbed 1,20,000. You say over absorption 20,000, it will become like income. In costing, that is only for decision making, but in accounting, that cannot be the case. How do you allocate your fixed overhead? You compare your actual capacity and normal capacity. If actual capacity is less or equal to normal capacity, then on the basis of normal capacity. Meaning, if the normal capacity is 10,000 units, but you actually manufacture only 8,000 units, then 1 lakh of factory rent will be divided by 10,000 or 8,000. 10,000. Don't do 8,000 and then take 20,000 is under absorb. I'll repeat. What do you do in costing? 1 lakh rupees factory rent. Normal capacity of the factory 10,000 units. How many units did you manufacture? 8,000. You do 1 lakh divided by 10,000. Absorption rate 10 per unit multiplied by number of units manufactured 8,000. Value absorbed 80,000. 20,000 expenditure paid but absorption not made, under absorption. Do you do that? No, you do that to evaluate the performance of the production of the entity. But here we cannot tell that 20,000 on utilize madala, expenditure include madala. That's not the way you do it. That is for only strategic decision making. Here accounts is post-mortem. After the entire thing is over, you need to allocate entire 1 lakh. You get it? Costing is like before someone dies, how can you kill? What happens, how to do, that's costing. Accounts like person is dead, they're like, how did he die? You do post-mortem analysis. You get the difference, no? So what do we do here? 1 lakh is the cost incurred. You manufactured only 8,000 units. Normally you could have manufactured 10. What do? We divide by normal capacity is 10, actual capacity is 8,000. So actual capacity is less than or equal to normal capacity. We take on the basis of normal capacity of 10,000 units and then divide it. You get what I'm trying to tell? However, if the actual capacity is more than normal capacity, see, till here it is same, okay? Till here it is same. Point of difference is only here. Here what we have as something called as over absorption. No, that is not there here. If in case, if your actual capacity is more than normal capacity, then what do? In costing, you still identify your absorption rate based on normal capacity. Here what do? We take actual capacity. If the actual capacity is 12,000 units, how many units did we produce? 12,000. But normally, what is the production capacity? 10,000. And expenditure is 1 lakh. We don't do 1 lakh divided by 10,000. We'll do 1 lakh divided by 12,000 only. Because the total expense cannot exceed 1 lakh. Total expense allocated to inventory cannot exceed. Did you understand the point of difference? So over absorption concept is not there in inventory here. If actual capacity is shortcut to remember, if actual capacity is lesser than or equal to normal capacity, take normal capacity. Only if actual capacity is greater than normal capacity, then fixed overhead is allocated based on actual capacity in the denominator, not based on normal capacity. Variable cost is not difficult. Why? You have it per unit, no? It is fixed per unit. So take that only. Direct, though, you will know directly what is the amount you allocate. You get it? So there can be questions on this allocation of fixed overhead. Slightly be careful. 10 seconds revision of entire fixed overhead concept. If actual capacity is lesser than or equal to normal capacity, total fixed overhead divided by normal capacity. If in case your actual capacity is more than normal capacity, total fixed overhead divided by actual capacity is how you determine your per unit cost of fixed overhead. Got that? Then if there is any other expenditure which is incurred to bring the goods to its present location or present condition, that will also be included in the value of inventory. So this is all told in our cost definition. Like we discussed, what and all is included. Let me just tell what and all is excluded or not considered. Abnormal loss. If in case the loss is normal, it is considered and included. If it is abnormal, excluded. Identify the per unit cost of that abnormal loss, exclude it from the value of the inventory. Meaning, whenever you're doing the table with units, per unit rate and the amount column, you write number of units of abnormal loss, per unit rate for that abnormal loss units, multiply them and identify the value. In value or amount column also, you eliminate to find the closing inventory. So remember, when I say abnormal loss is to be excluded, you identify number of units of abnormal loss, per unit rate of that abnormal loss units, multiply it, and then I eliminate it from the amount column, and only then we'll get the item. If it is normal loss, eliminate only in units column. So same value will be there for lesser number of units. Would have done this in consignment in foundation if you would have studied under old scheme. If you are under new scheme, I'll tell this to you once again. Remember, 100 units, each unit is 10 rupees. 100 into 10, 1000. Number of units, 100. Rate per unit, 10. Value, 1000. When I deduct normal loss of 1 unit, I will deduct in units column. Number of units become 99. Value will still remain 1000. So now 1000 rupees is to be allocated for 99 units. So per unit rate will not be 10. It will become more than 10. If it is abnormal loss, what do you do? 100 units, 10 per unit, 1000. When I deduct 1 unit, against it 10 rupees will be deducted in the amount column also. So value will become 990, units will become 99. So per unit rate will remain at 10 rupees. For normal loss, per unit rate will increase because it is adjusted only in units column. For abnormal loss, we eliminate it in units and amount, so per unit rate will remain same. An entire abnormal loss would have been shifted to PL. It would not add on to the value of inventory. Got that? Storage cost. After the inventory is ready for sale, if you store it, because after you manufacture, people have not bought it immediately. Such storage cost is there, no? That should not be included in value of inventory. Storage cost should not be included in the value of inventory unless such storage period is part of the production. If you buy timber, if you take timber as an example, once you cut it, it's not ready for sale. It needs to be oxidated. You need to let it react with oxygen and become hard from inside. So you store it for 3 months. That storage period is part of the production process. So during that storage period, whatever rent you pay for 3 years or 3 months, whatever, that will be included in the cost of inventory. Rice, the moment you take the paddy out, it is not ready for sale. It is soft. Bike account kachidre, it will become paste. It will not become katum powder. That's how you pick which rice to buy. So you store it in the sack for a certain period of time for it to become hard. That period is storage period, part of the production process. Such storage cost will be included in the value of inventory. Wine. Wine is grape juice preserved for such long period. Same with your beer or whatever it is also. So you take that barley, wheat juice out and then preserve it, no, let it ferment for certain period, let the yeast develop. So that yeast development period where you put in that tanker and then you keep it for certain period, 3 months, 4 months or anything. Nowadays people have become the trend, freshly brewed beer. I don't understand the concept of beer only. Leave it. So what I'm basically telling you is if that storage is part of the production process, then that storage cost is to be included in the cost of the inventory. Got that? Then any administration expenditure or selling and distribution expenditure, your corporate office fees, director fees, meeting fees, or receptionist fees, sales manager fees, sales commission, transportation to customers place, after sales service, all of these are not included in the value of the inventory. They are to be excluded. Got it? Then let's talk about valuation technique. What technique should we use to value the inventory? Depends whether the inventory is ordinarily interchangeable or not ordinarily interchangeable. If one water bottle and another water bottle is all same, idu adu ella onde, same type, same capacity, same paint, everything same, ordinarily interchangeable, so there is no need to identify it separately. Then what do we follow? We can either follow first in first out method or weighted average method, considering historical cost. If you don't consider historical cost, like FMCG sector, then what do? I don't want to identify the value. My profit margin is fixed 20%. So what do? MRP I would have put no. Identify selling price of the items that I have. Eliminate the profit margin. I'll immediately get the cost. That is adjusted selling price. This is for ordinarily interchangeable units. One unit can be replaced with another easily. What if units cannot be replaced one by the other? Everything is different. Each unit is different. Or like for example, a jewelry shop where every ornament that's there is different. No two ornaments will be same weightage. No two ornaments are same design. Then what do? Specific identification method. Specifically, the cost has to be identified for each unit. See valuation technique. If ordinarily interchangeable, specific identification method. Sorry, if not ordinarily interchangeable, specific identification method. If ordinarily interchangeable, considering historical cost, FIFO and VAM. Without considering historical cost, adjusted selling price method. If selling price cannot be identified, we can follow standard cost. That is not the usual go-to method, but in a very rare circumstance, when the profits are usually fixed, costs are usually fixed, not subject to inflation, then you can go to which method? Standard cost method. Got that? But standards keep changing every year, no? So usually that's not recommended. Then last part, no, actually not last part, last but one you can say. So this is what if in one process more than one product comes out. The process is one, outcome is two. Then you need to check whether those products what they come, are they material or immaterial. Let's say two products comes out, both the products are material, they are called as joint products. One product is immaterial, one product is material. Then that product which is material, no, is main product. The product which is immaterial is called as byproduct. Do you understand when to call it joint product, when to call it byproduct? Based on materiality. Materiality means it is significant, it is important, there is a specific accounting policy adopted, you recognize it as sale, joint product. It is like scrap, then it is byproduct. What do? If it is joint product, what you do is at that split off point, the point at which both will be processed separately, till that point whatever the cost is incurred, that needs to be split between both the products. The cost that is incurred together for both the products, common production process, that has to be separate, that has to be split between both the products. How do we do it? This is done based on the sale value. This is done based on the not sale value per unit. Let's say joint one common process is there, no, in that common process at the end, for every 1 unit of joint product 1, there are 2 units of joint product. For every 1 unit of joint product 1, there are 2 units of joint product 2. We are not taking sale price, we are taking sale value. For this 1 unit of joint product 1, what is the sale value? What is the sale value for joint product 2 per unit multiplied by 2? So sale value of these two is considered as a basis to split that cost. Not sale price per unit, but sale value. Remember, you get it? And after that split off point, whatever further processing cost is incurred, that you know it for both the products separately, that you recognize individually for whatever you incurred. Whatever is incurred before that split off point, that has to be apportioned based on sale value. You got this? Very good. What about byproduct? Byproduct is very simple. After that split off point, whatever is the sale value that will be generated from that byproduct, that will be deducted from the cost of production of the main product. I repeat, if it is byproduct, what do? The sale value from the byproduct will be deducted from the cost of production of the main product. If it is joint products, what do? Then till the common production process, whatever expenditure is incurred will be split between both the joint products based on the sale value, not sales price per unit. At any point of time, if the byproduct starts becoming a material product, then you start treating it like a joint product. I've given you examples: coir, coconut coir and all. When it's taken out, they usually treated it as scrap. At one point of time, they started making cocoa peat out of it, so it become a very material product. If you sell, if let's say you are running some cocoa powder or coconut ice cream or something based entity or coconut oil based entity, so you buy coconuts, you break it, you take the inner shell, throw the outer shell, coir and everything, so that becomes like scrap. It is like byproduct. Whatever the sale value you get out of that sale will be deducted from the cost of production or cost of purchase of this main coconuts. However, at one point you started doing cocoa peat out of that. Now that generates as much revenue as much as you get from sale of coconut oil. So then that cocoa peat is become a joint product. It's not a byproduct anymore. If you observe, cocoa peat is sell one single brick of cocoa peat is sell at 50 rupees, 60 rupees. One single coconut is there, no? From that you take how much? 100 grams of 50 grams of coconut oil you get. And 50 grams of coconut oil will come, one cocoa peat brick will come from that. So it's almost generating same amount of revenue. So that coir will become joint product, it will not be byproduct. In that case, the cost of purchasing the coconut, transporting the coconut, breaking open the coconut, entire cost has to be split between both the products based on the sale value, and it will not be treated as a byproduct, and sale value of that coir will not be deducted from the cost of the production. You got it? Then valuation of raw material. How do you value raw material? How do you value work in progress? Depends upon how do you sell finished goods, because your objective, is it to sell raw material or is it to sell finished goods? Finished goods. In my entity, I only sell finished goods, I don't sell raw material. Do you agree with me? Let us say I am an entity which sells shirts, USPA. I only sell shirt, I don't sell cloth. You get it? I don't sell thread. So if my finished goods is sold at profit, if my finished goods is sold at profit, or let's say finished goods is not sold at loss, meaning it's sold at cost or above cost, then my business is profitable. I will continue to do production. If my finished goods is sold below cost, finished goods is sold, meaning every item I sell, I'm selling it at loss. If I sell each unit of my finished goods at loss, no, then why do I have to incur expenditure, manufacture, and then make loss? Raw material sell ಮಾಡ್ತೀನಿ. You decide, no, you make these decisions in costing, make or buy. Now, should I buy cotton, make the thread, make the cloth, and then make the shirt? Or should I buy the cloth and make the shirt? That is make or buy. Should I make the cloth or should I buy the cloth? My sale is shirt. So in that case, if in case my production cost of cloth is very high, purchase price only cheap, what will I do? I will end up buying the cloth and then selling the shirt. No, correct or not? I will stop manufacturing the cloth. You get what I'm trying to tell? But if my finished goods is sold at profit, then there is no problem. I will continue to make everything. If my finished goods is sold at loss, that is below cost, then my raw material might not be converted to finished goods, it might be sold at raw material stage. Get the logic here? If the finished goods is sold at profit or basically above cost, then what do? At cost or above cost, I will continue to convert my raw material to finished goods and then sell. If my finished goods is sold below cost, I might not have any intention of converting raw material to finished goods. I might dispose my raw material at raw material stage only. So till the time our finished goods are sold at cost or above cost, raw material will be valued at cost. I repeat, till the time finished goods are sold at cost or above cost, raw material will be valued at cost. If finished goods are valued below cost, that is finished goods are sold at NRV, then raw material will be valued at cost or NRV, whichever is less. Raw material will be valued at cost or NRV, whichever is less. Actually, raw material ge NRV irodilla. Why? I know where to buy raw material, I don't know where to sell raw material. So what do? in such case, replacement price is considered to be best estimate for NRV. What is it? Replacement price is considered to be best estimate for my replacement price. Means we discussed now in valuation principles. Now you understand why chapter 1, 2, 3 is important. What is replacement price? The price at which I can buy the inventory now. Price at which I don't know where to sell, but if I buy now, whatever is the price is considered to be equivalent to my selling price. You got it? So read this. Valuation of inventory depends on valuation of, very good. If finished goods are sold at or above cost, then finished goods is valued at cost. Raw material is also valued at. If finished goods is sold below cost, then finished goods is valued at NRV. Raw material will be valued at cost or NRV, whichever is less. NRV is not available, then replacement price is considered to be the best estimate if NRV is not available. Replacement price is not NRV. NRV is sale price. Replacement price is current purchase price. Because sale price is not available, I will consider the current purchase price, that is replacement price, to be the best estimate. You got it? This is done based on conservative approach. What approach? Same rule applies to valuation of work in progress also. With regard to work in progress, what I'll do is, again I will check, is my finished goods sold at cost or above cost? If my finished goods is sold at cost or above cost, no problem. NRV will be valued at cost. Cost is cost of raw material plus expenditure already incurred for conversion. I repeat, how do you value my work in progress? If the finished goods is sold at cost or above cost, then my work in progress will be valued at cost. That is cost of raw material plus expenditure incurred for conversion already. If in case my finished goods is not sold at cost, it's not sold above cost, my finished goods is sold below cost, then what do? My work in progress will be valued at NRV or cost, whichever is less. What is cost? Already whatever is incurred. What is NRV? WIP to be valued at cost incurred, and we would have to take that expected loss that I will make by making it into further finished goods. Cost plus expected cost to be incurred to make it sell, because you cannot sell WIP, you can only sell finished goods. So cost incurred, that is purchase price of raw material plus expenditure incurred for conversion already, plus expenditure expected to be incurred to make it finished goods, minus the expenditure that will be incurred for sale. Sorry, if there is any sale expenses, you deduct that will arrive at your NRV. You get that? So you basically take NRV or cost and take whichever is less to be the valuation of your WIP. You got this? Very good. Last point in accounting standard 2 is reversal. Let us say you valued your inventory at cost or NRV, whichever is less. Cost is 100, NRV is 90. At what price do you take your NRV? So current year closing stock is 90. Next year opening stock is 90. Next year that 90 is not NRV. That NRV 90 has become revised cost. Cost is 100. NRV is 90. You take whichever is less. Whichever is less is NRV. In your books, you are not writing NRV. You are writing revised cost. Cost of 100 minus return of 10. It becomes 90. So what is that 90 closing stock in the current year? Revised cost. Next year opening stock 90 is revised cost. What if next year that item's NRV goes up to 96? So revised cost is 90. New NRV is 96. Can you take 90 or 96, whichever is less? 90? No. You are allowed to reverse it from 90 to 96 and increase the value of inventory to 96. That is reversal. Cost was 100, NRV is 90. Whichever is less, you took 90. Next year, if NRV becomes 96, you are allowed to take it up to 96. Next year, if NRV is 98, you are allowed to take it up to 98. Next year, if NRV is 99, you can take it up to 99. Next year, if NRV is 100, okay. 101, not okay. It can be reversed up to 100, not beyond 100. Read this. If economic conditions requiring write down from cost to NRV reverse, or it is no longer existing, then it can be reversed to the extent previously decreased. So this ends your accounting standard 2. I hope you people understood. Very good. Let's now start with accounting standard 3 cash flow statement. When we're doing accounting standard 3 cash flow statement, alongside we'll also finish chapter 10 unit 2 financial statements unit 2, which talks about cash flow statement preparation. Now, to begin with, what do you mean by the word cash flow statement? Why do we prepare cash flow statement? Section 2 subsection 40, which talks about financial statements, no definition as per Companies Act. That definition includes the word cash flow statement. So we have to mandatorily prepare cash flow statement. Why? Because the definition of financial statements includes the word cash flow statement in the same. Now, when we talk about this, it is flow. Basically, cash flow is nothing but inflow and outflow, receipt and payment. So it is your receipts and payment account. It is your cash account. It is your cash book presented slightly differently. If there is already a cash book, if there is already a cash account, why should we separately do cash flow statement again? Because cash book doesn't give us enough information to take decisions. Cash book only says receipts, payments, inflows, outflows, but it doesn't tell what category of inflow is it, what category of receipt is it. Now, this can be understood by cash flow statement. In cash flow statement, what we do is that cash book will be divided into three parts. Each receipt, each payment will be put into three categories. Is that receipt operating, investing, or financing? What is this operating, investing, financing? Very simple. Whenever I want to start my business, I get an idea. So I first raise the money that I need for doing my business. That is financing activity. Using that money, I set up my entire infrastructure, building and everything. That becomes investing activity. After that, I start my business. That is operating activity. So issue of shares, issue of debentures, borrowing of loan. That is in the initial stage. That becomes financing activity. Using that, I buy machine, I buy building, I construct building. That becomes investing activity. Then finally I start my business, purchase goods, sell goods, pay rent, pay salary, earn income, pay debtors, sorry, collect from debtors, pay creditors. All of this will become operational activity. Now my asset has become old. I will sell the asset, investing activity. I will repay my debt, financing activity. I pay interest on debentures, financing activity. I pay dividend to shareholders, financing activity. I buy back shares, financing. I redeem preference shares, financing activity. You are able to understand no three categories: raising the money, financing; utilizing the money, investing; doing business, operating; and again replacing the assets, investing; and again repayment of debt or further borrow of debt or paying interest or giving dividend on the debt, financing activities. Are you able to understand? So same cash book, we will write it based on three activities. Operating, how much of cash has come in because of operating, how much has cash has gone out because of operating, how much as cash is inflow because of investing, how much of cash is outflow because of investing, how much of cash is inflow because of financing, how much of cash is outflow because of financing. I'll use these three metrics. If an organization has huge financial inflows, that means organization is borrowing too much money for great expansion. And this entity which has huge financial inflows should have huge investing outflows. I borrowed too much money to expand my business. I should have spent too much money on infrastructure. You get it? So positive financial inflow and negative investing outflow means organization is expanding. Positive investing inflow means investing may inflow is there. That means you're selling asset. Basically, organization is closing. And you will have negative financing outflows. So are you able to understand? And basically your operating cash flows will tell whether the organization's performance is good or bad when it comes to operations. Profitability daga, huge operational cash inflows will be there. Are you getting it? Sometimes there'll be huge operational inflows, but the organization is still bad. So then there is some working capital mismanagement or profit percentage is wrong. So basically an investor will be able to decide whether to invest in this company or not after looking at cash flow statement. One of the important metric. It is not just your P ratio beta. They can also look into cash flow of an entity. You understand? That's the reason we prepare cash flow statement separately. And the word cash and cash equivalent, what is used in this context, what we write separately, is very different from the definition of cash and cash equivalent, what is given in Schedule 3 of financial statements. Under Schedule 3, cash and bank balance will include everything. Whereas here, when you say cash and cash equivalent has a definition to fulfill. Now tell me, what does cash include? Cash will include your cash in hand and cash at bank. What will cash include? Cash in hand and cash at bank. To call an item as cash equivalent, it has to fulfill the condition it should be readily convertible, it should be having insignificant risk, it should be short term, and it should be highly liquid. RISH is the condition. RISH. An investment which is readily convertible, having insignificant risk, which is short term and highly liquid, will become cash equivalent. Lot of items which are cash equivalent as per AS3 are recorded as current investments in Schedule 3 balance sheet. I'll repeat, lot of items which are recorded as cash equivalent as per Schedule 3 will be recorded as current investments as per, lot of items which are recorded as cash equivalent as per AS3 in cash flow statement might be recorded as current investments as per Schedule 3. There is difference. Definition all by itself is very different. It can be an interview question. A few batches ago, one of the students who cleared inter went on to articleship. In one of the big four interview, the question that was asked to her was, is cash and cash equivalent the same? No, sorry, what is the meaning of cash equivalent was the question. And then this student replied to that question in the interview asking, are you asking me in the context of AS3 or Schedule 3? Then the interviewer told, are they different? They told, yes, obviously. Then this student went on to tell a very impressive answer of how different is cash equivalent as per AS3 and Schedule 3. So whenever you're reading accounting standards, remember you're not just preparing for your CA intermediate examination. You're also preparing for the life after, not interview, not just interview, life after CA intermediate also. You interview goskaraನೆ ಓದ್ತಾ ಇದೀನಿ ಅನ್ಕೊಂಡಿದ್ದೀರಿ. So you understood this difference, no? Cash equivalent, yes or no? So a lot of times in the question they will tell investments purchased. They will tell short-term highly liquid investments purchased. Don't write it as investing activity. That will be change of cash and cash equivalent. Don't consider that item only. You got it? Yes or no? Very good. So whenever we talk about cash flow statement, like I mentioned, no, we need to categorize all the activities into these three. Some specific items of discussion. Dividend. Whenever dividend is paid, it is financing activity. It does not matter what type of business you do. You have collected capital by way of issue of shares. On those shares, when you pay dividend, such dividend is very good. Financing activity only. If you receive dividend, that depends. If yours is an investment company, you are not manufacturing water bottle. What is your business? Buying shares, selling shares. Buying shares, selling shares. Yours is an investment company. Then that dividend income will become operating. However, your business is water bottle manufacturing company. Some extra money what you have bought some 2-3 big company shares. Then on that, if you receive dividend, that shares were your investment. On that, when you receive dividend, it becomes investing activity. You got it? So dividend paid, always financing, always financing. Dividend received, depends. If your company is investing company, operating activity. If your company is not investing company, investing activity. Do you get this? Some they won't use the word investing enterprise, they use the word financial enterprise at sometimes. Then if you pay interest, what is it? Okay, interest paid, depends. What if your business itself is dealing with interest? You borrow money at lower rate, lend money at higher rate, then it becomes operating. Your business is not that. You are doing water bottle manufacturing company, and what did you do? You borrowed money to buy one equipment. Then it is financing. You issued debentures and you raise money. It will become financing. You taken loan so that you can use that money to give it to loans to somebody else. Then it will become operating. So interest paid, operating or financing or investing, depends upon nature of business. For financial enterprise, operating. For non-financial enterprise, financing. What about interest received? Again depends. If your business itself is financing enterprise, then it is operating. If your business is not financing, you have invested that money, you have given that, you loan whatever you have given is like investment. On that, when you receive interest, it becomes investing activity. Investing, you have invested money by giving it as loan to somebody. So whatever interest you get on that will be treated as investing activity. However, if your business itself is borrowing money, lending money, then it will become operating. Everyone understood? Should I repeat this? Pakka? Very good. So unless the question specifically mentions, don't ever assume that an entity is financial enterprise or investing enterprise. They should tell that this entity is investing enterprise or operating enterprise. If they only give interest paid, what is your answer? Financing activity. You will not assume. If they tell the business is financing, then you will say operating. If they say interest received, what is the answer? Investing activity. Unless they mention in the question that the business is financing enterprise, you will not treat it as operating activity. Got that? Very good. Then talking about preparation of cash flow statement. There are two ways of preparing cash flow statement. How many methods? Two methods. One is direct method, other one is indirect method. What is the correct method? As per schedule, as per Companies Act, whenever an entity has to prepare, we should do indirect method only. We should do indirect method. But in the exam, questions can be on both direct and indirect. Now your question is, sir, what is direct, what is indirect? How do we differentiate between direct and indirect? Very simple. You have cash book, here you have receipts, here you have payments. Opening here, closing here. Opening balance of cash, receipts, payments, closing balance. All the receipts you cut, all the receipts and payments you cut into three categories: operating, investing, financing. You write operating inflow, operating outflow, net operating cash flow. Investing inflow, investing outflow, net investing cash flow. Financing inflow, financing outflow, net financing cash flow. Total net cash flow, add opening, you get closing. This is direct method. So directly we're writing inflow outflow, inflow outflow, inflow outflow, ಎಷ್ಟು ಬಂತು ಎಷ್ಟು ಹೋಯ್ತು ಎಷ್ಟು ಬಂತು ಎಷ್ಟು ಹೋಯ್ತು, for everything. Direct method. Under indirect method, what you do is same to same like how you did for direct, for investing and financing. Only change is operating. Only change is, I'll tell you. Under direct method, what do? You take cash book, each receipt, each payment, you categorize it into investing, operating, financing, you write them. Operating mein what do you write? Operating inflow, operating outflow, operating net flow. Investing inflow, investing outflow, investing net flow. Financing inflow, financing outflow, financing net flow. Add opening cash and cash equivalent, you will get closing cash and cash. Khata. What is this? Direct. Under indirect, it is same to same for investing, financing. Only changes. Very good. For operating, what do? Don't ever try to mug up any format. So come to the logic. The logic is like this. See, if this is our balance sheet and this is our P&L account, you observe balance sheet entire liability side is actually representing financing activities. Share capital increase, shares issued, financing. Long-term borrowings, debentures increased, financing. Loan borrowed, all of it is financing. No, asset side is all investing. Correct? P&L account basically talks about operating items. Correct alva? Whatever is income, revenue from operation and other income, that is inflows. Salary paid, rent paid, inventory purchased, all the expenses are outflows. So this is incomes is inflows, expenses is outflows. When you do income minus expense, income minus expense is profit. That is somewhat like net cash flow. Not exactly, but very close. So what do? You start with net profit as per P&L account as the beginning point. Start with net profit as per P&L account as the beginning point. Why? Because we believe income is cash inflow, expense is cash outflow. After that we realize some incomes are not operating, like interest income, interest received, dividend received. Investing activity, no. But in net profit computation, that is included. If you write 10,000 interest income, net profit will become more by 10,000. But net profit in the start ಮಾಡಿದ್ರೆ, that 10,000 interest income is investing in nature. We cannot take it in operating. So what do? Whatever operating items which are already included has to be eliminated. If there is operating income, which is credited to P&L, minus it. Why? It's already added, so we deduct it. Understood? Not just operating income. If there is any non-cash income, again that will be eliminated. If there is any non-cash expense like depreciation, or if there is any non-operating expense like interest paid, are you getting it? Or if there is any profit on sale of asset or loss on sale of asset. Let's take example of loss on sale of asset. You would have debited to P&L. Depreciation on assets would have debited to P&L account. Interest paid on debentures would have debited to P&L. Because of this, profit has decreased. But is it operating? Not operating, but it is still treated as outflow, so add it back. So remember the logic. Non-operating or non-cash income credited to P&L will be deducted. Non-operating or non-cash income credited to P&L will be deducted. Non-operating expense or non-cash expense which is debited to P&L will be added. Why do we add? Because it's already deducted. Why do we add in? Why do we deduct income? Because it is already added in arriving at net profit. Net profit is after adding income. So non-cash income is added, deducted. Non-operating income is added, deducted. Net profit is after deducting expense. Non-operating expense is deducted, add it back. Non-operating expense is deducted, add it back. So you take net profit as per PL. What do we take? Net profit as per P&L. And you adjust it for non-cash and non-operating items. What do you adjust it for? Non-cash and non-operating items. Non-operating or non-cash income credited to P&L is deducted. Non-operating or non-cash expense debited to P&L is added back. Do you get this? This is the logic that you should remember. If you do this, it is adjusted for P&L, but there are some items which are actually relating to operating, which are there in our balance sheet. Current assets and current liabilities. We need to adjust these. How do we adjust these? You can't identify one on the cash flow. Why? If you take one current asset like data, it will have hundreds of transactions in it. So what to do? Don't try to pick individual cash transactions. Take the difference between opening and closing balances. Same for current liabilities. If you take current assets other than debtors, let us say there is something like prepaid expense. There are so many payments, so many expenses in that. So we cannot identify a line wise. So what do we do? Difference between opening and closing. You got it? You need to check the impact of this asset on the balance sheet. Very simple. Current asset other than cash and cash. Current asset other than cash and cash. If current asset other than cash increases, cash decreases. Why? Asset is increasing along. You need to buy it. To buy it, you pay money, no? So if current asset increases, cash decreases. You got it? So let's say opening current asset is 10, closing current asset is 12. That means you purchased no 2000. You should write minus in cash flow statement. I'll repeat. Opening current asset is 10, closing current asset is 12. What happened to current assets? Increased by 2, which means you purchased current assets by 2000. Cash would go out by 2, should write minus 2000 in cash flow. Opposite for current liability. Let's say current liability is 10, opening, closing is 12. That means liability increased. Opening current liability 10, closing current liability 12. That means current liability increased by 2. You borrowed 2000 cash, cash balance will increase. You get it? So you don't have to think too much in the exam. Very simple logic. Current asset, you do opening minus closing. Current liability, you do closing minus opening. Don't think too much. Okay. Current asset, opening minus closing. Current liability. Okay, let me help you with that. This is what I was trying to teach. Current asset, opening minus closing. Current liability, how to remember? Current liability, CL, CL closing minus opening. Current asset, CA, A is the first letter, no, opening minus closing. So what do you do for current asset? Opening minus closing. Current liability, CL, closing minus. Blindly take current liability closing minus opening, current asset opening minus closing. See this. You start with net profit as per P&L, add non-cash and non-operating items debited to P&L, less non-cash or non-operating incomes credited to P&L, add or less changes in working capital, you will get cash flow from ordinary activities, operating activities. Investing and financing is same for direct as well as indirect. If there is any extraordinary item, disclose it separately. Not because of accounting standard 3, but because of accounting standard 5. If there is any extraordinary cash flow, it has to be disclosed separately as a separate line item. Did you get it? Very good. Rest upon is everything the same. So this is the logic that I was trying to tell. For current asset, do opening minus closing. Current liabilities, closing minus opening. There are multiple logics to remember. Mathematical logic or normal logic. Now it's not required. If you would want me to do for one question, I'll teach you how it is done. Just an example question. If you would want, but this is only under direct. If you want to do indirect method, then we can do a question. Or what I can do is I can share one questions video recording to you people, which you can see. Because now if I do, I would have to give you copy time also, and we are eating away our revision time. But I hope you people got the overall view of cash flow statement, how it should be done. And very important point that I want you to remember is with regard to provision for tax. Provision for tax, always remember that opening provision for tax, sorry, these two items you should remember. One is provision for tax, second one is dividend. I'll give you one small overview on that. Don't worry. I'll show. Dividend and tax. That's it. No, that's the part. Come on here. Looks very dark, no? This is better. With regard to proposed dividend and provision for tax, I agree with you that they are current liabilities and current assets, whatever it is. But don't treat them in changes in working capital. Don't treat them in changes in working capital. Open separate ledger. Shortcut for it, remember, for proposed dividend provision for tax, don't treat it as current asset and current liability. Always open ledger account. I will tell you the reason why. Very simple. Provision for tax and dividend are items which exist in 1 year but are settled in another year. This year you have made sales. This year you have earned profit. This year you create provision for tax, but you pay it next year. Provision for tax created on the current year profit is actually paid in next year. Dividend also. This year you made sales. This year you earned profit. On this profit you pay tax in next year. So you pay dividend in next year. See, there are exceptions. Interim dividend is paid during the same year. Advance tax is paid during the same year. I'm not talking about exceptional scenario. I'm talking about general scenario. You got it? So always open one ledger. When you open the ledger, opening provision for tax you write on the credit side. Closing provision for tax you write on the debit side. Provision for tax created during the year will appear in P&L account as tax expense. That will again come on the credit side because tax provision created during the year. Then you will find the balancing figure as how much is tax paid during the year. Some questions they'll give tax paid and you find provision for tax created during the year as balancing figure. That provision created during the year is there, no? That and tax paid might match but might not match. Might match in some problems, but it will not match in all the problems. We need to treat them separately. Provision for tax created during the year is a non-cash expense debited to P&L to be added back. I repeat, provision for tax created during the year. Provision for tax created is non-cash expense debited to P&L, added back. Tax paid is operating outflow, so deducted from the cash flow in operating activities. You got it? Very simple. Provision for tax, opening balance on the credit, closing balance on the debit. P&L account, whatever tax you have debited is the provision created during the year, that will be written in your provision for tax account on the credit side. Once you write that, you identify the tax paid during the year as balancing figure. Some questions, tax paid during the year will be given, opening and closing will be given. You find the provision for tax as balancing figure. Your ultimate objective is to find two things. One, provision for tax created during the year, tax paid during the year. Provision created during the year is already debited to P&L account. It is non-cash expense debited to P&L. What do we do? Very good. Tax paid during the year is cash outflow, deducted. Sometimes both will match, but still you would have to add it and then deduct it separately. Add it to find cash flow before tax, deduct it to find cash flow after tax. Lot of your decisions are based on CFAT, cash flow after tax. Lot of decisions. So you should know how much is before tax and after tax, because sometimes for decision making purpose you ignore tax because it's not in your control. You never know when will Nirmala aunty suddenly tell pay something more or pay something. You don't know, because she tells I am not taking your tax money. If I have the power, I will make your tax zero. I am not telling this. Finance minister told I don't take anything home. It's not that I want to collect extra tax. If the need be, if I had the power, I would make the tax zero. It's just that we need enough money to do scam. Sorry, it's just that we need enough money to develop the country. Get what I'm trying to do? So that's the very clear statement. Sometimes fumble, guys. Don't take it wrong. And no one comment on just this part of the video. It is fumbling. I hope you agree. Sometimes it does happen, mistakes. Correct, no? Yes. You understood this part. Same happens with dividend also. Same. Let me tell you. Dividend is proposed in this year. Correct or not? At the end of the year, you propose the dividend. But dividend is, I would say, declared in the general meeting. General meeting happens after the end of the financial year. No. So 31st of March, proposed dividend will come in the balance sheet 1 lakh. It is declared after 31st of March and paid in the next year. It is not an adjusting event as per AS4. We'll discuss now after this. Is dividend an adjusting event? Straightforward answer. I'll tell you before I start with AS4. It is not an adjusting event. Previously, if in case you read any book which says that dividend is an adjusting event, change the book, because AS4 previously was not telling anything about that dividend part. So there was something called as limited revision which was given till the time AS4 clarifies what to do. So we used to always refer to that limited revision before the exam when I was rating. But now that's not the case. Remember it very clearly. Dividend declaration is not an adjusting event. If the dividend is proposed in this year 22-23, declared in 23-24, then it will be written as an entry in 23-24. Never comes in 21-22. But sir, condition existing. Proposal is not a condition. ಒಂದು ಅಚ್ಚನೆ ಪ್ರಪೋಸ್ ಮಾಡಿ ರೆಡಿಯಾಗಿ ಇಟ್ಟಿರ್ತೀವಿ, ಯಾರ್ಯಾರು ರಾಖಿ ಕಟ್ತಾರೋ ಗೊತ್ತಿಲ್ಲ, ಉಳಿದವ್ರು ಆಮೇಲೆ ನೋಡ್ಕೊಳ್ಳೋಣ ಅಂತ. So proposal is not a condition existing on the balance sheet. Acceptance is when the game will start. Declaration is important. Declaration in the general meeting is the beginning. You get it? Proposed dividend is not the point of consideration. You get it? So let's say proposed dividend at the beginning of the year is 1 lakh. Proposed dividend at the end of the year is 1 lakh 20. That means 20,000 dividend is proposed during the year? No. 1 lakh what was proposed is paid. 1 lakh 20 what is closing is proposed during the year. Did you get it? Remember, opening proposed dividend is how much?
1 lakh.
Closing proposed dividend is how much? That will not mean 20,000 is further dividend declared. Once the dividend is declared, within 30 days you have to pay, guys. Correct? No. So that opening proposed dividend 1 lakh is paid during the year. Financing outflow. Financing closing 1 lakh 20 is the dividend proposed during the year. Appropriation of reserves will not affect cash flow. It is not expense, will not be adjusted in operating. Why? Appropriation of income, not charge against income. Did you understand? Simple shortcut and simple point for the entire last 5 minutes discussion is proposed dividend and provision for tax are current liabilities. I agree with you for presentation as per schedule 3, but as per accounting standard 3, when you're preparing cash flow statement, don't treat provision for tax as closing minus opening. Don't do proposed dividend as closing minus opening in changes in working capital. For proposed dividend and provision for tax, open a separate ledger. Provision for tax, provision created during the year, non-operating expense debited to P&L, add back. Tax paid during the year, operating cash outflow, deduct in operating activities. Amounts can be same but need not be same. Proposed dividend, opening proposed dividend, closing proposed dividend. Opening proposed dividend credit side opening, closing proposed dividend debit side. You write the dividend proposed during the year and identify the dividend paid during the year as balancing. If nothing given, opening proposed dividend is paid, closing is declared, closing is proposed during the current year. Whatever dividend is paid is financing outflow. Is financing outflow. Dividend proposed during the year is appropriation of income, not cash flow at all. If they have given net profit as per P&L, very good. If they have not given, sometimes you need to see increase in the reserves as net profit. You need to prepare reserves on surplus account, opening reserves, closing reserves, appropriations you need to write to find the net profit as per P&L as starting point. There you would have to take this dividend proposed during the year as appropriation of reserve on the debit side to find the net profit for the current year, which is a starting point for operating activities. Understood? That's it. Last point is that extraordinary cash flow has to be disclosed separately in the operating cash flows, not for the purpose of AS3 but for the purpose of AS5, and this calls end of accounting standard 3 cash flow statement along with 10.2 financial statements. Got it? Very good. Shall we go to AS4? Yeah, so there's a very interesting question. He's asking how to treat unclaimed dividend. Whenever there is unclaimed dividend, remember there is some part of the dividend declared which is not paid. Let us say opening unclaimed dividend is 0, closing unclaimed dividend is 10,000. How much is opening unclaimed dividend? 0. Closing unclaimed dividend is, that means at the beginning of the year there is no liability. At the end of the year 10,000 worth of dividend is not paid and we are liable. That you kept in mind. Then what you do is CO proposed dividend ledger. Let's say opening proposed dividend 1 lakh, closing proposed dividend 1 lakh 20. I repeat, opening proposed dividend 1 lakh, closing proposed dividend. That means 1 lakh dividend is paid during there, 1 lakh 20 is proposed during there, will be paid next year. So 1 lakh dividend is supposed to be paid. In the 10,000 is unclaimed. We don't know who's the rightful shareholder, or there is a fight, or there is some problem. So we have not paid 10. 1 lakh is the dividend to be paid. In the 10 is not paid. 90,000 is paid. In financing activities, we'll write financing outflow, not 1 lakh. 90. Got that? 10,000 will be there as a current liability for the next year opening date also. In the next year, if it is paid, it will become financing outflow in the subsequent year. Should it be disclosed as a prior period item? Firstly, it's not prior period. It's not our mistake. It is they have not claimed, or legally there is some problem, and it is paid in the next year. Then it will become normal only. It's a financing activity. Disclosure is required only for extraordinary in cash flow statement. No disclosure for prior period or exception. Only for extraordinary item disclosure is required in cash flow statement. Shall we go to AS4? Come on, let's discuss AS4. Events occurring after balance sheet date. Accounting standard 4 talks about events occurring after balance sheet date. This question is the basic question of periodicity. We know that whatever happens in the current year, let us take 2023-24 as one financial year. 2023-24. Whatever happens from 1st of April 2023 to 31st of March 2024 is current year. I will write it in this year financial statements. Whatever happens after 31st of March 2024, it is next year. That is the periodicity. Whatever happens in the current year should be taken in current year. Whatever happens after 31st March will appear in next year. Breaking this periodicity. Certain events, what will happen after the balance sheet date, will also be considered in current year balance sheet. I am preparing balance sheet for 31st of March 2024. I am preparing balance sheet for, I should take only events happening till 31st of March 24. No, something happens in April, something happens in May, something happens in June. I might have to consider it in my 31st of March balance sheet. When it is an event occurring after balance sheet date. What is event occurring after balance sheet date? Event occurring after balance sheet date are such significant events, whether favorable or unfavorable, happening after balance sheet date but before the approval of financial statements. I repeat, what is events occurring after balance sheet date? They are significant. First and foremost point is significant means material. Some kanji pinji children transactions happens. Don't take them, yeah. It's only if it is significant. It can affect the decision making. Disclosing that in the current year, not disclosing that in the current year will significantly impact the decision making of the user. Then you should consider it. That's the first filter. So such significant events, it can be favorable, it can be good news, or it can be bad news. It can be either. So significant events, whether favorable or unfavorable, it should happen after balance sheet date. If it happens before balance sheet date, no doubt only current year item. If it happens after balance sheet date, till what date? Till the date the financial statements are approved by the signing authority. Means board of directors will approve the financial statements. No, our sign akakinta munche agirbeku. It should happen before the sign. After the sign, if it happens next year only, no matter how significant it is, we don't care. It should happen after the balance sheet date, before the board of directors approve it. Between these dates, if it happens, that will be considered as event occurring after balance sheet date. All the transactions are event occurring after balance sheet date. Should we include it in financial statements or not? Depends upon conditions. Should it be included in the financial statements after as on 31st of March or not? Depends upon conditions. If it fulfills both the conditions. Condition number 1, the situation was existing on the balance sheet date. Condition number 2, event occurring after balance sheet date gave additional evidence. What are the conditions? Number 1, condition was existing on balance sheet date. Condition number 2, events occurring after balance sheet date gave additional evidence. For example, on 31st of March, You have created provision for doubtful debts. You know that this debtor might not pay money. You know it for a reason. A fire broke out in his factory, and that guy has not told you, but he is crying. So you see him cry, you created provision, 10% provision. After 31st of March, before you approve your statements on 31st of July, somewhere in June, he declared himself insolvent and it became bad debts. Now, bad debt is happening in next year, but 31st of March, you knew, no? You had created provision. For 10%, you created provision. Now, you would have to make 100% provision, basically bad debt. So, should you record 10% provision in this year and bad debts in next year? No. Current year, remove that provision, write bad debts. This is adjusting event. What is this? What if 31st of March? Normally, for all the debtors, you create provision 2%. For this debtor also, you created provision 2%. You still think he is good boy, okay? You are not expecting him to do default. Fire broke out in his premises after 31st March. Let's say 20th of April, fire broke out in his premises. And May, he declared himself insolvent. You already created 2% provision. Now, should you record entire bad debts? Answer is no. Why? On the balance sheet date, there is no condition existing. On the balance sheet date, normally you created provision, but you don't have any doubt that that guy will cheat and not pay money. So, should you do adjustment? No. It will appear as bad debt in next year's financial statements. Are you getting it? However, you are there, no? 90% of your sales is to that guy only 10% is to somebody else. 90% of your sales is to that one debtor only. If that debtor's business catches fire, it's almost like you have caught fire, because 90% of your sales is to him. 90% of your debtors is him. If he becomes bad at your business, going concern is only question mark. So it is an adjusting event only if the condition is existing on the balance sheet date and event occurring after balance sheet date gives additional evidence. However, even if the condition is not existing on the balance sheet date, if such an event occurring after balance sheet date questions your substratum of going concern, battery kali agoitu because of them, you are about to die, that transaction will wind up your business, then though the condition is not existing on the balance sheet date, you have to still adjust. Why? Sometime in the month of September or August, no user is seeing your financial statements. He is thinking that there is going concern, but going concern was there in March. August going concern illa. Next balance sheet date, you might not be there only. So you'd have to redraft your financial statements. Very important, no? Going concern, fundamental accounting assumption. Are you getting it? Very good. So now tell me, what is event occurring after balance sheet date? Significant event, favorable or unfavorable, occurring after balance sheet date but before financial statements are approved by the. Now conditions, if the condition is existing on the balance sheet date and the events occurring after balance sheet date gives additional evidence, then it is adjusting event, meaning financial statements have to be redrafted. Though it is happening after balance sheet date, such transaction and its impact will be included in the financial statements. However, if condition is not existing on the balance sheet date, only event is occurring after, then we don't consider it an adjusting event. Or if the condition is existing but event occurring after is after the date of approval, then there is no adjustment. However, if that event occurring after balance sheet date questions your substratum of going concern, then though it is not existing on balance sheet date or though it is not fulfilling that condition, you still have to adjust and redraft your financial statements. You got this? If it is EOABD but not adjusting because it is not significant, then what do? Disclose it in director's report. If it is EOABD but not significant, item is too small, yeah, then what do? You don't adjust, but you should have to make disclosure in director's report, section 134, director responsibility. There has to give one board report, no? There you will include it. Same thing has to be checked by auditor. Significant events, 570 going concern, 580 return, 560 ansatala, 570 significant events, 560 going concern. When you read 570, you read subsequent events, alva. 570 going concern, so 560 is subsequent events. 560 you would read, no? Continuation will come in 570 going concern. Are you getting it? Yeah. Written representations is 580. Correct? Written representations 580 or related party? 550 is related party, 580 is written representations. Correct? No? Yeah, 560 significant event, what you read will come here. Yeah, standards on auditing. So if you want, we'll have a small quick overview on this AS4 part. Yeah, see this. So our financial year is 1st of April to 31st of March. If you sell goods on 30th of June, it is to be recorded in financial year 23-24, not in financial statements of 24-25. If in case you purchase goods on 1st of August 23, 23-24, not 24-25. Same with bad debts of 31st of December 23, 23-24, not 24-25. What about bad debts in 1st of May 2024? Not 23-24. It should be 24-25. What if you purchase a land on 1st of June 2024? 24-25. This is the basic rule. Do you agree with me? Now let me introduce to you the concept of EOUBD. Even if the transaction happens after 31st of March, if the board approves the financial statements on 30th of June, then what to do? Year is same, April to March. Goods are sold on 30th of June. Year and all same. Okay. Now come to bad debts. 1st of May 2024, there is bad debts. This is 24-25, no, but it can be recorded in 23-24. Why? Because it is happening after 31st March, before 30th June. When will you write it in 23-24? If on the balance sheet date you had created provision and you are expecting it to become bad, and it became bad before the financial statements are approved. Can be. When will it be? Yes, we should check the condition. Purchased land. So you purchased land on 1st of June 2024. It should be written in 24-25, no, not 23-24. What if the agreement was entered in 23-24? Consideration is given in 23-24. Only registration is pending. Then you would have to record it in 23-24 only. Why? On 31st of March 2024, condition is existing, and that additional evidence, registration in your name, happened before the financial statements are approved, that is 30th June. You got it? That's it. So for example, see, bad debts. 1st of May 2024, debtor declared himself bad, but customer's warehouse met with fire on 25th of February, and you had created provisions on 31st of March. Then 1st of May 24 is 24-25, but you still record as bad debts in 23-24. Got it? Is this what you are expecting when you say questions on some difficult adjustments? In the standards where this kind of data is ready, I'll do it. Okay. Now talking about purchase of land. You purchase land on 1st of June 2024. So it usually falls to 24-25. But what happened? Sale agreement was signed and consideration was settled on 25th March, that is 23-24. Only registration happened on 1st of June. Again, that is before 30th of June when the financial statements are approved. So we rate it in 23-24, not in 24-25. However, purchase lands on 1st of June 2024. Only negotiation was finalized on 25th March. Negotiation negotiation is only talking and coming. Even if you have given token advance, you get it? That is not finalization. Negotiation is different from entering into agreement. Are you getting it? So if only negotiation was done, then it is next year. There is not enough conditions existing on the balance sheet date. You get it? Yes. So this is with regard to accounting standard 4. You want more? Can we discuss one more, two more questions? You want more? Okay, let's see. Inventory was lost by fire on 30th of May 2024. Is it an event occurring after balance sheet date? Yes. See, we're assuming that the year ending is 31st March. Financial statements are approved on 31st of July. Okay. 31st March and 31st July. When inventory is lost by fire on 30th of May, it is an event occurring after balance sheet date, but there is no condition existing on balance sheet. Okay. 31st March, I did not know that my inventory will catch fire. If I know it, I would have protected it, no, kept it somewhere else. So you cannot say 31st March, then you save it correctly. It will not become adjusting event. Should we adjust it? No. However, cashier stole cash on 30th May. You cannot say, no, 31st of March, I knew that this cashier, then change the cashier or change him to accountant. You got it? So that is again not an adjusting event. What if cashier stole the cash on 31st January? That is before 31st March. You get it? And later you got to know that he stolen cash. Cash was difference. You did not know what has happened. Later, after 31st of March, you realize that the cash was stolen. Then it will become an adjusting event which needs to be adjusted. 31st of March, cash difference is there. You will write suspense. In the month of May, you understood that cashier as the one who was stolen cash. Then you will write it as an expense. Then it is adjusting event. Got it? Yeah. Then what if cashier stole the cash on 31st of Jan? However, it was found out only on 31st May. That's what I was discussing. Condition is existing. After 31st March, you realize, so you need to adjust. Provision for expense was made on 31st March. Actual payment is made on 25th May. And it was more than provision. Actual expense is more than expected. Condition is existing. Provision was made. Actual expenditure increased. You can revise the expenditure for previous year, because condition is existing and you got additional evidence before the balance sheet was approved by board. So you can redraft the financial statement. There was a suit pending. Suit means case pending against your company. What did you do on 31st of March? It was there. Bench gives a caution, meaning your advocacy board, your legal board, legal representative of you, sorry, that legal consultant of you know, they told that, sir, we might lose this case. They told that 31st March case is pending. Before financial statements are approved, your legal consulting board told you that you might lose money. So you'd have to create provision or not? Yes, you have to. Why? Case is existing on 31st of March. You got additional evidence after. So you have to create provision to record the same. So this is your accounting standard 4. There is one more question, but I think you people are good enough, confident with AS4. Previously, there used to be a lot of theory-based questions that used to ask based on writing, where you need to write the provision, facts of the case, and conclusion. Questions used to come from AS1, AS4, AS5, and AS9, 10 ali kadime, 11 ali kadime, 12 kadime, 13 less, 14 less, 15 less, 16 also no, 17 no, 18 theoretical questions used to come. 19 ಬರೋದಿಲ್ಲ, 20 ಇಲ್ಲ, 21 ಇಲ್ಲ, 22 ಇಲ್ಲ, 3 no, 24 again, 25 no, 26 no, 27 no, 28 also again no, 29. So 1 5 1 4 5, then 9, 29, 24. So in these standards, theoretical questions used to come, but in fact we practiced also. If you were part of our May 24 examination batch, lot of questions we wrote and practiced. But after the May 24 exam, it is realized that in the 30 marks MCQ part only they try to eat that up, and in the rest of the 70 they'd ask 0 questions for theory rating. They're only practical questions. So expecting to be the same, but not the same. After September we'll get more assurance. So if there are any those theoretical based standards, they'll usually eat them up in your case study based question and MCQ question. They might not expect you to write a theoretical answer. So in the 70 marks writing types, they're only testing you number based standards, like they're testing you on accounting standard 3 cash flow, they're testing you on 10, 11, 12, 7, 15, 16, 19, 17, 20, 21, 22, 23, 25, 27, or branch 26. All of these are tested again. So that's the basic expectation. However, we'll get to know after your September 2024 examination. Let's now start with accounting standard 5. Accounting standard 5 talks about net profit or loss for the period, prior period items, and changes in accounting policy. If you observe the name, no, name tells only 3 things. One is profit for the period, second one is prior period items, third one is changes in accounting policies. But we're going to talk about 5 items in this standard: ordinary, extraordinary, prior period, changes in accounting policy, and changes in accounting estimates plus 1, which is exceptional items. So actually we're discussing 6, but I would tell it is to be categorized into 5 heads. And the entire standard is about telling, if they tell a specific transaction or an event, your objective is only to categorize it into one of the 5 blocks. Once you categorize them into one of the 5 blocks, it's over. There is no accounting here. There is only disclosure, because certain items needs to be disclosed separately, because their impact on the profit or loss statement needs to be perceived differently by the user. I'll go on telling this to you. People will understand it better as I start explaining. Ordinary items. In your profit and loss account or profit and loss statement, you will have revenue from operation, other income, consumption of raw material, purchase of stock in trade, changes in inventory, employee benefit expenses, other expenses, finance charges, depreciation and amortization, all of these items. No, these should be ordinary in nature. Once you take those incomes minus expense, total income A, total expense B, A minus B, you get no profit for this. That should be ordinary. What is repetitive? What is recurring? What is frequent? Let us say I show my profit and loss statement in which I have shown my profit in the last year to be 1 lakh. In this year, I've shown the profit and loss to be 1 lakh 20. Now you say last year profit was 1 lakh, this year profit is 1 lakh 20. That means there is increase in the profit by 20,000. There is increase in the profit by 1 lakh has become 1 lakh 20, means 20% increase in the profit. You see the organization is taking an upward curve. There is increase in the profits. You would perceive so. What if that 20,000 profit is on sale of an asset? It is not repetitive in nature, meaning that 20,000 profit, it is booked this year. Next year I might not make 1 lakh 20 plus something. Next year I might again make 1 lakh. Why? In the current year P&L, 1 lakh is from sale of goods, 20,000 is on sale of asset. Sale of asset is not recurring profit, it is not repetitive profit. If you think my company is growing and then invest further money, that might become wrong decision by you. Why did you take wrong decision? Because I gave the information in a way that it was deceiving in nature for you to take wrong decision. I should not do that. I should tell 1 lakh revenue from operation, sale of goods, 20,000 is profit which is not repetitive in nature. I would have to disclose that. Same is the case with regard to loss also. Let's say I made 1 lakh profit last year. This year I made profit of only 90,000. I made 10,000 less no than last year. Why? Because in the current year a fire broke out in my premises, because of which I made 20,000 loss. After writing that 20,000 loss, my profit is 90. If that fire would have not broken out, I would have made 1 lakh 10,000. No, that fire won't happen every year. So last year profit 1 lakh. Current year, if not for fire, my profit would have been 1 lakh 10. So I've actually progressed from last year to this year. If I don't disclose that separately, I show 1 lakh and 90, you will think my company is going bluk, 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 bluk. You think that company is doing bad. So it is my significant responsibility to ensure that I will present the information in such a way so that you can perceive the impact of that item on P&L in the best possible way. So I categorize these items. First and foremost thing is ordinary items. Ordinary items need no separate disclosure. Ordinary items should form part of financial statements. Ordinary items are the items which are native items of P&L statement. What are ordinary items? Items which are ordinarily occurring in the, which are arising in the ordinary course of business, or incidental to business, or in furtherance of business. 3 points to be remembered. What is it? One, in the ordinary course of business, incidental to business, or furtherance of business. Ordinary course of business ಮಾಡ್ತಾ that is happened. Incidental means related to business. Furtherance means to continue the business. In these three cases, if you have incurred any expense or if you have earned any income, it becomes ordinary activity. However, certain things which are ordinary based on the size of that item, based on the incidence of that item, based on the nature of that item. Remember, based on the size, incidence, nature. Based on the size, incidence, and nature, we call it sin. Shortcut, remember, is sin. Based on size, incidence, and nature, these will be categorized as exceptional. Andre, this is ordinary. This is happening in the ordinary course, but these are exceptional. Exceptional means it will not happen again, or it is special. Remember, the word exceptional is not used by AS5 at all. You read the entire AS5 cover to cover, you will never read the word exceptional. So then why did you write exceptional? The word exceptional is used in schedule 3, and here AS5 only tells it is an ordinary item, but based on size, incidence, and nature, it needs separate disclosure to perceive the impact of this item on profit or loss. I repeat, AS5 never uses the word exceptional. Only thing AS5 says it is ordinary item, but based on the size, impact, and nature, it has to be disclosed separately. What should be disclosed? The nature of the item and the amount involved in this item should be disclosed separately, so that the impact of this item on the profit and loss statement can be perceived separately for the purpose of decision making. So this is only disclosure requirement. So there is no use of the word exceptional, but this to be disclosed separately is because it is exceptional item as per schedule 3. In schedule 3 P&L, if you see profit before extraordinary and exceptional items, profit before extraordinary items, profit from continuing operations, then you write profit from discontinuing operations separately. That discontinuing will learn in AS24. In the same video, you'll see it little later. If you're watching it face to face, we're doing it in tomorrow's class. Got that? Fantastic. So what is ordinary items? Which is happening in the ordinary course of operations as a part of the business, for furtherance of business, or incidental to business. When is it called as special or exceptional? Based on the size, incidence, and nature. When you categorize it as exceptional or special, what should you do? You should disclose the nature and amount. You should disclose the nature and amount to perceive the impact of this item on profit or loss. To perceive the impact of this item on what? Profit or loss. Example will be something like your inventory is written down below cost. Inventory you purchased at 10,000, you sold at 8,000. You made loss of 2,000, ordinary. It is what? Ordinary. You purchased at 10,000. You didn't sell it at 8, but NRV is 8. Now you write it down to 8. No, you make 2,000 loss. Without selling the goods, you make 2,000 loss. On the sales, if you make loss, ordinary. Without selling the goods, if you make loss, it will become special. It needs to be disclosed separately. By way of conservative approach, we've recorded it. Or something like disposal of fixed assets. You sell goods, you make profit, ordinary, no problem. You sell assets, you make loss or you make profit, needs to be disclosed separately. Why? It is special category item. You get that? Taking that hook into further part, let me tell you. If in case you sell assets and you make profit, it is exceptional. In certain cases, it will become extraordinary. There is difference between exceptional and extraordinary. What we're discussing now is exceptional. Extraordinary is next discussion. I will continue from exceptional to extraordinary. Hey, let's say I've been doing business, my asset has become old, worn out. I sell this asset to buy another asset. So when I sell this asset, I make profit or loss. That profit will become exceptional if I am selling this asset in the ordinary course of operation. Meaning for the purpose of furtherance. Ordinary will include three things. One, in the course of business. Two, furtherance of business. Two, incidental to. Three, incidental to business. So I sold this asset with an intention to buy another asset. So it is in furtherance of business. So sale of that asset, you make profit or loss, ordinary. But based on the profit size is huge, incidence is irregular, nature not in the normal course, so has to be disclosed separately. However, I am closing my business or I am changing the course of my business, ಬೇರೆ business start ಮಾಡ್ತಾ ಇದ್ದೀನಿ, or that liability is there which I don't have money to pay. That liability holder daily is asking me money. So I decided to sell my asset to pay the liability. Then again you sold the asset, you make profit or loss. Such profit or loss is not in ordinary. Why? It is not incidental, it is not furtherance, it is for shutting down the business. So it will become extraordinary. What do you mean by extraordinary? Extraordinary items are events which are not in the ordinary course. Business ಮಾಡೋದಕ್ಕೆ ಮಾಡ್ತಾ ಇರೋ ಕೆಲಸ ಅಲ್ಲ, business close ಮಾಡೋದಕ್ಕೆ ಮಾಡ್ತಾ ಇರೋದು. It is not in the ordinary course of operations. Then what will it become? Extraordinary. How do we decide whether an item is ordinary or extraordinary? Based on two things: frequency and regularity. What is the category? What is the basis? Frequency and. If a transaction is frequent and regular, ordinary. If it is not frequent or not regular, extraordinary. I'll repeat. If it is frequent and regular, what is it? Ordinary. Ordinary. If it is not frequent or not regular, what is it? Every day in your home, what is there for dinner? Ragi mudde, anna, rasam, sambar, ordinary. Today you go home, there is gulab jamun. Yenivatto extraordinary. That is not in the ordinary course. Do they do gulab jamun every day at your home? No, but in a sweet shop, it is ordinary. You get it? So they do gulab jamun at your home. Last yenivatto special. That is extraordinary, not frequent, not regular. It is a very extra. It should be disclosed separately. Should tell all your friends that they made gulab jamun at your home. How? Your friend will ask, ba tea kudu, will say tea ಆಗೋದಿಲ್ಲ ಇವತ್ತು. Why? ಇವತ್ತು ನಮ್ಮ ಮನೆಯಲ್ಲಿ ಗುಲಾಬ್ ಜಾಮೂನ್ ಮಾಡಿದಾರಲ್ಲ, ಸ್ವೀಟ್ ಜಾಸ್ತಿ ಆಯ್ತು, ತಿನ್ನಕ್ಕೆ ಆಗೋದಿಲ್ಲ ಇವತ್ತು. You get it? After the class gets over, then you say, come, let's go out. It's like, no, I should go home early today. ಯಾಕೆ? ಇವತ್ತು ನಮ್ಮ ಮನೆಯಲ್ಲಿ ಗುಲಾಬ್ ಜಾಮೂನ್ ಮಾಡಿದಾರಲ್ವಾ, ಪಾತ್ರೆ ತೊಳೆಯಕ್ಕಿದೆ. Then tomorrow you are writing slowly in class. Your friend will ask, why are you writing slowly? Say, ಅದೇ actually ನಮ್ಮ ಮನೆಯಲ್ಲಿ ಗುಲಾಬ್ ಜಾಮೂನ್ ಮಾಡಿದಾರಲ್ವಾ, ಅದಕ್ಕೆ ಪಾತ್ರೆ ತೊಳಿಬೇಕಾದ್ರೆ ಕೈ ಸ್ವಲ್ಪ ನೋವಾಯ್ತು. So you continuously tell your friend in a way or not that you had gulab jamun yesterday, because eating is kind of happiness. Telling everyone that you ate is more happiness. So you need to disclose the nature and amount to perceive the impact of this item on profit or loss. You basically want them to feel jealous that they did gulab jamun at your house but not at this. You get what I'm trying to tell? So ordinary items, no separate disclosure required. But if an ordinary item based on the size, incidence and nature, if it looks special, we will call it exceptional and disclose nature and amount to perceive the impact of this item on P&L. Again, extraordinary, which is not in the ordinary course of operations. How do we decide ordinary or not ordinary? Based on frequency and regularity. If it is frequent and regular, ordinary. If it is not frequent, not regular, extraordinary. Extraordinary item to be disclosed separately. What should you disclose? Nature and amount to perceive the impact on profit or loss. You got this? Now I told nature, frequency and regularity is the basis, but it is not the sole consideration. Frequency and regularity is the basis, but it is not the sole consideration. The major consideration is professional judgment. For example, there is earthquake that happened in your business premises because of which you incurred loss. That loss, is it ordinary or extraordinary? Why? Earthquake won't happen frequently. Earthquake won't happen regularly. It is not frequent and regular. It is very irregular, very less frequent. So that loss, what had happened, is extraordinary in nature. It is not in the ordinary course of operations. It is not in furtherance of business. It is to shut down the business. You got it? But what if your business is situated in a place where earthquake is regular? Every year earthquake will happen. Every year loss will happen. Can you call it ordinary? No. Frequency and regularity is the basis, but that's not the sole consideration. You have to use professional judgment. What is it? See this, frequency is not the only condition. They are just know I was about to tell the same thing. Loss due to earthquake, no matter how often you are exposed to earthquake, it is still an extraordinary item. It is still an extraordinary item. Frequency and regularity are the consideration, but not the sole consideration. That's not the only consideration. You get it? Now, sale of asset. What is it? Ordinary, but based on size, incidence, and nature, profit or loss needs to be disclosed separately. However, if the sale of the asset is to settle a liability, it becomes extraordinary. See here, property attachment against payable. You have a liability, you don't have interest to pay, so you sell the asset to pay them the money. It is not ordinary. Sale of the asset is ordinary because you are selling the asset and replacing it with a new asset. So the sale of the asset transaction is in furtherance of business. Whereas when you sell the asset not with an intention to buy new asset, then it is not in furtherance of business. You are decreasing, you are downsizing your operations. Then what would it become? Extraordinary. Extraordinary items are to be disclosed separately. Special or exceptional items should be disclosed separately. Are you getting it? Pakka? Then comes the next one, prior period item. What is the next one? Prior period item is PPIs, like PPI. This is like last year you did some mistake. It is an error or it is an omission. You realized it this year that last year you did the mistake and you correct it this year. Why? Last year's financial statements are closed. Last year's books of accounts are closed. When last year's books of accounts are closed and you make the entry in the current year, that will become a prior period item. What will it become? Prior period item. What do you mean by prior period item? Item arising in the current year because of an error or omission in previous year. I repeat, item arising in the because of an error or omission in if you have done it correctly last year, it would have come last year. No, let's say last year you forgot to write some purchase, last year you forgot to write some expense, you missed that invoice, you realized it this year. Can you say this year you won't write because it belongs to last year? Because you did not write last year, you should write it at least this year. Am I right? When you write it this year expense increases. If this year expense increases, this year profit decreases. This year profit should be computed by writing this year expense and this year income. No, matching concept. Current year expense, current year income, current year profit. If you write current year expense and previous year expense and write current year income, what you arrive is not current year profit. So ಅದಕ್ಕೆ ಏನು ಮಾಡ್ತೀವಿ? First we write current year expense, current year income, current year profit. Then write previous year expense, disclose it separately. Because what if you are actually making profit this year? Because you forgot to write that expense last year and you wrote it this year, it's becoming loss this year. Your profit last year is 1 lakh. Why? You forgot 20,000 expense last year. So what did you do this year? This year's profit is again 1 lakh. What did you do? You booked the 20,000 loss of previous expense of last year. This year it is looking at 80. Actually, last year profit is 80. This year profit is 1 lakh. You are increasing. Last year, because you did not write 20,000 expense, last year profit became 1 lakh. This year profit is 1 lakh. Because you wrote last year expense, current year profit has become 80. True picture is 80,000 last year, 1 lakh this year, profits are increasing. But how does it look? Last year 1 lakh, this year 80, profits are decreasing. Jare bandi tara kanse. Tappalva. Someone who looks at these financial statements, they will take wrong interpretation. So what should you do? You should show this year profit 1 lakh, but last year's expense 20 was not written last year. So I rate that 20. So current year profit 1 lakh. Prior period item 20,000 expense, profit 80. 80 is not current year profit. How much is current year profit? So you should disclose the 20,000 what is written as expense in current year because of previous year's error. So basically, prior period item is an item arising in current year because of an error or omission in previous year. Because of an error or omission in. Very good. When we disclose this, we need to disclose what do you say? Nature and amount so that we can perceive the impact of this item on profit or loss. See, exceptional item, extraordinary item, prior period item, all the three same disclosure. First table is exceptional. Second one is extraordinary. Third one is prior period. What are we disclosing? Nature of the transaction, amount involved in the transaction with a simple intention to perceive the impact of this item on our profit or loss. Got it? Very good. So remember that prior period item and changes in accounting policy are different. Changes in accounting policy, changes in estimate and prior period item are different. Last year you followed FIFO. You should have followed weighted average method. This year you change it to weighted average method. That is not a prior period item. Last year you should have followed WAM, but you followed FIFO. When this year when you change from FIFO to WAM, it doesn't become prior period. Prior period ಅಂದ್ರೆ ಎರಡೇ, ಒಂದು error, ಇನ್ನೊಂದು omission. This is can be treated like an error, but there is better classification. What is the better classification? Changes in accounting policy. What is it called as? Changes in accounting policy. Next, shall we discuss change in accounting policy? We have discussed this change in accounting policy already at two places. One, framework for financial statements. Two, in accounting standard 1. We're discussing it for the third time. Where? In AS5. Changes in accounting policy. What is accounting policy? It is significant accounting principles and methods of applying these accounting principles in preparation of financial statements. I repeat, what is accounting policy? Significant accounting principles and methods of applying these accounting principles in preparation of financial statements. This should be consistent from one accounting period to another accounting period. However, as per AS1, there are exceptions given. How many? 3. Whenever there is change in accounting standard or requirement in by law or for the purpose of better presentation, you can change this. Whenever you change this, you need to give retrospective effect. What effect? For example, let's take the example of inventory. Last year I followed FIFO, but I know that I should have not followed FIFO, I should have followed WAM. This year when I change to WAM, this year 23-24, closing stock will be computed as per WAM. 22-23 closing inventory was computed under FIFO. That has become my opening stock under FIFO. That opening stock should be now revised to WAM. If in case I had followed weighted average method last year, how much would have been the closing stock of last year? That revised value should be taken as opening stock in this year. I am not reopening the books of last year. But if I had followed weighted average method last year, if scenario, I need to compute and that has to be taken in the current year. That will become retrospective. Retrospective means what? From the beginning we should change. Why? Policy that we followed is incorrect. Then there is something called prospective change. Prospective change is from now I'll change. For example, Karnataka Bangalore Traffic Police, Bangalore Traffic Police basically decided that whoever doesn't wear helmet, 5,000 rupees fine. 5,000 rupees fine. If they say prospectively, means from tomorrow, whoever goes out without wearing helmet, 5,000 fine. If they say retrospectively, 1 week ago you had say driven vehicle without helmet, you were riding vehicle without helmet, adu nimge 1,000 rupees fine collect ಮಾಡಿದ್ರು. Balance 4,000 ಗೆ ಇವಾಗ ಚಲಾನ್ ಕಳಿಸ್ತಾರೆ. You say ಯಾವನ್ ಪೇ ಮಾಡ್ತಾನೆ? No, if you were supposed to pay, that becomes retrospective. You understand retrospective? So retrospective means from the beginning we change. Prospective means from now we will change. You got it? Very good. So whenever there is change in accounting policy, what effect should we give? Retrospective. If that accounting policy was implemented from the beginning, the new accounting policy from the beginning will give the impact. That is retrospective effect. Whenever there is change in accounting policy, you need to make 3 disclosures. How many disclosures should you make? Very good. What are the 3 disclosures? Number 1, what is the change? Number 2, why are you changing? Number 3, profit with the old policy, profit with the new policy, how much is the difference? Profit if you follow old policy, profit if you follow new policy, what is the financial impact, if any, arising due to such change in the policy? Remember this, accounting policy should be consistent. Can it be changed? Yes. Three situations: law, as, better presentation. If in case you change, you should make the change retrospective. And when you change, how many disclosures should you make? Three. Number one. Second one. Third one. How much is the financial impact, if any? Here the disclosure requirement is different from extraordinary and exceptional. Got it? Last one is about change in accounting estimate. I discussed accounting estimate in framework. You get that? Framework of financial statements, you remember in the beginning. So there I told you valuation principles are there: historical cost, realizable value, replacement price, current cost. These have to be followed. If in case there is an item which cannot be measured using these valuation principles, basically if valuation principles fail, then this is like supplementary accounting estimate will come. When valuation principles fail, then we arrive at accounting estimate. For example, provision. How much provision to make on debtors? You tell 2% provision. No. How do you arrive at 2% historical cost? Did you buy debentures? Did you buy debtors at 2%? No. There is no realizable value. There is no present value factor. There is no historical cost. May you make 2% because in the past, whenever you made sales, it so happened that for every 100 people you met, 2 people did not pay money. For every 100 people you met, 2 people turned out to be considered bad people. They did not pay money. So you are expecting that 2% people or 2% of the money will not be realized. This is your accounting estimate. So in the past experience is that 2% money is not recovered. That 2% will be applied on the current year debtors. Current year debtors is 50,000. In the past, 2 rupees out of 100 was not received. Past experience is 2%. You apply it on current year debtors of 50,000 to arrive at some 1,000 rupees as your provision. That past experience applied on the present situation is accounting estimate. What is accounting estimate? Past experience applied on the present situation. Read that: estimate based on the past experience and present situation. Now, past experience was there, present situation is there. The beauty about experience is it will keep on increasing day by day. The beauty about present situation is it keeps changing every day. You understand things better. You get more experience and you get better understanding. So last year you created 2% provision on debtors. This year you got more experience and you had better understanding. What happens after some time? More experience, better understanding. Now the 2% you want to change it to 2.5%. What is that? Change in accounting estimate. Why will estimate change? Estimate is made based on two things: experience and understanding. Experience will become more, understanding will become better, estimate will change. Estimate change can be more or less. Either ways, such change in accounting estimate, should be given prospective effect. What should be given? Andre, last year you created 2% provision on debtors. Now, when you have to create 2.5, you won't change last year's. Current year closing debtors mele you maintain 2.5%. 2% already some amount is there. 2.5% you will arrive at provision. Difference is there, no? Such excess provision you create, that you will write it in your P&L statement. That is change in accounting estimate. What is it? Change in accounting estimate should be given prospective effect. You got it? So have a look at this. So read this part. Change is based on more experience and better understanding. If difficulty arises, whether it is accounting policy change or accounting estimate change, always assume it is accounting estimate change, because prospective effect for estimate are there. Change in accounting policy is like an error, not an error. You got it? So only if they clearly mention the accounting policy, old policy, new policy, and you understand the change, then it will be considered as change in accounting policy. Otherwise, doubt idre always change in accounting estimate. And what effect will we give? Prospective effect. Whenever there is change in accounting estimate, what should you disclose? Nature, amount, to perceive the impact of that item on P and L. Now we'll discuss list of examples and I'll tell you whether it is change in accounting estimate or accounting policy or prior period item. This list, if you cover, more than sufficient. We are not expecting lengthy questions on this. If in case you expect a lengthy question, I have taught you the definition of ordinary, extraordinary, prior period, change in policy, change in estimate. Write that definition in the first paragraph. Second paragraph, question ತಗೊಂಡು ಅದಕ್ಕೆ ಸ್ವಲ್ಪ ಹಂಗೆ ಕಟಿಂಗ್ ಮಾಡಿ write that. Third paragraph, write conclusion, whatever it is. If they tell it is change in accounting policy, you write definition of policy, definition of estimate. You write same question once again. Third point, conclusion, stating that it is estimate and not policy. Or if it is policy, write it is change in policy. You write that meaning. That you will be able to answer. But I am expecting MCQ based questions on AS5 if in case it comes in the exam. So this I have put in an exhaustive list of about 37 cases. If we discuss these 37 cases, then you will be done. I can very confidently tell, do this 37, you will be done. Yeah, first one, loss due to enemy action. If there is an enemy who is taking action against you, neighbor, friendly neighbor from right side, left side, top, or so-called friendly neighbor from the bottom attacks on you. Because of that, there is some loss. It is always considered extraordinary. Sir, whatever enemy keeps attacking, hey, just because it is frequent and regular doesn't become ordinary. You get it? It's still extraordinary. You got it? Next one, sale of land in city to buy land in industrial area. We had a similar question in AS10, that greenfield site, industrial area. Yeah, that is ordinary. That is ordinary. But based on the size, incidence, and nature, such profit can be considered exceptional. Why? We are selling one land to buy another land. It is in furtherance of business. Next one, nodi, sale of land to tide over liquidity issues. Liquidity issues andre ice cream melt ಆಗ್ತಾ ಇದೆ. We don't have ದುಡ್ಡು. Okay, ನಮ್ಮ ಹತ್ರ print ಮಾಡೋ machine ಇಲ್ಲ. So what did we do? We took some sites in our name, we sold that site, and then we used that money to pay off the liability. You get it? So no reference to anyone, whether alive or dead, whether now or in different time zone. You get it? I want to stay safe. So when you sell land to tide over liquidity issues, it is not in the continuance of business. Is it ordinary? No. It is extraordinary. What is it? Yeah, there are some fans in the class who's feeling offended. No, don't feel bad. ಪುನೀತ್ ಕಾಣಿಸ್ತಾ ಇದೆ, ಬೇಜಾರಾಗ್ತಾ ಇರೋದು ಗೊತ್ತಾಯ್ತು. ಯಾ, ಸೇಲ್ ಆಫ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ಸ್. If your business itself is investment business, you buy investments, sell investments, buy investments, sell investment, ordinary. Your business is not that. Your business is selling water bottle, but you had some shares and you sold those shares. What will that become? Ordinary. But based, don't use the word exceptional in the exam. What should you say? Ordinary, but based on size, incidence, and nature, needs separate disclosure. Based on size, incidence, and nature, it needs separate disclosure. Then non-recurring loss. How are non-recurring? Andre it's not in the ordinary course. Extraordinary. Recurring and ordinary. Ordinary, but the amount is huge. Exceptional, that is size, incidence, and nature needs separate disclosure. Okay. Creating provision for bad debts. Ordinary, and it is accounting estimate. However, when you revise that provision, already provision is there. Now you are creating new provision. It is ordinary, but it is change in accounting. Change in accounting. What is AE? Accounting estimate. What is AP? Akka? Very good. Then reversal of provision. Andre, you have created provision. That provision is no longer necessary. It will become ordinary item, but based on the size, incidence, and nature, it will become exceptional. How? Very simple. This year I want to show less profits. This year I want to show less profits. Why? I am allotting shares to myself, directors. I am issuing shares to directors. If the profit is more, valuation will become more. You got it? Next year I want to go for public issue. So next year I want to show higher profits. You know what will I do? This year I'll book some loss, not actual loss, provision. I'll make some provision. 1 lakh is the profit of current year. Let's say I make 20,000 rupees provision. Current year profit will become from 1 lakh to 80,000. Correct? No. Next year profit is actually 1 lakh. I will say last year provision created 20,000 is no longer required. I will reverse the provision. Reversal of provision will become income. Next year profit will become 1 lakh 20. So current year 80, next year 1 lakh 20. Current year 80, no profit. Valuation of the share will be less. I will buy share for myself. Next year valuation became 1 lakh 20. Public ge pangnama hakol part higher price. You got this? Can they do it? No. So what should you do? The 20,000 reversal is there, no provision. You have to disclose it separately, stating that 20,000 increase in the profit is arising not because you made sale, but it is because of reversal of provision. Reversal of. So this has to become what? Exceptional item. It is ordinary, but exceptional items are ordinary items. Sir, ordinary item, exceptional item undena. Exceptional ಅನ್ನೋ word ಇಲ್ಲ AS5 ಅಲ್ಲಿ. You get it? Exceptional is a word which is not there in AS5. It is ordinary item, but based on size, incidence, and nature, it has to be disclosed separately. Got that? Next, sale of scrap. Ordinary, but based on the size, incidence, and nature, can be considered exceptional because that's not your ordinary course of business. That is ordinary, but size is different. You got it? It's like this scrap might not be sold every year. You might accumulate the scrap for certain years, 3 years, and then sell it for once. That might look like you made huge profits in that year, but that's incorrect. No, you get it? If it is immaterial, it will be ordinary only. Got it? Then loss on embezzlement of cash. Cashier stole cash. Ordinary. In the ordinary course of business, ಇದೆಲ್ಲ ಆಗ್ತಾ ಇರುತ್ತೆ. It is not extraordinary. You get it? What is it? Ordinary. What if the cashier steals so much cash that your business is very majorly affected? Then based on the size, it can become item requiring separate disclosure. You got it? Very good. Then inventory written down from cost to NRV. Exceptional. It is in the ordinary course, but without selling the goods you're making loss, it will become. Then GST paid on demand notice. Ordinary course of operations ಅಲ್ಲಿ GST pay ಮಾಡ್ತಾ ಇದ್ದೀವಿ. Ordinary. What if last 3 years you paid GST, but you have paid some amount? Now it is disputed and government issued an additional notice to you. Will it become prior period item? No, ordinary. ನಮಗೆ ಗೊತ್ತಿಲ್ಲ. We paid whatever we thought we should pay. You got what I'm trying to tell? Yeah. Next, custom duty paid on order. Which one? If the amount is very huge that it will impact your PL, then it will become exceptional. Otherwise, no. That is based on size, incidence, and nature of the amount. You tell me, custom duty, ordinary. Difference between actual and expected expense. Ordinary. You get it? Sir, is it change in accounting estimate? Accounting estimate change yavaga andre you created provision for repairs 10,000. Next year actual repair if it becomes 12, it is not change in estimate. You created provision for 10,000. Now you are changing that provision to 12,000. Provision is changing from 10 to 12. Change in accounting estimate. Provision is 10, actual is 12. That 2,000 is ordinary. You understand when will it become change in estimate? You created provision for repairs 10,000. Now you are revising that provision for repairs 10,000 to provision for repairs 12,000. What will it become? Change in estimate. You created provision for 10,000. Actual is 12. Ordinary. You created provision for 10. Provision is no longer required. You are reversing the provision to 0. Exceptional. What is it?
Exceptional.
Understood? Then revision of provision for expense. Change in accounting estimate. Reversal of provision for expense. Very good. Receivables written off as bad debt. Ordinary. Advances written back. It's like bad debt, but with creditors. It's like debtors is the person who's supposed to pay money who will no longer pay. Creditors written off means you are supposed to pay money to somebody, you no longer have to pay. What will it become? Ordinary. Are you getting it? Next one. Year sold creditors not payable in previous year, written off in current year. Lot of years ago you have purchased goods from them, you are supposed to pay money. Last year you fought with them and you so told that you won't pay money. Last year it was agreed by them also that you won't pay money. You should have written off last year, but you are writing off in current year. Then it will become prior period item. 3 years ago you purchased goods from them. Then only you told goods are of poor quality, you won't pay them money. They have not agreed. They are still saying that you should pay money. You are telling that you won't pay money. So it is disputed, but it's still a liability to you. Why? The other party has not accepted it. It will be shown as liability in year number 1. It was shown as liability in year number 2. Last year 22-23 ಏನಾಯ್ತು? He agreed. You don't pay money to me. I agree. The goods are of poor quality. He agreed when? Last year. You should have written off last year, no? If you would have written off last year, it would have not been prior period. It would have been ordinary item. Last year you forgot to write. They agreed not to receive money, but you forgot to write last year. You wrote it off this year. What will it become? Prior period item. You got it? If you would have written off last year, sale happened in 18-19. Purchase you made in 18-19. From 18-19 you are saying you won't pay money. 22-23 he agreed that you don't pay money. In 22-23 you wrote off. What is it? Ordinary. 22-23 he agreed, but you forgot to write entry. You wrote it in 23-24. Prior period. Why? It should have written off last year. It was written off current year. Got it? Creditors outstanding for more than 5 years, written off as an accounting policy. From 5 years it is creditors liability, you did not pay. Your policy is whatever money is outstanding for more than 5 years and not paid, write off. So you wrote it off in this year. It is change in account. It is ordinary item. It is written off as per accounting policy. Got that? Can I go to next one? Next, If you have no policy, you newly adopt policy, that will not become change in accounting policy. It will become change in accounting policy when you already have a policy and you change it. If you newly adopt a policy, what will it become? Ordinary. What will it become? Ordinary item. Understood this? Very good. However, if you have one policy, see that adoption of formal gratuity scheme in the place of ad hoc ex gratia payments, meaning till now you did not have any policy to make payment of gratuity. Gratuity is retirement benefit. When an employee leaves the entity, you should pay him money. No, how much gratuity to give? There is no policy. That employee and you will sit, both of you will bargain. He will say 5 years salary, you will say 2 years salary, you will say 4 years, both will shake hand at 3 years salary. Okay, 3 years salary and give us gratuity. Is there a policy? No. If he is a good bucket to you, you give him more gratuity. If he is a bad bucket to you, you give him less gratuity. So when there is no accounting policy, when there is no accounting policy, and newly anymore you will say, yeah, all the employees are fighting, ಅವನಿಗೆ 3 years ಸಂಬಳ ಕೊಟ್ರಿ ನಮಗೆ 1 year ಸಂಬಳ ಕೊಡ್ತಾ ಇದ್ದೀರಾ, how is this? So now you finally freeze one policy for this category of employees who have served for more than 10 years. We'll give them 1 year salary. If the employees work for more than 20 years, we'll give 2 years salary as gratuity. You adopted some policy. Adopted some. Is it a change in accounting policy? No. Why? Till now there is no policy. No. Now only you adopted policy. It is ordinary. What if you had one policy and you changed it? You had FIFO method, you changed it to a change in accounting policy. Last year you had one policy, up to 10 years if they work, 1 year salary as gratuity, up to 20 years if they work, 2 years salary as policy. Then you change that policy to something new, 1.5 years and 2.5 years, something. Then it will become change in accounting policy. Are you able to change it? Understand this? It's like you go to your friend's house and then call him, hey, I'm downstairs, please come quickly. And your friend says, hero maga batte change ಮಾಡ್ಕೊಂಡ್ ಬರ್ತೀನಿ. If your friend is already wearing clothes and then change, that is change in accounting. He is not wearing clothes, then he is not, you cannot say change ಮಾಡ್ಕೊಂಡ್ ಬರ್ತೀನಿ. You say batte ಹಾಕೊಂಡ್ ಬರ್ತೀನಿ. There is difference between adoption of new policy and change in accounting policy. Do you get that? Very good. What if you change your cost formula in inventory? Change in accounting policy. Change in useful life of an asset. Useful life is accounting estimate. Method of depreciation is accounting estimate. Sir, ಇದೆಲ್ಲ ಹೇಳ್ಕೊಟ್ಟಿಲ್ಲ. AS10 will do. Once again, you got it? What if change in method of depreciation? Rectification of error, prior period item. Change in NRV. Why? NRV is selling price minus selling expense. It is not selling price, it is estimated selling price. It is not selling expense, it is expected selling expenses. So that estimated selling price, estimated selling expenses, when it changes, estimated NRV will change. That is change in accounting estimate. Got that? Then inventory considered as absolute and you have recorded at NRV. Now you reverse it. That is change. See, cost is 100, NRV is 90. You recorded at 90. Next year NRV is 96. You reverse from 90 to 96. Closing stock will increase, profit will increase. That is change in accounting estimate. Why? NRV valuation changed from 90 to 96. NRV is an accounting estimate. When you change that, it is change in accounting estimate. Understood? Treating change in accounting estimate as an ordinary item or changing extraordinary item as an, sorry, change in accounting estimate as an exceptional item is incorrect. Then it will become prior period item. Yeah, don't do that. Then payment of arrears of disputed bonus. Disputed andre, I am telling I'll give you 10,000 rupees bonus, you are saying 12,000 rupees bonus. We did not agree. We did not agree. I have paid 10, you are asking how much? 12. Did I agree? No. Next year I paid 2,000 because I agreed. Then it will not become prior period. I agreed that I'll pay 12, I should pay 12. I by mistake paid only 10, or I by mistake booked expense of only 10. Next year I booked additional 2,000 expense. Then it will become prior period. Here it is disputed, meaning I never agreed. I never agreed that I'll pay you extra. Finally, the day I agree, it is that year's expense only. We need not treat it as a prior period item. It is not change in accounting policy. It is not change in accounting estimate. Okay. Then surcharge for several years. This, there is a question. Electricity department had given you provisional bill for so many years. 5 years you paid provisional bill. 6th year they realized that they forgot to charge surcharge. And for all the 5 years together they will charge surcharge and give you one new bill. Every month you are getting 10,000 rupees bill. This month you got 1,50,000. Why? 10,000 this month bill, 1,40,000 surcharge for last 4 years. That 1,40,000 what you pay extra, it is for last 4 years. No, it will not become prior period. Why? According to you, last year every month 10,000 was the bill. Whatever bill they give, we saw that bill and we wrote the expense. Am I right? So it is their mistake, not your mistake. So to you it is ordinary only. It is not prior period item. But if the amount is very huge, based on size, incidence, and nature, you can call it special. Otherwise, it is ordinary. You got it. In the similar lines, there is one more question. I'll tell you this. I'll discuss that. I have not written it here, but let me explain. Let us say insurance company. From the insurance company, you took one health insurance policy on all your employees. You took one health insurance policy on all your employees. So let us say health insurance policy is taken by all the taken by you for all the employees. Insurance company gave one bill. You paid that amount. Next year, insurance agent understood that he is undercharged you, and insurance company gives you one revised invoice for some additional amount. That additional amount what you pay in the next year, is it prior period item or is it ordinary item? Prior period item. The reason is they've told you, no, for one employee this much is the health insurance policy premium. You know the number of employees what which you're taking. No, let's say premium is 5,000 rupees per employee. You have 10 employees in your entity. 5,000 into 10 employees, 50,000 is the expense. No, if the insurance company charges you 45,000 rupees, you should know that they've not charged it for one employee. Though the bill is given by the insurance company, you is the one who's preparing financial statements. You should take responsibility. You have not written employee expense for one employee. Next year if they give, it will become prior period item. This is not applicable in electricity bill. Why? ನೀವು ಎಲೆಕ್ಟ್ರಿಸಿಟಿ ಬಿಲ್ ಹತ್ರ ಹೋಗ್ಬಿಟ್ಟು ಮೀಟರ್ ಅಲ್ಲಿ ಲಾಸ್ಟ್ ಮಂತ್ ಎಷ್ಟಿತ್ತು ರೀಡಿಂಗು, ಈ ತಿಂಗಳು ಎಷ್ಟಿತ್ತು ರೀಡಿಂಗು, ಡಿಫರೆನ್ಸ್ ಎಷ್ಟು ಇಂಟು ಸ್ಲ್ಯಾಬ್ ರೇಟ್ ಹಾಕೊಂಡು ಮಾಡೋಕ್ಕಾಗತ್ತೆ? ನೋ, ವಿ ಕ್ಯಾನ್ ಡೂ ದಟ್ ಕಂಪ್ಯೂಟೇಷನ್. ಬಟ್ ಇನ್ಶೂರೆನ್ಸ್ ಪ್ರೀಮಿಯಂ ಕ್ಯಾನ್ ಬಿ ಕಂಪ್ಯೂಟೆಡ್. ಐ ಆಮ್ ನಾಟ್ ಆಸ್ಕಿಂಗ್ ಯು ಟು ಕಂಪ್ಯೂಟ್ ಪ್ರೀಮಿಯಂ. ಇಫ್ ದೇ ಗಿವ್ ಪ್ರೀಮಿಯಂ ಪರ್ ಎಂಪ್ಲಾಯಿ and you know total number of employees, can't you do A into B to find the total insurance premium expense? If you haven't done that, then it will become prior period item. If number of employees is charged less, because one day when he came for KYC, some 5 employees of you were absent. Next day when he came, you met 4 employees. One employee met last day. That one employee forgot to charge. He gave a separate bill next year. It will become prior period. It will become. You should see whether it is your mistake or their mistake. This is an audit question that was there with regard to insurance. We have it in our material. You would have done that. Yeah. Then claims received from railways. So long ago, when you were transporting goods through railways to your customer, what happened? One customer didn't receive the goods. Goods got destroyed in railways. So you filed a claim with railways. Not you. Your father had filed a claim with railways. Now what happened? You've taken the business from your father. Now railways accepted their mistake and they give you claim money. You received it in this year. It is ordinary. Why? The claim was not accepted, no, back then. It was pending. So it was receivable this year, received this year, it will become ordinary item. Understood? If you pay VRS payment to an employee, voluntary retirement scheme ali amount kotre, ordinary. VRS payment is made based on special restructuring. Your company is changing. Your company is taken over by somebody, or you are changing the course of the business. So VRS is paid because one employee will leave, another employee will come. If VRS is paid because you are re-implementing your business, you are installing computers and removing people, or you are subletting some part of your business to somebody else, contract ತಗೊಳ್ತಾ ಇದ್ದೀರಾ, you giving it to somebody. Previously you used to do sales and service, so you had more employees. Now you will do sales, you won't do service. Service, you are taking a tie-up with some other company. So that is restructuring his business. No, that is not in the furtherance of business. That is shutting down your operations. Then that VRS payment made will become extraordinary. Why? If you remove an employee, put a new employee, it is in furtherance. If you remove an employee, don't adopt a new employee, it is not in furtherance. It is shutting down the operations. Got it? Then government grant becoming refundable, extraordinary. Then treatment of operating leases, finance lease, tappo, prior period item. How about capitalizing the borrowing cost on working capital? Prior period. Working capital, if you incur borrowing cost, it should be treated as revenue. You thought it is on qualifying asset and by mistake you capitalized it. It is prior period item. Understood AS5 everyone? Can we go to AS7? Come on, let's do now accounting standard 7, construction contracts. Accounting standard 7 construction contracts is applicable if you are constructing contractor, meaning you are taking contracts from people to construct. If you are building your own building, it's not applicable. If you have given contract to someone to build one building for yourself, it's not applicable. It is applicable only when you earn your revenue out of constructions. And construction doesn't just mean building. It will include building, railways, highways, roads, tunnels, bridges, dams, lot of things. Okay, construction is much more than what we always think. Though the name of the standard is about construction contract, it is actually talking about revenue. AS9, when we read revenue recognition, we will talk about how to recognize revenue other than for construction contracts, because we have a specific standard. Why does this standard come into picture? Very simple. Let's say you are a construction contractor, you take one contract to construct. That won't happen in 1 month, 2 months, 3 months, 4 months. No, you take 2 years, 3 years, 4 years, and for that 3 years together I'll give one construction revenue, contract revenue. Let's say I've agreed to give you 100 lakh rupees as revenue for entire construction. Construction now runs over 3 years. 100 lakhs revenue what I give, should you record it as income in first year, second year, or third year? You should record in all the 3 years. How much to record in each year? That's what AS7 will tell. AS7 will tell how to recognize the revenue over 3 years, because expense is incurred over 3 years. Revenue should also be recognized over 3 years, so that the profit will be recognized over 3 years. How much revenue to recognize each year will be based on how much expense will be recognized each year, and based on that we find the profit or loss for each year. So though the name is construction contract, it actually talks about revenue from construction contracts. You agree with me? Very good. So quickly see what is the meaning of construction. It's a contract for constructing of an asset or a combination of assets. It can be one single asset or it can be combination of assets that are interrelated. It should be related based on design, technology, and function. If they are not related based on design, technology, and function, they should be treated as two separate contracts. For example, I gave you a contract to build one apartment, one complex of buildings, one in Kanakpura, one in Electronic City. So land area might be same, design might be same, technology that you use might be same, function that you do might be same. But can we negotiate the contract terms differently? Can we identify the negotiation? Can it be done differently? You will say Kanakpura, labor is available easily, so you would want to charge less. Electronic City, labor is available but transportation cost will become huge, so you want to charge extra for Electronic City. You get what I'm trying to tell? Material transport is difficult to Electronic City. Material transport is easier to Kanakpura. So you want to charge higher money for Electronic City construction, lower money for this construction. Can you do that? So you can negotiate the terms separately. You have incurred the expense. No, your expense can be identified separate. Can you identify expense incurred there, expense incurred here separately? Yes. Can you determine? Can you enter into two separate contracts? Yeah. So, but what have we done? We've entered into one single contract. They contract will be spoken about both. But for the purpose of recognizing revenue from contract, you need to treat both of them as two separate contracts. Why? Read this. Because negotiation, revenue, cost, and profit. Negotiation, revenue and cost, and profit can be determined separately. It can be determined because negotiation can be done separately, revenue cost can be done separately, profit can be determined separately. You need to see those two as two different contracts, though they are part of one single agreement. You agree with me? Yes or no? Very good. Why is it? I'll tell you people slightly later. So these contracts can be two types. Contracts can be two types. One, fixed price contract. Second one, cost plus contract. Fixed price means I have told you, ishtu construction I am going to give you 100 crores. I don't care how much cost you incur. You incur 40 crores, you incur 120 crores. I will give you 100 crores. What is it? Fixed price contract. What is cost plus contract? I will say, okay, I agree. It is too much of a contract hassle. You are not able to tell in precise how much should you give. See, if you incur 80 crores, you want to charge me 100 crores, but you are not sure whether it will cost you 80 crores or 100 crores. What will you say? You will charge me more money so that your cost, you will say me 150 crores. Actually, your objective is not to make 70 crores profit. 20 crores profit saku nimge, but you are scared and you are not sure how much is the cost. You are not able to give me one bid, so you will overcharge me. I don't want you to overcharge. I will tell, don't be scared, don't hide things from me. Let us go for a open contract called cost plus contract. How much ever cost you incur, I will reimburse that to you. On the cost, I'll give you 20% profit. On the cost, I'll give. No, you are also happy. If you incur 80 lakhs as cost, I'll give you 96. If you incur 100, I'll give you 120. If you incur 150, I'll give you 150 plus 30. So how much ever you incur, on the 30% I'll give you extra. Sorry, 20% I'll give you extra. It is called cost plus contract. One thing that you should remember is whatever we say fixed is not always fixed. It is subject to escalation clause because it's long-term contracts, no 4 years, 5 years contract. 4 years you never know. Next year, Nirmala aunty comes and then says bricks is very part of nation building. On bricks, we are charging 50% GST and Tilbutra. Then how can you construct? You can't. You will better say that I will stand, put cement on me only. So what will you say? We'll put one escalation clause, meaning if the cost of material goes up by 5% or up to 5%, I will not give you anything extra. If the material cost goes up more than 5%, I will give you 5% extra revenue. Material, cement, brick, iron, everything. If the material goes up to 5%, no change in revenue. If it is goes up more than 5%, then I will increase my revenue also too. That is what contract? Fixed price contract subject to escalation. Cost plus contract is whatever cost you incur plus agreed percentage I will pay to you. You understood this much? Now let's talk about profit. How do we recognize profit from the contract? Like any other thing, revenue minus expense. Revenue minus expense. Now, contract revenue in total is for the entire contract period. Contract expense is also incurred over the entire contract period. You need to recognize the revenue in each year. You need to recognize the expense in each year so that you will recognize the profit in each year. That's the entire construction contract about. Now the question is, what forms part of your revenue? What does not form part of your revenue? Whatever I promised you by way of agreement, no, that is revenue, undoubted. Over and above that, there are 4 things to be considered. CVIP. Over and above the revenue that I have agreed to you by way of contract, what else should be considered? CVIP. Claims, variations, incentives, penalties. What is it? Claims, variations, incentives, penalties. What is claims? Claims is, see, in the process of construction, you need some asset. You don't have that asset. I will give you that asset for construction. I will install one temporary lift. I will install one crane for you to use for construction. It is not yours. You are the contractor. I am the owner of the land. I gave you something. Okay. The construction is complete. At the end of the construction, who should take that asset? I should take. But I will be like, what will I do with the temporary lift? You take it and go. I want my premises to be clean. First ಅದೆಲ್ಲ ತಗೊಂಡೋಗಿ ನನಗೆ ಗ್ರೂಪ್ ಪ್ರವೇಶ ಮಾಡಬೇಕು, heat ಆಗಿರಬೇಕು. You take that and go. I will let you take it. Did you pay money for it? No, that's mine. I give it to you. So that's like you got it free, no? Nothing comes free. It is non-cash consideration that I have given you. So whatever the contract revenue that we agreed plus the value of that asset you should consider. Or for example, you charged me for material, you charged me for bricks, you charged me for granite, you charged me for cement, you charged me for iron, everything. I paid you for everything. At the end of the construction, some granite is left, some material, construction material is left. Now, after the construction is over, what will I do with it? Am I interested in that small money? To me, the place should become clean soon. I want to do inauguration soon. I will say, take that leftover granite, metal, whatever is there, you take and go. I don't even want to sell it. So you have charged me for it. I have paid you money and you took that material also with you now. That will become your claim. That is additional consideration that you received over and above what we have agreed in the contract. That should be added to your contract revenue. Understood? Next one, incentive. Sorry, variation. What is variation? After that entire plan is frozen, when the blueprint is ready, I will tell Itara construction beku. You agree, you sign, I sign, revenue is written. After that, someone told me that idu illidbedi, adu allidbedi. Someone told something. Now I am influenced by it. I am suggesting you some variation in the plan. Now there is change in the terms of the contract. We need to re-enter into a new contract. We'll be like, beda. Why to pay money chumma to lawyer? Okay, this variation I want from the existing contract. You understood the variation? I understood the variation. Please execute it. Whatever extra you incur, no, I will give. So what did we do? We did variation from the existing contract. That was not agreed upon in the old contract. So because you are putting extra effort, I am giving you extra money. That should also be considered as a part of your contract revenue over and above the contract revenue what we agreed in the past. Got it? That is variation. Incentive andre enu? Incentive is very simple. I gave you 3 years time to complete. You finished it in 2 years, 9 months. I am full kush. I gave you 10 lakhs extra for timely completion or before time completion or better quality. ನಾನು ಕೇಳಿದಕ್ಕಿಂತ better quality. I am more happy. ನನ್ನ expectation ಗಿಂತ ಜಾಸ್ತಿ ಚೆನ್ನಾಗಿದೆ reality. So what do I give you more consideration? 10 lakhs. That is also consideration only, no? Penalty ulta. Like I told you 3 years I'll complete ಆಗಬೇಕು. 3 years, 6 months, okay. Beyond 6 months, for every month you delay, I will cut 10 lakh from your revenue. Why? It's delaying me, no. For that much time, I need to pay extra rent. Or I might lose out on rental income, opportunity cost. So what will I say? 3 years is the term. If you complete it before 3 years, for every month you complete early, I'll give you 10 lakh rupees. After 3 years, 6 months time, I'll agree for some delay. Beyond 3 years, 6 months, if you delay, for every month of delay, I will charge you 10 lakh rupees. Meaning, from the consideration that we have agreed in the contract, I will pay you 10 lakh less. Let's say you finished in 3 years, 8 months. 2 months beyond 3 years, 6 months, 20 lakh rupees from the existing contract revenue, you will deduct 20 lakh. That becomes your contract revenue to be recognized. So, contract revenue to be recognized by the contractor is, what is it? Contract revenue as per the agreement plus claim plus incentive plus variation minus penalty. Penalty can be one more thing. You did not keep the place hygiene, or you encroach some road property, or you damage the road, or you damage electric pole. You who's constructing, because of which BBMP is charging me a notice. They have sent me a notice. I paid 10 lakh rupees to BBMP or Bescom, or what do you say? I paid it to BWSSB. Nimminda. Got it? Now, when I pay 10 lakhs extra, thank you. When I pay 10 lakh extra, I will say because of you this happened. No, in your contract revenue, I will cut 10 lakh. That is penalty that you are bearing. Your contract revenue will decrease by 10 lakh. Understood this? Say something, yeah. Very good. So this is contract revenue. On this will compute the percentage. Now, when should you recognize this contract revenue? This is what we'll learn in AS9 also. I want you to know it in AS7 also. Contract revenue will be recognized only on fulfillment of two conditions. Number one, there should be reliable measurement. You should be able to measure it in terms of money. If you cannot measure it in terms of money, you cannot trade. That granite leftover, that material leftover, you will take. No, you should be measure it in terms of money. ಅದಕ್ಕೊಂದು ವ್ಯಾಲ್ಯೂ ನಂಬರ್ ಕೊಡಬೇಕು. If you cannot assign one number, qualitative things have no place in accounts, guys. You can take it only when you can reliably measure it in terms of money. Second one, probable result, meaning there should be probability that I will pay and you will receive. If you have just told it in thin air, somehow you believe that I won't pay. Somehow you believe that I won't pay. Will you recognize it as revenue? No, no, no. There should be probable result. One more thing is, I told you, no. If you finish it before 3 years, for every month you finish it in advance, I'll give you 10 lakh. You have an estimate that you will finish it in 2 years, 6 months. 60 lakh revenue recognize ಮಾಡ್ಕೊಳ್ಳೋದು additionally. No. First perform, then record. What is the probability that you will complete? There is a proper project, there is a track record. 2 years is over, 90% of construction is over. Then you recognize revenue. I agree. You are signing the contract. Now only you are overconfident that you will finish it in 2 years, 6 months, and you want to record 60 lakhs additional revenue. Can you record it? No, you're like, sir, confidence andre nanu andre confidence. No, adella movie work agutte. Here it's not possible. Is there a probability that you will finish? What is the odds that you will finish? Are you able to reasonably prove it on paper that you will finish? Then don't record. So revenue will be recognized only on fulfillment of two conditions. One, reliable measurement. Two, probable result. Then percentage of completion. You need to identify how much percentage of the contract is complete. Only so much revenue will be recognized in first year. Let's say first year 10% of the contract is complete. You should only book 10% of the revenue. Second year 25% of the contract is complete. First year already you booked 10. Second year you will book 15%. Question is, how do you compute that percentage? There are multiple methods. One which is not there as per accounting standard 7 is total cost method. There are two methods. One is total cost. One is completion method. Second one is percentage completion. Total completion method andre, once the contract is fully complete, you will recognize revenue. This is not as per accounting standard 7. This is not what we should follow. Should always follow percentage completion. 10% complete, book 10%. Don't say only after 100% is complete, I will record. How do you recognize that percentage? There are multiple methods. Work certified method, survey method, expenditure incurred method. What we follow in all the questions is expenditure incurred method. I'll tell you why. Work certified is based on me. You finish the work, I will certify. Only then it is done. You finish 10% of the contract. 8% of it I will certify. Only 8% revenue you can book. You will say, why will your revenue recognition be dependent upon my work certified? So basically, work certified method is not followed by anyone. So what are the two methods that is left? Cost incurred method and survey method. Survey method will actually be followed, but survey method is based on valuation expert. Andre, you are constructing, I am the interested party. Both of us will appoint one surveyor. This surveyor will go and inspect the place. He will say 20% complete. You should recognize 20% revenue. In the exam, no. If it is survey method, they should mention the percentage. If they mention percentage, fun is gone. No, marks ಏನು ಕೊಡ್ತಾರೆ. And if not, no, they should give a drawing of an image and ask you to identify the percentage. That is not possible. So usually they'll ask what method? Expenditure incurred method. Let's say total contract cost is 100, you incur 20. 20 by 100, 20% complete. Next they say, first is they'll say total contract cost is 100, cost incurred is 20. How much complete? That is one way. Another way is they will tell cost incurred 20, expected cost to be incurred 80. Avag heli, cost incurred is how much? 20, expected cost to be incurred 80. Andre total cost eshtayitu? 100. Sometimes they'll give total cost, sometimes they won't give total cost. They'll tell cost incurred and cost to be incurred. Can you find the total cost? Very simple, cost incurred plus to be incurred is total cost. 20 plus 80, 100. 20 by 100, 20%. You get this? Second year ಅಲ್ಲಿ cumulative ಇರುತ್ತೆ, be careful. Second year when they say cost incurred 30, to be incurred 70, 30 incurred, 70 to be incurred, total 100, 30 by 100, 30%. 30 by 100, 30%. 30% is after completion of 2 years, not for year 2. After year 1 you recognize 20, at the end of year 3, at the end of year 2 it is 30, second year completion is 10%. Should remember that. Understood? Very good. So remember, all the questions that you get in your exam will be on which method? Cost incurred to total cost method. Cost incurred to, very good. Next is contract expense. Contract expense ಹೇಗೆ recognize ಮಾಡೋದು? Very simple. It should be recognized when incurred. If you incurred the expense, you should recognize. If you give an advance or not, you should not recognize. Let's say I have given you the construction contract. You do construction, you don't do electrical work. You appointed one subcontractor, you gave him 10 lakhs, he has not done the work yet. Is that 10 lakh your expense or not expense? Not an expense. Why? You've given only advance. What if your subcontractor has done the contract work for 10 lakhs, you have not given him money? Expense or not expense? Expense. It is expense when it is incurred, not when it is paid. Even if it is not paid, if it is incurred, it is expense. Even if it is paid, it is not incurred, it is not expense. In the big questions, the small adjustment will come. Advance paid, expense not expense. Not an expense. Sir, we have already paid money. No, even if we don't take service, that money is gone. No, you might use him at some other construction place. You have given him 10 lakh advance. If not here, you will use him at some other place. So advance given is not expense. Advance not given, but work done, expense. Understood that? Very good. So direct cost, it will include all the direct costs that you incurred for material. And then for allocable cost, allocable cost means what? It is not direct, but it can be allocated. For example, you have 3 construction sites, you are running 3 contracts, ಒಂದು ನಂದು ಇನ್ನೆರಡು ಬೇರೆಯವರು. You appointed one chief engineer. This chief engineer, morning 9 o'clock to 10 o'clock construction site number 1, 12 o'clock to 3 o'clock construction site number 2, 4 o'clock to 6 o'clock construction site number 3. Now whatever salary you pay to this chief engineer, it is not direct to any construction site, but it can be allocated to all the 3 construction sites. Or let's say 2 days in a week he'll go here, 2 days he'll go here, 1 day he'll go to that site, rest of the time he'll sit in the office. So based on the man hours or based on the man days, can you split that engineer cost? Site engineer cost, not the office engineer cost. Not the engineer who sit in the office and then draw the tables. The engineer will visit the site. No, on-site engineer irtaralla. Can you allocate his cost? Yes or no? Yes. Or you have one JCB machine. You have one JCB machine that is there, that will be used commonly for all the construction sites. Based on number of days that you send that machine to that place, you charge depreciation on that machine to that construction site. Can you do that? Yeah, because if you would have not owned that machine, you would have taken it on rent. This construction site 10 days you took that machine, that construction site 8 days, 8 days rent, 10 days rent allocate ಮಾಡ್ತಿದ್ರಲ್ಲ, depreciation of that machine also should be allocated to each of the construction sites based on this. That can be the other cost or allocable cost. So any expenditure which is directly incurred or which is allocable or which is other cost should be taken care. But general cost, whatever is there, administration cost, office expenditure, your CEO office, your board of directors sitting fees and all of that, or S&D overhead, your receptionist expenditure, pre-construction cost, all of this should not be considered. When I say pre-construction cost, there is one important thing that you should note. Pre-construction cost is actually not part of the cost of the contract. It should not be allocated to that specific contract. It should come in general PL. However, if it fulfills IMP condition, if that cost is specifically identifiable to that contract, it can be measured, and because of that contract, because of that expenditure, it is probable that you will get that contract. That should be allocated to that contract. For example, you are applying for one contract for building the bridge over the ocean, high seas, marine bridge you are constructing. That marine in the ocean you will construct one bridge, no, that Mumbai and Navi Mumbai is there, no, you are applying for that contract, but that will be allocated to you only if you have two marine experts in your team. Marine experts means who understands. Let's say two people should have done one degree on marine life, because you're constructing there, no, in that marine life will get affected. So two people should have done one certificate course on marine life, and they say that. So what do? Two of your engineers, you send them to do one marine life course. Why? Exclusively for this contract. Is it identifiable? Can you measure the cost? Because of that, is the probability of getting the contract becoming more? Yes. So that can be allocated to that. Or you have no past experience of building one bridge over marine, what to say, in the marine. So what do? They tell that you should buy some marine technology. So in the Japan, you know one engineering company which has built bridge over in the ocean. So you buy their marine technology, marine construction technology, know-how, technical know-how, how to construct. You buy the intellectual property from them. That whatever intellectual property you buy from them, it is bought specifically for this contract, identifiable. Money that you paid for that contract is measurable. You get this? Maybe they can say, we will give you the technology. For every kilometer you construct using this technology, you should give us 15 lakh rupees. Measurable, no, still. And probability of getting this contract will become more because of that expense. So if it fulfills the condition, identifiable, measurable, and probable, such cost can be added to the cost of this contract specifically. If not, then it is treated as pre-construction contract, which will go to general P&L, and it will not go to that contract specific P&L over now. Are you getting it? Are you able to get the holistic understanding of A7, guys? Good. Last point. How do we recognize the profit? Very simple. If you observe one trading or P&L account, ignore construction contract. If you imagine one trading or P&L account, credit side you write sale, debit side you rate purchase, difference will become profit. Credit side you rate income, debit side you rate expense, you get profit. To the extent expenditure is incurred in the current year, you write expense, no. That expenditure incurred plus expenditure to be incurred will become total. In the numerator, will take expenditure incurred, you will get percentage completion. That percentage you apply on total contract revenue, will get contract revenue to be recognized. Will take contract revenue to be recognized on the credit side, contract expense on the debit side, difference will become contract profit or loss. Difference will become contract profit or, I'll give you an example. 100 crores contract revenue, sorry, 100 crores contract cost, 120 crores contract revenue. How much is contract expense? 100. Contract revenue 120. Let us say 50% of the contract is complete. How much is complete? Contract expense is 100, no. Expense you write 50. Revenue should book 50%. 60. 50, 60, 10 profit. Total profit is how much from the contract? 20, no. In that 50% is how much? 10. That's how you book 10. Expense is the basis. On the basis of the expense, you determine percentage of contract complete. That percentage on total, if you apply, you will get contract revenue to be recognized. Then you will get balancing figure as contract revenue or contract profit to be taken. You get it? This is subject to one beautiful paragraph called para 35 of accounting standard 7. Most important paragraph. What is it? Para? Only two concepts left. Para 35 of accounting standard 7 says, if in case at any point of time during the entire construction contract, if in case at any point of time during the construction contract, you feel that your total contract cost is going to exceed total contract revenue. I repeat, if at any point of time you feel that total contract revenue is going to, sorry, total contract cost is going to exceed total contract revenue at any point of time, total contract cost will exceed total contract revenue, you book entire loss. You book, sir, but percentage, no one cares. Book entire loss. Let's say your contract cost is 100 alva, contract revenue is 120 alva. Let's say this was the initial estimate. Later you understood that when you're digging the ground to put the pillar, rocky boy sikkudru, rocks. So what happened? Now your cost is not 100, cost is 150. Revenue estu? Cost estu? So you'll make 30 crores loss. Oh my god. You'll make 30 crores, book entire 30 crores loss. because contract cost is 150, contract revenue is 120. 30 crores loss, no, book entire 30 crores loss. But I have not started the contract yet, doesn't matter. Entire loss of 30 crores has to be booked irrespective whether the contract has been started or not, irrespective of percentage of completion. Number 3, profit from other contracts. Let's say this contract will 30 crores loss ಆಗ್ತಿದೆ ಅಲ್ವಾ, I am the person who gave you the contract. I'll be like, you are sorry, you are making loss because of me, but don't feel bad. You do the contract with full heart. Next 2-3 contracts I won't call tender, I'll give it to you only. In that each of the 3 contracts I'll give you 10 crores extra revenue to cover up this loss. I have promised this to you. I have promised this to you. Will you still book loss? Yes, you would have to still book loss immediately, full amount also. Contract is going to take 4 years to complete. Don't say that loss no, I'll record 25 every year. No, full loss first year only. Even if you have not started, even if I promised you that I'll compensate. Are you getting it? Sometimes they'll make the question tricky by telling you that you are a new contractor, I am a very rich person, so in order to become my friends, you are intentionally taking one contract at loss so that I will feel like you charge the cheapest amount of money. So next time onwards, even if you charge me high, I'll still give it to you because first contract you did it at loss. So even if your intention is to make huge profits in the further contracts by making loss in this contract, still entire loss has to be booked. So remember this, read this last point. What does it say? If total contract revenue exceeds total contract loss, sorry, total contract cost exceeds total contract revenue, record entire loss, record irrespective of the fact whether construction is started or not, stage of completion, and profit from other contracts. Nothing you will consider, you will book entire loss from the contract. You got this? So sir, how will it work? Very simple. Let's say 50% of the contract is over. How much is over? Contract revenue is 120, contract cost is 150. Contract revenue 120, contract cost 150. So if you open your contract PL, contract revenue, contract expense ಎಷ್ಟು ಬರೀತೀರಾ? 150 ಅಲ್ಲಿ 50%, no, you will write 75 ಅಲ್ವಾ? Contract revenue 120 ಅಲ್ಲಿ 50%, how much? 60. You write 60 here, 75 here, balancing figure here is 15. Why? Total contract loss is 30. In that only 50% is complete, only 15 loss ಬರುತ್ತೆ. Should write here 30. If you write 30 here, balance 15 difference on the debit side will become provision, because you have not incurred loss. You are going to incur the loss in the future. For the loss that you're going to incur in the future, you are making provision right now. For the loss that you're going to incur in the future, you're going to make provision now. That will become provision for loss. Understood this? Last point, some questions they can ask you to compute amount receivable or advance from customers, asset or liability. Very simple. This is not at all tricky, very easy part. If they ask this, it is lottery to you people. How should you remember? You are constructing building on my behalf. What should you recover from me? Any expense that you incur, you should recover from me. Your expense you will charge me. Expense ಮಾತ್ರ ಇಸ್ಕೊಳ್ತೀರಾ? You will recover profit also. Expense that you incurred plus profit ಅಷ್ಟು charge ಮಾಡಬೇಕು. If there is loss, it is loss because you have incurred expense, but I will not pay money. Contract revenue is 120, contract expense is 150. How much is loss? ಯಾಕೆ? You will incur 150 crores to construct, but I will pay you 120 crores. Correct alwa? So you should receive 150 crores minus 30 crores. 120. Sir, isn't it easy? Straight away I can take 120. Hey, we're talking about middle of the year. At the end of second year, total contract period is 4 years. What do you do at that time? Contract expense incurred plus contract profit earned, or contract expense incurred minus contract loss incurred. Loss based on PCM. You will also deduct provision for total loss. You will also deduct provision for total loss. Basically, expense plus profit or expense minus loss. Whatever you get, no, that is the amount that you should charge me. That is the amount that I should pay. If you already charged me some money and I've already paid you some money, deduct that. That is called progressive billings. Already charged some money, I've paid, deducted. If the resulting number is positive, that means you should charge me, I should pay you. To you, it is asset. If the resulting number is negative, that means you have charged me more. I have paid you more. To you, you have charged me more than what you have done. So liability is on your side. That's liability. So what is this? Expense plus profit minus loss minus progressive billings. If you do, if the number is positive, it is asset to you. If the number is negative, it is liability to you. Ashte. Based on this, you can do every other question. One thing that you should remember is it will be cumulative. That contract revenue, contract expense will be cumulative. Decumulate ಮಾಡೋದು ಮರಿಬೇಡಿ. Meaning, when you say 20% at the end of first year, 35% at the end of second year, first year 20% is booked, second year 35 only 20 is already booked. When you apply 35% on revenue, deduct 20 already booked and balance you write. Both for expense and income. You get it? That's it. So by this, we are done with accounting standard 7. I hope you people enjoyed it. I hope you people understood it as well. Can I take you all to AS9? Pakka? Sure. Let's go. Accounting standard 9. Accounting standard 9 talks about revenue recognition. What does it talk about? Very good. See, AS9 talks about revenue recognition, but it excludes certain revenue recognitions. It excludes revenue recognition from construction contract. Why? There is one specific standard 7. It excludes revenue recognition for leases. Why? There is AS19 separately which will tell how to recognize revenue. It will again exclude AS12 government grant and insurance contracts. Insurance contracts are not covered under any other standard. There is one separate Ind AS 104 or 104 ಅನ್ಸುತ್ತೆ that is issued, which is now applicable. But ASL insurance contracts ಕೆಲವು ಹೇಳೋದಿಲ್ಲ. So insurance contracts are outside the purview. Are you getting it? Because IRDA regulations have to be considered. Whatever premium I receive fully, it's not my income. Why? Premium ಬರೋದು 1 ರೂಪಾಯಿ, claim ಆದ್ರೆ ಹೋಗೋದು 100 ರೂಪಾಯಿ. Correct ಅಲ್ವಾ? So I have to keep certain part of the premium aside. So insurance contracts are very special contracts. They are not considered here. Under AS, no, this construction, leases, everything is given separately. Whereas if you see Ind AS, no, there is one big standard called Ind AS 115 for revenue recognition. 115, if I'm not wrong. That talks about construction also. There is no separate standard there. That's a very big standard which recognizes almost everything in it. But here we have separate. So what is the objective of this standard? It will tell when to recognize and what is the conditions that it should be fulfilled for you to recognize the income. You make sale. ಯಾವಾಗ ಬರೀಬೇಕು ಸೇಲ್ ಎಂಟ್ರಿ ಟೈಮ್ and what is the condition which it has fulfilled for you to write that sale entry or basically revenue. Now I told you what it does not cover. It does not cover 7 construction. It does not talk about government grant. It does not talk about leases. It does not talk about insurance at the head. What does it talk about? It talks about 3 things, 3 major things which are further classified into, that last item is further classified into 3 more. One is sale of goods, 2 rendering services, 3 other incomes like fetching royalty, interest and dividend. I'll tell you, it talks about how many things? 3 things. Sale of goods, rendering of services and other income. Other income is nothing but interest, royalty and dividend. It will tell us when to recognize this income. So this is to be recognized that revenue means inflow of cash or receivable. Cash has come or cash is about to come, and or any other consideration. It need not be cash also, non-cash consideration also in the ordinary course of business. If you're selling the asset and you're receiving money, AS9 is not applicable to you. If you're selling an asset, PPE and receiving money, AS9 is not applicable. AS9 is only for sale of goods, rendering of services or royalty, interest and dividend. For sale of goods, see, sale of PPE, liability settled against restoring when carrying amount, forex, translation difference, all of this AS9 is not applicable. You see AS11 or you see AS10 to recognize that. Got it? Now let's quickly start with the first part, sale of the goods. When you sell the goods, when do you recognize the income? Very simple thing. You need to recognize income on transfer of 3 things. On transfer of how many things? Risk, reward, effective control. Risk, reward, effective control. Risk, reward, effective control of the product is transferred, then you recognize income. Risk, reward and effective control of the item is transferred, then you should recognize the consideration. What should you recognize? That consideration, whatever you are supposed to receive. But there are some special considerations. There are some special contracts. What are the special contracts? There are some situations where it's a special order. It's not a normal product that I sell. It is specifically made for you. You give now sofa. I don't do it usually. I show you one model one. If you ask 3-seater, I'll do 3-seater. If you ask 4-seater, I'll do 4-seater. You say with reclining, I'll do with reclining. You say without reclining, I'll do without reclining. You say inside what kind of material you want, also you pick. On the top fabric, what you want, also you pick. Height you pick, width you pick. So it's a special item, no? Once you place the order, I will do. You get it? For this, you won't go by the general rule of risk, reward, effective control. Risk reward effective control is for general things. If it is a special order, whenever the goods are ready, I'll recognize revenue. Andre, you gave one specialized order. ನಿಮ್ಮ ಮನೆಯಲ್ಲಿ ಗೋಡೆ ಇಷ್ಟು ಅಗಲ ಇದೆ, L shape ಇದೆ, you want L shape sofa, this variant, this material inside, this fabric on the top, this height, this width. You asked. The moment the product is ready, I should recognize revenue. Why? I cannot sell it to anybody else. I have not delivered it to you yet. Have I delivered? Effective control is not yet transferred. Risk and reward is still with me. I have not transferred it to you, but I will still recognize revenue. You know why? Once you make that product as per my order, you will say, if I say beda, will you agree? Chanag baratte ankondi, ee tara baratte ankondi, nange beda. If I say will you agree? You will like, no way. You would have collected money from me in advance. In fact, though you have collected money from me, now today I gave the order. Today I gave the order. Will you recognize revenue today? No, you cannot recognize revenue today. Why? If you don't deliver the product, you have to reverse that money to me. No, income book maadi reversal of income bariyodilla. You won't recognize that income. You will write it as advance receipt. When will you book that income? When the product is ready. Or you're making one cake. I gave you 1,000 rupees advance today to make the cake. I've told cake nange star shape irbeku. Round ಬರುತ್ತೆ, circle round ಬರುತ್ತೆ, box ಬರುತ್ತೆ ಅಲ್ವಾ, ನನಗೆ ಸ್ಟಾರ್ ಶೇಪ್ ಅಲ್ಲಿ ಬೇಕು. You are agreeing to do it. So I gave you 1,000 rupees. When will you book the income? The moment the cake is ready. The moment the cake is ready. You agree with me? Then second thing, certain things are based on installation. Certain things are based on, now certain products, now I need to come and install only when the product is ready. Now the product is there in dismantled condition. So if the asset is based on installation, sofa is not based on installation. It is ready. Illing kanatto, in your home also it will look like that only. Now some interior, false ceiling or some TV unit, I need to come and install it. So then when should I recognize the revenue? It should be based on buyer satisfaction. I bring it and install in your place. If you are satisfied, you will give me consideration. If you don't like it, you will say, no, it's not looking like how it's there in the image. I am not satisfied. Take it back. If you tell that, then I won't recognize income. So if it is based on installation, then buyer satisfaction. If it is customized, then it is when the goods are ready. Then if it is subject to inspection, then when the buyer approves it. If it is sale on approval basis, when the buyer accepts it or the time to accept lapse or time to return lapses. When the buyer accepts it or time to return lapses, or when the time to, I'll tell you, you take it, sir. If you don't like it, you give it back. But within 15 days, you should give. 16th day, even if you are not happy, it is sales only. I should recognize revenue. We've done this in goods sent on return or approval. If you learned under old scheme. If not, also when you did valuation of inventory, you would have still done one adjustment on this. In foundation. Okay, if someone has come under direct entry, don't be scared. Nothing much you missed. Then buyer requires delayed delivery. Meaning I bought the product from you. I am telling you, don't deliver it today. After 1 week you deliver. Why? I am not available at home. Though I am not available at home, though you did not transfer the effective control, it is ready for disposal. No, it is ready for transfer. I did not take the delivery. That does not stop you from recognizing the revenue. You should still recognize the revenue. I gave the product as order. I liked the product. I'm telling I am not available at home. Deliver it 5th of April. 31st of March, your product is ready for delivery. 5th of April, you delivered. Should you recognize it as sales in this year or next year? This year only. Sir, but effective control is not transferred. That is in general case. Usually in an ordinary case, it is risk, reward and effective control. But in a special case, when it is specialized order, when the goods are ready, when it is subject to installation, buyer satisfaction, when it is subject to inspection, buyer's approval, when it is goods or return or approval basis, then when the buyer accepts or when the time lapses, when the buyer delays the delivery, whenever the goods are ready, you recognize the revenue. This is for sale of goods. Next comes revenue from services given. So whenever the services are given, you should see, is the service one single activity or is it multiple activity? It is one single activity, cutting. Whenever the haircut is done, recognize the revenue. It is multiple activity, cutting, shaving, face detan, matte hair spa, hair wash. Then what do you do? One of the activity recognize revenue. Usually that it's not the problem because entire service is done in one single day. However, what if the service is given over certain months? Then you will book the revenue as and when that service is complete. If it can be apportioned into different contracts. If it is one single thing which cannot be separated, then you will recognize it at one single thing on completion. Service will be recognized on completion, on service completion. Half service complete I would recognize madakagala. Are you getting what I'm trying to tell? And if it is more than one activity, proportionate service. 1 out of 4 services done, recognize that revenue. 2 out of 4 services done, proportionately you recognize revenue. Are you getting it?
Service, but it's done in installments. Like, for example, root canal.
Ah.
Root canal is done in like 4 installments. Like, of 4.
Now, can we negotiate and can we enter into 4 different agreements for it? Answer is yes. But I've entered it. See, let's say you need to have 4 sittings. I am a dentist. So 4 sittings. I can negotiate for each sitting 10,000. What did I do? I wrote it in one single contract of 35,000 and collected entire 35,000 from you. One sitting is over. When one sitting is over, balance 3 sittings money what I've collected, it is refundable to you if in case you don't come. Correct? No. So then I should recognize only first sittings money I should recognize as revenue. Balance 3 I should treat it as advance. However, I will say in my dental hospital, we put one board, fees once given will not be returned. You don't come 3 more times, your problem. So what will I do? Then the moment I recognize it, the moment I receive it, it is my income. Because I don't have a responsibility to refund that money to you. You have agreed to it and signed no in the fees receipt when you paid me 40,000, 35,000. So entire 35,000 I'll book it at the beginning only. Why? I have a right to receive that money. That's the next thing. See here. Special cases requires client approval. Whenever the approval is received, subject to specific task, when the task is complete. It is subject to specific task when the task is complete. It requires client approval when the approval is received. Timing for recognition based on the question what she is asking based on root canal. Significantly certain. Recognize the sale on rendering the service. If in case it is not refundable, I can recognize the entire income upfront. But still the correct method is treat that balance as advance only and then recognize it. However, if there is no obligation on me to refund that money, what can I do? I can book the entire money. I can book the entire money as my income. You get it? Very good. So we spoke about service here, no? Then comes the last part: interest, royalty, and dividend. Interest, P into T into R, no? Principal into time into rate based on time. 6 months over 6 months interest you record. 3 months over 3 months interest you record. Interest is recognized based on time. Interest is recognized based on time. What about royalty? Royalty is based on the agreement. What is the agreement that we have with you? Let us say I have a book. I have written a book. You are taking the responsibility of publishing the book and selling the book. You should get revenue. You will get revenue on the sale of my book. You are sharing it with me. I have told 20% of the sale price is my revenue, is my royalty. How much? 20%. But what if you sell less books every month? Because you are not marketing properly. I'll say 20% subject to minimum amount of 1 lakh every month. 20% subject to minimum of 1 lakh. However, it is subject to recoupment. If you would have done in BCom, you remember no recoupment. Minimum rent to, dead rent to, short workings. Short workings, I'll explain. Let's say you need to pay me 20% of the revenue or 1 lakh. 1 lakh is minimum rent. Alva. Let's say you sold 5 lakh rupees revenue you made by sale of book. 20% is 1 lakh. You need to pay me 1 lakh. Let's say you sold books of 6 lakh. 20%. You need to give me 1 lakh 20. You gave 1 lakh 20. What if we sell books of 2 lakhs? 20% is 40. But you still pay me 1 lakh. But you still pay me 1 lakh. 60,000 I will allow as short workings. Meaning you have not sold the book but still you paid me the money. Next month, if in case you sell 5 lakhs, 6 lakhs worth of books, you should pay me 1 lakh 20, no? In that 20,000, I will not say, okay, last month you paid 20,000, we'll adjust it there. Minimum you should pay 1 lakh, no? That 20,000, last month you had paid how much? Some 60,000 you had paid extra, in that 20 gone. Still 40,000 short workings available. Next 2 years we'll adjust. I can tell short workings allowed up to 2 years. Fixed period of 2 years, floating period of 2 years. You have all of this in BCom. Previously, it was there in CA Foundation. In 2019, they removed it. 2016, new scheme of education was introduced in CA Foundation. Royalty accounting, ratio analysis, all of that was there in CA Foundation. 2019, they removed it. But I'm telling you, you would have learned it in BCom. So all that I'm trying to tell you is royalties, it is based on the agreement, what I and you agree upon. Based on that, the revenue should be recognized. Last one is dividend. Remember, dividend is very, very simple. When the right to receive is established, when should recognize dividend income? When the right to receive is, when is the right to receive of dividend established? When it is declared. Let's say you are an investor, you have shares in my company. I have done proposed dividend in my books. Will you recognize income? When will you recognize? When I declare, not when I propose it. Are you getting it? So dividend income should be recognized only when it is, not when it is proposed. Now the question is timing of recognition of revenue. When to recognize? Timing. Very simple. Whenever there is significant certainty and right to receive. Whenever there is significant certainty and right to significant certainty ಇಲ್ಲಿ ಕಲಿತಾ ಇದೀವಿ. Right to receive ಇಲ್ಲಿ ಕಲ್ತಿದ್ದು. When do you have right to receive money? In the case of special order, you have right to receive when the goods are ready. In the installation based contract, you have right to receive when the installation is complete to buyer satisfaction. In the case of goods sent on return or approval, you have a right to receive when the product is accepted or time has lapsed. Alva. So right to receive is established here, and you will recognize only when you have significant certainty. Let us say you have not received money. You have not received money, but you are significantly certain that you will receive money. Can you recognize income? Yeah, because recognition of revenue is on accrual basis, not on cash basis. Somewhere you feel some smoke, some way, somewhat you feel like this guy will not give money. That means there is significantly uncertain. There is no surety that he'll give. Then what do? Even though you have right to receive, you will recognize only when they give. When there is significant uncertainty, what do? Though you have right to receive, though the service is complete, you will recognize only when the money is received. Then comes a beautiful scenario. Work is complete, whether the goods are sold or service is given or interest earned. What did you do? You recorded the money because right to receive is there. In the beginning, no trigger is there. It triggered. You assumed it is significantly certain and you recorded it. Subsequent year, they did not pay. Now it is significantly uncertain. What do? Reverse the income. Reverse the income by creating provision. See here, significantly uncertain. Recognize only when there is significant certainty. If already recognized, then what do? Previously you booked as income, now charge it to P&L and create provision against it. Again, when it becomes significantly certain, then reverse that provision and book that income. If not, written off loss. Understood? Finally, disclosure requirement. What is the policy that you are adopting? You should disclose what is the change in the policy. For example, in your entity, the service, the goods that you are selling is based on inspection. Revenue will be recognized on the inspection of the customer to the satisfaction of the customer. Should disclose it. However, later you say, no, ours is based on installation, but it is product is customized to the customer's benefit. So we are now changing it. Anymore, we will not book it on installation because our policy is once we install, whether the customer likes or not likes, he has to still pay money. So then what do? You are changing your policy to recognizing the revenue from point of installation to point when the product is ready. So then what do? You're changing the policy. No, you have to disclose that. So what should you disclose? Two things. One, what is the policy that you're adopting? Number two, what is the change in the policy that you are basically done? Got this? Pakka? Everyone? Very good. This is the end of accounting standard 9. Can we go to accounting standard 10? Come on, let's discuss accounting standard 10, which talks about property, plant and equipment. Accounting standard 10 talks about property, plant and equipment. To begin with, to call an item as PPE, it has to fulfill certain conditions. Basically, the definition criteria. Number one, tangible. It should be tangible. It should have physical existence. If it doesn't have this tangibility condition, even if it fulfills rest of the conditions, it will become AS26 intangible asset. It will not become AS10 tangible asset. So to be calling it a PPE, it should be tangible. Then the second thing, it should be used for one among these three purposes. RAP. It should be one among these three. It's not all three. It should be used for rental purpose. It should be used in administration or for production of goods and services. So it should be tangible. It should be used for rental, administration or production of goods and services. Then production of goods or rendering of services. Last one is its expected useful life should be longer than one accounting year. Longer than 1 year. Only then it will be called as PPE. So very good. Tell me, what is the condition to call an item as PPE? Number one, tangible. Two, one among RAP, rental, administration purpose, production of goods or rendering of services. Last one, expected useful life from this asset should be longer than one accounting period. Next one. So this accounting standard 10 will not apply to biological assets. Sir, but I can touch the cow, but it's not your item which can be considered as PPE. Biological assets will include two things. One, living animal, living plant as well as andre animal living animal itself is living. So living plant and animal, both of these are called as biological assets. For biological assets, AS10 is not applicable. However, exception is bearer plant. Sir, not apply antira, exception antira. Usually it is not applicable to biological assets. Exception bearer plant means for bearer plant, AS10 is applicable. For biological assets, not applicable. For bearer plant, AS10 is applicable. What is bearer plant? Bearer plant is a living plant. Bearer plant is a living plant. It is used in production of goods or rendering of services, that supply of agricultural produce. That living plant should give agricultural produce. That itself should not be agricultural produce. And the possibility of selling itself as agricultural produce should be very remote. Mango tree is a bearer plant. Why? Mango tree will give mango. Mango is agricultural produce. We sell mango, not mango tree. We might cut the tree and sell, but that is very remote possibility. We don't grow the mango tree for its wood. We grow the mango tree for its mango. Timber, mahogany, all of these are not bearer plants. Why? You grow it for the sake of the wood. It doesn't give you agricultural produce. Itself is agricultural produce. You grow sandalwood tree not because you cut its branches and then sell. No, you cut the tree only. It itself is the agricultural produce. When the tree itself agricultural produce, it is not to be considered as bearer plant. Banana tree, banana plant. Okay, banana plant. Is it bearer plant or not? Not a bearer plant. Why? Once you take one cut of bananas, no, you cut the tree. You cut the tree. You will not let it grow because it doesn't have the strength to bear bananas once again. So once that one lot of bananas is done, no, that tree will be cut. And the tree is also an agricultural produce. So the objective is not just banana, but the plant also. You got it? So, and that plant should sustain for more than 1 year. Now you cannot say, sir, paddy is there. No, sir, that is bearer plant. Why? From paddy, you take only the top part, sir. Rest of the plant is the plant from that you get. No, you cut the plant only, no. And plant only, once you take the paddy, remaining will it still stay and give one more raise of paddy? No, you cut it. Wheat, cut. Sugar cane, cut. Ragi, cut. Corn, cut. All of this done, no. Potato, onion also. Full pluck, no. Roots ಅಲ್ಲಿ ಇರೋದು. You take the plant out, potato ತಗೊಂಡು ಮತ್ತೆ plant ಹಂಗೆ ಇಡ್ತೀರ. Where did you do your farming from? ಹಂಗೆಲ್ಲ ವರ್ಕ್ ಆಗಲ್ಲ. So these are all not bearer plants. It is called as a bearer plant when it is a living plant. It is used in production or supply of agricultural produce. It will bear produce for greater than one accounting period. And there is very remote likelihood of it being sold as agricultural produce. Fatafat, some 3 examples for bearer plant: coconut tree, and then areca nut, and then mango tree. Tell something more. Date palm. Okay, she's telling from the place where she comes from. Then grape vine. Anna correct ಆಗಿ ಹೇಳ್ತಾರೆ. Grape vine. You take the grape, you leave the plant like that only. Why? ಮತ್ತೆ grapes ಕೊಡುತ್ತೆ. Correct or not? So all of these are our bearer plants. So for bearer plants, AS10 is applicable. For other than bearer plant, rest of the agricultural produce, AS10 is not applicable. Then wasting assets, meaning coal mine, oil well, gold mine, iron ore, quarry, stone quarry. For all of this, AS10 is not applicable. AS10 is not applicable for mines, ores, wells. You got it? It's not applicable for biological assets. Exception, bearer plant. Lastly, items which are covered under other accounting standards. AS19 specifically talks about leased assets. Don't apply AS10. Got it? If there is any other asset, inventory specifically covered under AS2, don't apply this year. So if there is any specific investment, share certificate, either sir, it is tangible. Yeah, it is tangible, I agree. But there is a specific standard 13 covering that investment. Don't cover under AS10. If there is a specific standard covering it, don't apply the generic standard what is there here. Is that okay? Very good. Let's go to the next part. Recognition of PPE. When do you recognize PPE? It should fulfill 2 conditions. First, definition. If the definition is fulfilled, it is PPE. Recognizing that PPE in the balance sheet as an asset is on fulfillment of these 2 conditions. Number 1, future economic benefit should come from this asset. If it fulfills the definition criteria but there is no future economic benefit, write it fully in this year only as expense. If it is going to reap benefit in the future, then you will not write as expense in P&L, you will write it in the balance sheet because next year you go balance carry ಮಾಡಬೇಕು. Second condition is that reliable measurement. You should be able to reliably measure its value. If you are not able to reliably measure its value, then you cannot write that asset in the balance sheet only, because no monetary representation means not an item in balance sheet. Balance sheet or basically accounts is based on quantitative representation. Qualitative factors doesn't really matter. So there should be reliable measurement and there should be future economic benefit. We tell this FEBRM. Future economic benefit should be there and reliable measurement is there. Only then it can be recognized as a tangible asset, that is PPE. Otherwise, no. It should fulfill definition criteria. Then it should be giving you future economic benefit and reliable measurement. If there is any spare parts or standby equipment, it will be considered as a part of your PPE if it fulfills definition criteria. And what about recognition? There are two types of recognition: initial recognition, subsequent recognition. Initial is right now when you incur the expenditure, it is initial recognition. After that, if it undergoes some major repairs, and if that repair expenditure is giving you future economic benefit and it can be reliably measured, that repair expenditure will not be written to P&L as expense. Instead, what do? You capitalize it. That repair expenditure will not be written to P&L account as expense, you capitalize it. If you capitalize that expenditure, then it will be considered as subsequent recognition. What will it be? For an item to be called as subsequent recognition, it doesn't have to fulfill definition criteria. Why? Definition criteria ಆಗಿದ್ದಕ್ಕೆ ಅದು asset ಆಗಿದೆ. For subsequent recognition, you only check these recognition criteria. If there is future economic benefit and reliable measurement, such an expenditure what is incurred will not be expensed, it will be capitalized. It will not be expensed, it will be capitalized. You run one bike, it is your PPE. Small repairs you got an air filter, brake shoe you got it changed, expense. You got the engine changed, capital. Why? With that engine there is future economic benefit and that money can be reliably measured. It is huge amount of money. Entire asset is nice, engine ಮಾತ್ರ ಹಾಳಾಯ್ತು. ಒಂದು 40,000 ಕೊಟ್ಬಿಟ್ಟು engine change ಮಾಡಿಸಿದ್ವಿ. That 40,000 will be added to the cost of the machine and that 40,000 will be depreciated over the remaining useful life. Are you getting it? So that engine doesn't have to fulfill your asset criteria, tangible asset definition criteria. No, it has to fulfill only recognition criteria. Now, talking about the cost of the asset, there are three phases in which the cost will be incurred.
Spare part from the loose tools we saw in AS2.
Loose tools can be used for multiple things. Spare parts, if it cannot fulfill the definition criteria, will record it as per that AS2. If it fulfills definition criteria, then it will be considered as AS10 PPE. Let's say there is one certain spare part that comes on big machine like a ladder, that can be used for multiple things. No, it has an extended useful life also. You can treat it as a PPE. If it comes one big spanner comes which cannot be used for anything other than this, then it will be, what to say, your loose tools in AS2. So it has to, if it fulfills definition criteria, it becomes PPE. If it doesn't fulfill AS10 PPE criteria, then it will be recognized as per AS2 based on the consumption value. Got it? Very good. And same with regard to standby and service equipment also. Cost, no, there are three forms of cost that is incurred for PPE. Number one, purchase price. Number two, directly attributable cost. Number three, other cost. It's all similar, but small amounts of items are difference between AS2 and AS10. So AS2, AS7, AS10, all the three places we discussed definition of cost. But there is small element of difference in each of the cases. Okay, you identify the difference later. Talking about purchase price. To purchase that PPE, whatever money you paid is purchase price. You get it? If you give cash consideration, you take that cash consideration. If you give non-cash consideration, I'll tell you what to do. We'll discuss that slightly later. You should check for commercial substance. And whenever you are paying cash price, you'll take cash price. If in case you're deferring the money, not paying in one installment, you're paying it in 5-6 installments, then the money that you pay might not be cash price. It will be slightly more than cash. It will include interest element in it. Such interest element should not be included prima facie into the cost. Let's say I'm giving you the asset for 5 lakh rupees. 5 lakh immediate kodbeku. 5 lakh is cost. I'll say, sir, you take the asset and go. You give 1,20,000 rupees 5 times. 5 installments of 1,20,000, 0% interest. I will tell 0% interest, but I'm giving you I'm asking you to pay 1,20,000 5 times. 1,20,000 5 times is 6 lakh. You will ask, sir, 0% interest beda. I will pay right now. How much will you charge? I'll say, sir, ಈಗಲೇ ಕೊಟ್ರೆ ಸರ್ ನಿಮಗೆ ಒಂದು ಕ್ಯಾಶ್ ಡಿಸ್ಕೌಂಟ್ ಹಾಕ್ಬಿಟ್ಟು 5 lakh ಮಾಡ್ಕೊಡ್ತೀವಿ. Then actually the price of the asset is 5 lakh. I don't want to book as interest income. So what am I trying to tell? I'm telling you that it is, what is a 0% interest, but consideration is 6 lakh. But cash price is how much? 5 lakh. That 1 lakh, no, even if I call 0% interest, that 1 lakh is in the nature of interest. So what should you do? Should record the asset at cash price. You are buying the asset with installments. You are buying the asset with 5 easy installments of 1,20,000 each. 6 lakh you are paying, but still you ask them what is cash price. They'll say 5 lakh rupees cash price. Should record the asset at 5 lakh, 1 lakh is interest. Sir, can I record that 6 lakh? That 1 lakh can be capitalized to the cost of the asset, provided it fulfills the conditions as per AS16 that the asset is qualifying asset, which we don't know right now. We'll discuss later. Got it? So even if the asset is purchased on deferred credit installments, asset has to be recognized at cash price. Understood this? Then comes interest. What if there is interest? Interest can be capitalized subject to accounting standard 16. As per AS16, if it fulfills the conditions, take it. If it doesn't fulfill, don't take it. As sweet and simple as that. Taxes. What about taxes? In GST, you read no input tax credit available, not available. If it is included in the cost, input tax credit not available. If it is not included in the cost, input tax credit available. Have you read like that? Accounts are ulta. If input tax credit is available, don't include it in cost. If input tax credit not available, then include it in cost. Sir, then who will tell? So basically, GST law should tell if input tax credit is available to you, then you should check no, is it incidental to business? You get it? So is it not under blocked credit? Have you purchased it from a registered dealer? Is the asset used for business purpose? Is the asset installed in the business premises? Do you have the invoice with you? Adella conditions ಇದೆ ಅಲ್ವಾ, conditions for claiming input tax credit. If all the conditions are fulfilled or expected to be fulfilled, and that person who took money from you, is he going to pay that and then disclose that all the conditions? You should check. If that is fulfilled, then you are claiming input tax credit. Then the asset will not be taken with input tax. Let's say 1 lakh is the value of the asset and 12,000 rupees is GST. Should record the asset at 1 lakh, not at 1 lakh 12. If input tax credit is available. Let's say you're buying one truck. Alva. Input tax credit allowed, not allowed. Not allowed. Blocked credit. On automobiles it is blocked credit. No. Food, automobile, fuel. Oh, in the group 1 tax.
Motor vehicle is used for transportation of passengers.
I am not selling motor vehicles. No. If I am selling motor vehicles, then it will not be AS10 PP. It is AS2 inventory. I am obviously using my truck for the purpose of giving services or selling goods. Obvious, no? Simple basic logic. On truck, I will be allowed GST credit only if I am a trader in trucks. If I am trader in trucks, my truck purchase will be inventory. The moment you treat the truck as AS10 PPE, input tax credit is not available. I'll tell it to you openly based on accounts knowledge. So then block credit. So what will I do? Input tax credit not available. I'll write that entire GST amount also as a part of my cost. If input tax credit available, then I won't include it. I'll exclude that GST portion and write the value of the asset. Understood? Then comes the most interesting part. What if there is non-cash consideration? We'd have to check whether the commercial substance exists or the commercial substance does not exist. If the commercial substance exists, andre enu? What do you mean by commercial substance? Using the asset that I have before exchange. Andre, I gave this and I'm taking this from you. So before exchange, I have this. Using this, I will generate some cash flows. After I give this to you and take this from you, I will generate some cash flows. If both the cash flows are different, then commercial substance exists. If whether I have this asset with me before exchange or me giving this to you and taking this, cash flows are not going to be any different. If the cash flows are not different, there is no commercial substance. If the cash flows are different, there is commercial substance. Are you getting it? So I'll give you a detailed link on multiple questions on this commercial substance. So please drop a message in the comments. I'll share the link. There is another video on the YouTube only for this commercial substance existing, not existing, no existing. No. About 15-20 minutes video is there. Multiple cases. How many questions? We've done about 6 questions, but it covers very good amount of concept. So whoever is watching it on YouTube, drop a comment asking for this part. I'll share it to you. Yeah, you will get to see that video. Then we'll right now discuss only the overview of it. So all that I'm trying to tell you is, when before exchange and after exchange. Before exchange, the asset that you have is different. After exchange, the asset that you have is different. So before exchange, after exchange, you have two different assets. The cash flows that you're generating from these two assets are different. Then commercial substance exists. Whether you use that asset or you exchange that asset with this asset, cash flows are same. What does it mean? Commercial substance does not exist. When commercial substance exists, cash flows are different. Then you would have to record it at fair market value of the asset given. Priority number one. If fair market value of the asset given is not available, then fair market value of the asset received. You get it? What if both are available? Fair market value of the asset given, priority number one. If this is not available, then this. If both are available, priority is to fair market value of the asset given. If one is not clearly available, then whichever is more evidently available. But priority number one, fair market value of the asset given. Understood? What if there is no commercial substance? Then account at the book value of the asset. Book value of the asset given. E asset the book value again. I should record this asset. Adjustment with cash possible, but there cannot be profit or loss. When there is no commercial substance, whether I use the old asset or I use the new asset, there is going to be no profit or loss. No profit or loss. There is going to be no cash flows changing. So I cannot book profit or loss. Artha ಮಾಡ್ಕೊಳ್ಳಿ, whether I use the old asset or whether I use the new asset, there is going to be no change in cash flows. Then what should I do? I should not book any profit or loss. I should not book any profit or loss. However, if I use the old asset, cash flows are different. If I use the new asset, cash flows are different. Then it is actually like I'm not exchanging. I'm selling the old asset to you and I'm buying the new asset from you. So it's actually like two different transactions. On the sale, there is profit, and the new asset has to be recognized at some value, fair value. Are you getting it? So if the cash flows are different, there can be profit or loss. If the cash flows are not different, there cannot be profit or loss. So, or if not, just search for AS10 PPE accounts man. You will get that one more video. 6 sub questions are there. You do those 6 questions, you will be thorough with this. And again, a possible question for case study. This one. So there is sometimes cash is involved, commercial substance is there, commercial not substance is not there. Tricky, huh? All the 6 questions are very different and tricky. So don't skip that part. Then let's go to next part. Next part is directly attributable cost. What is the next part? So this is not paid for purchase of the asset, but this money is incurred till the time the asset is ready to be put to use. After I buy the asset, before the asset can be used, I've incurred some expense like transportation of the asset, freight of the asset, assembly cost of the asset, installation of the asset, trial run of the asset, repairs before the trial run of the asset. Every expenditure incurred till the time the asset is ready to be put to use. This will not include the cost for removal of the old asset. There is one old asset. In the place of old asset, I'm installing new asset. Removal cost of the old asset is not included. In the process of installation in the factory, rest of the factory operations cannot happen. So temporarily, I've shifted the factory operations to a temporary site. That will not be included in the cost of the asset. After that, that office will be shifted back. That will not be included. But for installation of this asset, no, site has to be set up. That is to be included. And importantly, at the end of the useful life of this asset, I need to remove this asset. Dismantling cost, disassembly cost at the end of the useful life after 10 years, that has to be made provision for today. I need to estimate how much money will I incur at the end of the useful life for dismantling of this asset. Discount it to today's date using the present value factor. Such an amount has to be added to the cost of the asset today only. You got it? So that is part of the cost. Read this. What and all is included? Employee cost to site preparation, delivery, handling, installation, assembly, professional fee, testing, everything is included. What is excluded? New location, because we are shifting. No, I'm installing the machine here. So other operations are shifted somewhere else. That's not my cost. New product. Let's say with this machine, I'm bringing in new product. That new product manufacturing, I'm advertising. New service, I'm advertising that. That is not to be included in the cost of this asset. New service or new product, new facility inauguration, you're calling one big celebrity to inaugurate, not part of the cost of the asset. any other normal administrative, general overhead, selling and distribution overhead. And if in case for the installation of the asset, some people labor is required, no, you appointed your own labor. You appointed your own labor who was there in the factory, you diverted them to installation. If in case you would have not diverted your own labor, hired external agents, you might have paid 20,000 rupees. Because you used your own labor, you incurred only 15,000. How much wages are you paying them? 15. If you would have not diverted them, if you would have hired external agents, how much you were supposed to pay? Now can I add 20,000 considering it opportunity cost? No, no, no. You should take 15,000 only. Internally, for installation of your own asset, you can't make profit. You cannot give service to yourself and then make profit. No, see, self-service, adrallu profit. How can you do, yeah? And in between the tax also you should pay on that if you book profit. So it's incorrect. So you cannot book internal profits for self-constructed assets. If in case you are running one production facility, your manufacturing units, internally you started constructing the asset also within the same facility. Lot of institutes like BHEL, BEML, BEL and all, they do this. They manufacture some machines, no. For manufacturing that machine, they use one bigger machine. That machine also they only manufacture. They manufacture machines. To manufacture those machines, they have one big machine. That machine also they build in-house. Let's say this side they're manufacturing goods. This side they're building one asset which will be used in manufacturing goods. So that expenditure, rent, production capacity, wages, electricity, everything has to be split. How much for this building of big asset? How much is for production? For production, what you incurred, you'll add it to value of inventory. For building the asset, whatever you incur will be added to the cost of that PPE. Are you getting it? Then comes the last one. I told you, no, cost of dismantling. Any expenditure that you are expected to incur for dismantling the asset and removing the asset and restoring the site. What do you mean by restoring the site? Let's say this site doesn't belong to you. You've taken this site from the government. Government has given this site to you for 50 years lease. So after 50 years, you have to return this land in the condition the government gave the land to you. To install the asset, you dug 4 feet deep ground. 4 ಅಡಿ ಆಳದಲ್ಲಿ ತೋಡಿದೀರ. ಯಾಕೆ asset fix ಮಾಡಬೇಕಲ್ವಾ? Now at the end of 50 years of lease, you take that asset and go. You would also need to make the land good, no? For making the land good, you will incur some construction cost. Construction for the dug up ground. You get it? That should also be pre-estimated. At the end of 50 years, how much will you incur? You need to expect it today, discount it to today's date and then rate it. Usually not 50 years, 10 years, 12 years now. When Nano manufacturing unit was set up in Gujarat, it was for a short term lease, 10 years or 8 years lease. At the end of 8 years, the land was given back to Gujarat Urban Development. They gave back the land, but they would have installed high equipment machinery. No, they need to make it all good and then give it in the original condition. So cost that they'll incur for dismantling at the end has to be pre-estimated at the beginning and then added to the cost of the machinery and depreciated every year. Because let's say at the end of the useful life, you'll incur 5 lakh rupees for dismantling. 5 lakh rupees if you write as an expenditure in 8th year. 8th year only 5 lakh proportionate income illa. That machine you used over 8 years and you earned income. No, that 5 lakh what you incur at the end of 8th year should be estimated to be at the end of 1st year. After discounting, let's say it comes to 3 lakhs. 3 lakhs should be added to the cost of the asset in the beginning and it should be depreciated over 8 years. Pre-estimation, conservatism. Are you getting it? Logical, no? You get it? Yeah. You're not feeling bored, no? Theory ruptavni appa veli. Oh my god, accounts class SM class gottagtilla. Last one, subsequent cost. I don't know, subsequent cost is expenditure incurred against an existing asset. You didn't buy a new asset, yeah. For old asset you incurred expenditure that has already fulfilled your definition criteria. Should it fulfill definition criteria? No, it should only fulfill the recognition criteria. Future economic benefit to reliable measurement to. These two conditions, if it fulfills, sufficient. Add that subsequent cost to the cost of the asset and the new revalued cost will be depreciated over the remaining useful life. Then comes PPE after recognition at the balance sheet date. First time recognition is at cost. First time when you write that PPE in the balance sheet, at what value will you write? Cost of the asset. After you write it at cost in your asset, then what do? First balance sheet date or the second balance sheet date, you have two options. One, you can follow cost model. Two, you can follow revaluation model. What is cost model? whatever cost you have incurred on that asset minus depreciation will be deducted. Whatever value comes will be the cost. If in case there is any impairment loss, I will discuss it tomorrow, AS28. If there is any impairment loss, deduct that impairment loss also from that, and balance will be the carrying amount of that asset. This is cost model. Revaluation model, what you do is, you have the cost. You will identify one value of the asset. Cost 10 lakh idya. Under cost model, you do 10 lakh minus 2 lakh depreciation, book value 8 lakh. Under revaluation model, what it is, 10 lakh is the asset. Now you look at the asset and think, the rest the value. You will think, let's say you arrive at 7. 10 lakh is there. You want to recognize at 7. Difference of 3 lakh is the amount that should be decreased. That is what model? Revaluation model. You always have an option. You can either follow cost model or you can follow revaluation model. When you follow cost model or revaluation model, this is an accounting policy. It should be followed on consistent basis. If in case you are following cost model, now you want to change to revaluation model, change in accounting policy. This has to be disclosed separately. Why is there a change in accounting policy? What is the change in accounting policy? What is the financial impact, if any, arising due to this change in accounting policy has to be disclosed. Understood? Like I told, cost model, what do? Original cost minus accumulated depreciation minus accumulated impairment loss, if any, already charged till date. If you deduct, you will get book value. Under revaluation model, what do? You take fair market value. Then this is after that revaluation. Whatever you think is the value today, you take that. After that fair market value, whatever is the depreciation, that you will record it. After that, if there is any impairment loss, record that. Then you will get carrying amount. Understood? Revaluation can be two types. Revaluation means what? Already there is one value. You somehow feel like that value is not correct. You want to say innocity value marana. You do one more valuation. That is revaluation. You got it? This has to be done for the entire class. This has to be done for the one asset martini, one asset madala. See, I have 3 buildings. Building 1, building 2, building 3. Building 1, I will do revaluation. 2 and 3, I will follow cost model. Can I say that? No. If you follow revaluation, all 3 revaluation. If you want to follow cost model, all the 3 cost model. However, if all the 3 buildings are factory buildings, what I told works. Like if all the 3, factory 1, factory 2, factory 3. If you apply revaluation, all the 3 revaluation. If you want to apply cost, all the 3 cost. You cannot say factory number 1 revaluation model, factory number 2 and 3 cost model. Not all. However, you have factory building, you have office building. Can you say for factory building you will follow revaluation model, for office building you will follow cost model? Answer is yes. Both of them are building, but they are different class. Sir, class purpose, nature. Building, which is office, depreciation will be at a different rate. The purpose is only different. But factory, it's very different. Do you agree with me? Tell something.
Yes.
So based on the class of the asset, you can pick the model. All the factory buildings, same model. All the office building, same model. Let's say you have motor vehicles. Certain motor vehicles are used within factory. Certain motor vehicles are used for commuting of the management personnel. Can you use 2 different models for these 2 different motor vehicles? Yes. Understood? Okay. Like I told, revaluation can be 2 types. One, upward, downward. Upward means you're taking the value of the asset up. So you will debit the value of the asset and credit revaluation account. Your entry will be PPE account debit to revaluation. You cannot write P&L straight. Why? Let's say the value of the asset is 1 lakh. Now when you revalue it from 1 lakh to 1 lakh 20, till now it was 1 lakh. For the remaining useful life, depreciation would have been on 1 lakh. But now, when you revalue the asset from 1 lakh to 1 lakh 20, depreciation will be charged not on 1 lakh, but on 1 lakh 20. Andre, next 3-4 years, get 20,000 extra expense. So what you do is that revaluation reserve of 20 will not be transferred to P&L. You keep it as revaluation reserve, transfer it to P&L account over the remaining useful life as income. Let us say SLF. 1 lakh is the value of the asset. How much is depreciation for every year? 10. Now when you revalue to 12. Correct? Assuming 10 years useful life. So now every year depreciation has increased from 10 to 12. 2000 expense jasti aita. 2000 you will write revaluation reserve as income. 20,000 revaluation reserve will be written off over 10 years as 2,000 every year. Without revaluation, depreciation 10. With revaluation, Depreciation 12, revaluation reserve 2. Depreciation 12, revaluation reserve 2. So overall the impact is same. Sir, then why do we do revaluation? We want to show the asset at a revalued figure in the balance sheet. Objective is not the impact on PL. Objective is financial position. I want to show the valuation of the asset at a higher value. This is upward. What is downward? Very simple. The value at which the asset is very long. And there, previously we should have charged more depreciation, but unfortunately we have not charged more depreciation. We have wrongly charged less. Already late agbutide. Now there is no more deferring. Immediately downward revaluation will be charged to P&L. When the asset is downward revalued, entry will be P&L to PPA straight. Upward revaluation reserve. You write asset to revaluation reserve. Little you will transfer to P&L. Downward immediately to P&L. Other way is conservatism. Yeah, expected expense, no loss. Book it immediately. Whenever you do upward revaluation, check. Is it like whenever it is upward revaluation, you're telling revaluation reserve? No. What if it is actually not upward revaluation? It is reversal of the downward revaluation that you've done in the past. Andre enanta artha? You are revaluing the asset upward. Previous year, you are downward revalued the asset. Then what happened? Previous year you wrote it to P&L. No. This year when you do upward revaluation, it is actually not upward revaluation. It is reversal of previous year's downward revaluation. Previous year P&L debit ಮಾಡಿದ್ವಲ್ಲ ಈ ಸತಿ P&L credit ಮಾಡೋದು. I'll repeat. Last year, year number 1, asset value 1 lakh. We wrote it to 80,000. Where do we write 20,000? P&L. This year, we're like, ayyo, 80,000 is not correct, 1 lakh is correct. Andre last year ಮಾಡಿದ ತಪ್ಪಲ್ವಾ? Now when you increase the value from 80 to 1 lakh, don't write revaluation reserve 20. Previously you wrote P&L expense 20. Now you write P&L income 20 and record the asset as 1 lakh. Will it become prior period item? No, it will not become prior period. Last year we felt it is profit, so now we are reversing. It is not mistake, but it is reversal. Is reversion of provision prior period item? No, it is ordinary. Expectation change. It is ordinary. Are you getting it? Same to same here also. Similarly, asset is 1 lakh. We revalued it from 1 lakh to 1 lakh 20. Year 2, we realized like 1 lakh 20 is not correct. Yeah, actually 1 lakh was only correct. Now I'm doing downward revaluation. We should not charge it to P&L. We should adjust it with revaluation reserve which was previously created. However, if revaluation reserve is not sufficient, then P&L. Sir, yake not sufficient? I'll tell. 1 lakh is the value of the asset. We revalued it to 1 lakh 20. 20,000 little will be transferred to P&L. No, I wrote 2,000 to P&L. Only 18,000 is available in revaluation reserve. Now I am doing downward revaluation by 20. 18 is available in revaluation reserve. 18 I'll reverse. 2,000 is already transferred to P&L. Now also I'll transfer 2,000 to P&L. Did you understand? So whatever has happened in the past, we will reverse it. This is with regard to reversal of upward revaluation and reversal of downward revaluation. Understood? Then comes last 3 parts. I'll explain this and then we'll wind up the day. One is depreciation. What do you mean by depreciation? It is systematic allocation of depreciable amount over the useful life of PP. This definition is given in Schedule 2 of Companies Act 2013. What is depreciation? It is systematic allocation of depreciable amount over the remaining useful life of the asset. See, this is an accounting estimate. What is this? Hege, depreciation is done based on 3 factors. Number 1, cost of the asset. Number 2, useful life. Number 3, scrap value. Depreciation is done based on cost of the asset, useful life, scrap value. Alva. If scrap value is more, depreciation is less. If useful life is more, depreciation for each year is less. Correct or not? See, cost is actual. Useful life is an estimate. Scrap value is an estimate. Based on 2 estimates, if you arrive at some amount, won't it be estimate? Obviously. So when do you change depreciation? When the useful life changes, depreciation changes. When the scrap value changes, depreciation changes. Or when the usage pattern of the asset changes, depreciation again changes. What is usage pattern? I am expecting first year, second year, third year, fourth year, fifth year. Pattern is same. I follow SLM. I expect first year high usage, second year swalpa kadme, third year inna kadme, fourth year innu kadme. I follow WDV. I believe higher the production, higher depreciation, lower the production, lower depreciation. Then what do I follow? Production units method. Initially, I thought usage will be same. 2 years over. Later, I realized it's actually WDV. Then what do? I change the method of depreciation. What is the reason for changing method of depreciation? Usage pattern of the asset. Remember, what is the reason for changing method of depreciation? Very good. And change in the method of depreciation is change in accounting estimate and not change in accounting policy. Should we be giving prospective effect or retrospective effect? Prospective. Andre last 3 years I followed WDV. From this year I am following production units. Fourth year onwards I will recognize the depreciation. I don't have to recompute the depreciation for year 1, 2, 3, which was done under the old method. So the basis for selection of method of depreciation is usage pattern, and the methods that is allowed is SLM, WDV and production units, and change in the method of depreciation is change in accounting estimate. Last point, when do we start depreciation of the asset? When the asset is ready to use. When do we stop depreciation on the asset? When the asset is derecognized. Sir, derecognized means opposite of recognition. When do you recognize an asset? If it fulfills recognition criteria. We discuss no FEBRM, future economic benefit and reliable measurement. Asset, no future economic benefit. The asset is too old. What do you say? You are retired, ready for sale. Derecognized means sold. Retired means ready for sale. Take it side, get it. Asset you are no more using it. What is it then? It is retired. Asset is retired means not in active use. See here, retired. What do you mean by retired? Not in active use. ಅಯ್ಯೋ ನಮ್ದೆಲ್ಲ ಯೂಸೇಜ್ ಆಗೋಯ್ತಪ್ಪ, ಯಾವಾಗ ಕಾರ್ಡ್ ಹೋಗಿ ನಾಡ್ ಹೋಗಿ ಕಾರ್ಡ್ ಬರುತ್ತೆ ಅಂತ ಕಾಯ್ತಾ ಇದೀವಿ. ಸೊ ಇಟ್ ಈಸ್ ಹೆಲ್ಡ್ ಫಾರ್ ಡಿಸ್ಪೋಸ್, ರೆಡಿ ಟು ಬಿ ಸೋಲ್ಡ್. ಎನಿ ಮೂಮೆಂಟ್ ಇಟ್ ಮೈಟ್ ಬಿ ಸೋಲ್ಡ್. ಒಳ್ಳೆ ಪ್ರೈಸ್ ಬಂದ್ರೆ ಸೇಲ್ ಮಾಡ್ಬಿಡ್ತೀವಿ. ದೇ ಆರ್ ವೇಟಿಂಗ್ ಫಾರ್ ದ ರೈಟ್ ಟೈಮ್ ಟು ಡಿಸ್ಪೋಸ್. That is what? Retired. Asset is retired. When the asset is retired, no, there is no future economic benefit from that asset. So though it is PPE, it is still considered PPE, but valued like inventory. Why? It is like finished goods, no? Finish, held for sale, ready to be sold. How do we value inventory? Cost or NRV, whichever is less. Asset which is retired and held for sale will be valued at book value or realizable value, estimated realizable value, whichever is less. See, lower of carrying amount or NRV. Difference will be transferred to P&L. Are you getting it? Pakka? Yeah. Retirement means it is stopped. It is no more used in production. You kept it aside. Held for sale, held ready for disposal. It will be valued at cost or net realizable value, whichever is less. Derecognized means sold. Derecognized means, yeah. When do we recognize the revenue on this derecognized asset? Should we check AS9? AS9 specifically tell, don't ask me. You ask AS10 only. AS9 tells no recognition of revenue for sale of goods, but not for disposal of PPE. Disposal of PPE as per AS10 only. Whenever you sell it, you recognize it. Whenever there is reasonable certainty that you will receive money, you record it. Any gain or loss will be transferred to P&L account. You get this? Consideration will be booked as per AS9. And significantly certain, then you will recognize. Otherwise, you won't. Are you getting it? And this will become what activity? This gain or loss, whatever you get here. Come on, tell me. Help me understand whether I've taught you nice today or not. Gain or loss on sale of PPE. What activity as per AS5? Ordinary, extraordinary, exceptional, prior period item, change in policy, change in estimate. Ordinary, but depends upon size, incidence and nature. It depends whether it is in furtherance of business or not in furtherance of business. You sold this asset, no? Are you buying new asset? Or is it sold to settle a liability? If it is sold in the furtherance of business, you're getting a better equipment. Then it is ordinary, but because of size, incidence and nature needs separate disclosure. Basically exceptional. If it is to settle a liability, then it is extraordinary. Got it?
There's no economic benefit, so it's mostly.
But might be whenever you remove one machine, you will buy another machine, no, in that place. Then it will become ordinary. Oh, okay. No. I also forgot to give you marks because you forgot to give marks. I hope you didn't feel bad. Yeah. Just in lighter note, ಬೇಜಾರ್ ಮಾಡ್ಕೊಬೇಡ ಪುಟ್ಟ. So whenever there is sale of an asset, it can become ordinary, it can become extraordinary. Depends whether it is in furtherance of business or not. If it is in furtherance of business, ordinary, but based on size, incidence and nature needs separate disclosure. However, if it is not in the furtherance of business, whatever is not ordinary is extraordinary, so then it is an extraordinary item where nature and amount has to be disclosed to perceive the impact of that item in P&L. ನನಗೆ ಒಳ್ಳೆ ರಿವಿಷನ್ ಆಯ್ತು. yes, ನಿಮಗೆ ಆಯ್ತಾ ಇಲ್ಲ? You tell now what should be disclosed. Nature and amount to perceive the impact of this item on. Very good. That becomes derecognition. Last one, impairment. Previously, impairment was covered under accounting standard 10 fixed assets. Now we have a separate standard, AS28. AS28 was not there in the initial days. So now we'll read the entire impairment under accounting standard 20. Still, if you see AS10 paragraph, some parts of impairment are given, but that same what is there there. However, when we have a specific standard, why read it here? We'll read it there only. So this calls for end of accounting standard 10, property, plant and equipment. I hope you will got this. Let's now quickly start with accounting standard 11. And accounting standard 11 talks about effects of changes in foreign exchange rate. In a global scenario, when you start doing business, it might not so happen that the buyer and seller are in the same country. The borrower and lender might not be in the same country. The service giver and the service recipient might not be in the same country. You are domesticated. You are residing in India, but the person to whom you are selling the goods, the person from whom you are purchasing the goods, the person from whom you are taking the service, giving the service, borrowing the loan or giving the loan might not be in India. So in that case, the transactions might be affected in a currency other than our INR, other than Indian rupees. In such case, we cannot prepare balance sheet with two currencies numbers mentioned in it. It has to be reported in the reporting currency. Reporting currency is the currency of the country where your business is located. Your business is in India, the currency of India is INR. You need to report all the transactions in INR, even if the transaction is affected in USD or GBP, Great Britain pound, or yen, or Australian dollar, or baht, or dirham, any currency. Even if the transaction is affected in a different currency, it has to be reported in INR because your reporting currency is INR. For this purpose of this standard, we are basically dividing all the transactions that happens in foreign currency into three basic categories. One, foreign currency transaction. Second one, foreign operation. Three, forward exchange contract. All three are different. They are not the same. Foreign currency transaction is you buying the goods abroad, you selling the goods abroad, you taking the service, you borrowing the loan, you lending the loan. All of this keeping your business in India. You don't have branch outside India. You don't have a subsidiary or associate outside India. You are whole and soul related to India only. Your business is completely in India. Only your customer or only your supplier, only borrower, lender is outside India. So then it become foreign currency transaction. When will it become foreign currency operation? When you have a place of business outside India, you have a branch outside India, you have a subsidiary, associate, or joint venture outside India, then it will become foreign currency operation. Third one is forward exchange contract. Forward exchange contract is an extension of foreign currency transaction. To cover that foreign currency transaction, you have entered into a forward exchange contract. Or you see a possibility of making profit with forex movements, so you have entered into a forward exchange contract. Are you getting it? So let's start with foreign currency transactions. To begin with foreign currency transactions, like I mentioned, it can be buying and selling of goods, it can be availing or rendering services, it can be lending or borrowing. This transaction has happened in foreign currency and the settlement has to happen in foreign currency. Certain times what happens is there is a foreign buyer but is going to pay you in INR. In that case, this is not applicable. Or you have a platform which will give you money in INR, that customer will pay in foreign currency. Then again, this AS11 is not applicable. This is applicable only when the settlement is happening in foreign currency. Settlement is happening in. Very good. Now, the points that should be remembered is the recognition of this transaction has to be made at three stages. One, initial recognition, that is when the transaction is happening. Next one is at the time of settlement. If the initial recognition and settlement is happening within 1 year, only two is sufficient. If the initial transaction is this year and the settlement of the transactions happen in the next financial, then in between at the balance sheet date, this has to be restated. So there are three dates that you should be careful. One, initial recognition. Two, at the balance sheet date, 3 settlement date. How do you basically do this? Initially, the transaction will be recorded at spot rate. Initially, the transaction will be recorded at spot rate. What do you mean by spot rate? The rate prevailing on the date when the transaction happens. The transaction is happening on 20th of August. On 20th of August, whatever is the exchange rate, that rate will be considered. Let's say you sold goods for $1,000. Let's say you sold goods for $1,000. We'll write the entry debtors account debit to sales $1,000, and as of today, let's say each dollar is 94. We'll write $1,000 into 94 per dollar. That is the entry will be that is the amount at which you will make the entry today. And if in case the guy pays the money immediately to you today, that is over today only, there is no problem. But the problem comes where the goods are sold today, the customer will pay you later. The debtors has to be recorded at $1,000, but in Indian currency, that is at current spot rate you will record it. If he pays the money during the current year only, before 31st of March, again no problem. Closing date you will record it at the rate that you receive, difference will become foreign exchange difference. However, what if he pays in next financial year? Then as on 31st of March, such debtors has to be restated. It has to be restated. That asset in the balance sheet has to be restated. If in case the spot rate is not available, then periodic average can be considered. Usually spot rate will be available. For some reason, the date on which the transaction happened, that date's rate is not available to you. Then what do? You take the average. RBI will give out 52-week average. So you take that average, whatever is given by RBI. Understood? Then valuation at balance sheet date. If this is done only if the transaction is not settled in the current year and it is expected to be settled in the next financial year. What do? You need to categorize the items into two. One, monetary item. Second one is non-monetary item. Definition is not given for non-monetary item. Item which is other than monetary items is non-monetary items. Example, in our case I told no, we have sold goods to a customer, he has to pay us money, he becomes our debtor. Such debtor is a monetary item. To make you understand with example, if you have bank balance, monetary item, loan, monetary item. If it is fixed asset, not a monetary item. So what are non-monetary items and monetary items? Anything which is not monetary is non-monetary. What is monetary items? Money held, cash. If you have currency, foreign currency in dollars, pounds, yen, that is monetary item. Second one, any asset or liability which is supposed to be received or paid in fixed or determinable amounts of money. The amount or the value of that asset or liability is always fixed and it is determined. There is no difficulty, there is no uncertainty in determining its value. Now, when you say debtors, he has to pay you $1,000. Is there a difficulty in determining it? No. You have taken loan, you have given loan, there is interest, creditors, trade receivables, trade payables. All of these, the value can be decided with certainty. Whereas a fixed asset item, it cannot be decided with certainty. You get it? Book value is different, realizable value is different, net realizable value is different, current cost is different, replacement price is different, and that keeps changing depending upon the market condition, because you only know where to buy the fixed asset. You don't know where to sell, whom to sell, at what rate to sell. So there is a lot of uncertainty. It cannot be determined in fixed sum of money. So that becomes non-monetary. So monetary item is money held, assets and liabilities which are supposed to be settled in fixed or determinable amounts of money. Example will be debtors, creditors, bills receivable, bills payable, etc. What are our non-monetary items? Fixed assets, investments and inventory. If you have any, these will become non-monetary items. Monetary items on the balance sheet date will be recorded at closing date. For example, in our case, I told no, I sold goods to a customer for $1,000. Today's rate is 94, August 20th. I'll record 1,000 into 94, 94,000. Let's say my debtor will pay me money next year. As on 31st of March, what I would do is, I would identify the exchange rate on 31st of March. Let's say on 31st of March, each dollar is rupees 100. I will write debtor account debit. It was previously recorded as 94,000 for $1,000. On 31st of March, $1,000 into 100 will become 1 lakh. Debtors is already recorded at 94,000. So 94,000 rupees worth of debtor should now become 1 lakh. How will 94,000 rupees worth of debtors become 1 lakh? It has to increase by 6,000. I will debit my debtors by 6,000 and credit it as foreign exchange difference. Understood? This is for a monetary item, and amount likely to be realized or dispersible will be considered if the closing rate is not available, or closing rate is there but you know it will be settled on 15th of April. So if we know that it will be settled on 15th of April, what you would do is you will not try to take the 31st of March value. You will take that 15th of April's value all by itself directly. Did you get that? So usually you take closing rate. However, if the amount at which it is like most likely to be realized or disbursed is available, then you consider that and restate it on the balance sheet date. For non-monetary item, what do you do? You need to check. Non-monetary item is like fixed asset or investment. If it is fixed asset, it will be recorded at historical cost. Correct or not? You continue to record it at historical cost only. If in case that asset you have applied fair value, then the date on which that fair value is applied, no, that date's rate you take. Otherwise, it will be continued to be recorded at historical cost. Let's say I bought one fixed asset, foreign currency, 1 year ago at 94 rupees. Even at the end of there, it will be still recorded at an exchange rate of 94 only, irrespective of the fact whether the exchange rate goes up or exchange rate goes down. I won't restate it. Are you getting it? Very good. So foreign currency transactions are sale of assets, so giving services, taking services, and giving loan, taking loan, and all of these. These items have to be recognized at 3 stages. 1. Initial recognition. 2. Balance sheet date. 3. Very good. Spot, no, settlement date. Initial recognition will be on the spot rate. And if the spot rate is not available, periodic average. Then on the balance sheet date, how to recognize? Depends upon the category of the item. If it is monetary, then closing rate. If you know the most likely rate of settlement, instead of closing rate, take that most likely rate. And what do you do if it is non-monetary item? Record it at if it is recorded at historical rate, then historical value, then the date on which that historical rate is taken, that date's exchange rate. If it is taken at fair value, at that fair value rate, fair value, whatever date you have taken fair value, that date's rate will be considered. And any difference that arises, no, that will be transferred to P&L account. Where will it be transferred to? P&L account. And then comes a very, very beautiful paragraph. This is para 46A of what to say, accounting standard 11. This was issued by a separate notification by MC. So why did this come into picture? Long ago, this is in the year 2008-9. What really happened is globally the exchange rates became very bad. Let's say you are an entity who has lot of foreign currency transactions. Your entity is doing good. Your entity is profitable. You are doing good profits. From last year to this year, you made huge profits. But unfortunately, your exposure to foreign currency assets is huge. Because the foreign currency increased all of a sudden by 20%. The exchange difference became how much? 15-20% up. Usually every year it goes up by 4%, 5% at the unquote average. Suddenly that year it went up by how much? 15 to 20%. Suddenly if it goes up by 15-20%, all the foreign currency assets and liabilities should be restated. Actually you are making profit. Last year to this year you made profit, but foreign currency monetary items you will restate. No, when you restate 20% up by talwa, there are a lot of foreign currency liabilities. So when you restate all those liabilities, huge amount of foreign exchange difference one, but that huge amount of foreign exchange difference made their profitable company look like loss making company. Now, this increase all of a sudden that happened by 20%, no, is not something that will happen every year. It happens once in 10 years or once in 20 years. Very, very unfortunate it happened in that year. It doesn't usually happen. Correction and market correction. Suddenly it happened that year. No, usually entity is profitable. Last year you made 120 crores profit. This year you made 130 crores profit, if not for foreign exchange difference. But suddenly 20% jump happened in exchange differences. Because of that, your foreign currency liability increased all of a sudden. So that 130 crores profit now became 10 crores loss. Actually, are you making loss? No, it is because of foreign exchange difference. Sales wise, it's better. Revenue wise, it is better. All the operating costs are good. Working capital management is good. Everything is amazing. But because of foreign exchange difference, you made huge loss this year. No, if it happens with the one company, it is okay. It is happening with all the in your Nifty 50, you say, no, top 50 companies. Let's say 40 out of 50 companies have huge foreign currency exposure. 40 out of the top 50 companies have huge foreign currency exposure. No, 40 companies out of the top 50 will make loss. No, 40 out of 50 companies if they make loss. No, everyone. No, when you look at the balance sheet of a company making huge loss, what will you do? You will sell that company shares. You are selling top 40 companies sales. Everyone is dumping. Panic in the market. People are doing dumping. They literally selling the shares. When everyone sells the shares, no, it is not just 40 companies share price that is dropping in the country. It is the entire Sensex, entire Nifty of the country is it's taking a dip. It is not good for the entire country's economy also, no? Do you get it? So suddenly everyone panicked. Everyone went to Ministry of Corporate Affairs. They're like, hey God, please help us. This is not something that happens every year. Unfortunate incidents, foreign currency exchanges increased by 20-25% all of a sudden. We have huge loss. Not actually, but only because of foreign exchange difference. What to do? What to do? What to do? MCA told, okay, I understand your problem. It is not just your problem, it is my problem also. If in case I take no measure right now and I let it be quiet now, our foreign exchange market will take further dip because our what to say our share market drops now, value of our rupee will further depreciate. So lot of value will be lost by all the people in the country who have invested. Small investors will lose lakhs of money. Next day newspaper will ಬರ್ತಾರೆ 1,60,000 crores rupees was lost yesterday. Yeah, it happens. So this should not happen. So what did the government do? MCA issued one notification. Usually in foreign exchange difference, when you restate the liability on the balance sheet date, where do you transfer the difference to? P&L account. Very differently they told, when the difference arises, that liability is there, no? Maybe loan. That liability is against an asset. That liability is there, foreign currency liability is there. Against that liability, you might have had foreign currency asset also. You have taken foreign currency loan to buy some foreign currency asset. This exchange difference, instead of writing it to P&L, instead of writing it to, add it to the cost of the asset. Add it to the cost of the, write it off over the next remaining useful life of that asset. Do you understand? What did they tell? If you write it to P&L, immediately recognized. They told instead of immediately recognize it to P&L, defer and amortize by capitalizing it to asset. Now you have taken loan in foreign currency to buy one asset. ಅವಾಗ ಏನಿದೆ foreign currency loan is a monetary item. That exchange difference arises because you are restating it to closing rate. You will add it to P&L, usually debit it to P&L. Now they are telling add it to asset. What if the asset is a monetary, non-monetary item? There is a fixed asset that is purchased. So you can add, depreciate ಮಾಡಬಹುದು. What if that loan was taken not for buying one asset? Not for buying one asset. It was loan was taken for working capital management. You cannot write that exchange difference as asset, no? ಅದನ್ನ ಡೆಪ್ರಿಷಿಯೇಟ್ ಮಾಡೋಕ್ಕಾಗುತ್ತೆ, ಅಸೆಟ್ ಇಲ್ಲ ಆ್ಯಡ್ ಮಾಡೋಕ್ಕೆ. ಸೊ ವಾಟ್ ಡಿಡ್ ದೇ ಟೆಲ್? ದೇ ಟೋಲ್ಡ್ ಓಕೆ, ಐ ಅಂಡರ್ಸ್ಟ್ಯಾಂಡ್ ಯು ಡೋಂಟ್ ಹ್ಯಾವ್ ಎ ನಾನ್ ಮಾನಿಟರಿ ಅಸೆಟ್ ಟು ಆ್ಯಡ್ ದಿಸ್ ಫಾರಿನ್ ಎಕ್ಸ್ಚೇಂಜ್ ಡಿಫರೆನ್ಸ್. Create it as one reserve called as FIC-MIT-DA. What is it? Foreign currency monetary item translation difference account. What is it? Foreign currency monetary item translation difference. If there is a non-monetary asset, what to do? That difference you add it to asset. If there is no asset, then write it to FC-MIT-DA. Basically, we're doing only one thing. That foreign exchange difference, no, is huge. Without foreign exchange difference, entity is profitable. Because of foreign exchange difference, entity is now becoming loss-making entity. So what do? Instead of writing that to P&L account debit side, you write it to P&L over 5 years, 6 years or 10 years, little every year. How to write little? If there is asset against that foreign currency liability, add it to the asset, value of the asset will increase and then depreciate it. If in case there is no asset against it, then you create one asset called FC-MIT-DA. FC-MIT-DA. What is it? Foreign currency monetary item translation difference account. Did you understand this? Should I tell the entire thing once again? You have taken one foreign currency loan of $1 lakh. When you took the loan, it is 50 rupees per dollar. You wrote it as 50 rupees into $1 lakh, 50 lakh rupees is the loan. What happened after that? 1 year later, suddenly 50 becomes 60 rupees. You say, sir, 10 rupai. Hey, 10 rupai alla, 20%. 1/5 is how much? Yeah? 20% increase agoytu. 20% increase adre interest ಬಗ್ಗೆ ಮಾತಾಡ್ತಿಲ್ಲ, principal. Look at that principal. $1 lakh into 10 lakh rupees is foreign exchange difference now all of a sudden. That 10 lakh usually we should write to P&L, usually, but they gave an option under para 46A. What do? That loan you took, no, let's say that loan was taken to buy one foreign currency asset. One asset you bought, land or building or machinery or equipment or something. So that 10 lakh rupees will add it to building or that machinery. Value of the machinery will increase. Increased value of the machinery will be depreciated over the next 5 years. What if you took that loan not to buy building but for working capital management? You write that to FC-MIT-DA. That FC-MIT-DA will act like an asset. What is the value of the asset? 10 lakh. You won't write it to P&L account 1 year. 5 years, every year 2 lakhs you will write. Did you understand this? So this is an option. This is an not a mandatory thing. See, if this option is availed, what do? Such foreign exchange difference will, if option is not availed, option avail ಮಾಡಿಲ್ಲ ಅಂದ್ರೆ ಏನು ಮಾಡೋದು? Such foreign exchange difference will be transferred to, if such option is availed, what do we do? Read this. If option is availed, such foreign exchange difference will be added to the cost of the asset, which will increase depreciation to be transferred to P&L. Instead of writing immediately to P&L, we write it through the asset account to P&L little. Got it? Okay. Then foreign currency monetary item translation difference account. What is this? This is if in case there is no asset. If there is no asset against such monetary item, a loan ತಗೊಂಡಿದೀವಲ್ಲ ಅದಕ್ಕೆ against asset ಇಲ್ಲ, then what do? Then such exchange difference cannot be written off as, cannot be written as asset in the balance sheet. So what do? We create foreign currency monetary item translation difference account. Will be shown on the balance sheet under equity liabilities. It will be shown as a negative item. Further, it will be transferred to P&L over the loan period. Because there is no place in the asset side, it will be written in the liability side as a minus item. Liability side as a minus item. Like your preliminary expenses, which used to long ago write off little. You write it on the liability side as a negative item and write it off to P&L over the useful, over that 5-6 years. You got it? This is a very old provision. As of date, this provision is still there, but it is given as an option. It is given as an option. Sumne, if you take this option, it will be like financial statements are not showing true and fair view. So you should have a reasonable justification when you take this. Usually when the question is given on this topic, they should mention whether the option is availed or not availed. If they don't mention, you can assume either ways and write it. You got this? Did you understand the reason why we do this? Pakka? Very good. By this, we're done with foreign currency transactions. Next, shall we discuss foreign operations? Foreign operations, what we're going to discuss now is the same what you discuss in foreign branch. In the branch accounting, what you discuss at the end, no, that is AS11 Effects only. If you have a subsidiary, or if you have a branch, if you have a joint venture, or if you have an associate outside India, then what do? You should check, is it integral operation or is it non-integral operation? Integral andre eno? Integral andre it is extension of your home operations. Non-integral means it is almost like a separate entity. Integral means you take the decisions, where to buy the goods, what price should they sell, what expense should they pay, everything you decide. Non-integral means it is almost dislocated. They can take decisions there only. They can buy goods there, they can sell goods there, they can decide the selling price, they can decide their own terms. That becomes non-integral. Are you getting it? If it is integral operations, it will be treated like foreign currency transactions only. If it is non-integral, then what happens? Assets and liabilities has to be classified into monetary or non-monetary. And whether it is monetary or non-monetary, doesn't really matter. You take it at closing rate. And income and expenses will be taken on the date on which the transaction happens. However, if it is not available, then what do? You take it on the average rate. Even if it is integral, no, you do the same thing. No, monetary items you take closing rate, non-monetary items you will take transaction rate. If it is non-integral, what do? Monetary or non-monetary, both you will take at the closing rate. And whatever the difference arises here, no, it will be when net investment is disposed, it will be taken. Andre, if it is integral operation, difference arising will be written straight away to P&L. Foreign exchange difference account and P&L. Yavadake integrally. If it is non-integral, you won't write it to P&L. You will write it to foreign currency translation reserve account. You remember FCTR? Would have done this in branch. Remember, if it is integral, if it is extension of my own operations, I am selling goods in India, I am selling goods in USA. Whether I have a branch and sell the goods in USA, without having the branch I selling goods in USA, it's the same. If there is any difference, that will be transferred to P&L. That will be transferred to, if it is foreign currency transaction, straight away transfer. If it is integral operation, I write it through one account called as FEDA, foreign exchange difference account. I write it through foreign exchange difference account. If in case it is non-integral operation, I will not straight away transfer to P&L. What do? every year difference whatever comes, no, in trial balance when you restate you get the difference, no, it will be not written to P&L, it will be written to one reserve, FCTR, foreign currency translation reserve. This year there is positive difference, I'll write it. Next year there is negative difference, I will deduct it. The year after that I'll go on adding, I'll go on adjusting that FCTR. That FCTR will be there till the time I have that foreign branch or associate or joint venture. The day I close that, that is the day I'll recognize that income. Till then I'll not recognize. Did you understand this? So integral, immediate recognition to P&L, foreign exchange difference. Non-integral, what do? You write it through FCTR, foreign currency translation reserve. It will be there till the date you hold the investments. The date you dispose that investment, you recognize that income. You do the same, no, in foreign branch. So remember, foreign branch is integral or non-integral, you should see. If it is integral, straight away PL, FEDA, FEDA. Non-integral, FCTR, and to be recognized to P&L only on sale. Did you understand this? Then we will come to the last part of the standard, that is forward exchange contract. What is forward exchange contract? Forward andre munde. Exchange is two currencies. Contract is between two people, there is an agreement. So I and you enter into an agreement. I and you enter into an agreement. What is this agreement for? For exchange of currency. You will give me rupees, I will give you dollars. Today, no. After 1 year, or after 3 months, or after 6 months. For us to exchange, you giving me rupees, me giving you dollars, after a certain period of time, after 3 months, 5 months, 6 months, 10 months, 12 months, 2 years, in the future, for us to exchange the transactions, today only we enter into one contract. Are you getting it? So it's the contract between two parties to exchange two currencies on a future date. I repeat, what is forward exchange contract? It is agreement between two parties to exchange currencies on a future date. Can you deny that transaction? No. Let us say after 1 year, let's say August 2025, you want $10,000. August 2025, you want how many dollars? So today we both will enter into an agreement wherein I will give you $10,000 in August 2025. How much rate will you give? We will decide it today. We are deciding the rate to be 100 rupees per dollar today. On that day, the exchange rate might be 90, exchange rate might be 105. Irrespective of what is the exchange rate on that date, I will give you every dollar at rupees 100. And you have to buy, how many dollars is the agreement for? You have to buy $10,000 for me for rupees 100, irrespective of what is the exchange rate on that date. This is forward exchange contract. So did you understand? Now the question is, why do you enter into forward exchange contract? You, the businessman who entered into this contract, why did you enter into this contract? That will decide how to account this. Two reasons. Reason number one, you have one foreign currency liability. Let's say you've taken some loan in foreign country. You are paying interest now. That loan is repayable in August 2025. Or you purchase some goods, there is a creditor to whom you are supposed to pay the money in August 2025. So there is credit period available till August. If they give you option to pay till August, do you want to pay today only? No, you will take the complete time. You want to pay in August, but you are not getting sleep in the night. ನಿಮಗೆ ಭಯ exchange rate ಜಾಸ್ತಿ ಆಗುತ್ತೆ, ಕಡಿಮೆ ಆಗಬಹುದು, it can go in your favor, rupee might appreciate against dollar, but you don't want, you are scared that what if dollar appreciates against rupee, what if you would have to pay too many rupees to get $1, you are scared. So just to get that peace of mind, just to get, you are okay paying any amount of money, but you want to know the fixed amount of money. So what do we do in that case? I give you that mention number, no, that you agree, no, for 100. This is to hedge your risk. This is to hedge your, you have a foreign currency exposure. You have a foreign currency, you have a liability of $10,000. You have uncertainty as to how much rupees should you pay for this. So you want certainty in the uncertain situation. What do you want? Certainty in the uncertain situation. You want a fixed liability in rupees. So you enter into one forward exchange contract with me. That is called as hedging. What is it called as? So today's rate is 94 rupees per dollar. What is today's rate? 94 rupees. What is the contract rate? 100. So 94 ittu 100 ಗೆ agree adi. Andre you are willing to pay 6 rupees extra, no? That 6 rupees is called premium. What is that 6 rupees called as? 6 rupees into $10,000. How much is it? 60,000 rupees. 60,000 rupees. You have $10,000 exposure. Today each dollar is 94. For August to 2025, 1 year later, we entered into an agreement saying that I'll give you each dollar for rupees 100. So you are willing to pay 6 rupees extra. That 6 rupees per dollar will become your premium. For how many dollars? $10,000. $10,000 into 60 rupees, 6 rupees per dollar is how much? 60,000 rupees will become your contract premium. What you do is that 60,000 will be recognized over the contract period. 12 months alva. 60,000 is to be recognized over 12 months. In that, August, September, October, November, December, January, February, March. 8 months is in current year. 8 months. 60,000 is for 12 months. 60,000 divided by 12 andre 5,000 per month. No. For 8 months in this year, 40,000 is this year expense. 4 months is next year, 20,000 is next year expense. Did you understand? This is done for hedging. What is hedge? You have a foreign currency exposure. To mitigate or to reduce your foreign currency exposure, you are entering into one forward exchange contract. Forward rate is greater than spot rate. Forward rate and spot rate difference is there, that is premium. Such premium amount will be amortized over the contract period as expense. Did you understand? Very good. There is another thing. ನಿಮಗೆ ಫಾರಿನ್ ಕರೆನ್ಸಿ ಎಕ್ಸ್ಪೋಜರು ಇಲ್ಲ, ಏನೂ ಇಲ್ಲ. You don't have any foreign currency exposure. You are a trader. Who are you? Trader. You are doing speculation. You somehow feel like after 1 year, forward ಅಲ್ಲಿ after 1 year the rate will become 105. What is your belief? After 1 year it will become 105. But I say that it will be 100. When I say 100 and when you firmly believe 105, what will you say? Beta, challenge, nodana. You are entering into one contract with me. That 100 rupees, naane togoltini. You give it to me 100 rupees. I will buy $10,000 from you. We both are entering into one contract. Do you have any foreign currency liability after 1 year? You don't have any. Actually, at the end of 1 year, I am supposed to give you $10,000. You are supposed to give me 100 rupees per dollar, irrespective on that day whether it is 95 or 105. You believe how much will be the rate that day? 105. What is the rate today? 94. I am a dealer. What am I offering? 100. So if you enter into one contract with me, not for hedging your risk, but for trading and speculation, on that date, let us say it goes in your favor, the exchange rate is 105. You know what happens? You will not buy $10,000 from me for 100. Let's say you will buy $10,000 from me for 100 rupees. And what will you do with that? You have any money payable? No. You will sell those $10,000 for 105 and you make profit? No. You will not buy it from me. You will not sell it to somebody. I will give you only 5 rupees per dollar as difference. We both agreed 100. No. I have to buy from the market for 105 and I sell it to you for 100. I make 5 rupees loss. I will not buy. I will not sell to you. You will not buy from me and you will not sell to somebody else. I will straight away give you 5 rupees per dollar into $10,000, 50,000. I'll give it. Did you understand? So today's 94 is not at all considered. Will you consider today's 94? No, it will not be considered. So ಇಲ್ಲಿ ಸ್ವಲ್ಪ ತಪ್ಪಿದೆ. So what do? You straight away record. ಇಲ್ಲಿ ಸ್ವಲ್ಪ ತಪ್ಪಿದೆ. I'll correct this. You guys observe it later. What you do is straight away you will record the difference between the transaction rate on that date and the forward rate as your profit or loss. If it is what transaction? Speculation or trading transaction. If you enter into a speculation transaction, on that trade the exchange rate is 105. We have entered into contract for 100. 100 go 105 go 5 rupees difference into $10,000. You will recognize it as income when? Not this year. Next year, August, when the settlement happens only. What if that day actually turns out to be 98 rupees per dollar? You will buy from me for 100 and you will sell at 98. So you will make 2 rupees loss. Actually, you will not buy from me, you will not sell. You will give me 2 rupees per dollar for $10,000. 20,000 ನೀವು ನನಗೆ ಕೊಡ್ತೀರಾ. Like, sir, ಚೆನ್ನಾಗಿದೆ sir. ಇದೇ ಮಾಡಬಹುದಲ್ಲ. Hey, there is huge amount of loss that is involved in this. You might make loss. Are you getting it? It is not in our control. Yeah, if the new US president ಯಾರು ಆಗ್ತಾನೆ ಅನ್ನೋದ್ರ ಮೇಲೆ ಡಿಪೆಂಡ್. Correct or not? And whether they'll be friends with Modi ji or not friends with Modi ji, or which war will break out between India and US, which side are we taking, which side are they taking, all of this are there. Get it? So geopolitical scenario, political instability, trade discussions between two countries, everything will come into picture. Let's say our Sidramaya uncle will say no, that 80%, 20% people, 80% should be local people. What if Microsoft and Google go back from India? They won't shift from Karnataka to Orissa or Karnataka to Andhra Pradesh. What if they shift from India to some other country suddenly? Gone, no. So much of employment opportunities gone. Foreign exchange reserves will get depleted, and entire foreign exchange rates will fluctuate really differently. You get what I'm trying to tell? So it is the exposure and risk is way too much. Did you understand this? This is the end of accounting standard 11. Do you want me to do any question on any part? Which part do you find difficult and tricky in this? Transaction, operation, or forward exchange contract? We'll see one of each. Shall we? Okay, if we are trying to see foreign operation, it's like this. Let's say we purchased inventory for cash of $1,000. When we purchased it, exchange rate is 80. And on 31st of March, inventory is still there with us, then the exchange rate has become rupees 85 per dollar. What is the entry for purchase of inventory? Purchase account debit to cash. You will record $1,000 at rupees 80 per dollar, 80,000, 80,000. Now, we've already paid, so there is no liability, and we have inventory. You get what I'm trying to tell? Inventory is a non-monetary item. It will be recorded transaction rate. If in case you have done inventory cost or NRV, whichever is less, then NRV rate, whatever is there, no, that date you would have taken. If the inventory is still in foreign country, if inventories come to India, then it doesn't matter. Do you agree with me? Yeah. What if it was on liability? Andre, you took this and then you paid cash. Not paid cash. What if you had not paid cash? You will write the initial journal entry purchase account debit to creditors account. 80,000, 80,000. Creditors is there. Creditors is initially recorded rupees 80 per dollar. At the end of the year, exchange rate became 85. So liability will be restated to 85. So $1,000 into 85 is how much? 85,000. Creditor should be recorded at 85, but it is initially recorded at 80. So what do? You increase that liability from 80 to 85 by 5,000. Creditors, liability is increasing, credit the creditors by 5,000 and debit will be foreign exchange difference. Where would this foreign exchange difference go? Very good. It will go to P&L. Did you understand this? Very good. So after this, so we were discussing this. See, if in case the inventory is purchased for $1,000 at the rate 80, you initially write the journal entry purchase account debit to creditors. Basically, stock is recorded at $1,000 at rupees 80,000, and creditors is also recorded at that rate. On 31st of March, if inventory is still in stock and inventory's rate has become, I would say NRV is $900, meaning inventory is still there in foreign country. NRV is not 90,000 rupees, it is $900. So if you would have taken cost, then it would have been recorded at historical rate, because inventory is monetary item, inventory is non-monetary item. It will be, if it is recorded at historical cost, we will take the transaction date of the historical cost. If it is recorded at fair value, the date on which we recognize fair value, that date's rate has to be taken. Now inventory has to be recorded at $1,000 or $900, whichever is less. Then it will become $900. That $900 is NRV as on 31st of March. Now inventory also will be restated to 85 rupees per dollar. Creditors will continue to be at $1,000, but the rate has become 85. So creditors, liability for us to pay is 85,000. Asset that we purchased against that inventory will become 76,500. Did you understand this? Very good. So then that's the same thing. We'll write the journal entry purchase to creditor 80. At the end of there, we'll decrease the value of the inventory by 3,500 to 76,500. I will increase the value of my liability from 80,000 to 85,000 by writing foreign exchange difference to creditor. This foreign exchange difference of 5 and this foreign exchange difference of 3,500 together 8,500 will go to our P&L. Asset decreasing is loss, liability increasing is also loss. Understood that? Then, so similar examples are there for slightly more. I will straight away teach you the part on foreign exchange difference, a forward exchange contract. Is that okay? See, this is the question. So the contract is signed for $1,000. Spot rate is 80, forward rate is 85, market rate is 90 on the date of settlement. How to recognize this transaction depends what is the purpose for which you entered the transaction. If you have entered the transaction for the purpose of hedging, then what do? 80 is spot rate, forward rate is 85. 80 is the rate when we enter. What is the rate at which it will be settled? 85. How much is the premium? 5 rupees per dollar. How many dollars is the contract for? 1000. 5 into 1000. 5,000 is the premium which will be recognized over the contract period. They have not told the contract period here, but over the contract period will be recognized. See, case A, hedging the risk. 80 and 85 will be considered. 90 market rate, nobody cares. So contract value is $1,000. So premium is 5,000. It will be transferred to P&L over the contract period. What if the forward contract starts and ends within the same accounting year? 5,000 fully that year. What if it starts in 1 year, ends in another year? Then you see how many months in this year, how many months in that year. Based on that months, you segregate it. What if it is for the purpose of speculating or trading? Then you ignore this spot rate. Spot rate ಯಾವನಿಗೆ ಬೇಕು? No one cares about spot rate. On the date of settlement, what is the forward? What is the exchange rate? 90. What is the spot rate? Forward rate? 85. So on the date of settlement, you will buy it for 85, sell it for 90. You make 5 rupees per dollar profit into 1000. So 5,000 will be the entry passed on the settlement date. That settlement can be in this year, can be next year. Are you getting it? Do you care about spot rate? No, you don't. Did you understand this? Can I go to the next standard now? 11, you understood? There is one set of topics on which I did not make you do questions. That is foreign operations. That you will do in branch accounting. And this part also, same way you will identify the foreign exchange difference. But instead of writing it to P&L, you add it to the asset if the asset is there. If the asset is not there, then you write it to FCMITDA and again amortize it to P&L. That FCMITDA will be shown in equity and liabilities. I hope you got it. Very good. We are done with 11. Let's now go to accounting standard 12. Shall we do accounting standard 12? Government grants. Very good. So government grant refers to any assistance received from the government. It can be in cash, it can be in kind. And government doesn't give the money just like that. They'll give conditions. If you comply those conditions, or if you promise that you will comply those conditions, and if in case you don't comply, if you accept to return that money, then the government will give you such money. It will become, what is it? Government grant. So the money in cash or in kind given by the government for compliance in the past or to be done in the future, that is government grant. Did you get this? So when you say government, it will include state government, the central government, panchayat, the local, all of these are included when we say the word government. And there should be reasonable assurance that you will fulfill the conditions, and there should be certainty that you will receive the money from the government. Only then this has to be recognized. So it will be recognized based on two conditions. What is it? Number one, reasonable assurance. Second one, certainty of ultimate receipt. Meaning money should have been collected, or there should be guarantee that you will receive that money. Second one is there should be guarantee, the assurance that you will be earning that money, you will be not returning that money back to government. Then you will recognize it. Grant can be given in multiple ways. Government can tell, in your electricity bill, I will give the money back. Like you pay the electricity bill to BESCOM, 50% of it I will give the money back to you. Or government can tell, I will give the money to you to buy asset. Or government can give the asset to you free of cost. Government can give land to you free of cost. Or they can give the land or building or asset at a concessional rate. Are you getting it? Or they can give it in kind also. So depending upon that, we'll do accounting. Let us say the government grant is given to us in cash. How is the government giving us the grant? Cash. They're giving you cash. So that cash grant received from the government can be classified into three. Number one, specific asset. Number two, revenue expense. Number three, promoter's contribution. Specific asset means government has given you money to buy an asset. When you say revenue expenses, government has given you money to pay salary or that electricity expense reimbursed. Or promoter's contribution is government has given you money by way of capital. When you start your business, government has given you money to start the business, like seed capital. If the government has given money to buy a specific asset, you have two options. Let us say you buying one equipment. If you buy this equipment, you will start manufacturing export quality goods. When you start exporting, there is favorable balance of trade and foreign exchange reserves will also be created. So government wants you to use that machine, but you don't have enough money to buy that machine. That machine is 1 crore rupees. So government will tell, okay, you buy that machine, 40 lakhs, none in the contribution. I will give it to you. So when the government gives 40 lakhs, you put 60 lakhs from your pocket and then buy the asset. There are two ways of accounting. Number one, you paid how much? 60, but the asset is how much? 1 crore. Government gave 40, no? You can tell asset value 1 crore, grant received 40, so you'll record the asset at 60 only. You'll record the asset at, so what have you done? Grant received is straight away deducted from the cost of the asset. Grant received is straight away deducted from the, this is first method. Second one, what you do is, you will record the asset at 100 lakhs, that is 1 crore. 40 lakhs what the government gave as grant. No, you defer and amortize it to P&L. Both ways it is same. Let us assume scrap value 0, useful life 10 years. What is scrap value? Useful life, asset value 100 lakhs or 1 crore. If in case you depreciate the asset of 100 lakhs over 10 years, how much will be depreciation every year? 10 lakhs, no. Now you got 40 lakhs as government grant. 100 lakhs is the value of the asset, 40 lakhs government grant. If you deduct that 40 from 100 lakhs, cost will be 60. 60 will be depreciated over 10 years as 66666 every year. This is first method. Second method, what you do is, you will not deduct that 40 from 100 lakhs. Asset side you will write 100. Liability side you will write government grant 40. So this 100 will be depreciated over 10 years as 10, 10, 10, 10. 40 lakhs grant will also be transferred to P&L over 10 years 4444. So if you straight away adjust with the cost, every year depreciation is 6. If you treat it as a separate money, separate reserve, then depreciation will be 10. Grant received recognized as income will be 4. So 10 depreciation, 4 grant, 6 will become expense every year. So either ways it is same. Which one to do? Your accounting policy. It's left to you. Either ways is okay. Either ways is okay. Accounting impact is absolutely same. If in case you want to show the asset at its true value, then you can not deduct the grant from the asset and recognize it separately as income. You are like, you don't want to show two items. You want to show it as net. Then you can deduct that grant from the value of the asset and recognize the asset net of grant and then depreciate it over the remaining useful life. Either ways is okay. Are you getting it? Next, what do you mean by revenue expenses? You paid some expense, government reimbursed it. Government will tell, if in case you take people from local as your employees, from this regional background, from this specific background, if you give this much of women employment, if you this much of uneducated or say unemployed graduates, if you give this much of work, I will give you 20% of the salary what you pay to them. No government has promised, but can do. Some countries may they do it. They say that you need to hire this many employees. So people right out of their college they get employment. Because government has told that if in case you give these many employments, then you don't have to pay tax. If you don't give this much of employment to this category people, then you would have to pay this much tax. For them, giving salary is easy than paying tax. Tax is such high rate. So what do? They don't route it through like the company has to pay tax to government. Government has to give uneducated. Sorry, uneducated unemployed graduates. Government doesn't have to give UNIDhi 2,000, 3,000 rupees. Straight away, government will hire them as interns and then a company will hire them as interns and company will pay them salary straight. By that, no, straight away they get the benefit. Government's involvement is minimal. That's how the government should work. Without you getting involved straight away, the country should run. The system should be so strong that that should work as a system. Are you getting it? That way, employment is also created, skill development is also happening, and you don't have to put your photo everywhere that you're giving money. Correct? No. People who are giving money, their photo will not come. People who are distributing money, their photo is coming here everywhere. See, we are paying the money to all those people who get 2,000 rupees, 3,000 rupees, free bus service. We are paying, but our photo is not there. Correct or not? But let's get little away from that. So, if there is any revenue expense that I have incurred, which is reimbursed by the government, what will be the entry? I will first write the expense, electricity expense account debit to cash. And the government gives that money to me, I will write the entry as cash account debit to government grant. That government grant what I receive can be deducted from the expense and expense to be posted net. Or you can write that government grant as income and you can write that expense separately to P&L. Up to you. That is with regard to revenue expense. Lastly, promoters contribution. Here, government is not taking shares from you. Lot of times this angel investing seed funding, my government takes share from you. Government will take 10% stake in your company and gives money. Then it is not grant. Then it is not grant. Grant is when, without taking one share from you, government has given you money to start the business. Then you will write cash account debit, credit share capital burial. What will you write? Capital reserve. What do you write it as? You get this? So if the promoter's contribution is received from the government, meaning government is giving you cash without collecting any cash, without collecting any shares in return, it will be returned to capital reserve. This is for grant received in cash. Understood? What if the government has given you non-monetary grant? Andre, government has given you grant not in the form of cash. Like they've given you one asset free of cost. They gave you one machine, machine free. You do manufacturing and then export goods. You don't have to give me any money. You have two options. One, recognize the asset at its value. Let's say the value of the asset is 10 crores or 10 lakhs. You will write the asset at 10 lakhs. You will write the grant 10 lakhs. 10 lakhs worth of asset will be depreciated every year. 10 lakhs worth of grant will be transferred to P&L account every year. So amount will be same. Option number one. Option number two, you'll be like, I did not pay money. I don't want to record it at that value. So you'll record it at nominal value. Nominal value means what? Nominal value for certain entities is 10 rupees. Certain times nominal value is 1 lakh. Why? When you prepare your balance sheet, you are preparing balance sheet, you in the top you're writing rupees in lakhs. You're writing rupees in lakhs. So 1 lakh is the nominal amount in that case. You will record this asset at a nominal value of 1 lakh. Why? Free ಆಗಿ ಬಂತು ಅಂತ if you don't record the asset, if the asset is not there in fixed asset register, what if the employees of the company steal the asset? You don't even get to know that the asset is stolen. So asset has to be recorded at full value and you record full government grant. Depreciation ಮಾಡಿದಂಗೆ government grant will be transferred to P&L. One option. Second option, you can record the asset at nominal value of 1 lakh. Certain times 1 crore is nominal value. You get asset of 40 crores, 50 crore rupees. You record it at nominal value of 1 crore. When you record it at nominal value, please don't depreciate it. Please don't. It will be recorded at that nominal value only for. You get this? Very good. What if you get it at concessional price? You write it at acquired value. You however have that option, write it at full value and recognize the grant and then do that. Did you understand? Last one. Special cases. Certain times government will give grant only for specific companies. Let us say you have one manufacturing entity or you have one port business in Vishakhapatnam. That hood came, no? That entire hadad anta ಹೇಳಿದ್ರಲ್ಲ. That cyclone came and it spoiled the entire industry. So that cyclone came, because of that your manufacturing entity got completely damaged. You are there in that coastal belt. Now your company will get demolished. Your company will lose. So many people will lose employment. So many people who had invested in your company will lose it. You people who are doing business with you will not get the money. So what will the government do? It is a natural calamity. And I told you to open the entity there. Maybe this there is an SEZ there, or is it easy to export there, export from there, or import from there? So I had only given you land there and asked you to stop. But you got exposed to natural calamity. And your sustenance is important for me. Because the moment you don't sustain, 10,000 people will be unemployed in that city now. You get it? No one will come and do business in a situation like that. So to support you, I will give some grant to you. What is this grant for? To give dividend to your shareholders, to give salary to your employees, to pay money to your creditors, to continue your business. I will give you grant. This will be considered as an extraordinary item. Read this. For immediate financial support only to one entity or one industry. One entity or one specific industry. For in the COVID time, they gave special grants to hospitals. To give, they told you whoever comes, it doesn't matter whether you are super specialty hospital or multi specialty hospital. If someone comes, you would have to admit him, you would have to give him services. Don't charge him money, I will pay that money. Agilla money. Some places they told, but government pays that money to you. You get that? That will become something like grant. So compensation for expense or losses in previous years. It can be because of natural calamity, need not be because of natural calamity also. It can be for one single company or for a specific group of company. If they receive it, it should be treated as an extraordinary item. It will become income, but it is extraordinary. It is not in the ordinary course. Okay. Certain times when the government comes into picture, they might give grant to the company in which they are invested money. So that's also extraordinary. Alva. So next one is refund of government grant. Now I told you here, government grant is assistance in cash or in kind for compliance of future or past. Not every time because you complied with some condition, government will give money. Certain times government will give grant expecting you to comply in the future. ಮುಂದೊಂದು ದಿನ ನೀವು ಕಂಪ್ಲೀಟ್ ಮಾಡ್ತೀರಾ ಕಂಡೀಷನ್ ಅಂತ ಹೇಳಿ government has given you grant. What if we don't comply with that condition in the future? They will take that money back. They will tell, I will give you one machinery free, but you would have to do minimum 10 crores of export business every year. I will give you one machine, you should do minimum 10 crores of export business every year. What if I give you and then after that you don't do 10 crores of export business? Then I will say, give me my asset back or give me the money for the sake of the asset. I had given you asset free, no. You would have to give me the money or you would have to give the asset back. So then whatever entry we would have previously done for the grant has to be now reversed. You got it? So let's say related to fixed asset. Asset was 100 lakhs. Okay. I gave you 40, you paid 60 and you bought the asset. You failed to comply with the condition. Now I am asking you to pay the 40 lakhs to me. Let us say initially you recorded the asset at 60 lakhs because you paid 60. You wrote the entry fixed asset to cash 100 lakhs, 100 lakhs. Then you wrote cash to fixed assets 40 lakhs, 40 lakhs because I gave you cash. You recorded the asset at 60. You reduce the government grant from the asset. Now I am asking the money. You're paying 40, increase the value of the asset, right? Fixed asset account debit 40 to cash 40. What if you had recorded the asset at 100 and the grant what I gave you, you wrote it as cash account debit to grant. Then what will you do? Now you'll write grant account debit to cash. When I gave you 40, what is the entry you wrote? You have two options. One, cash account will be debited. Did you credit the asset or did you credit the grant? If you have credited the asset, now you debit the asset. If you credited the grant, now you debit the grant. ಆವಾಗ ಏನು ಮಾಡ್ತೀವಿ ಅದನ್ನ ಉಲ್ಟಾ ಮಾಡಬೇಕು. One question that you should be little cautious is, let us say 100 lakhs is the cost of the asset. I gave you 40, you are putting 60. You recorded the asset at 100 lakh. Grant that I gave, you recorded it separately. You didn't adjust with the asset. But 40 lakhs only, 4 lakhs you transfer to P&L already. At the end of 1 year, how much is there in grant account? 36. But I'm asking you to pay me back 40 lakh rupees. What is the entry then? Grant account debit 36 lakh. P&L account debit 4 lakh. To cash 40 lakh. You had credited P&L. Now you debit P&L. Basically, you do reversal of what you have done in the past. Reversal of what you have done in the past. Too fast? Are you able to get it? If you have read once, you will understand. If this is the first time reading, then it will become too fast. Got it? Then, if it is related to revenue, same. When I gave that revenue to you, when I pay that electricity expense to you, you had booked as income. Now you reverse it. Now you book it as expense. Debit your P&L. If in case I had given you promoter's contribution, then I understood that documents that you filed are all fake documents. Now what do? I'll ask for government grant to be paid back to me. Ulta. What is the entry then? Yeah, capital reserve debit to cash. When I gave the money to you, you wrote cash to capital reserve. When you reverse, you write capital reserve to cash. Understood? Very good. Lastly, you need to disclose the accounting policy. What is accounting policy? When that grant is received against asset, I told you, you have an option. You can adjust against the asset or write it separately. What have you chosen to do? Disclose that accounting policy. And nature and extent of government grant recognized. Whenever there is government grant received, you tell no whether is it capital grant, that is that capital contribution, is it received against asset, or is it received against revenue expense, is it asset given at concessional price, or is it asset given free of cost? What is that government grant? You recognize that government grant. You tell that, disclose the nature of the government grant and amount of that government grant recognized as income in the current year. You get this? One more point, I already told this to you, I'll tell you once again. Government grant will not be recognized in P&L when it is received. It is recognized in P&L when you think you have the conditions that is supposed to be fulfilled to be received. Meaning, when there is reasonable assurance that you will fulfill all the conditions, and when there is certainty that you will receive that money, you will record it. Let's say I have to give you money. You have fulfilled all the conditions. You have filed the grant claim with me. I am yet to give. Still you can receive. Still you can record it. Let us say I have given you the money, but you know pakka that you will not fulfill the conditions. You would have to refund it. Though you received the money, you will not recognize it as income. You will write it as advance received liability and you will pay it back to me when the conditions are failed to be fulfilled. When you have reasonable assurance that you will fulfill all the conditions, only then you will recognize it as income. Did you understand this? Everyone? Very good. So this is your accounting standard 12. Accounting standard 13 talks about investments. See, if you have invested money in shares, debentures or any other securities, It is specifically excluded from AS2, though it is in the purpose of trading. It is specifically excluded from AS10 and it is only included in Accounting Standard 13. Accounting Standard 13 defines investment as it is an asset held for two purposes. One, earning interest, dividend or rental money, or for capital appreciation. When we use the word rental, remember that investment property is also covered under this actually. But our questions are restricted to only investment in shares and debentures. But actually investment property is also included in this context only. Rental income. Got it? Very good. So what are investments? Investments are assets held for the purpose of earning interest income, dividend income, rental income, or for the purpose of capital appreciation or any other benefits. Now, this does not include, it doesn't tell when to recognize dividend, interest, and rental. That is told in Accounting Standard 9. And if it is investment in the form of operating or finance lease, again that is not covered under AS 13, it is covered under AS 19. And if you have made any investment for the purpose of employee benefit plan, like when the employees retire or when the employees get out of the job, you need to give them retirement benefit, no termination benefits or post employment benefits. So to do that, you invest some money in plan assets ಅಂತ ಹೇಳ್ತೀರಾ. Remember defined benefit plans, defined contribution plans. So you invest some money, no? So that money invested, it is an investment. But the treatment of that, you follow Accounting Standard 15 and don't apply AS 13. You get that? Because that termination and post employment along with your reclassification will become little kitch kitch. So they say follow AS 15, don't follow AS 13. So these are specifically not covered under Accounting Standard 13. So for the purpose of accounting, under Accounting Standard 13, investments are classified into three categories: current investments, non-current investments. These are securities, shares, debentures, and then bonds. But there is something else called as investment property, which is not intended to be occupied or used in operations. It is used exclusively for renting. I have a building, my intention is not to use it for my purpose. I won't stay there. You get it? My only objective is to give it as rent, and renting is not my normal business. My normal business is manufacturing or rendering of service or investing or something. Sorry, not investing, other than investing. But I have one property which I'm giving out for rent. That will come investment, that will become investment property as per AS 13. But that we have no questions in Accounting Standard 13 in our material. Because rent, when it is received, it will become income. You don't have such complication like your what to say, investment in house property, standard rent to normal rent to actual rent. Oh my god, you don't have all of that. So here simple, rental income received, income, or right to receive is established, income. AS9 prakara record ಮಾಡ್ತೀವಿ. You don't have any questions on investment property. So our major discussion in investment is only on securities. So this entire investment will be classified into two major classifications. How many? Two. Number one, current investments. Number two, non-current investments. This current and non-current is based on the period of holding, not actual but intended or expected. Actually ಎಷ್ಟು ದಿನ ಇಟ್ಕೊಂಡಿದೀವಿ ಅನ್ನೋದು ಲೆಕ್ಕಕ್ಕೆ ಬರೋದಿಲ್ಲ. What is our intended period of holding? When I buy an investment, if it is intended to be sold within 12 months, I might hold it for 15 months. But what is my intention? To sell it within 12 months. That will become current investments. If in case I have an intention to hold it for long term, but I got a good price, I sold it in 2 months. Though I sold it after 2 months, it will still be considered as non-current investment. Here it is based on intention. This is completely opposite to your tax. Tax ಅಲ್ಲಿ we don't go by intentions. Why? We will see STCGL tax ಜಾಸ್ತಿ ಬರುತ್ತಾ, LTCGL tax ಬರುತ್ತಾ ನೋಡ್ಬಿಟ್ಟು ನಾವು ಇದು ನನ್ನ intention was short term but by mistake I held it long term. So they say I don't go by your intention, shut up and pay for the actual period. Actually held for more than 12 months, long term capital asset. Actually held for less than 12 months, short term capital asset. I don't care about your intention. 12 months 1 day, long term. 11 months 29 days, short term. You get it? Here, if you hold for 15 months, still you can call it short term. If you hold it for 3 days and you sold, still you can call it long term. I had an intention of long term, but unfortunately I sold it after 3 days. Are you getting it? Very good. So it is intended period of holding, not actual, and it should be readily realizable. It's like naming intention idre sakagalla. Market also should be ready to sell it. So it should be like a listed security, or there should be market where you can sell it. There should be buyers. So all of that should be there. You cannot buy investment in some private company and then call it my short term investment. No, unless there is a possibility that they have promised that they'll buy the shares back from you at the end of certain 3 months or 4 months. Unless there is such agreement, shares in a private company cannot be called as current investment. It will be called as non-current only. So why do we classify them into current and non-current? Very simple. This is based on this is for the purpose of accounting. If it is a current investments, accounting is done at cost or fair value, that is market price, whichever is less. If it is non-current, you have an intention of holding it for a pretty long term, it should be recorded at historical cost only. Unless such decrease in the price from historical cost is permanent in nature. I'll repeat. If it is current investments, it should be recorded at cost or market price, whichever is less. However, if it is non-current investments, it will be recorded at historical cost only, unless such decrease in the cost is permanent in nature. From 700 rupees, the share dropped to 30, and this is permanent drop. 30 ಮತ್ತೆ 700 ಹೋಗಲ್ಲ, 30 maximum 50 ಅಥವಾ 60 ಹೋಗ್ಬೋದು. Such decrease that happened no, because of some major fault that is there in the company, entire board resigned, there is one big loss to the company, that is permanent decrease, then you will write it to P&L. If not, you bought it at 700, the share price went to 670, still record it at 700. The share price went out to 750 or 760, still record it at that price. Let's say you buy ITC, I'm expecting a breakthrough. So let's say you buy ITC at 501 today. So no stock tip, I am not a CB registered dealer, I won't give any stock tips. So let's say you buy ITC at 500 rupees. After you buy ITC at 500 rupees, Government of India realizes that tobacco causes cancer, and lot of people are getting deceived, and mere advertisement that you will get cancer is not sufficient. They will ban tobacco in the country. No one can smoke cigarettes. Then what will happen to ITC share? They have exposure to hospitality sector, FMCG sector, classmate book over there. But do you really think they're making so much revenue from classmate books? No. So let's say 500 rupees share price drops to 100. 100 rupees with 400 rupees decrease. It is your long-term investments. You will record it at 100 and book 400 rupees per share loss. Why? Such decrease is permanent in nature. Let us say due to some normal market fluctuation, 500 rupees went up to 600 or it came down to 400. Then you will still record it at 500 if it is your long-term investment. If I bought it for short-term investment, then at the end of the year, I will restate it at cost or market price, whichever is less. That market price is given a word called as fair value. Fair value means what? Arm's length price between two unrelated parties in a knowledgeable market without undue influence and coercion. At what price do we enter into a contract? That is arm's length price. Like you are my friend or like you are my student, I'll say, from me won't you buy shares? Like I'll teach CA final classes of financial reporting free to you, but each share of mine, which is of 100 rupees, you should buy it from me at 300 rupees. Now I can unduly influence you. Or I will take one knife. Let's say I come in one vehicle, so I will come in one vehicle, I keep one rod next to your head and then say buy it at 10,000 rupees. If not, then you buy it. So then it's not arm's length price. Arm's length price means we both are at one arm distance, not like very close to each other. I'm keeping knife on your throat. So we are maintaining one arm distance and we are unrelated parties. We are not like relatives. We are unrelated parties and both of us are knowledgeable. It's not like you don't understand. You are like you are not financially sound. I sold it at higher value. It is not like that. Both of us are knowledgeable and it is an active market and market is also knowledgeable. It is not like a very remote place where marketally now what has happened, there is some war scenario happening or what is it, we're on the top of a mountain. I'm saying you buy one water bottle from me for 10,000 rupees, then you will buy. So it's an uncontrolled market, unrelated parties, and there is no undue influence, coercion. Then whatever price at which I sell it to you will become the fair value. You get what I'm trying to tell? Yes or no? Very good. So investments which are current should be recorded at cost or fair value, whichever is less. Non-current investment should be recorded at cost unless such decrease in the price is permanent in nature. When you say cost, how to do cost? How to compute cost? There are two formulas. There are two methods which are allowed. You can follow first in first out or you can follow weighted average method. Sir, why does this cost first in first out and weighted average come into picture? Because let's say I bought 100 shares of ITC yesterday. I bought 50 shares of ITC today. I buy 50 shares of ITC tomorrow. Yesterday it was 500. Today it is 490. Tomorrow it is 510. When I sell 150 shares after 1 week, then what do you take? Two methods. One first in first out. Andre first bandit shares sale agutte. Second and third lot will still remain. Weighted average means number of shares multiplied by average price. Total amount, total number of shares if you divide, you will get average price. It will be recorded at that average price. Are you getting it? In your all demat accounts, it will happen on first in first out. Why? Because for taxation purpose, it is first in first out. For taxation purpose, when you file your income tax return, no, you need to disclose your income based on first in first out. So your demat accounts run under first in first out. However, for the purpose of accounting, AS13 gives you both the options. You can follow FIFO or you can follow weighted average method. Either of it is okay. Artha aita idya? Very good. So then, what is it? Cost. What and all will cost include? Cost will include purchase price, the money that you pay to buy. Second, it will include brokerage. If in case you pay any brokerage to buy that, that will be included. And stamp duties and any other registration fee. Once you take it, usually now it's not there. But previously, let's say I sell the share to you. Share is in my name. Now share certificate will come to your name. Share certificate will actually not come to your name. We both will have one sale agreement. You should take the share certificate which has my name, and you should take the sale agreement between me and you. Take both of them to the company and then give. Then the company will change the name in their register and give you new share certificate with your name. For doing this, company is charging you some money as registration charges. That cost is also part of your asset. Let's say you buy one land, ಎಷ್ಟಾಯ್ತು ಅಂತ ಹೇಳಿದ್ರೆ 1,20,00,000 ಆಯ್ತು, ರಿಜಿಸ್ಟ್ರೇಷನ್ ಎಲ್ಲ ಸೇರಿಸಿ 1,35,00,000 ಆಯ್ತು ಅಂತೀರಾ. So when you record that asset in your books, no, you recorded it 1,35 lakhs, 1,20 lakhs what you pay to the seller, and then 15 lakhs what you incurred for registration charges. So everything will be included in the cost of the asset. Basically, like PPE, we tell no any expenditure incurred till the time the asset is ready to be put to use. Here there is no concept of ready to be put to use, but any expenditure is incurred in the process of purchasing is to be added, like brokerage as well as registration fee, stamp duty, for sale agreement stamp duty, and all of this. Usually brokerage and stamp duty and stamp fees will be given as percentage. So you add that percentage. You get it? Now the purchase whatever we agree upon can be X interest price, can be cum interest price. There can be two kinds of shares, two kinds of instruments. One is debt instrument, other one is equity or preference instrument. Let us say you are buying debentures from me. What are you buying? Debentures from me. Debenture interest is due in September and March. Once in 6 months, the company will give money. When will the company give money? 30th of September and 31st of March. ನಾನು ಏಪ್ರಿಲ್ ಮೇ ಜೂನ್ ಜುಲೈ ಆಗಸ್ಟ್ 5 ತಿಂಗಳು ನನ್ನ ಹತ್ರ ಇದೆ. 5 months I am holding the debenture. After 1 month I'll get 6 months interest. Today I am selling the debenture to you. You buy it for 1 month. In the month of September, when the company is giving interest, will company give me 5 months interest and give you 1 month interest? Because I held 5 months. No, company doesn't do that. On 30th of September, whoever has the debenture, for them they give 6 months interest. But do you deserve 6 months interest? You held it only for 5 months. Sorry, you held it only for 1 month. So what I do is, whenever I'm selling the debenture to you, I will ask you to pay the money for debenture and also 5 months interest to me. Are you getting it? So you pay me 5 months interest, you receive 6 months interest. So that 5 months interest what you pay to me is not to be included in the cost of the investment. So if the price given in the question is X interest price, very good. If the question mentions cumulative of interest price, what should you do? Eliminate the interest from that and record the X interest price as your asset. That interest amount will be recorded as expense. You get 5 months interest will become expense. Then you will receive 6 months interest, that will become income. 5 months expense bardu, 6 months income bardu, 1 month income aitalva. Yeah, that's how you will record it. Now let us say you are paying me money for the debenture and you're also paying me 5 months of interest because I'm selling it to you in August 31st. Artha aita? Now I don't know you, you don't know me. Between us there is a broker. Between us there is a, this broker is charging 1% brokerage. 1%. My question, will you pay 1% brokerage on excluding interest price or interest or cumulative of interest price? That is debenture price plus interest. Cumulative of interest price mele 1% brokerage, X interest price mele 1% brokerage. Come on, tell me. Depends upon the price that is mentioned in the agreement. Broker doesn't understand cumulative of interest, X interest. Both of us will enter into an agreement. In that agreement, let's say we wrote 105 cumulative of interest. He will ask 1% on 105. If both of us will say, we will deal for 102 rupees, okay? Interest amel nan kodtini. I will give you interest separately. You munde helbeda. Don't tell in front of this guy. Why? If you tell in front of broker, he'll ask brokerage on interest also. So we both agree to settle at 102 X interest. On the agreement we mentioned 102 X interest. So broker will ask commission on 102. Interest we will settle separately. If you don't pay me interest, I can't go to broker and ask him help. Why? He's like, you didn't tell me, no, behind my back you're trying to settle it. No, you're sorry. You get it, no? So if you mention it in the agreement, his involvement is there. If you don't mention in the agreement, his involvement is not there. If his involvement is there, we need to pay him brokerage also on the same. Sir, how do we get to know? Remember, in the question, whatever price they mention, on that we compute brokerage. Let us say there are 4 transactions. First transaction, they have given cumulative interest price. Second transaction, they have given X interest price. For the first transaction, you will compute brokerage on cumulative interest price, whatever is given. Second transaction, they've given X interest price, on that you compute brokerage. So compute brokerage as a percentage on the amount mentioned in the question, whether it is cumulative or X interest. You get it? You are buying the debenture. So you pay brokerage, you add it to your purchase cost. Got it? I am selling the debenture. I deduct it from my sale consideration. When I sold it to you, I am receiving money from you. From that money, I am giving some brokerage. So to buyer, brokerage will be added to the cost of investment. To the seller, brokerage will be deducted from the sale consideration. Did you understand this? Say something. Very good. So that interest, dividend or rental, whatever is there, it will be transferred to P&L. I told no 5 months interest what you pay expense, 6 months interest what you receive income. Dividend what you receive if it is equity share is income. Rental is also income. But if it is pre-acquisition in nature, it should be adjusted against cost. This pre-acquisition will come usually with dividend. You get what I'm trying to tell? With interest also it will come. Let's say I'm charging you 105, or let's say I'm charging 1,20,000 rupees for debentures. 5 months interest also I'm collecting from you. Why? I'm selling it to you in August, interest rate is September. So that 5 months interest is already included in 1,20,000. Then you deduct, no, and book it as expense. So that pre-acquisition interest is deducted from the cost. It is deducted from the cost, adjusted against the cost. And then comes pre-acquisition dividend. This is very, very interesting. You guys would have to pay some attention. Usually people get this concept wrong. So be little conscious. Okay, correct. What do you mean by pre-acquisition dividend? So dividend received after acquisition is post-acquisition. Dividend received before acquisition is pre-acquisition. Hey, little you should think, okay, why will you receive dividend before acquiring the shares? You will receive dividend only after you acquire the shares. Let's say you acquire the shares in August. When did you acquire the shares? You acquired shares in my company in August. I gave you dividend in the month of September. Is it pre-acquisition dividend or post-acquisition dividend? Depends from what profit am I giving dividend. Depends on from what profit am I giving dividend. You acquired shares when? August 2024. I am giving dividend for the financial year 23-24. 1st of April 2023 to 31st of March 2024 financial year, whatever profit is earned, no. On that, I had proposed dividend on 31st of March. I declared a dividend in general meeting in August. Now I am distributing the dividend to you. You tell me, were you holding the share 1st of April 2023 to 31st of March 2024? No. But you are receiving dividend in August. That becomes pre-acquisition dividend. Let us say you purchased that shares for 5,000 rupees. You had recorded it at 5,000. Now you receive 200 rupees dividend. What you will do is 5,000 in your investment account you had written in amount column, debit side, credit side, not in the dividend column. In the amount column you will write 200. Why? 5,000 is already recorded. You cannot make 5,000 now 4,800. Why? You purchased in August. I gave dividend in September. Sir, August ಅಲ್ಲಿ 4,800 ಬರೀತಾ ಇದ್ದೆ. ನಿಮ್ಮ ಹತ್ರ ಏನು ಟೈಮ್ ಮಿಷಿನ್ ಇದೆಯಾ? How will you know in August that in September I'll give 200 rupees dividend? You will not know. So when you purchased it for 5,000, you recorded investment at 5,000. In the month of September, when you receive 200 rupees dividend, which is for the year 2023-24, 1st of April 2023 to 31st of March 2024, during which you are not holding the share, what will you do? That 200 will be deducted from 5,000, but 5,000 is already recorded. So you write that 200 in the credit side amount column. If you write 5,000 debit, 200 credit, it will become 4,800 debit. Did you understand this? This is if it is. What if I give you interim dividend for 24-25? You hold for one year or 1 day also, it is post acquisition only. You hold it even for 1 day in 2024-25, it is post acquisition. This will not be adjusted against the cost. This will go to P&L account, meaning you will write it in the dividend column. Dividend column will be closed by transfer to P&L. Same share, instead of buying it in August, you bought it on 31st of March. When did you buy? In the month of September, I give you dividend for last year. It becomes post acquisition. Even if you hold for one day in the previous year, it will be post acquisition. If you don't hold, it will become pre acquisition. Did you understand? Why does this come for equity share only? Why not for debenture? Debenture, fixed rate of interest you can compute. Dividend, it is based on declaration. Do you get that? Quickly read this. What is pre-acquisition dividend? Dividend received for a period during which shares were not held. Let us say final dividend for 2023-24 was received in July 2024 when the shares were purchased in May. During 23-24 you did not hold shares. You bought it in May and you received dividend in June. June only whatever dividend you received is pre-acquisition. So May when you paid the money, you paid for the share as well as the dividend. But you did not know how much dividend. Now when you get to know, you would have to deduct. Are you getting it? It's like this. You bought one nai which is already having puppies in its stomach. So there is no contribution of yours. So after you take the dog, if the dog puts puppy, and then that puppies, if you sell and then you get money, that will be deducted from the cost of acquisition of that dog. You get that? However, when you get that dog, no, the dog is not pregnated. Like after you get the dog has puppies now. So your contribution is there in that. So that revenue what you get will become revenue income. It will not, that profit, the dividend what you get will become revenue. It is not capital in nature. There is always difference between capital profit and revenue profit. Capital profit is one time. Revenue profit is multiple times. After you get the dog, it can give birth to puppies any number of times. Your contribution. When you get the dog only, it's already pregnant, and later it gives birth to puppies. There is no contribution of yours. That is capital in nature. There is difference. You always treat those puppies and the next set of puppies differently. I'm talking about dividend. You get what I'm trying to tell? Pakka. Post acquisition dividend means what? See here. Your contribution is there. Dividend is received for a period during which the shares are held. Final dividend for the year 2023-24 is received in July and shares were purchased on 1st of April 2024. You have those shares. Opening balance of current year. And then last year also you are holding the shares. So what do? You write it through dividend column to P&L account. You get it? Whenever you see this lecture, if you're watching it online, please drop a message. I will share one video link to you, which is one question on current investments, which covers both what you say first in, first out and weighted average method in the same question. And I'll share one more video link to you, which is one question which has fixed income bearing securities and variable income bearing securities. Meaning there is equity shares, preference shares, and debentures. All the three in one question. And there is reclassification adjustment also in that question. So those two questions video link I'll share it to you. It's like master question on investment. So once you see these two questions, you will be ready for exam. Yeah, I'll share that to you people later. Okay. Whatever I told I'll share, but I have not shared. No, please drop a message on Telegram and ask me. Sir, idu kalistini anta helidri kalisilla. You ask, I'll send one message. And how do you get into the Telegram group? Those of you who have not joined the Telegram group, very simple. Search ACCOUNTSMAN. Search for the word accounts man on Telegram. You will get one first channel, broadcast channel. It is called as accounts man for accounts. So you select that. Then there is one message in that called as discussion channel for CA Foundation, discussion channel for CA Inter. Click on that CA Inter channel and then join. Sir, why two channels? Because I don't want to make it a public channel. I want to keep it private. Public andre ellaru bandbittu click on this link, see the magic. Oh my god, I did not believe till the time I saw this. I got $10 million. Sumne ondashtu message ಆಗ್ತಾರೆ. Anyone wants to buy this class, anyone wants to buy that class, I've got it, I want to, ondashtu what to say spam messages will come. So I've kept that as a private link for healthy conversation and then discussion only. No spamming, no happy new year, you have to say Merry Christmas, good night, good morning, and all. I won't send all of that. I'll send only what means business in that Telegram channel. And if in case I've told I'll share something but I've not shared, drop a message there. I'll share the video link in that channel. You got it? Very good. So then we'll talk about two beautiful things. One is right issue, other one is bonus issue. After that, we'll talk about reclassification. Talking about right issue. What do you mean by right issue? Right issue means the company has issued shares to existing shareholders. Company has issued shares to. Why will the company issue shares to existing shareholders? This is because they want to give the percentage of holding maintenance option to the existing shareholders. Let's say you have 30%, she has 16%, she has 50% stake in the company. If I issue shares not to you but to outsiders, your 30% will become lesser than 30 or 50% will become lesser than 50. So before the company offers shares to outsiders, company should give an option to the existing shareholders to buy the shares to maintain their power in the company. So if I give you an option to buy the shares in the company, that will become right shares. When I give you that option to buy the shares in the company right shares, I'll give you an option to buy at a price lesser than the market price. If I offer it to you at market price or higher than market price, why will you buy? It will be a failed issue. So company will definitely offer the shares to existing shareholders at a price lesser than right price. And this is a condition that whenever the company issues right shares, no, company should give you option. You can buy the shares, you can sell the right, or you can do nothing. You can buy the shares, you can sell the right, or you can do nothing. If you buy the shares, normal purchase entry, investment account debit to cash, how much ever money you pay, number of shares, multiply it 100. If in case you sell the rights, you sell the rights, the value for which you selling the rights will be written in P&L account credit side, should not be written in investment account, because you are not selling shares, you are selling only rights. Are you getting it? So right ಗೆ ಹಣ ಕೊಟ್ಟಾಗ share ಆಗುತ್ತೆ. Right is only right to buy, it is an option, not a share. Are you getting it? So let's say I gave you 10 rights, you don't buy the shares, you sell it to somebody else. So any consideration that you get against those 10 rights will be written in P&L account credit side, should not be written in investment account. However, there is an exception. Immediately after the right issue, the share price dropped and you had bought the shares just before right issue. You bought the shares just before right issue, immediately after right issue, the share price dropped and you sold the rights. Then that consideration can be written as decrease in the cost of acquisition in investment account. I'll repeat. Whenever the company offers right shares, as an investor, you have three options. One, buy the shares. Two, sell the right. Three, do nothing. If in case you buy, normal purchase entry. If in case you sell the rights, that sale consideration that you receive, that difference between theoretical X right price and cumulative right price, where do you write it? You should write it to P&L account credit side. It should not affect investment. Why? You are not selling the shares. However, if you buy the shares just before right issue at the cumulative right price, the moment you buy, there is right issue. You don't want to buy the right shares, you sold the rights, and immediately after right issue, the price will become theoretical X right price, share price drop. Then you know what's happening. It is current investment. You are recording at cost or market price, whichever is less. Cost was cumulative right price. Market price is theoretical X right price. So when you do whichever is less, you will record it at a lesser price. Shares you bought it at, let's say, 200 rupees. After I sold it to you for 200, rights were offered, and after right the price came down to 150. No, so you bought it at 200, closing rate is 150. You will record at 150. 50 rupees per share into number of shares, you will record loss in P&L account debit side. Why did that price decrease? Because you sold rights. That rights, when you sold, whatever consideration you got, you wrote P&L account credit side as income. Same amount is income, same amount is expense. See, Angela Martara. No. So instead, what do? Instead of writing same amount expense, same amount income, that sale of right consideration, whatever you get, can be written in investment account credit side in amount column. When do you write it? Only if you bought the shares just before right issue, you sold the rights, and immediately after right issue there is year end and the price has dropped because of right issue. Because of right issue, the price has dropped. Then you will do this. Understood this? See this. If you subscribe to the shares, what do? Treat it like any other purchase. Don't add brokerage. Company will not take any brokerage. If you renounce, sell the right, what do? Sale consideration to be taken as P&L. If purchase was at come right price, price decreased after right issue, we may choose to decrease the cost by such consideration. We may choose. It's an option only. Okay. Then if you do nothing, you don't buy, you don't sell, then you also pass no journal entry. Got it? What is cumulative right price? The price of the share before the right issue. What is right issue price? Price what the company will collect for the right shares. What is theoretical X right price? Expected market price after the right issue. How will you find theoretical X right price? number of shares before right issue multiplied by cumulative right price plus number of right shares multiplied by right price divided by number of shares held before plus number of right shares. This will give you theoretical X right price. I'll repeat, number of shares held before right issue multiplied by the cumulative right price, that is the price in the market before right issue, plus number of right shares multiplied by right issue price, whole divided by number of shares that was there before right issue plus number of right shares. This will give you theoretical X right price. Theoretical X right price is the price in the market after right issue. Cumulative right price in the market before right issue. Cumulative right price and theoretical X right price difference is value of right, the rate at which you should sell those rights. If you sell it at a higher price than that, you will make profit. If you sell it at a lower price than that, you will make loss. If you sell it at that exact rate, then there will be no profit, no loss. How much ever profit you make, how much ever consideration you get, to the same extent your share prices will drop. Again, on right issue, I had shared one quick revision video to you because you people, fortunately or unfortunately, were a group of students who studied, who never studied right issue at foundation because you were under old scheme. And when you were in foundation, right issue was in inter. When you came to inter, right issue went to foundation. If you skipped it, ask. I'll share that topic video again. Right issue and bonus issue. Then bonus issue. What is bonus issue? It is capitalization of reserves. It is free share given to the existing shareholder. You will not give any money, but you will get shares. So this will not change anything in the amount column. Just increase the number of shares and increase the nominal value. In the nominal value column, you write the number of shares. So in the number of shares, you write number of shares you get, and you increase the nominal value. When you do this, average price will change. Average price will change. Sir, what if we are following first in first out? Then again you need to average this out with the other shares to find out the price. You cannot say bonus issue sales, entire sale consideration is profit agala. Let's say you have 100 shares. I will give you 20 shares as bonus. 100 shares value whatever is there will be divided by 120 to identify the value of each share, even if you follow first in first out. Even if you follow first in first out, for bonus issue, what should you do? Average out the cost before recording the sale. Understood this? Please don't forget. Today do one question with bonus issue, right issue adjustment. One on FIFO, one on VAM. When we've done in the class, same questions we've done in our FIFO and VAM, though they've asked only FIFO. If they've asked only FIFO, we still did FIFO and VAM. If they had asked only VAM, we did both VAM and FIFO again for the same question. Got it? Last topic of discussion in our accounting standard 13, reclassification. Initially you purchased it as current investment. Later can you reclassify it as non-current investment? Yes. Initially you purchased it as non-current investments. Now can you reclassify it as current investment? Answer is again yes. Reclassification is allowed. When you transfer current investment long term to current investments, you need to treat it as current investment anymore. So you should record it at cost or carrying amount, that is book value, whichever is less. Cost, whatever was paid historically, or the carrying amount after decreasing the loss, if any, which is permanent in nature. Whichever is less will be considered as the cost of the current investments. Once it becomes current investment, at the end on the balance sheet date, we'll do cost or fair value, whichever is fair value, whichever is less. However, when the current investment is to be treated as long term, what do? You do cost or fair value, whichever is less as on that date. Let us say last time we did cost or fair value, whichever is less is 31st of March. I am reclassifying this current investment to long term on August. So what should I do? On this 20th of August, I need to find the fair market value. I need to compare the cost. Whichever is less will become the historical cost type for that non-current investment. That will be continue to be recorded at that historical cost forever, unless there is decrease in that value of the item which is permanent in nature. Would you want me to do some questions on that cumulative interest price, X interest price, brokerage part? But you will be able to understand if I'm not wrong. Brokerage is to be computed on cumulative interest price or X interest price, whatever is given to you in the question. And investment should be recognized always at what price? X interest price. If it is pre-acquisition dividend, deduct it from the cost of the investment, that is right in the amount column. If it is post-acquisition dividend, write it in the dividend column. Understood? Right issue only in the nominal value column. Sorry, bonus issue only in the nominal value column. Right issue, if you purchase, number of shares and the amount that you pay. If it is sold, consideration in P&L. Unless after right issue the price is decreasing, you purchased it before right issue, then you have an option to write that consideration in amount column on the credit side. Understood? And that's it. We have nothing else left in this standard to be done. So we could have done some questions, but I hope you people are smart enough to get this part. Okay. Let's now discuss accounting standard 14 amalgamation. And we aren't just doing amalgamation of companies. Alongside with amalgamation accounting standard 14, let's also finish chapter 12. Chapter 12? Chapter 12 or chapter 14? Chapter 13 of our syllabus, amalgamation of companies. See, in the general layman context, no, amalgamation, absorption, external reconstruction, merger, all of them are different. However, for the purpose of accounting standard 14, we have just one word called as amalgamation. This word amalgamation will include merger, will include absorption, will include external reconstruction, will include acquisition. Everything is covered with only one single word, amalgamation. This is much different from how they use the word amalgamation in the business world, but we're talking in the accounting world. In the accounting world, when we use the word amalgamation as per AS 14, this will include absorption, this will include merger, this will include acquisition, this will include every other external reconstruction also in this. Understood? Now, the definition of the word accounting amalgamation is not given anywhere. It will only say that it will include merger also. It will include amalgamation as per Companies Act 2013 and merger. Now, the difference between amalgamation, absorption and external reconstruction, this is for business world, not in our accounting world, is like this. If two or more companies come together to continue business, amalgamation. If one entity takes over another entity, it is absorption. If one new company is created to take over the business of an existing company, it is external reconstruction. In the case of amalgamation, minimum two companies are liquidated and one new company is incorporated. In absorption, minimum one company is liquidated, no new company is incorporated, an existing business only will take over. In external reconstruction, there is one liquidation and one incorporation. One company will incorporate one new company and transfer its entire assets, liabilities and business to that new company. That is external reconstruction. However, when we talk about amalgamation in the perspective of accounting standard 14, merger, acquisition, external reconstruction, absorption, everything is covered. And in this process, there are two parties. One is transferor, other one is transferee. Transferee company is the company which is receiving the assets, which is receiving the liabilities, which is taking over the business. We call it the big company. Transferor is a small company which is dying, which is transferring us assets, liabilities so that it will die peacefully. So that is transferor company. Small company is transferor company. Big company is transferee company. Did you understand the difference between transferor and transferee? Very good. Now, let's see upon here as to when do we consider amalgamation, how do we do accounting for amalgamation? As per accounting standard 14, all the amalgamations are classified into two categories. All the amalgamations are classified into how many categories? Only two. One is amalgamation in the nature of merger. Two is amalgamation in the nature of purchase. Number one, amalgamation in the nature of merger. Two, amalgamation in the nature of purchase. How do we decide whether it is amalgamation in the nature of merger or purchase? This is decided based on accounting standard 14. So accounting standard 14 gives us 5 conditions. How many conditions? 5 conditions as per para 3. If all the 5 conditions are satisfied, it is merger. Even if one out of these 5 conditions are not satisfied, it is purchase. I'll tell you, amalgamation for the purpose of accounting, exclusively for the purpose of accounting, is classified into how many categories? Two categories. What are they? Merger, purchase. So AS14 is telling merger and purchase. So AS14 only should tell when is it merger, when is it purchase. So AS14 will call it as merger if it fulfills all the 5 conditions. It will be called as purchase if it doesn't fulfill even one out of 5 conditions. So what are the 5 conditions? Let's see those 5 conditions and then come back. Number 1, all the assets and liabilities of the transferor company should be taken over by transferee company. What is condition number 1? All the assets and liabilities of transferor company should be taken over by, including reserves and surplus. Condition number 2, minimum 90% of the shareholders of transferor company should continue to be shareholders in transferee company. In this 90%, shares held by transferee directly or through subsidiaries is not considered. So number one, all assets and liabilities, including reserves and surplus of transferor, should be taken over. Number two, minimum 90% of shareholders of transferor should continue to be shareholders in transferee. And in this 90%, we exclude shares held by transferee directly or through subsidiary. Third condition is I should continue their business. Sorry, that is fourth condition. Third condition is consideration to shareholders of transferor company should be settled by way of equity shares in transferee company. ಆ ಕಂಪನಿ ಶೇರ್ ಹೋಲ್ಡರ್ಸ್ಗೆ ಈ ಕಂಪನಿನಲ್ಲಿ ಶೇರ್ಸ್ ಕೊಡಬೇಕು, ಈಕ್ವಿಟಿ ಶೇರ್ಸ್ ಕೊಡಬೇಕು. Can you give them cash? Answer is no, you cannot. However, there is an exception for fractional part, meaning let's say the exchange ratio comes to be like for every 2 shares in transferor company you are giving 1 share in transfer. For every 2 shares in transfer you are giving 1 share in. There is a shareholder who holds 3 shares in transferor. Can you give him 1.5 share? Is an auto driver 1.5 alla kelake. You can't give 1.5 shares. You get this? Already it is a share. How can you further share it? It is already a share. It is like for your friend's birthday you're getting 10 rupees cut honey cake and then on that you are asking him to cut. ಅದು ಆಲ್ರೆಡಿ ಕಟ್ ಮಾಡಿರೋ ಕೇಕ್ ಅದನ್ನ ಎಷ್ಟು ಸತಿ ಕಟ್ ಮಾಡಿಸ್ತೀರಾ? It is bad, no? You cannot further share a share. So what do? If he holds 3 shares, for 2 shares you give 1 share in this company. For this 1 share you give cash. So because you gave cash, will it become amalgamation in the nature of purchase? No. You are giving cash because it is a fractional share. You getting this? So the consideration to shareholders of transferor company should be settled by way of issue of equity shares in transferee company, except for fractional part, which can be settled by way of issue of cash. And then comes the fourth condition. Equity shareholders, you should give the consideration in the form of equity shares only. Yeah, business of the transferor company should be continued by transferee company. Unlock ಮಾಡ್ಬಿಡಿ sir. Yeah, so business of the transferor company should be continued by transferee. Our intention should be to continue their business. Last and final condition, when I take over assets and liabilities of transferor, no, it should be taken over at book value. I cannot do any change in the values. However, if both of us follow different accounting policies, to bring in uniformity in accounting policies, I am allowed to change its value of assets. I follow first in first out, they follow weighted average. I am changing their method of valuing inventory from weighted average to first in first out. So then that inventory value changes. That will not constitute that we have taken the asset at different value and it won't become purchase. It will be still considered as merger. Did you understand this? So what are the 5 conditions? Number 1, all assets should be taken over, including reserves and surplus. Number 2, minimum 90% shareholders should continue. Exception, shares held by transferee. Number 3, PC to equity shareholders of transferor should be by way of equity shares in transfer. Exception, fractional shares. Business of the transferor should be continued by transferee. Last condition, all the assets and liabilities which are taken over should be at book value. If all of these 5 conditions are satisfied, it is merger. If it is merger, then in the books of transferee, my company, when I take over, I will follow pooling of interest method. If it is not merger, even if one out of these 5 conditions is not satisfied, then it will become purchase, amalgamation nature of purchase, transferee should follow purchase method. Which method? Purchase. Both the methods are different. I'll teach you the difference in accounting. So we should identify whether it is merger or purchase because the accounting method is different. However, AS14 is silent about accounting in the books of transferor. If you ask how to do accounting in the books of transferor, AS14 says I don't know. AS14 says I don't know. So the method of accounting in the books of transferor is not told by AS14. So what do? In the books of transferor, we follow GAAP. What do we follow? GAAP andre generally accepted accounting principles. By way of GAAP, that is generally accepted accounting principles. In the books of transferor, we follow realization, liquidation or dissolution approach. All the 3 names are different, but method is same. So it doesn't really matter whether it is merger or purchase. Accounting entries in the books of transferor is same. ಅಲ್ರಿ ಸಾಯೋರಿಗೆ ಉಳ್ತೀರಾ ಸುಡ್ತೀರಾ ಏನು ಇಂಪ್ಯಾಕ್ಟ್ ಆಗೋದಿಲ್ಲ, ಅವ್ರು ಸಾಯ್ತಾರೆ ಅಷ್ಟೇ ಅಲ್ವಾ. So that company is dying, it doesn't matter whether you bury them or burn them, their treatment will be same. However, in the books of the one who's going to live, It matters. How you live matters when you are living. When you are dying, how you die doesn't matter. Because you are dying, no, at the end of the day. You get it or not? For half an hour, they'll cry. After that, to Chitrana Mate, another copy tarastare. Chitrana copy ಬಂದಕ್ಷಣ everyone will stop crying and then like, ನನ್ನ ಚಿತ್ರಾನ್ನದಲ್ಲಿ ಮೆಣಸಿನಕಾಯಿ ಸಿಕ್ತು, ನಿನ್ನ ಚಿತ್ರಾನ್ನದಲ್ಲಿ ಕಡಲೆಕಾಯಿ ಬೀಜ ಇದೆಯಾ? People will forget. So this is basis of accounting. Now let's quickly understand the concept of purchase consideration. What do you mean by purchase consideration? Money given to the shareholders of the transferor company. So there are three kinds of people who will come when that company is dying: debenture holders, equity shareholders, and preference shareholders. Whatever you give to this equity shareholders and preference shareholders, whatever you give is PC. To debenture holders, even if you give equity shares, it's not PC. To equity shareholders, even if you give debentures, it is PC. So remember that PC what is important is whom are you giving to? You know, Bittu. Okay. So what matters is to whom are you giving? What matters is to whom are you? It doesn't matter what are you giving. Alva. To equity shareholders, even if you give debentures, it is PC. To debenture holders, even if you give equity shares, it is not PC. To equity shareholders and preference shareholders, if you give cash, if you give equity shares, if you give debentures, if you give preference shares, everything is PC. To debenture holders, if you give debentures or equity shares or cash, doesn't matter, it is not part of PC. So remember like this: equity shareholders and preference shareholders that were there in that company, to them you give money because that assets and liabilities belong to them. You go to that company, you take their assets and liabilities and come. That is their assets and liabilities. Because you are taking it, you should give them PC. Understood? When you bring assets and liabilities, you are bringing debenture holders also. So that company you give PC, that company is liquidated, dead, no. So here you have debenture holders who have debenture certificate of the company which is dead. That debenture holder is now an orphan. Debenture holder is crying. Will say, don't worry, I will raise you like my debenture holder, and you give them your debenture holder, your debentures. That is not PC. That is after the liquidation of transferor company, you give them new debentures in the place of old debentures. That is post amalgamation adjustment entry. You can give them equity shares. You can give them preference shares. That company might have treated you like a debenture holder, but I will treat you like my own child. I'll treat you like an equity shareholder. So you give equity shares. You can give. Or you can give them cash and then send. Whatever treatment you do, it is post amalgamation adjustment. What is it? So anything given to debenture holders is not PC. What is given to only equity shareholders and preference shareholders is PC. Understood this? Very good. Then let's quickly see methods of PC. There are multiple methods. One is lump sum method. Under lump sum method, they tell the total amount. You are giving 20 lakhs as PC. How that will figure out later. They'll tell some ratio, some basis, and everything. So if they give total amount, that is lump sum method. If they don't tell total amount, they will tell for every 3 shares in that company you give 2 shares. For every 1 share in that company you give 2 rupees cash. For every 1 share you give 1 preference share. They give all these payment details. ಎಷ್ಟು ಹೇಗೆ payment ಮಾಡಬೇಕು, they give payment details. You write all the payment details, take the total. That is payment method. What is that method? Certain times they won't give payment details also. They will tell, I will take that land at 10% more than book value. I will take inventory at 5% less than book value. I will not take debtors. I will take investments at 90,000. They will give all revised figures, full bargain number. So you take all the assets taken over at agreed values, that which you are taking over. All the liabilities taken over at agreed value. Total of assets taken over minus total of liabilities taken over at agreed value. When you do assets taken over at agreed value minus liabilities taken over at agreed value, you will get difference. That is your net assets taken over. What is it? NATO. Did you understand this? NATO need not be PC. NATO is a basis to determine PC. They can say these assets are taken over at this value, these liabilities are taken over at this value. You do so much, it can be PC. Sometimes they say, after all that, they say 1 lakh is paid over and above the NATO. That is goodwill. So you add goodwill to NATO and it will become PC. Are you getting it? Or sometimes if you pay 20,000 lesser than net assets taken over, that will become capital reserve. So NATO is the basis to determine PC. NATO can be equal to PC, but NATO need not be equal to PC. NATO means North Atlantic Treaty or something, no? North Atlantic Trade Organization. Remember social studies? No, it's not that. This is net assets taken. You get this? NATO, net assets taken over, can be equal to PC but need not be equal to PC. If PC is more than NATO, it is goodwill. If PC is less than NATO, it is capital risk. PC is more than NATO. PC means not Pariniti Chopra. PC is Priyanka. No, purchase consideration. If in case you pay more money than the assets that you take, that means you are giving some money for the assets what I and you don't see, but it's still there. What is it? Goodwill. If in case you pay lesser money, you made profit. It is not revenue profit, it is capital profit. So you write it to capital risk. Did you understand? Then comes the last method, intrinsic value method. Intrinsic value method is like NATO, but you won't just find the net assets of transferor, you find it of transferee also. Now remember, I'll identify the assets of the transferor company that I'm taking over, take the liabilities of the transferor company that I'm taking over. I'll arrive at the value of that business that I'm buying. Am I giving them cash? Cash kotre okay, problem illa. I am giving shares of my company. When I give shares of my company, I am giving it nominal value. Nominal value kotre okay, problem illa, but I'm issuing it at some different price. Let's say I agreed that their company's value is 20 lakhs, asset minus liabilities. I am issuing shares of my company at 100 rupees. ಇವಾಗ ಅವ್ರು ಕೇಳ್ತಾರೆ, how do we believe that your company share is 100 rupees? No, I have to prove that my company share is 100. So what do? All the assets of my company minus all the liabilities of my company, I will deduct. I will arrive at total value of my business. Divide it by number of shares that is there in my business. I will arrive at one value, that is intrinsic value per share. In fact, this is the most prominent method. Avaradu intrinsic value, nannadu intrinsic value. For both the companies, I'll take assets minus liabilities, find total intrinsic values. Divide it by number of shares. I'll get intrinsic value per share. That will become exchange ratio. For these many shares in this company, I'll give these many shares in this company. You tell no. That is done based on intrinsic value. Did you understand this? Small intrinsic value adjustment was there in May 24 exam question paper. I hope people have solved it. I've shared you a separate playlist. All the questions of May 24 paper question wise solved. I'll share it for September 24 attempt also. After your exam. After September exam. Obviously, how can I share before September exam? After. If I share solutions to that before September exam, I'll become full famous. Hinge, how can I do it? And I need your help, okay? When you write your September 2024 examination, that first case study question is there, no? 30 marks MCQ. Write it somewhere in your question paper or remember it and then come. The moment you come outside, please text it on Telegram group telling that this was the question, this was the question. I don't want your answer. You type the question. I will promise that I will not discuss the answer in the Telegram group. And if anyone discusses the answer, I will delete that message. Don't worry. I will not make you people feel bad for sending that message. But I want you to send that question to me. ನೆನ್ಪಿಟ್ಕೊಂಬನ್ನಿ ಇಲ್ಲ ಕ್ವಶನ್ ಪೇಪರ್ ಅಲ್ಲಿ ಬರ್ಕೊಂಡು ತಗೊಂಡ್ಬಂದು ಟೈಪ್ ಮಾಡಿ ಕಳಿಸಿ. ಯು ಡೂ ಸಮಥಿಂಗ್. Somehow you people please remember and then text it to me. Why? The point is pretty simple. It will help people who are writing in January. You get it? Sir, what do we get in return? I will ask all the January aspirants to pray for your success in September exam. I will ask all of them to make 1 minute prayer saying that message ಕಳಿಸಿರಲ್ಲ ಅವರೆಲ್ಲ ಪಾಸ್ ಆಗಲಿ ದೇವರೇ ಅಂತ ಪ್ರೇ ಮಾಡೋಕ್ಕೆ. Okay, get it? No? And they will send it in January and people who write in May will pray for people who write in January. Prayers matter. Yeah. When prayers go up, no, blessings come down. More prayers go up, more blessings come down. So if too many people are praying for your success in the exam, God will think that you are a good person. Hey, ತುಂಬಾ ಜನ ಪ್ರೇ ಮಾಡ್ತಾ ಇದ್ದಾರೆ ಈ ಹುಡುಗ ಪಾಸ್ ಆಗಬೇಕು ಅಥವಾ ಈ ಹುಡುಗಿ ಪಾಸ್ ಆಗಬೇಕು ಅಂತ ಹೇಳ್ಬಿಟ್ಟು ಮೇ ಬಿ ಈ ಹುಡುಗ ಅಥವಾ ಹುಡುಗಿ ತುಂಬಾ ಒಳ್ಳೆಯವರು ಇರಬೇಕು, ತುಂಬಾ ಜನಕ್ಕೆ ಒಳ್ಳೇದು ಮಾಡಿರ್ಬೇಕು. ಛೇ, ಇಂಥ ಒಳ್ಳೆಯವರಿಗೆ ಕೆಟ್ಟೋದು ಮಾಡಿದ್ರೆ ನಾನು ದೇವ್ರಿಗೆ ಹೆಂಗ್ ಆಗ್ತೀನಿ? So let me do good for this. So you understand how it works now? So also pray for me also, okay? Not for exam, yeah, ಹಾಗೆ ಅಷ್ಟೇ. Good health, ಬೇರೆ ಏನು ಬೇಡ. I told pray. ಇಲ್ಲಿ ನೋಡಿದ್ರೆ ನೀವೇ ಸಾಯಿಸೋ ಆಗಿದ್ದೀರಾ. Okay, done. So let's start. So goodwill or capital reserve. I told you, if in case the purchase consideration is greater than NATO, it will become goodwill. If in case purchase consideration is lesser than NATO, it will become. Do you get it? And as a matter of gesture, you can start today only. I have ordered sweets. By the end of the day, you will get. As a matter of Raksha Bandhan, you people can get Raksha Bandhan to class and then I'll be very happy. You get it? So last time also we celebrated Raksha Bandhan in class. To the people who are willing to get it tied, you can tie. Okay? You know? Hey, this is something which we have lost the fame of. Okay? Raksha Bandhan is not a festival between brother and sister, especially. It is anyone whom you want to be safeguarded from the bad happenings and then bad and everything. Anyone can tie Rakhi to anyone. A guy friend can tie a Rakhi to another guy friend also. You get what I'm trying to tell? But it is very stereotyped saying that sister only should tie and everything. No, sister-in-law can tie. You get what I'm trying to tell? So anyone can tie Rakhi to anyone. It is just that I want you to be safe. Anta intention ashte. You get what I'm trying to tell? So it doesn't have any just because one person ties Rakhi and ಬೇಡ ಬಿಡಿ ಈಗ ಅದೆಲ್ಲ ಬೇಡ so you get what I'm trying to tell, no? Okay. Let's quickly start with accounting entries. Shall we? Now, accounting entries will start with accounting entries in the books of transferor company. Accounting entries in the books of? Very good. See, in the books of transferor, it does not really matter whether it is amalgamation in the nature of merger or it is amalgamation nature of purchase. Irrespective of the fact whether it is merger or purchase, accounting entries in the books of transferor will be same. So what is the accounting entries in the books of transferor? Very simple. Remember the story, then I'll tell you the entries. First, you will pack all the assets and keep it in one box. Pack all the liabilities and keep it in one box. Balance sheet ಖಾಲಿ ಮಾಡಬೇಕು. Because the business is closing, no? ಮನೆ ಖಾಲಿ ಮಾಡ್ಬೇಕಾದ್ರೆ ಎಲ್ಲ ಪ್ಯಾಕ್ ಮಾಡ್ತೀರಲ್ವಾ? So business ಖಾಲಿ ಮಾಡ್ಬೇಕಾದ್ರೆ assets liabilities pack ಮಾಡಬೇಕು. So once you pack that, you are not going to live forever. You are dying. I'm going to say transferor company. So what do? You give that box to transferee company. You go give that box to transferee company. Bittina? No, you will receive money from them. You give box to them, you will collect purchase consideration from them. Before you come, you will just see once that box what you gave them. No, sometimes they will take whatever they want, whatever they don't want, no, they will throw with the box. If they throw, you will lift that box. Okay, you gave it to them, they threw it, no, you take it. If in case there is any asset in it, you will sell it. If there is any liability in it, you will settle it. After that, what will you do? ದಾರಿಲೆಲ್ಲ ಸ್ವಲ್ಪ ಖರ್ಚಾಗುತ್ತೆ for going, coming, packing and everything. You will incur some money. After paying that money also is paid from what is there in your pocket, what they give. After you pay that, whatever money is left, no, first you will give to preference shareholders, then you will give to equity shareholders. Did you understand this story? First you will transfer all the assets and all the liabilities to one box. Give that box to transferee. Collect consideration from transferee. And then after you collect the consideration, you see if they'll throw. If they throw the box, you take the box, sell the assets in the box, sell the liabilities, pay the liabilities in the box. If in case they don't take it, then what do? You incur some money for this entire commute. Then you will first pay to preference shareholders from the money that you receive, or shares or debentures, whatever you receive. After that, you will pay to equity shareholders. Now, shall we discuss entries? Beginning, that box is called as realization account. What is that box called as? When you transfer all the assets, assets will have debit balance. When you transfer it, asset has to be credited. Realization account will be debited. Entry is realization account debit to assets. All the assets, whether taken over or not, should be transferred at book value. All the assets, whether taken over or not, should be transferred at book value. Cash will be transferred only if it is taken over. Cash will be transferred only if it is not taken over, you won't transfer cash. Why? See, let's say you transfer cash to realization, they'll again throw that box. You will take that box, in that cash is there. Will you sell cash? See, ಅದಕ್ಕೆ ರಿಯಲೈಸೇಷನ್ ಅಕೌಂಟ್ಗೆ ಕ್ಯಾಶ್ ವಿಲ್ ಬಿ ಟ್ರಾನ್ಸ್ಫರ್ಡ್ ಓನ್ಲಿ ಇಫ್ ದೇ ಆರ್ ಟೇಕಿಂಗ್. ಇಫ್ ದೇ ಆರ್ ನಾಟ್ ಟೇಕಿಂಗ್, ವಿಲ್ ನಾಟ್ ಪ್ಯಾಕ್ ದ ಕ್ಯಾಶ್ ಇನ್ ದ ಬಾಕ್ಸ್ ಓನ್ಲಿ. ವಿಲ್ ಕೀಪ್ ದ ಕ್ಯಾಶ್ ವಿತ್ us and then give the box. Understood? Very good. Then entry for the next one. So realization to assets account. This will not include accumulated losses. Accumulated losses, preliminary expense, P&L account, debit balance, underwriting commission, ಅದೆಲ್ಲ transfer ಮಾಡಲ್ಲ. Then we'll transfer all the liabilities. Liabilities will have credit balance. When we transfer it, liabilities will be debited, realization account will be credited. Entry is liabilities account debit to realization. All the liabilities, whether taken over or not, should be transferred at book value. I repeat, all the liabilities, whether taken over or not, should be transferred at book value. We will not transfer equity share capital, preference share capital, reserves and surplus. Other than share capital and reserves, everything else will be transferred to realization account. After this, we'll give this box to them. They are supposed to give us money. This is PC due entry. Transferee company has to give us PC, debit transferee company name. What did we give them? Box. That box name, realization. Entry is transferee company account debit to realization account. After that, they will give us money in the form of PC. Whenever they give PC, you write cash debit, bank debit, equity shares in transferee, preference shares in transferee, debentures in transferee to transferee company. Whatever they give debit, credit their name. Even if they issue shares at premium, even if they issue preference shares at premium, even if they issue debentures at premium, write it to equity shares in transferee, preference shares in transferee, debenture account only. Security premium bariyodilla. Premium will be recorded by transferee, not by transferor. We receive it, we write it at the value that we receive. Then if in case they sell that, if they don't use that assets and liabilities, if they throw that box, we lift that box, and let's say there is asset in that box. Let's say we sold the asset. What is the entry? Bank account debit to cash account debit to realization. If you sell the asset, if in case you settle the liability, realization account debit to bank. If you sell the asset, bank to realization. If you settle the liability, don't try to adjust cost price of the asset, selling price of the asset, profit ಎಲ್ಲ adjust ಮಾಡಬೇಡಿ. Write the entry at settlement price. For liability again, don't try to adjust cost price, settlement price, profit. No, write the entry at settlement price. Are you getting it? If in case nothing is mentioned, assume that asset is sold at 0 rupees. If in case nothing is mentioned, liability is settled at book value, asset is sold for 0 rupees. Don't try to adjust separately the profit or loss on sale or settlement. Understood? Then comes, that is because of conservatism. Then you incur some expense, no realization. Whenever you pay the expense, realization account debit to bank. You will not write any P&L account. If you bear that expense, there is no separate entry supposed to be written. This realization account is like nominal account. We'll identify the profit or loss and transfer to P&L account at the end. If in case transferee company is paying us our realization expense, then reverse the entry. When we paid, we wrote realization to bank. If they give the money, we write bank to realization. If they don't give, no entry. What if they pay? They will write the entry. I will not write any entry. If they pay, but I reimburse it to them. If I pay straight away the expense, or if I pay to them, no difference. When I pay, I'll write realization to bank. If they pay, I write no entry. If I pay and they pay it back to me, when I pay, I write realization to bank. When they pay it to me, I'll write bank to realization. Am I going fast? You will tell me no when I go fast. Yeah, long ago there was one Audi which was going on a highway. Road suddenly ನಾನು ನಿಂತಿತ್ತಂತೆ. ಏನಪ್ಪ ಏನಾಯ್ತು ಅಂದ್ರೆ ಗಾಡಿ ಬ್ರೇಕ್ ಡೌನ್ ಆಯ್ತು ಅಂದ್ರೆ. Okay, don't worry, if your vehicle is stopped, no, I'll tow your vehicle ಅಂತ BMW started towing nano. Then one guy from the far, no, saw this entire scene and he got heart attack. He was taken to hospital and asked what happened. He told, I was really surprised to see what happened. What actually happened is BMW, when he was going, no, he had told this guy behind nano, at any point of time, if I forget that I'm towing you and I go really fast, you blink your lights, I will slow down the speed. At one point, what happened? Pakdal on the Mercedes Benz went. BMW and then Mercedes Benz, they got into one kind of race. Face to face, they saw. So they both started racing each other. From a distance, when one guy is seeing, he didn't see that rope. All he could see is one BMW and Mercedes are racing with each other, and behind there is a nano blinking the lights. Oh, yo, he is blinking lights to ask them to give way, and they would do heart attack. So you guys should blink your eyes like this, sir. What are it? You should blink. When you blink, I will slow down. If you don't blink, I'll keep going. I am seeing the time left over, standards left over, and I'll increase the speed. You will blink, no? So now nano na. Hey, illa, non BMW. Okay, just kidding. Come on, let's go ahead. So after you write that realization expense entry, what is the next thing? You pay that realization expense also. Then I told you, no, first you should pay to preference shareholders. Then you will pay equity shareholders. You will write preference share capital account debit, whatever you're supposed to pay them, and credit preference shareholder, whatever you're going to pay. See, capital is 1 lakh. If capital is 1 lakh, it does not mean that you should pay them 1 lakh. You might actually decide to pay them more than 1 lakh. You might actually decide to pay them less than 1 lakh. If capital is 1 lakh, you are paying 1 lakh, no problem. If capital is 1 lakh, but you're going to pay more than 1 lakh, whatever you're paying extra should be credited to realization. It will become loss. If in case you are paying, sorry, it should be debited to realization, loss. If in case you are paying less, it will be credited to realization, profit. Understood? So difference in the excess amount or shortage amount payable to preference shareholders, like premium on redemption, will be routed through realization. After that, you will debit that preference shareholder account and give them whatever has to be given as per the PC agreement. You can give them equity shares, preference shares, cash, debentures, heart, lungs, kidney, coding. After you give them whatever you have to give them, before you give equity shareholders, close your realization account by determining profit or loss. Everywhere, wherever you have debited, wherever you have created, take it all together, identify the balance. If realization account ಅಲ್ಲಿ loss ಇದ್ರೆ debit realization, debit equity shareholder, credit realization. If in case there is profit, credit equity shareholder, debit realization. Understood? After this, close your equity share capital, reserves and accumulated losses which you did not transfer to realization account. Debit equity share capital, debit reserves and surplus, and credit equity shareholders. If there is accumulated losses, debit equity shareholder and credit accumulated losses. Finally, whatever consideration is there with you, you pay to your equity shareholders. This is the end of the PC settlement to equity shareholders. This is the last entry. ಈ entry ಬರ್ದಾದ್ಮೇಲೆ transferor company is dead. You get this? They can ask you ledger accounts instead of journal. If they ask ledger, whatever ledger they ask, you do ledger. Sometimes they'll ask only realization. You do only realization. If in case they don't mention what ledgers to prepare, if they say prepare necessary ledger accounts, then what will you prepare? You will prepare number 1 realization account, number 2 transferee company, equity shareholder account, preference shareholder account. If in case the cash is not taken over, then you prepare cash account. I repeat, you prepare realization account, equity shareholder, preference shareholder, transferee company. If cash is not taken over, prepare cash account. Usually they'll mention what ledgers do they want. Got it? Yeah, if they ask journal, you do journal. If they ask ledger, think of the journal entry, post the ledger post. Then comes accounting entries in the books of transferee.
Cash or bank is not taken over, it is still purchase or will it be merger?
If cash or bank balance is not taken over, immediately it will become amalgamation nature of purchase. It can't be merger. If it has to be merger, all the assets, including cash and bank, has to be taken over. No, they are not dropping anything. They're taking it somewhere else. Okay. Yeah. And here, no, they don't go through building. They go over building. Very good. Let's go to the next part. Accounting entries in the books of transferee company. So when you discuss accounting entries in the books of transferee company, we need to check the method of amalgamation. It can be merger or purchase. If it is merger, entries are different. If it is purchase, entries are different. I'll discuss both simultaneously. See, previously I told you the story. From the transferor's perspective, they put assets, liabilities, pack the box, give the box, take the consideration, thrown box, they take, sell the assets, settle the liabilities, they pay expenses, they pay preference shareholders, then profit or loss, then equity shareholders. Now the story from the other perspective. Here the story starts from receiving the box. First we'll receive the box. After we receive the box, first open the box. Unboxing. Assets will come, liabilities will come. Then I give money to them. After I give money to them, I will be organizing these assets and liabilities in my balance sheet. When I'm organizing these assets and liabilities in my balance sheet, I need to do adjustments for DRUMS, drums, 5 adjustments. So many? DRUMS, 5 adjustments. I'll repeat. I will receive the box, I'll open the box. When I open the box, assets and liabilities will come, I will throw the box. Give them the consideration, arrange these into my balance sheet. Ashte. When I'm arranging, how many adjustments? 5. DRUMS. You people are already going. Interesting. Very good. Then let's start with the first one. That box is there, no? For them it is realization. For me it is business purchase. That box is business purchase. Business purchase account debit. Box is coming in. I should give them money. Liquidators in transferee company account credit. What is the entry? Business purchase account debit to liquidators of transferee company account. So transferor company. Business purchase account debit to liquidators of transferor company. Entry is same in purchase and pooling of interest. There is no difference. After that, I open the assets. When I open the box, assets debit, liabilities credit, and I throw that box. No, business purchase, the name of the box. Credit business purchase. Entry is assets account debit, liabilities account credit, business purchase account credit. Did you understand? Any difference that will arise will be goodwill or capital reserve. See, assets debit and liabilities credit will make it NATO. Business purchase will be written for PC. PC NATO difference. If it is positive goodwill, negative capital reserve. Did you understand that? This is in the case of purchase. If it is merger, you need to remember 2 things. Number 1, assets, liabilities, reserves and surplus to take over martin. I'll take reserves and surplus also at book value. So assets debit, liabilities credit, reserves and surplus also credit, business purchase credit. Any difference that is arising cannot be goodwill or capital reserve. See, merger, it was I, it was you, now it is we. I am not purchasing your business. It's like we are doing business together. So there cannot be profit, there cannot be loss. There cannot be profit or loss arising. It is us anymore. So any difference arising between PC and NATO, if there is any, will be written straight away to reserves and surplus. It will be adjusted with general reserve or reserves and surplus. We won't write it as goodwill or capital reserve. I repeat, in purchase, what do? Assets debit, liabilities credit, business purchase credit. Difference, debit goodwill, credit capital reserve. Merger, assets debit, liabilities and reserves and surplus credit will also credit business purchase. Any difference arising in the nature of goodwill or capital reserve will not be called as goodwill or capital reserve. It will be returned to reserves and surplus. Done. So unboxing entry is over. Next, you should give them PC. When you give them PC, debit that, actually PC entry ಆದ್ಮೇಲೆ ಇದು ಮಾಡೋಣ. You come to this entry now. We will debit that liquidator and give them everything: equity shares, preference shares, debentures, cash. Illi, if there is premium, I would have to credit security premium. If there is discount on issue of debentures, I will debit it. Did you understand this? Entry will be liquidators of transferor company account debit to equity share capital to preference share. I won't write equity shares in transferee. Nane alva transferee. I should write equity share capital, preference share capital, debenture, cash, bank, in ಕೊಡ್ತೀನಿ ಎಲ್ಲ ಬರೆಯೋದು. Security premium also should be recorded. Understood? This entry is also same to same in the books of merger. Merger or purchase, same to same, no difference. However, after this we should do DRUMS. D, debenture adjustment. R, realization expenses. U, unrealized profit. M, mutual indebtedness. S, statutory reserve. I'll repeat. You'll do adjustment for DRUMS. D, debenture adjustment. R, realization expenses. U, unrealized profit. M, mutual indebtedness. Yes. When you say debenture adjustment, in that company there were debenture holders. I've taken it over in the form of liability. Unboxing entry all liabilities ತಗೊಂಡ್ಬಿಟ್ಟಿದ್ದೀನಿ. Their debenture holders are now in my hand. They have debenture certificate of a company which is not there. So I will debit the debentures in transferor company account debit. Credit whatever I give them. I can give them equity shares, preference shares, debentures at premium or at discount, or I can give them cash. Whatever I give, I'll write the entry. This entry is same both in merger and purchase. Debenture entry over. Then realization expenses. Actually, they should pay realization expense. But because they are dying, when someone dies and you go to their home, ಖರ್ಚಿಗೆ ದುಡ್ಡು ಕೊಟ್ಟು ಬರ್ತೀರಲ್ವ. So they are dying. For their last rites, you gave money. So that realization expense, what they would have paid, they would have written realization to cash. If you pay, you should write the entry as cash credit, but you can't write realization debit. You are getting nothing in return. So you should write goodwill account debit. So what is the entry you write? Goodwill account debit to cash. If the transferee pays the realization expense of transferor, entry is goodwill account debit to cash. However, if it is amalgamation in the nature of merger, I cannot write goodwill. Then I'll write P&L or general reserve. Basically, you will write reserves and surplus. Then D over R over U, unrealized profit. Andre enu? So that transferee company has sold goods to transferor, or transferor company has sold goods to transferee. They have sold goods to each other. Transferor to transferee or transferee to transferor. And these goods have been not sold to outsider. When there are two different companies, one company, selling company has booked profit, purchasing company has recorded inventory. No problem. When they become same entity, in the same books, profit is recorded. In the same books, stock is recorded at higher price. See, wrong, no? You can't do that. So you bring down the value of the inventory. You credit inventory. Stock ಏನು credit ಮಾಡಿದ್ರಿ, debit ಏನು goodwill. So the entry is goodwill account debit to stock. This is in the books of transferee if it is purchase. If it is merger, you can't write goodwill. So we'll write reserves and surplus, that is P&L account or general reserve account debit to cash. Stock. D over R over U over M. M is mutual indebtedness. What is it? Now I have sold goods to them or they have sold goods to me. We are debtor creditor relationship. So when we have debtor creditor relationship, To one entity it is trade payable, to another entity it is trade receivable. So what do? Trade receivable will decrease, trade payable will decrease. Bills payable will decrease, bills receivable will decrease. Creditor will decrease, debtor will decrease. Liability which is decreasing you should debit. Asset which is decreasing you will credit. Entry is trade payable account debit to trade receivable, or creditor account debit to debtor account, or bills payable account debit to bills receivable account. This is the entry you will write. Understood that? That's it. T over R over U over M over. Last one, statutory reserve. Let us say there is some reserve, there is some profit earned by the transferor company, but government has put some restriction stating that they cannot recognize that profit in PL. They put some restriction stating that that company cannot recognize that profit in PL. They told for 3 years you maintain it as reserve. Within those 3 years, if in case you make loss, let's adjust it against that reserve. After 3 years, if still you don't make loss, then you can use that profit. You get it? Because that profit is extraordinary in nature, or government expects you to make loss in next year. What if you made profit this year and full woodies you did dividend? Next year you made loss. The company will shut down. So they say maintain that as reserve and don't utilize that profit for anything. Let's say government when it puts such restriction, it will put restriction with time period. 3 years, 4 years, 5 years. So government has put a restriction of 5 years. 5 years, 2 years is over and the company died. So when that company is dying, no, it's asking for a promise. Transferee company is like, tell me what's your last wish, I will fulfill. So transferor company is giving the hand like this. Transferee company will be like, okay, fine. After you take that promise, transfer company will die. Now transferee's company's objective is to fulfill that last wish of the transferor company. You could not maintain that reserve for 3 more years and you did, I will fulfill your dream. I will show that statutory reserve in my balance sheet. So if you have to show that reserve, you have to credit that statutory reserve. When they gave, no, they gave only hand. They did not give money. ಸುಮ್ಮನೆ ಕೈ ಇಟ್ಬಿಟ್ಟು ಪ್ರಾಮಿಸ್ ಹೇಳಿದೆ ಅಷ್ಟೇ. They did not give cash. So what do? I'll debit amalgamation adjustment account and credit statutory reserve. And at the end of 3 years, when it is no longer required to be maintained, what do? I will reverse it. Statutory reserve account debit to amalgamation adjustment account. Understood? When the statutory reserve is created, because the transferor had an obligation to maintain it, transferee company, if the amalgamation is in the nature of purchase, entry that will be written is amalgamation adjustment account debit to statutory reserve. However, at the end of that required period, you will reverse it by writing statutory reserve to amalgamation adjustment. However, if it is amalgamation in the nature of merger, this entry need not be written. All the reserves will be taken over. No, illi unboxing entry baritivi gotta. Here only that statutory reserve is also taken over. Only then it is amalgamation nature of merger. Did you understand this? After this, finally they'll ask you to prepare one balance sheet. If question asks, then you prepare balance sheet and you are actually done with the problem. And when you do the problem, remember to make certain disclosure requirements as per accounting standard 14. Name of the transferor, name of the transferee, method of PC, nature of amalgamation, how is this consideration settled to debenture holders. These are to be disclosed in the answer. So when you start the answer on amalgamation, in the beginning only write name of transferor, name of transferee, nature of amalgamation, PC method, disclose madbidi. This one, it will act as disclosure. Second thing is, when you are doing such big problems, no, in the middle of the problem you should not get doubt. It will become easier for you to solve the question if you made such disclosures. With an intention, let's do it not with an intention of getting marks for disclosure requirements, but to make it easy for us to write the entries at large. Got that? That's it. By this we have successfully completed accounting standard 14 amalgamation. Also our accounting for amalgamations separate chapter number 13. Let's now start with accounting standard 15, which talks about employee benefits. I am sorry this is not colorful. Eventually I'll make it colorful for next time. So employee benefits is for the services that is given by the employee to employer. Employer is going to give money to employee. It is not just salary. Salary is a very easy and simple thing. It is much more than salary. For all the services given by the employee to employer, that is the enterprise, the money will be given by the employer. That will become your employee benefits. How should the organization record for the money that they are giving or going to give or to be given to their employees. How it should be recorded. For the purpose of this standard, we are going to classify all the employee benefits that will be given by the employer, I mean to say the organization, to its employees into four categories: short term, long term, post employment, termination. Short term benefits, long term benefits, post employment benefits, termination benefits. One item will not fall in two categories, it should be either of one of them. What is short term benefits? Payable within next 12 months, short term. What is long term? Payable during a period after 12 months. Not payable in within 12 months is long term. Short term is payable within 12 months. Long term is not payable within 12 months. Then we have two. One is post employment, second one is termination. Usually people think post employment and termination are same. No, post employment is very different from termination benefits. Post employment benefits means, let's say you joined our entity and you retire at the age of 60. At the age of 60, when you retire, we give you PF, gratuity, all of it. That will become post employment benefit. Termination benefit is at the age of 42, you are leaving the company. Then we give, that is termination. Or we are only removing you and then paying money. Then it will become termination. Termination is not at the end of the entire employment. It is intermittent removal or quitting from the job. You get it? It is not retirement. It is resignation or removal. Resignation or removal is different from retirement. Do you agree with me? Post employment means planned. I know that employee will stay till 60 years. At the end of 60 years, he'll leave. So from now only, I can accumulate the money to pay him. This resignation is immediate. Today they will give resignation, tomorrow they will stop working. Then how can I arrange the money immediately? But the termination benefits and post employment benefits are not to be treated as long term. They are different. Are you getting it? Long term, they are long term, but these are other long term benefits. So one item cannot be considered under multiple categories. They are to be treated very, very different for the purpose of our discussion. So remember that whenever we are discussing this, and after this, then let's discuss the first part, that is short term benefits. Shall we start with short term benefits? Yeah. What do you mean by short term employee benefits? Like I mentioned, the amount payable or due within the next 12 months is our short term employee benefits. Read this: benefits which fall due wholly within 12 months after the end of the period in which employee renders the related service. 12 months not from today, 12 months from the end of the current accounting period. See, I am preparing balance sheet on 31st of March. Within next 12 months, if I am supposed to pay, it is short term benefits. Are you getting this? For this, we will not apply any present value factor. Based on accrual basis, I go on rating it as expense. Total amount, actual expense will be recorded as a liability and it will also be recorded as expense. It is liability because it is payable, it is expense because the benefit is already taken. Read this: does not include termination benefits. Does it include the word termination benefits? The answer is no. The benefits that should be paid to the employees on removal. Let's say the employee will be leaving the job in 8 months. After the 8 months, whatever I'm supposed to pay, that is still termination benefit. That is not short-term benefit. Are you getting it? So for this short-term employee benefits, there is going to be no discounting and no difficulty. AS15 a beda. Normally like salary, bonus or anything. We'll write the full amount as expense at its actual cost based on accrual system. We'll write the full value on the accrual basis in the actual concept. Like actual expenditure on the accrual basis without doing any discounting. Done. Let's discuss the next part. This is post-employment benefits. Post-employment benefits andre ಏನು? After the employment is over, the money that we are going to pay to our employee. After that entire employment term is over, the money that we are going to pay to our employee is post-employment benefits. So read this: benefits given by employer to employee after completing the employment. Something like medical benefits after retirement, pension, gratuity, all of this. This is not termination benefits. Termination is intermittent removal of the employee and paying him money. Post employment is planned, like retirement. Retirement is different from resignation or removal. And these post employment benefits can be two major things. One, defined contribution. Second one is defined benefit. ಎರಡು ಒಂದೇನಾ? ಅಲ್ಲ, ಎರಡು ಬೇರೆ. Defined contribution and defined benefit are different. This is the major thing that you should remember. What is defined contribution? Now let's say there are you are an employee in my company. What I do is every year or every month from your salary I deduct some portion and then pay, or I'll pay it from my pocket. I'll pay it to LIC, or I'll pay it to some mutual fund institute, or I'll pay it to what to say provident fund authorities. I will pay them a fixed sum. and on your retirement they will pay the money. How much money they will pay, it is not my responsibility. How much money I will pay at the end of each month is my responsibility. Every month I'm supposed to pay 8,000 from your salary, 8,000 from my pocket. Ashte. At the end, will it come down to the value that you want or not? It's not my headache. That is defined contribution plan. Here, my responsibility is the contribution. Amount what I should contribute is fixed. Benefit what you get is not my responsibility. Defined benefit plan ಏನು ಅಂತ ಹೇಳಿದ್ರೆ at the age of 60 when you retire, I have promised to give you 20 lakh rupees. Now my responsibility to give you 20 lakh. I am not contributing to any LIC, UTI or any mutual fund. If I go to that agency and I'll ask my employee at the age of 60 when he retires, I want to give you 20 lakhs. Right now he's 25 years. They will tell pay 15,000 every month, pay 16,000 every month. They will ask. Once I pay 15 or 16, paying 20 lakh is their responsibility, not my responsibility. If in case I don't want to give them the money, I only want to maintain. It's like your URPF, unregulated provident fund. Company will only maintain or something like that. So I myself, I'll make investment. I will take money from your salary. I'll take money from my own pocket. I will only invest somewhere. I am not giving it to some investment company for investment. I myself will manage. So now, how much money will I put every month is not my obligation. My obligation is 20 lakh at the end of 40 years. 20 lakh generate ಮಾಡಬೇಕು ನಾನು investment. How much contribution to make? My headache. In the case of defined contribution, ultimate payment is not your headache. Your headache is only monthly contribution, periodic contribution. In defined benefit plan, ultimate payment is your headache. You get this? So if in case your entity, you don't want to take the headache of ultimate contribution, so you take one LIC policy on your employee, or you take some PF. Usually people go for a defined contribution plan only. So they pay a fixed amount of money to PF authorities, they pay you on your retirement. Big entities, if it is a very very big entity, they will say, why should I give money to PF entity? They will give me 8% interest. ನಾನೇ ಇಟ್ಕೊಳ್ತೀನಿ 12% interest ನಾನೇ generate ಮಾಡ್ತೀನಿ. So when you do that, what will it become? Defined contribution plan. If in case you pay to PF authorities, it will become defined benefit plan. Sorry, a defined contribution plan if you pay to PF authorities. If you yourself handle that investment and you maintain plan assets, it will become defined. Understood? Very good. So needs post-employment benefit plans, formal or informal agreement can be had. See, now what we can do is there is something else called as what do you say? Our multiple employer plans. What is multiple employer plans? Now I decide that I don't want to give it to some outsider. I decide that I will only manage it. I am taking a defined benefit plan. So let's say I have some 200 employees. 200 employees ಅಂತ ಹೇಳಿದ್ರೆ every employee is about 20 lakhs, is about 4 crore rupees I need to handle investment. No, 4 crore rupees I can't handle with myself. What do? I appoint one fund manager. But a fund manager ಗೆ ಒಂದು 30-40,000 salary ಕೊಡಬೇಕು. That is too much. So what I will do is I am running one company with 20 employees. Sorry, let's say 200 employees. You are running one company with 300 employees. She is running one company with 100 employees. He is running one company with 150 employees. All of us are friends. So you know what will you do? We will create one PF fund. My employees contribution, your employees contribution, her employees contribution, his employees contribution, will bring it together. That company is there, no? All four of us will jointly own that company. We'll appoint one fund manager for that company. He will manage the funds of PF of all four companies' employees. Did you understand this? That will be called as multi-employer plans. Multi-employer, you yourself created one pension fund, you created one fund management company, you created one AMC, and you appointed one fund manager. 3-4 companies together. Now a lot of Tata Group, Infosys Group and all, they do this. They don't give it to somebody else. They will invest money and they will only manage funds. Treasury management, they'll hire someone and they'll do it themselves. Group companies usually go for this policy. Now please read what is defined contribution plan. Nodi, post-employment benefit under which an enterprise pays fixed contribution into a separate fund with no further obligation. ಆ ಫಂಡಿಗೆ ಇಷ್ಟು ಅಮೌಂಟ್ ಅಂತ ಹಾಕ್ಬೇಕಷ್ಟೇ. Once I put that much money to that fund, after that it's not my responsibility. What is this? Defined contribution plan. If the post-employment benefit other than defined contribution plan, here the contribution is not defined, final obligation is defined, then it will become defined benefit plan. So whenever there is defined benefit plan, what do I do? At the end of 60 years of age for this employee, I want 20 lakh. Today the employee is 25 years. So after 35 years, I need 20 lakh. I'll discount the 20 lakh for 35 years. You did it for 5 years, 6 years in FM. You never did it for 35 years. So you do it for 35 years. 1 divided by 1.09 is equal to 35 times you do. Whatever you get, you multiply it with 20 lakh. Whatever you get, that is the current service cost. That is the amount that should be invested today. Next year get 34 madbekalva. You get little more money, no? That extra money should be contributed next year. After 3 years, interest rate is no more 9%. It becomes 12%. Then you divide 20 lakh divided by 1 divided by 1.12 for 20 times or 25 times, whatever is the difference between the existing service cost and the present service cost will be contributed during the current year. Did you understand this? Is it difficult? I'll explain. After 60 years to the employee, you need to give 20 lakhs. Today he is 25 years old. And after 35 years, you should pay 20 lakhs. You will assume that IRR is 9% or discounting factor is 9%. You will take 20 lakhs divided by 1.09 to the power 25. You will arrive at some number. That will become your service cost today. Employee has worked today, for that you need to pay money after he is 60. So that money you will keep. For next year, you will not do 1 divided by 1.09 to the power 25, so 35, you do 34. The resulting amount will be more. Whatever was the previous amount was previous year service cost. To the extent it is increasing, current year service cost, you will book as expense, you will keep that money aside. Interest rate can change and the discounting factor will change basically, and the amount will keep on changing, you keep on adding that money. On that you go on getting interest. Ultimately at the end of 60 years to the employee, that is 35 years from now, you will have 20 lakh rupees. You will sell that plan asset, you will give that money to the employee. You keep that money aside. That money is kept in one investment. That investment is called as plan asset. What is it called as? That is the asset that you have purchased to pay the money as per the plan to the employee. See this present value of defined benefit obligation. You need to pay money to your employee, as per the defined benefit. Present value of the expected future payment against the obligation of services in current or previous period. Employee is already worked for you in the past or is working for you now. For that you need to pay money to him in the future. That money is supposed to be paid in the future is obligation. That amount is defined. Benefit defined is 20 lakhs. Present value of it you will find, and that present value will be invested in plan assets. Long-term employee benefit fund and qualifying insurance policies you will invest. One fine day when the employee retires, you sell that investment, you sell that plan asset and you pay that money to employee. How much contribution to be made every year will be decided based on that present value factor you compute. I'll make you do couple of small example questions so that you will get it done. Then what about this defined contribution? See, post-employment benefit under which enterprise pays a fixed sum into a separate fund. I will go on paying 15,000. Ashte. Adar mele nan taleno illa. Adar mele interest to CRC, they'll pay to that employee at the end. You get it? You get what I'm trying to tell now? So defined contribution, defined benefit plan together, they can enter into multi-employer plans. Concept artha aita? Current service cost is present value of DBO, defined benefit obligation. 20 lakhs at the end of 35 years. Today value is service cost. Next year value will become defined benefit obligation present value for second year. First year whatever we booked already is expense. Difference between first year value and second year value will become expense for second year. Understood that? That is what is told here. And on that you go on getting interest. Let's say you want 20 lakhs at the end of 35 years. Do you invest 20 lakh? No. You will invest about 8 lakh or 9 lakh. Adar mele interest sesi 20 lakh agutte. Correct or not? That plan assets keep on increasing. That's because of the interest cost that is earned on that amount. Okay. Then last one is other long-term benefits of the employee. If there is any other long-term benefits that you're supposed to give to the employee after 12 months, then it will become what? Long-term employee benefits. Other long-term employee benefits. And what is termination benefits? What you need to pay to the employee on his removal. If you remove him instantly from the job, what you need to pay him is called as termination benefits. Termination benefits will be instantly, that day you record and then you write. You cannot remove an employee in a planned manner. No, that is incorrect. No matter how much plan you have, it is still called as illegal. You can't do that. So when immediately if they leave, suddenly if you give them some retirement benefit, whatever is already there as plan asset, you will sell and give. If there is no plan asset, you book it completely as an expense and give. So there is something that you should remember called as vested employee benefit and non-vested employee benefit. Vested andre employee has the eligibility for that money without any conditions. No, for example, if any employee joins, no, if anyone joins and after 3 months if they leave, you won't give them termination benefits. We'll tell they are eligible for termination benefits if they work for minimum 5 years. So once 5 years is over, you'll start booking that service cost. If 5 years is not over, if they leave, you will not give them any benefit. You will not give them any termination benefit or any retirement benefit. Someone joins your entity at the age of 58 and then leaves the entity at the age of 60. Gratuity ಕೊಡ್ತೀರಾ ಅವರಿಗೆ. You might not give. There will be minimum condition, minimum 3 years, minimum 5 years. So only after that you start booking that expense. Vested ಅಂತ ಹೇಳಿದ್ರೆ that condition is fulfilled. Now you can start booking service cost. Meaning for the service that they are giving now, you are going to give the money not just now as salary but on retirement or on termination also will give. If it is unvested, you will only book short term and other long term benefits. You will write termination benefits and post employment benefits only for vested entities or vested employees. You get it? There is very much in detail. So many other things are there in AS15. AS15 is one of the very big standards. But in your syllabus, there is lot of things about leave encashment, yeah, or to say holiday, idu baruttalla. You take lot of other benefits from your employee. Whatever other benefits you get from the employer, basically all the purposes that you get for everything will have in detail analysis. If you get a car from an employer to use, then how to recognize that, how should they recognize that expense, ಅರ್ಥ ಆಗ್ತದೆ ಪರ್ಕ್ವಿಸಿಟ್ಸ್ಗೆ ಎಲ್ಲ ಬರುತ್ತೆ. ಬಟ್ ವಿ ಡೋಂಟ್ ಹ್ಯಾವ್ ಟು ಲರ್ನ್ ಸೋ ಮಚ್ ಇನ್ ಡೀಟೇಲ್ ಇನ್ ಇಂಟರ್ಮೀಡಿಯೇಟ್. ವೆನ್ ದಿಸ್ ಇಸ್ ಶಿಫ್ಟೆಡ್ ಫ್ರಮ್ ಫೈನಲ್ ಟು ಇಂಟರ್ಮೀಡಿಯೇಟ್, only thing that you have is that defined benefit and defined contribution, recognizing that present value of DBO, defined benefit obligation. That questions are there, and you need to first learn how to identify whether it is short term, long term, defined benefit or defined contribution. Okay, I'll make you do 3 variety questions. Last 2 you do it from the study material. There are not too many questions from this topic. There are hardly about 4-5 variety of 4 questions or 5 questions are there. Do those 4. They should ask only from those 4. They cannot ask more. 23, 27, AS 15, 28. 28 BW, 15, 23, 27. The variety of questions that they can ask is very limited. They cannot ask something other than what's there in the material. They would have to ask something similar and same to same. So be prepared for that. Do all the questions from the study material on this topic. Okay, let's quickly see. See, salary that is paid within the 5th of every month is short term. What about bonus payable at the end of the quarter? Why? Quarter under 3-4 months, no, yeah. So that is within 12 months. What if you are going to pay pension at the end of employment? This is not termination, this is post employment. What if you are paying them gratuity at the end of employment? Post employment. What if you are going to pay them compensation for availment of VRS? VRS is not post employment, it is termination. They are eligible to work till 60. At the age of 54 they want to retire. Why? They want money to build a house, they want money for their children's education, or they want money for their wedding, sorry, for their children's wedding. Usually people take VRS like that only, some people take VRS and then do business. Some people take VRS and then go on world tour. ನೀವೆಲ್ಲ ಹಂಗೆ ನಿಮಗೆಲ್ಲ ಕೆಲಸ ಸಿಕ್ಕರೆ 50 ವರ್ಷ ಆದ್ರೆ ಕೆಲಸ ಬಿಟ್ಬಿಟ್ಟು ದುಡ್ಡು ತಗೊಂಡು ಪಾರ್ಟಿ ಮಾಡ್ಬಿಡ್ತೀರಾ. You will be like, I don't know if I live till 60 or not. Guarantee, no? Yeah, chance ಕೊಟ್ರೆ 35-40 ವರ್ಷಕ್ಕೆ VRS ತಗೊಳ್ತೀರಾ ನೀವು. Yeah, I had a plan. This is not my retirement plan, but this is something that is very exciting. It is one of the things that is there in my list. You can also search this. There is one cruise called as Life at Sea. I'll show this to you. I've made an Excel sheet out of this. So there's something called Life at Sea. So this is a 3-year cruise. So this cruise is for 3 years. So it goes to every country in the world. Not every country, it goes to several countries. It will touch all the 5 continents. You will go to Antarctica, you will go to Greenland, you will go to US, you will go to UK, you will go to India also. So several places. So it's like you are basically living on a cruise. So they'll take you to one port and they'll stop there for 3 days. Let's say they'll stop at Chennai port for 3 days. You can deboard from the cruise. You can take one car or bus and then roam around, go to Chennai, go to Pondicherry, go to Kerala and come back to the cruise by 3rd day. Similarly, they'll stop at multiple ports in USA, multiple ports in UK, multiple ports in Russia, China, Japan, and everything. So 3.5 years is the entire cruise term. 3.5 years will roam the entire world, and the cost is about 85 lakh as of date per person. Food, whatever you eat, whatever you drink, everything is covered. for 3 years for one person. Huh? Tsunami ಎಲ್ಲ free. ಅದಕ್ಕೆಲ್ಲ separate charge ಇಲ್ಲ. Photography charges will be extra. No, just telling you something exciting. No, see something exciting that you people can like, oh my god, one day. Correct or no? 3 ವರ್ಷ ಹಾಲಿಡೇ. One time payment. Hey, ಸಾಯ್ಬಾರ್ದಂಗೆಲ್ಲ. You have paid for 3 years. How can you die after 3 days? You should not die. You should not die. 3 ವರ್ಷಕ್ಕೆ ಪೇಮೆಂಟ್ ಮಾಡಿದ್ಮೇಲೆ 3 ದಿನಕ್ಕೆ ಯಾರು ಸಾಯೋದಿಲ್ಲ. ಯಾರಿಗೆ ಕೊಡ್ತಾರೆ? ಚೆಕ್ ಬರೆದ್ಬಿಟ್ಟು ಹೆಣದ ಮೇಲೆ ಇಟ್ಬಿಟ್ಟು ಸುಡ್ತಾರೆ ಅಷ್ಟೇ. So it's something exciting. You just read this one. So very exciting plan, no? 3 years on in the ocean. Okay, now let's see. Next one is ಹೋಗೋಣ ಒಟ್ಟಿಗೆ ಹೋಗೋಣ. ಓಕೆ, ನೀವು ರಿಟೈರ್ ಆದ್ಮೇಲೆ ಹೇಳಿ. ನಿಮ್ ರಿಟೈರ್ ಆದ್ಮೇಲೆ ಒಂದು 5-6 ವರ್ಷಕ್ಕೆ ನಾನು ರಿಟೈರ್ ಆಗ್ತೀನಲ್ಲ. Silver Jubilee payment. What is Silver Jubilee payment? They say no Golden Jubilee, yeah, Rajata Mahotsava, Belli Mahotsava. They say no Diamond Jubilee is 75 years, Golden Jubilee is 50, Silver Jubilee is 25 years. So 25 years of completion. So the company is going to give extra money to employees. 25 years of completion means long term, not within next 12 months. You get it? Then, sir, you got 24th year agide, still you would have planned long ago, no, that after 5 years you will give. So it is long term. What about sabbatical leave? Sabbatical leave means once an employee joins, after they work for 4 years or 5 years, you give them 3 months holiday. Go experience your life and come. Go do something else in life. And they mandatorily send in big entities for big managerial roles. They send on sabbatical leave for 2 reasons. One, you should experience life. Second thing, if you are doing some kitapati in the company, how will I get to know that you are doing kitapati? If you go 1 week leave, 10 days leave, I won't understand. I'll send you on 2 months or 3 months leave. When you go on 3 months leave, someone else will do your work for 3 months. So that company will understand if you're doing something wrong. Some people will never take leave. You know why? They would have done some big scam in that company. If they take leave, they'll get caught. So they'll never take leave till the time they retire. You haven't seen? A lot of them do that. They won't take the leave because if they take leave, they'll be caught. So kashtano sukano kelsa ಮಾಡ್ತಾರೆ. So they'll send on mandatory sabbatical leave for 2 reasons. One, to identify you've done some scam. Second thing is, company should not be dependent on you. Suddenly if you leave, 30 years you served the company. 31st year when you leave, company cannot survive. That should not happen. So they'll send you on sabbatical leave. Your role will be given to somebody else. You are still on employment, you still get salary. After that 3 months leave holiday, when you come back to job, no, they'll give you any designation that is available. If the same role is available, same role. If not, they'll give you different designation. It's like almost like you've taken one break in the career, you went out, did something in life and then came back for another job. Lot of them, you come from US, no, they come for, I've been 1.5 months, say I'm roaming in India. They all will come on sabbatical. They say I'm on sabbatical. This is a sabbatical leave. So they give you long leave to go do something else in life and then come back. You get it? So they say I'm on sabbatical. Are you getting it? So that sabbatical and all will not. You join today and then you say I want one sabbatical leave for 3 months. They won't give. To be eligible for sabbatical leave, you should have worked in that company for a certain number of years. So that is long-term benefit again. So defined benefit plan and defined contribution plan. Shall we identify the difference? See, fixed amount is transferred to LIC for gratuity of employees. Defined contribution. Once you give that fixed amount, you don't have any further obligation. That is defined contribution. Determined amount is transferred to state provident fund for gratuity of employee. You pay it to state PF. They will pay to your employee later. So what is it? Defined contribution is fixed. We don't have further obligation. What about determined amount is transferred to commonly controlled pool? Multi-employer pool. You get this? So in multi-employer pool, what they do is they invest certain money in risk-free investments, sovereign bonds, so gold debt, and all of that. Beyond that, they reinvest in their own companies. They reinvest the money in their own companies. You get it? Why to keep your money in some other company's investment and you take loan from some other company? You invest your PF in your own companies. No, you got it? Then determined amount of is transferred to PF fund created by enterprise. We have only created that fund. So we have obligation of the ultimate payment. Our contribution is not our only obligation. Our obligation is the final amount that we should pay. So it is defined benefit plan. Our obligation is the ultimate benefit what we should give to employee, not the contribution we make. Are you getting the difference here? Everyone? Very good. Now, let's see. We'll do one present obligation, the DBO question. I told you, present value of DBO should be recognized. Have a look. Employee is entitled, Odri, employee is entitled for rupees 5 lakh after 7 years of employment, of which 60,000 is attributable to services arising in first 3 years. Identify the amount of present value of DBO at the end of third year. At the end of third year, in year 3, we should write 60,000 as expense. Basically, after 7 years, we should pay him 5 lakh. How much is the contribution that we should make from third year? 60,000. So third year cash flow is 60. We keep 60,000 aside. Meaning after third year, if he leaves, we should still give him 60,000 rupees. Artha ಆಗ್ತಿದ್ಯಾ? This 60,000, it is to be created for 7th year. Alva. So 7th year, 3 years is over. 4, 5, 6, 7. 4 more years. Am I right? After third year, I've kept aside 60,000 to at the end of third year only if he leaves the employment. After 7 years, I'll give him 60,000. If he works for 7 years and then leaves, I'll give him 5 lakh. Hey, third year kelsa bitre third year 60,000 kodala. I'll repeat. At the end, if you work for minimum 3 years, you are eligible for defined benefit of how much? 60,000. If you work for 7 years, you are eligible for how much? 5 lakh. After third year, if you quit the job, you will get 60,000. Not at the end of third year, at the end of 7th year. So third year you worked, vested, no? How much money is to be my present obligation? 60. So I write 60. But 60 I need not pay at the end of third year. 60 I should pay after 7 years. After third year till 7th year, how many years? 4, 5, 6, 7. 7th year I should pay 60, no? What money should I keep aside right now? 1 divided by 1.1 to the power 4. If I do, I'll get 0.683. 40,980 is my expense for year 3. Current service cost. What is it called as? Andre, for the benefit, for the employee services that have received in year 3, payment will be made in year 7. That this year cost is 4980, but actually payment is 60. Sir, expense if you book 4980, how will you book 60? This will fetch me interest at 10%. When I book expense of 40,980, P&L account debit side, I'll write current service cost 40,980. From my balance sheet, I'll take cash of 40,980 and I'll invest in plan assets. Plan assets means some assets. If I invest there, that 40,980 for first year, that is year 4, it will fetch 10% interest, 4,098. Second year, it will fetch interest on 4980 plus 4098. I cannot withdraw that interest. First year I get 4098 interest. For second year, it will be 40,980 plus 4098. On that I get 10% interest, which will become 4,508. For year 6, I'll get 40,980 plus 4,098 plus 4,508 mele 10%. Like that, if I get interest for year 7, it will come to this amount. Take 40,980 and add all of this, you will get exact 60,000 rupees. Check. Did you understand what I did with those numbers? Puneet, this is what you are asking. No. Can be done at some cases, cannot be done in all the cases. Wherever it's possible, I will do. To the extent I'll send you home happy. Got that? Like that, they've told no current service cost at the end of year 3 is 60. What if they tell at the end of 4th year it is 1 lakh, at the end of 5th year it is 1 lakh 20, 1 lakh 40. So then the difference amount will be booked on that individual amount. I need to do discounting and they need to write it, and then individual amounts will interest compute ಮಾಡ್ತಾ ಬರಬೇಕು. For year 3 they told 60. Let's say for year 4 they say 1 lakh. Meaning what? At the end of year 4 if he leaves, he will get 1 lakh at the end of year 7. So I'll write year 4 payable after 7th year 40,000 baritini. 1 lakh barila. Why? Already 60 is booked. For that 1 lakh, discounting factor is 1 divided by 1.1 whole to the power 3. That I'll find the present value of cash flow. So much money will become my expense, current service cost for year 4 expense. And then that much money when I've invested, I'll take from my cash and invest in plan assets. And that will go on fetching interest every year. That interest will become income and that will also increase my plan assets. Every year interest income will be recorded and it will increase my plan assets. I won't transfer that income to P&L. I'll straight away add it to my assets. I'll straight away add it to my assets. Capital appreciation agta hoಗುತ್ತೆ. I won't receive cash. I won't receive cash. It will go on increasing my assets. And ultimately, one fine day I'll sell it and I'll get the same amount what I want to pay. But this is defined benefit obligation, okay, not contribution. So benefit is my objective. Sometime in the future, interest rate might not be 10. Practical ಆಗಿ ಹೇಳ್ತಾರೆ. In our questions, everywhere it will be same interest rate, yeah. We don't have complicated questions. There are only 4 questions in the study material. Do those 4 questions. ಅದೇ ತರ ಬರುತ್ತೆ. But practically that interest rate might change. You get it? Then you need to recompute. Let's do one more. I think this can be the last question that we'll do on this type. Okay. Employee is entitled to gratuity of how much? 3 lakh. After 4 years of employment. Service cost is 1 lakh for first year of service. First year if he works, he is eligible for how much gratuity? 1 lakh. If he immediately leaves after first year, how much should we give him gratuity? 1 lakh. When? Service cost is 1 lakh, not obligation is 1 lakh. Here obligation was 60,000. Here cost is 1 lakh. Andre here we computed 40,980, no? That is service cost. Here 1 lakh is service cost. If he works for 1 year, we should keep aside 1 lakh. We will give him 1 lakh plus interest at the end of that period. Artha agtidya? Do you understand the difference between obligation and current service cost? That say defined benefit obligation is there, no? If you discount it to today's date, what you get is service cost. In AQ3, they told us the obligation to be paid at the end of third year is 60. Correct. Here current service cost is 1 lakh. First year we keep aside 1 lakh. At the end of year 1 we keep aside 1 lakh. Second year on this 1 lakh 10,000 interest 1 lakh 10 ಆಗುತ್ತೆ. Third year on 1 lakh 10% interest will become 1 lakh 21. Third year on 1 lakh 21 10% interest will become 1 lakh 33 100. 1 lakh 33,100 will be paid to the employee if he leaves the employment after first year. But this 1 lakh 33,100 will be paid to him after year 4. Did you understand? Investment that you made and current service cost for year 1 is 1 lakh. Similarly, you would have to do one more table for year 2, one more for year 3, one more for year 4. But we don't have such complex questions. You're getting no AS15 can become very complicated. But what they've given is not very complicated. If they tell the defined benefit obligation in the future, you discount it to today's date to find the present value. That present value is current service cost. In the previous question, they had given defined benefit obligation, you discounted it. In this question, they have given current service cost already. If they give defined benefit obligation, you discount it and then add interest to become defined benefit obligation. If they give straight away current service cost, add interest to arrive at the defined benefit obligation. Clear? Pakka? Yeah, you have another question which is slightly similar to this. They'll tell you how much is the money that should be given at the end of that period. You discount it, you'll identify the current service cost. Here they've given defined benefit obligation. If you work first year and then retire at the end of it, employee will get 2 lakhs at the end of the employment. How many years? 5 years admin. So you discount it for 5 years. Second year is 2 lakh, 4 years. Third year is 2 lakh, 3 years, 2 years, and year 1 year. You discount it, this becomes the current service cost. These costs have to be booked as expense in each year. On this you learn interest. On this 136,600 you learn 4 years interest. On 150,200 you learn 3 years interest. On 165,200 2 years. On 181,800 1 year. On 2 lakh 0 interest. That is the reason it's 2 lakh. Together it will become 10 lakh. Are you getting it? So if you want, I'll do it slowly. Should I do this slowly? Okay, let's do this question and go to AS16. Please read this. Employee is entitled to gratuity of 10 lakh. 10 lakh is defined benefit obligation. After 5 years of employment, how much should we give him? 10 lakh. It is counted as 2 lakhs at the end of each year. If he leaves the employment at the end of first year, he gets 2 lakhs at the end of 5 years. If he leaves the employment after 2 years, he gets 4 lakhs at the end of 5 years. Are you getting it? So every year, not the service cost, obligation is 2 lakh. Payable at the end. Find the present value of it. For the first year, If he leaves at the end of year 1, 2 lakh would have to be paid at the end of year 5. So discounting factor is to be done for 4 years. For year 2, we have to do discounting for 3. For year 3, 2 lakh, 2 years. For year 4, 1 year. For year 5, at the end of year 5, 2 lakh is payable. If he leaves also, we'll give 2 lakh. So no discounting. 1. So when you discount it, you'll get that current service cost. First year expense 136,600. 136,600 plus 4 years interest of 10% will become 2 lakh. 150, 200 plus 4 years of interest at 10% will become 2 lakh. 165, 200 plus 3 years interest, 2 years, 181, 800 plus 1 year interest and 2 lakh plus 0 years interest will become 2 lakh. So I'll add 2, together 10 lakh will be paid. I'll write the opening balances. I will add interest on the opening balance. I'll add current service cost. I'll find the closing balance. Then closing balance and the opening balance with interest will be added. No, on that I'll add interest. Should I do this slowly again? 136, 600. You got it? Ashte. This variety of questions, if you do, it's done. Same on that, there is one ledger problem. I have not just covered some 4 basic problems. I have covered all the 4 problems that is there in your study material here. Now, ishte irodu. Plan assets is ledger. It is like investment. Yeah. Opening balance. Further, if you buy, debit. You sell, credit. You get interest, debit. You get it? Balance being figure, closing balance will be. You go on writing it like this. So they won't even ask for 3-4 years. They'll ask for 1. This can become very heavy computation based statements, but you don't have so much of complex. You'll get simple 4 questions are there in your material and do that. One among those 4 type questions only will be asked in the exam. Got it? 15. How many of you were scared of 15 before? Now you people are slightly comfortable with 15? Still scared? Ask if you have any doubt. Pakka? You don't too shy to ask? Don't want to ask? No doubt. Okay. See, ನಿಮ್ಗೆ ಟೀಚ್ ಮಾಡ್ತಾ ಮಾಡ್ತಾನೆ ಕಲರ್ ಮಾಡ್ಬಿಟ್ಟು ಆಮೇಲೆ ಅದಕ್ಕೆ ಸ್ವಲ್ಪ ಇಮೇಜಸ್ ಎಲ್ಲ ಹಾಕ್ಬಿಟ್ಟು ಫಾಂಟ್ ಕಲರ್ ಚೇಂಜ್ ಮಾಡ್ಬಿಟ್ರೆ ರೆಡಿ. I actually want to add more things to it. There is some concept of leave, casual leave, and then that and all is not there in your material. Questions are not there, but concept is there. Sanna concept ಹಾಕೋಣ ಅಂತ plan. But I'm still thinking, should I put or not put? If I put it, it's like I'm complicating your standard, which is actually not complicated in study material. Fine. Let's now do accounting standard 16, which talks about borrowing cost. Very, very simple standard. Whenever interest is paid, interest is expense, it should go to P&L. However, as per accounting standard 16, in certain cases, that interest what is paid, we believe that the benefit of that interest is much longer than 1 accounting year, and we won't write that interest to P&L. We add that interest to the cost of the asset, and that asset will be depreciated. So interest will be included in the cost of the asset. When do we do this? Firstly, the meaning of the word borrowing cost. Borrowing cost doesn't just mean interest. Borrowing cost includes several things. It's called FIDA. FIDAE. F. Financial charges in finance lease is borrowing cost. Interest and commitment charges. Sometimes if you prepay the loan with before the period that you agreed for, let's say you agreed 5 years as a loan term, you are repaying at the end of 3 years, they will say still you should pay 2 years of interest. Why? Term was 5, no, should pay 5 years interest. That 2 years of interest in that case will become commitment charges. You have committed to pay, not by way of interest but because of prepayment. That is interest and commitment. That is also borrowing cost. Then D is our discount or premium on loans. What is discount on loans? Let's say you are raising loan by way of debentures, and those debentures are issued at discount, or those debentures are supposed to be redeemed at premium. That discount amount and premium amount will also become borrowing cost. A is any other amortization of ancillary costs that you are incurring for taking the borrowing. Last one, to the extent no finance, this foreign exchange difference is also considered as interest. I'll teach what exactly is that and how much part of your foreign exchange difference will be considered as borrowing cost. I'll teach. That's the last part of A60 discussion. So all of these items together will constitute borrowing cost. If this borrowing cost is incurred against a qualifying asset, then it can be capitalized. Now the question is, what do you mean by qualifying asset? An asset which takes substantial period of time for its setup. What is qualifying asset? An asset which takes substantial period of time for its setup. It is not like you buy the asset today and tomorrow it's ready to use. That asset has to be assembled, installed, and that entire assembly and installation process, it's taking substantial period. There is no definition for the word substantial period. Standard only tells substantial period. However, accounting standard interpretation 1 states that substantial period as a word can be interpreted to be period of 12 months. But it's not like if an asset takes 11 months 29 days to be installed, it is not a qualifying asset. If it takes 12 months 1 day, it is a qualifying asset. Angalla. This is not hard and fast rule. Sometimes an asset takes 14 months to be installed, but it is still not a qualifying asset. Why? Usually it should take 2 months. You've taken 14 months. Just because you delayed it and then installed it over 14 months, it will not become qualifying asset. Some assets usually takes 18 months or 15 months to be installed. Okay, but you installed it in 11 months. Fast agi madidri. You work day and night and you installed it in 11 months. Because you installed in 11 months, it will not become not a qualifying asset. It's still qualifying asset. So that 12 months is there, no, it is just a vague number that is there in interpretation. What is that substantial period? It is subject to professional judgment. If you think asset takes substantially longer period, during such period, on the loan that you taken for that asset, if in case you are paying any interest, such interest, if you write it to P&L, it is incorrect. Why? See, that asset is not ready. There is no income from that asset, but you are writing expense. Are you getting it? It is actually supposed to be incorrect. So what do? Till the time you start earning revenue from that asset, you don't charge expense on that asset. You capitalize all the interest to the cost of the asset, and by way of depreciation, you transfer it to P&L every year. That is called as capitalization. To do this, asset should be, meaning it should take substantial period of time for its setup. If the asset is qualifying asset, then up to the date on which the asset is ready to be put to use, you can capitalize. Once the asset is ready to be put to use, you cannot capitalize. Till the date the asset is ready to be put to use, you can capitalize. Once the asset is ready, treat that as expense. If it is not a qualifying asset, treat that as expense from the beginning only. Treat that as expense from the beginning only. Now, what and all is included in the form of the capital asset? So, that qualifying asset. If you make any cash payment or transfer in any other way, all of this is included. What is excluded is any progressive payment or grant received. If you receive grant, you did not incur money, you cannot include interest on that. If you already made progressive payment of that loan, to the extent you paid loan repayment, interest will be less, no? To that extent, you can't treat as borrowing cost for capitalization. Did you understand that? Now let's talk about borrowings. There are two types of borrowings. How many types of borrowings? One, specific. Two, general. What is specific? What is general? Specific borrowing is the money borrowed exclusively for that asset. That money cannot be, will not be used for anything else. What is general borrowing? That can be used for your working capital also, purchase of another asset also, giving salary also. But that money will be used for this asset also. That is general borrowing. So, from when do you start capitalizing? You understood till when do you capitalize? Till the date asset is ready to be put to use. From when do you capitalize? When it fulfills the conditions. When it fulfills the, what is the condition? Number one, it should be qualifying asset. Number two, if it is specific borrowing, no, from the date you borrow, you start capitalizing. Interest from the date you borrow will be capitalized for specific borrowing. For general borrowing, from the date when it is incurred. This is very important. If you catch this, you know the standard, otherwise you don't. For specific borrowing, when do you start capitalizing? From the date you borrow. For general borrowing, from the date you incur. Why? General borrowings can be used for this purpose, but need not be used also, no? So you will consider only when you use it. Specific borrowing, it is only for this. Whether you use it or not, that interest can be capitalized. Understood? Let's say specific borrowings is borrowed in April. Specific borrowing is borrowed in active development of the assets started in August. From when do you start capitalizing the interest? From April. ಅದನ್ನೇ ಹೇಳ್ತಾ ಇರೋದು ಇಷ್ಟೊತ್ತು. When did you do the specific borrowing? April. When do you incur the money? August. If it is specific borrowing, from when do you compute interest? April. Let's say it is general borrowing. You borrowed in April, you spent it that money in August. From when do you count? August. When there is specific borrowing and general borrowing, what do? General borrowing will be assumed to be used only if the money spent is more than specific borrowing. General borrowing is assumed to be used only when the money spent is more than specific borrowing. You borrowed specific borrowing in April. August you incurred expense. Your specific borrowing is 10 lakh. Your specific borrowing is your expenditure incurred in August is 12 lakh. Then what do you say? Out of 12 lakh, entire 10 lakh is specific borrowing. Excess 2 lakh is general borrowing. Are you getting it? What if August you incur only 8 lakhs? Completely from specific borrowing, 0 from general borrowing. Why? Specific borrowing is 10, expense incurred is 8. Specific borrowing in 2 lakh is remaining idle. Did you understand this? Pakka. Always remember, specific borrowing interest is computed from the date of borrowing. General borrowing interest is computed from the date of spending the money. Understood? Then first we'll always utilize specific borrowing. Then we'll go to general borrowing. What if there is more than one general borrowing? Then we would have to take weighted average. What should we take? If there is more than one general borrowing, we will not take the lower interest irodu, higher interest irodalla. We will take all the loans and then multiply it by the respective interest rates. Find the total interest divided by total loan amount. We will get the weighted average rate of interest. That weighted average rate of interest will be considered. One loan is at 10%, one is at 12, one is at 13. What do? Loan amount multiplied by 10, loan amount multiplied by 12, loan amount multiplied by 13. Total interest divided by total amount, you will get the weighted average rate. That rate will be considered for general borrowing. Are you getting it? So I told you 3 important points so far. 1. Specific borrowing, from when do you count? Date of borrowing. General borrowing, only when it is incurred. Always you should first take specific borrowing, then you should take, very good, and then general borrowing will always take weighted average rate when there is more than one. Specific borrowing, I made it in April, I spent it in August. When did I make the specific borrowing? When did I spend it? April, May, June, July. Borrowing is made. Money is received. Money is there in bank. 4 months sumne ide alva. I will receive interest income on that. Bank will give me interest. You know what will I do? I will deduct it from the borrowing cost. I will deduct it from the. This is there only for specific borrowing. General borrowing madalla. We'll do it only for. Did you understand this? Pakka. Now next is all theory. It is to theory there, and then I would have to teach you something called as that borrowing foreign exchange difference to the extent it should be capitalized. Before I go there, this is the most interesting and important part that I want you to know. Question in the examination was on this May 24 exam. We've done the same question with different numbers in the class, but I very honestly believe that lot of them would have got this concept wrong in the May 24 exam. I'll tell this to you. Listen to me carefully. All the questions that you have in study material given by institute, not our material. In our material, this question was there, May 24 question. All the questions given in study material, what used to happen is, first expense ide alva, that used to be more than the specific borrowing. But in the examination question, first expense is lesser than specific borrowing. So specific borrowing came till second expense also. Artha agilla na? I'll explain. Listen. Let's say I've incurred money in April, I've incurred expenditure in August, I've incurred expenditure in October. April, August, October. Understood? April I've incurred 10 lakh rupees expense. How much have I incurred expense? Specific borrowing in all the questions given used to be 10 lakh or less than 10 lakh. They used to tell specific borrowing 4 lakhs. So 10 lakh is the first expense. In 10 lakh, what you used to do? 4 lakh specific, 6 lakh general. Alva? In the exam question, what happened is specific borrowing is 15 lakh. First expense is 10 lakh. Second expenditure is in August. So now second expenditure we count interest from August. But you should actually count interest from April. Did you get what I'm trying to tell? Usually what do? First expense is incurred in April. We do weighted average cost now. Expenditure into period outstanding, we'll get the total cost. That will segregate as specific and general and then compute. That shortcut will work only if the first expense is more than specific borrowing. That won't work if first expense is less and specific borrowing is more. Examination question, one of its kind, specific borrowing is more than first expense. You got it? Then what should you do? I'll show that question to you. May 24 exam question. I don't remember the question number. 6
One.
1A. Oh, very first question. See, how much is the first expenditure incurred in April? 4 lakh. Specific borrowing is how much? 14 lakh. How much is the specific borrowing that they had made? Should I show the question paper? I'll be a little surprised if I feel like you people have not even done the May 24 paper yet. Not too late. I am not telling you May 24 question paper alirode September 24 al baratte anta. Some people will definitely not do May 24. Yake? Already they've asked in May, so they won't ask in September. I'll show you instances where same question was asked in back-to-back exams. If in case they ask same concept once again and you get it like last ICA will tell last time you did one mistake. I sent you back to read that and come. Again you have not read that and come. Yen madadu. Kali nadi matte. Hogu kutkomba. Then next time again you will not read it. Why? 2 times they asked means third time they will not. Third time ನೀವು ಓದ್ಕೊಂಡು ಹೋಗ್ತೀರಾ they won't ask. They like ಅದು ಓದ್ಕೊಂಡ್ ಬಂದ್ಯಾ? Yes. ಬೇರೆ question ಈಗ. See. 1st of April 2023, Green Limited started construction of an office building. Office building is a qualified asset. The land under the building is regarded as a separate asset. See, land and building are two different assets. They are not the same assets. Land is not a qualifying asset. Land is ready for use the moment you buy. Land and ready made avashyakate illa. Building is a qualifying asset. So for the purpose construction of the building, company raised a specific loan of 14 lakh. How much is specific loan? 14 lakh. First expenditure incurred is how much? 4 lakh. So this 4 lakh is specific borrowing. How much is specific borrowing taken? 14 lakh. 4 lakh specific borrowing. 10 lakh is also specific borrowing. Now you tell me whatever I thought you. Specific borrowing should compute interest from date of borrowing. ನಾವೇನ್ ಮಾಡ್ತೀವಿ 4 lakh into August to January month ಹಾಕ್ಬಿಡ್ತೀವಿ. So ಇಲ್ಲೇ ಹೋಗಿ for this though expenditure is incurred in August, you should compute the interest from for 4 lakh and 10 lakh. For both of them should compute the interest from April. So what I would do is 1st April 23 to January 24, August 23 to January, December to January, January. January is when the asset is over, asset is ready. Once the asset is ready, we cannot capitalize anymore. Interest can be capitalized till the date the asset is ready to be put to use. So I would write 4, 10, 25, 5. How much is specific borrowing? 14 lakh. So this 4 lakh is specific borrowing. This 10 lakh is also specific borrowing. Here this is incurred only for 6 months. But when I compute here, I'll do it from April to January. See here, observe this 14 lakhs. I've done 10 by 12. Count April, May, June, July, August, September, October, November, December, January. I should do it for 10 months. Are you getting it? Pakka? What if here the expenditure was 11 lakh? 10 lakh I would have done for 10 months. 1 lakh I would have done for 6 months. Understood that? I think majority of you would have done mistake here. Another problem is people would have not stopped at 31st of January. I'm swalpa excitement. We'll take it till March. But the asset is ready on 31st of January. Capitalization will stop on 31st of January. Then you compute the interest and there is that savings in interest. They have given 15,000, we deduct that. And for general borrowing, no, there is more than one general borrowing. See, 20 lakh at 15%, 30 lakh at 8%. So I do 20 lakh into 15, 30 lakh into 8, take the total interest, divide by 50 lakh to arrive at that rate, average rate of 10.8. So I'll take 10.8 rate for general borrowings. That's how I'll arrive at the total amount of borrowing cost which can be capitalized, which will be added to the cost of the asset. They've also asked you to write journal entry. In this one, they've also asked you to write journal entry further to compute depreciation. Now tell me, when is the asset ready? January. So depreciation will be computed in the current year only for February and March. Depreciation will start when the asset is ready to be put to use. You got it? So you should start computing depreciation only from February. You should compute depreciation only for February and March. So how much is the useful life of the asset? They have given in the question that the useful life of the, when it was ready for intended use up to date of completion, useful life is 20 years. So you divide it by 20 years, including that 44 lakh you paid for the expense, 1 lakh 70 is for the interest, 45 lakh 70 will become the cost of the asset, 45 lakh 70, you divide it by 20. You get depreciation per year, 2,28,500. But depreciation for the year will be booked only for 2 months, 2 by 12. If you do 2 by 12, you get the depreciation, right? For that amount of depreciation, entry is depreciation accountable to building. Got this? Your usual shortcut of multiplying it with period, taking the total and then total weighted cost segregated into specific and general will work. It won't work in only one case. What is that case? When the specific borrowing is more than the first expense. So again, it all comes down to very simple thing what I've been telling all the while to you. For the specific borrowing, you compute interest from the date of borrowing. For general borrowing, you compute the interest from the date on which it is incurred. Understood? Very good. Capitalization conditions. Start when the condition is fulfilled. What is the condition? For specific borrowing, date of borrowing. For general borrowing, date of incurring. And when the asset is qualifying asset, you start capitalizing. When do you stop? End. When the asset is ready for commercial production. When do you pause? You start adding because the asset is actively developed. If the active development of the asset is paused, you pause the capitalization. Let's say for certain period of months, no, you stop the development of the asset. You are like, something is wrong. I need to go back to my drawing board and then redo the plan. So you pause the active construction, you pause the capitalization. During the period when the active development of the asset is not made, temporarily capitalization is suspended. You get what I'm trying to tell? So what is pausing? When the active development is interrupted. Got it? Then suspension means what? Temporarily, when the actively the asset is not developed, you will stop capitalizing. Cessation means asset is ready for commercial production, so you stop capitalizing. Cessation is end. Suspending is pause. Stop or pause. You know difference? No. Pause means from there you can do play again. Stop means stay end. You got that? Then the last part of the standard that I and you should discuss is the exchange difference. We discussed AS11 in the past. Whenever you have taken one loan and on that loan liability is there in foreign currency. Loan is taken in foreign currency. Liability is there in foreign currency. So beginning of the year the loan is $10,000. End of the year the loan is $10,000. Beginning of the year exchange rate is 70. End of the year exchange rate is 75. 5 rupees per dollar. Liability increase, no? 5 rupees per dollar into $10,000, 50,000. What is it? Foreign exchange difference. Write it to P&L account. Am I right? To the extent it is in the nature of interest, it is to be regarded as borrowing cost. What do we mean when we say to the extent it is regarded as interest? I'll teach that part to you now. Shall we? This is called IRPT, interest rate parity theorem, what people usually learn in CA final AFM. CA final? Today, each dollar is how many rupees? 80. After 1 year, each dollar is 87. How? This 80 to 87 is because the interest rate difference between India and USA. In India, interest rate is 12%. In USA, interest rate is 3%. In India, what is the interest rate? In USA, how much is the interest rate? So very simple, no? Why to do CA? Why to work hard to earn money? Very simple. Take the money in USA, bring it to India, invest it in India. India will get 12% return. After 1 year, you withdraw the money in India, take it back to USA, pay it at 3% interest. ಅಲ್ಲಿ ರೇಟ್ ಕಡಿಮೆ, ಇಲ್ಲಿ ಇಂಟ್ರೆಸ್ಟ್ ರೇಟ್ ಜಾಸ್ತಿ, ಅಲ್ಲಿ ಸಾಲ ಮಾಡಿ ಇಲ್ಲಿ ಸಾಲ ಕೊಡಿ. Can you do that? No, you can do, but you will not make any profit. That profit will be eaten by exchange difference. Let us say you take $10,000 in USA as loan. Okay, na? $10,000 loan ತಗೊಂಡ್ರಿ. Today, when did you take loan? Today. Do $10,000 into 80. $10,000 into 80. 8 lakh 80,000. You take $10,000 in USA as loan at 3% interest. You convert it to Indian rupees. It will become 8 lakh rupees. You will invest 8 lakh rupees in India at 12% interest. 1 year ಆದ್ಮೇಲೆ ಎಷ್ಟಾಗುತ್ತೆ? 8 lakh plus 12%. ಎಷ್ಟಾಯ್ತು? 8,96,000 rupees ಆಯ್ತಾ? You will convert it to US dollars. ಎಷ್ಟು dollars ಬರುತ್ತೆ? Divide it by 87. 10,298. $10,000 plus 3% interest is $10,300. ಅಷ್ಟೇ ಆಗುತ್ತೆ. ಇಲ್ಲಿ 12% ಅಲ್ಲಿ 3% ಆದ್ರೂ that is compensated by increase in the difference in the interest rate will be compensated by increase in the exchange rates. This is called as IRPT. Did I only teach in your batch also? It's called as IRPT, interest rate parity theorem. This is used by a formula 1 plus RH divided by 1 plus RF is equal to forward by spot. 1 plus RH andre home rate of return. 1 plus RF is foreign rate of return. Forward rate 87, spot rate 80. If you apply 80, you will arrive at 87 as the rate. Did you understand this? Pakka? So in this scenario, let us say you saw the interest rates in India to be 12%. You saw the interest rates in USA to be 3%. You are thinking that you are very smart. Lower interest rate there is there in USA. So you took loan in USA. Yes, to $10,000 you took loan in USA. How much loan did you take in USA?
10,000.
Alva. How much is your actual interest? $10,000 into 3%. $300. 300. When are you paying that $300 interest? Beginning or the end? End ಅಲ್ಲಿ ಎಷ್ಟು exchange rate? 87. Do 300 into 87.
26,100.
How much?
26,100.
26,100 is your actual interest. Okay. That is not the only interest. Beginning of the year, how much is your liability? $10,000. End of the year, how much is your liability? $10,000. But beginning of the year, liability is $10,000 into 80. At the end of their liability is $10,000 into 87. Beginning of the year liability is 8 lakh, end of their liability is 8 lakh 70. 70,000 increase in the liability is there, no? That 70,000 is foreign exchange difference. That 70,000 is foreign exchange. In that 70,000 also some part is your interest. Henge, how much is the interest according to you? 26,100. Alva. How much is the foreign exchange difference according to you? 70,000. ಇದೆಲ್ಲ ಯಾವನಿ ಬೇಕೆಲ್ಲ ಕಿತ್ ಬಿಸಾಕಿ. You would have taken loan in India. How much would have been your loan? Yeah, 8 lakh. 8 lakh into 12%. 96,000 interest ಆಗ್ತಿತ್ತಾ? Because you took loan in foreign currency, your loan became 26,100. But you are incurring 70,000 rupees foreign exchange difference. Correct? No? That difference is there, no? That is your additional borrowing cost. Did not understand, alva? If you would have taken loan in India, your interest would have become 96,000. Because you took loan in USA, 26,100 plus 70,000. You get what I'm trying to tell? Now do 96,000 go 26,100 go difference estimated. 69,900. Out of that 70,000 foreign exchange difference, 69,900 is borrowing cost. Only 100 is foreign exchange difference. Feel like you understood, but actually you did not understand. Correct? We'll see the same thing in a better presentation. Same story. What is the foreign exchange rate today? 80 rupees per dollar. What is it at the end of 1 year? 87. What is the interest rate in India? Now you tell me, actually where did you borrow the money? USA. Actually where did you borrow the money? Okay, now you borrowed the money in USA to buy a machinery costing dollars 10,000. Let's see, borrowing is actually made in USA. What is the price of the asset? $10,000. ನಿಜ ಹೊಡಿತೀನಿ ಸುಳ್ಳು, ಈಗ ಏನಾದ್ರು 10,000 ಅಂತ ಹೇಳಿದ್ರೆ what is it? There is more than one currency involved, so tell the tag also. What is it? $10,000. How much loan will you take? In Indian currency, if you have to write this loan, how much rupees will it become? Artha aita? At the end of 1 year, interest will be computed on $10,000 at 3%. Why? Loan is in USA, no? $10,000 into 3% is how much? $300. How much is the interest in Indian currency? $300 into 87 rupees per dollar. How much? 100. This is your actual borrowing cost. But at the end of the year, your liability is still $10,000, which is now become rupees 87 per dollar. So your liability has become 8 lakh 70 from 8 lakh. Artha aita? If in case you had taken the loan in India, if first, actually where have you taken? USA. I'm telling you, if scenario, if you would have taken in India, loan would have been 8 lakh, interest would have been 96,000. Loan at the end of the year would have been still 8 lakh. Got it? So actually borrowing cost is 26,100. There is no second thought there. Got it? To pay 26,100 as interest, no, you are paying extra 70,000 towards towards liability. Because you paid only 26,100 as interest, you are paying 70,000 as increase in liability. Am I right? 70,000 liability jasti aitu. How much did you save in interest? If you would have taken loan in India, 96,000. Because you took loan in USA, 26,100. ಎಷ್ಟು interest save ಮಾಡಿದ್ರಿ? 69,900. So out of this 70,000 what you're paying extra as liability, 69,900 is in the nature of interest. That 69,900, whichever is less among these two, will become additional borrowing cost. What will it become? If you add them both together, you will get total borrowing cost. Total borrowing cost is the borrowing cost that you would have incurred if the loan was taken in India. So though you take loan in foreign currency, India loan ತಗೊಂಡಿದ್ರೆ ಎಷ್ಟು ಇಂಟ್ರೆಸ್ಟ್ ಬರ್ತಿತ್ತೋ ಅಷ್ಟುವರೆಗೂ foreign exchange difference interest. Only beyond that it will become foreign exchange difference. Do you get this? We took loan in USA. If we would have taken loan in India, whatever is the interest that we would have paid, no, to that extent, though it is called as foreign exchange difference, I will treat it as borrowing cost. Only beyond the interest what I would have paid in India, if there is foreign exchange difference, then it will become foreign exchange difference. Artha aita? That's the point that you should do. I don't want you to mug up the format here. So whatever loan you have taken in the foreign currency multiplied by foreign interest rate multiplied by foreign exchange rate at the end, you will get the actual borrowing cost. Then what should you do? There is increase in liability because you saved the interest. That savings in interest and increase in liability is there, no? Among that, whichever is less is considered as additional borrowing cost. Actual borrowing cost and additional borrowing cost, if you add together, you will get total borrowing cost. Actual borrowing cost and additional borrowing cost, if you add together, you will get total borrowing cost. And this total borrowing cost will be capitalized as per accounting standard 16. Got it? From this increase in liability, I will deduct this additional borrowing cost. Whatever is the difference is our foreign exchange difference. 70,000 no increase in liability. That's the foreign exchange difference alva. In that 70, I am treating 69,900 as interest only. So balance 100 is foreign exchange difference as per accounting standard 11. You got this? Nice concept. You will read this once again in CA Final AFM, International Financial Management. What is it called as? IRPT, Interest Rate Parity Theorem. Okay. This is the end of accounting standard 16. Can we now go to 17? Let's now start with accounting standard 17, segment reporting. Segment reporting is a cute, sweet, easy standard, no, but it is not applicable to all the forms of entities. It is actually applicable only for level 1 enterprise. Meaning an entity should prepare accounting for entire year and entire organization as a whole. They don't have to prepare reporting for small segments unless it is very big. Segment reporting is not mandatory, but if you have to do segment reporting, you have to do as per AS17 only. What do you mean by segment? An entire business will be broken into small parts called as segments. This division into segments can be based on the product or service they render, or can be based on the geographical location. If it is distinguished based on the product or service, it is called as business segment. If it is based on the geographical location, it is called as geographical segment. This business segment or geographical segment is your choice. You can divide your business into columns or rows, your choice. You can divide your business into Bangalore segment, Mysore segment, Shimoga segment, Davangere segment, Bidar segment, or you can divide your business into product A, product B, product C, service A, service B, your choice. Sir, what if I don't know how to do? Then you do one table, illi product A, product B, product C, illi Mysuru, Bengaluru, Bidar, your choice. You can do multiple ways also. You can either do business segment or do geographical segment or do both. These business segments or geographical segments will be considered as reportable segments, meaning for this you need to identify assets separately, liability separately, expense separately, income separately, profit separately. Like you do balance sheet for entire entity as a whole, just for that segment you need to prepare financial statements separately all again. That is called as reportable segment. When will a business segment or a geographical segment become reportable segment? You need to check the condition TRAM or MART, but you start TRAM. M will come at the end. T is turnover. If the turnover or revenue from that specific segment, including both internal and external, if it exceeds 10%, if it is equal to or greater than 10%, then it is a reportable segment. Next one, R. R andre revenue alla. T turnover itself is revenue. R is result. Result can be positive, profit. Result can be negative, loss. Profit or loss from the segment should be greater than or equal to 10%. If the profit or loss is greater than or equal to 10%, then again it will become reportable segment. When we say profit or loss, here you should be little careful. For turnover, I told no, internal and external together. It is not so simple. If there are some profit making segments, some loss making segments, you know what do? First segregate. Profit making segments separate, loss making segments separate. Total of profit making segments, total profit into 10% for profit making segments. Total of loss making segments into 10% for loss making segments. Am I right? No. Total of profit, total of loss, whichever is higher. On that 10% will be applied for both. Sir, ಇದು minus loss, minus plus alla. Think it as just a number. I'll repeat. First divide all the segments into profit making, loss making. Take the total profit from profit making segments, total loss from loss making segments. Loss is also a number. Don't take it as minus. Loss and profit is there. No, check whichever is high. Whichever is high, you get one number. That number into 10% you see. If the profit exceeds or equal to that 10, or if the loss exceeds or equal to that 10, then it is reportable segment. Otherwise, it is not. Did you all get this? For turnover, we take internal and external both. For result, we take profit or loss, total profit or total loss, whichever is higher, multiplied by 10%. And then comes A, TRAM, no, A for assets. If the segment assets is equal to or greater than 10%, it is reportable segments. Last one, management discretion. Management by its choice can pick any other segment as reportable segment. If after you identify reportable segments based on T, R and A condition, if the total revenue reportable from reportable segments doesn't come to 75%, based on turnover, result and asset, you pick reportable segments. The revenue from this reportable segments, if it doesn't come to 75% of the total revenue, then total external revenue, if it doesn't come to 75%, then management by discretion has to pick such non-reportable segments and make them reportable in such a way that total reportable revenue is 75%. So out of the total revenue, how much should be minimum reported separately? 75%. You can pick one segment or you can pick 2-3 segments to make 75%. That's up to you. Last point is continuity principle. What is continuity principle? A segment will become reportable if it was reportable in the previous year, even if it doesn't fulfill TRA condition. You get this? Pakka? So even if it has not fulfilled turnover, result or asset based condition, if it was reportable in the previous year, by continuity principle it will become reportable in current year. If it is reportable in current year based on continuity principle, next year it will not be reportable. You get what I'm trying to tell? Next year it will be reportable only if it was reportable in the current year based on turnover, result and asset condition, not based on continuity principle logic. Did you understand this? And we did not discuss the definition of business segment. It is distinguishable component engaged in providing individual or group product or services. Risks and returns are different from each other. Geographical is distinguishable component engaged providing providers or a product or service within an economic environment. Risks and reward different from those in other economic environment. Here products is the differentiating factor. Here the economic environment is the differentiating factor. In one economic environment, several products and services are together regarded as one single segment. Here at each one product at different economical environments is regarded as one single segment. Did you understand this? Very good. So when we take segment revenue, what and all is included? Directly attributable items, allocated items and inter-segment transactions, everything is included. What is excluded? extraordinary items, interest to dividend to profit on sale of assets and investments is not included. In expenses, we take operating and allocated expenses. Same, extraordinary, interest, loss on sale of asset, income tax, general expenses excluded. When we talk about assets, we take operating assets, directly attributable assets. We never consider tax assets, deferred tax asset, advance tax, provision for tax. All of these are not considered in segment asset and liabilities. You got this? Then what should we do? We should be disclosing segment revenue, segment result, segment asset, segment liability, and all of this. Secondary disclosure requirements is, what is the primary reporting format? Is it business segment or is it geographical segment? For each of it you should tell. What if you pick both? Then you should draw one table. Illi business, illi geography ಹಾಕ್ಬಿಟ್ಟು ಎಲ್ಲ ಬರೀಬೇಕು table. Are you getting it? Then that's it. If there is any other requirement of disclosure required as per any other accounting standard like AS5, you would have to make it. Otherwise, no. One of the simple standards. Let's quickly see that example like I mentioned to you people slightly before. See, goods, service, spares. Revenue is 40, 10, 300. Total is 350. 40 by 350 is 11.43. Is it reportable? Yes. Why it is greater than 10? From service, revenue is 10. Total it is 2.86, which is less than 10%, not reportable. And spares is 300, 350, 85.71 is reportable. Similarly, you will do for assets also. You got it? What if they've given profits and losses? See, you would have to take total of profit and total of loss. Take 15 or 12, whichever is higher. Whichever is high turned out to be 15. 15 into 10%. Or basically do 5 by 15, 11 by 15, 8 by 15, 2 by 15 and 1 by 15. That's how we'll arrive at percentages. If that is greater than 10, it is reportable. If it is less than 10, it is not reportable. Everyone understood? Very good. Then once you identify reportable and non-reportable based on that, you have to check whether from the reportable segments you're getting 75% of the revenue from external. If it is not, then further segments will be recognized. Here, internal, external, both together is to be considered, no, for segment revenue. Total is 495. I'll do 40 by 495, 45 by 495, 120 by 495, 150. I'll find the percentages. 8.08 and 9.09 is less than 10, not reportable segments. These three are reportable segments. What is the revenue from external? 80, 10 and 120, no. How much is 80 plus 10? 90. 90 plus 120? 210 by 240. Ade, 87.5% of the external revenue is reported by these three segments. So, external revenue exceeds 75%. There is no need to identify another segment as reportable by management discretion. If this was less than 75, if this 87 turned out to be 67, then management by discretion should pick one among A and B such that minimum external revenue will become 75. B tagondre kelsa mugiyala. After you take B, again you should check. Should come to 75. If it doesn't come, then pick A also. Okay. So we've done that, and the next thing is with regard to that continuity principle and management discretion types. See here, continuity principle mele. That I hope you people will understand. No? Yes or no? Should we do that question, or can I go to AS 18? We'll quickly go to accounting standard 18. Yes. Let's now start with accounting standard 18. Accounting standard 18 talks about related party disclosure. Whenever we say related party disclosure, there is no restriction on related party transactions. But standard only requires you to disclose the related party transactions separately. Why? Because it might be, I'm not telling it will be, it might be detrimental to the interest of the company. If another party is your related party, you might do business at higher selling price, or you might do business at lower selling price, maybe to book the profits in a different entity. You get it? This is wrong, because let's say I have 80% in my company, one company, subsidiary company. So what am I trying to do? I'm trying to book their profits in my books. Why? I have losses. If I book their profits in my books, no, loss adjust madudu. So what will I do? Basically what I'll do is, whatever the sales that they're making, I'll make them sell at a price lesser than the normal selling price, or make them sell at a price more than the normal selling price. See, I can say that's mine, this is also mine, but there are 20% shares held by outsiders. No, they should not be taken away from the advantage of profit or something. So we need to disclose the related party transaction separately. You got it? So who are related parties? Your holding company and your subsidiary company is your related party. If you are being controlled by someone or if you are controlling someone, both are related parties. Holding means company which has control over the composition of your board or has more than 50% voting rights in your company. Voting rights, okay? It's not equity shares. Don't tell equity shares. We say usually voting rights. And next one, we also use common control. See, holding company is your related party, subsidiary company is your related party, and if you are under common control, again it's your related party. What is common control? See, you are a company and there is another company. Both the companies are controlled by one common company. For example, you and your brother or sister are puppets in the hands of your parents. Basically, you are commonly controlled with the same hands. So both of you are related party. Why? You are under common control. You don't control that other person. They don't control you. Both of you are under common control. You are related parties. You got it? Holding and subsidiary is related party. Subsidiary and holding is related party. Subsidiary is also your related party. You are a subsidiary and there is another subsidiary. Both of you are together holding of one single company. Then again, all three of you are related parties. Understood this? Then comes associate or joint venture. Associate is a company in which you don't own more than 50%. You don't have control, but you have significant influence. You don't have control, but you have very good. You have more than 20% equity in that company. 20% voting rights is there. More than 20% voting rights, but not more than 50%. Then that is your associate. Now listen to me. You are a company. You own 20% in my company or 22% in my company. You have significant influence over me. To me, you are related party. To you, I am related party. Let's say you have a holding company. To your holding company, am I a related party? Answer is no. I'll repeat. You hold 22% shares in my company. You hold significant influence in me. You and I are related parties. Your holding company is not a related party to me. To you, your holding company is a related party. Understood? Next thing, you hold 22% equity in my company, voting rights in my company. You have significant influence over me. I and you are related parties. I have 22% voting rights in another company. So I and that company are related parties. Is that associate of mine and you? Are you related parties? No. Associate of an associate is not a related party. I and you are related. I and that is related. You and that company is not related. Whereas I am your subsidiary company. I have a subsidiary company. That sub-subsidiary and you, are they related? Yes. Control can be passed on. Significant influence cannot be passed on. We'll do questions on that. You get that? And joint venturers, co-venturers are always related parties. And then comes individuals. Any individuals who has control. See, for example, you as an individual, you hold 70% shares in my company. You cannot become holding company. Why? You are not an artificial person. You are a real person. You are not my holding company, but you have a person who can control my business. So you are my related party. What if you have husband or wife? That person is a relative of you. You get it? You have control over my company and that person is your relative. That relative is also my related party. Nim relative andre non relative alva. Am I right? You have control over me. You have 70% equity in my company, 70% voting rights. If you have a relative, that close relative of yours is my related party also. Let's say you hold 70% equity shares in my company or voting rate. You are partner in a firm. That firm is my related party. Are you getting it? And lastly, KMP and their relatives. KMP means key managerial personnel, managing director, CEO, COO, CFO. These persons and their relatives are also considered as related parties. Standard is not asking you to not do transactions with related parties. It is only asking you to disclose the transactions with related parties. And this related party relationship needs to be checked at any point of time during the year, not on 31st of March. At any point of time during the year, if you and the other person are related parties, on that balance sheet date, disclosures are required. Next balance sheet date, not required. Understood? Then, disclosure of transactions is at the time of related party relationship only. Let us say, I and you are related for the first 6 months. Last 6 months, there is no related party relationship. At the end of the year, when we do financial statements, separate disclosure is required for the transactions happening between both the entities in the first 6 months. There is no separate disclosure required for the transactions happening in the next 6 months when there is transactions between us, but there is no related party relationship. Did you understand? Two important things. Read this. Related party relationship needs to be checked at any point of time during the year and not exclusively at the end of the year. Second thing, separate disclosure is required only for the transactions happening during the period of related party relationship and not after. Got it? What is the disclosures that you should do? Name of the related party, relationship with the related party, transactions with the related party, outstanding balance with the related party. If there is any money written off, what is the money written off? Sir, what if we are related parties but we don't have transactions? Disclose the name and relationship. Sir, why not transactions? You only told me that there is no transactions. So if there is transactions, we'll disclose name, relationship, transactions, outstanding balance, and if there is any money written off during the year, how much is written off. If there is no related party relation, sorry, if there is no transactions, disclose the name and related relationship, but don't, there is no transactions required to be disclosed. Did you understand this? Quickly, shall we see some questions? Okay, now you tell me. Holding company has 55% control over subsidiary. Subsidiary has 25% significant influence over associate. From holdings perspective, subsidiary is related party, associate is not. From subsidiary's perspective, both holding and associate is related party. From associate's perspective, subsidiary is related party, not holding. Okay, you can see this chart or you can see the table, whichever you understand. Shall we go to next one? Fast aita. Come to the second question. So there is holding company which has two subsidiaries. From holding company's perspective, both are related parties. From subsidiary one's perspective, holding and subsidiary to both are related parties. Why subsidiary to? Common control. From subsidiary two's perspective, both are related parties. Understood this? Come to next one. Holding company has two subsidiaries. One of the subsidiary has an associate. From holding company's perspective, subsidiary 1, yes. Subsidiary 2, yes. Associate 1, no. Why? Control plus control is control. Control plus significant influence, no. Got it? Think from subsidiary 1's perspective. Holding, subsidiary 2, associate, significant influence directly they have. Why? They only have influence, no? They are directly connected. What about subsidiary 2? Holding, subsidiary 1, associate. Why? Common control subsidiary to associate. Tumba durud relative. Relative alla namge. You get it? So not relative only. Okay. Then ಬೇಕಾದ್ರೆ ರೋಡಲ್ಲಿ ಆಕ್ಸಿಡೆಂಟ್ ಆದ್ರೆ ಜಗಳ ಆಡ್ಬೋದು ಅವ್ರ ಜೊತೆ. Yes. Sometimes it's weird, no? You and your friends are going for a bike ride. You eat your friend's bike. You both start fighting. Has it ever happened? Because it's friends, do people stop fighting and then like chance aunde tane tappu. Okay, holding company has one subsidiary and one associate, and the coincidence is it is an associate for subsidiary also. Got it? Now from holding company's perspective, is subsidiary related party? Yes. Is associate related party? Yes. What is the relationship between holding and associate limited? Holding company doesn't have significant influence. Holding company has control. Yake? Directly it has 25%. Indirectly it has 30%. Together it has 55%. The relationship between holding and associate is that of, what is it? Control, not significant influence. Did you understand? People who attended this chapter last time, you feel no there is significant development in the way this chapter is being discussed. Is it nice? Yeah, not just this, lot of chapters we've changed lot of things. So then come to accounting question 5. Holding, subsidiary, subsidiary associate, associate ಇನ್ನೊಂದು associate. For holding company's perspective, tell me, is subsidiary related party? Yes. Is associate 1? No. Associate 2? No. From subsidiary 1 perspective, holding? Yes. Associate 1? Yes. Associate 2? No. From associate 1 perspective, holding? No. Only subsidiary and associate 2 also. Got it? Associate 2 perspective? Associate 1 is the only related party. Are you able to get it? Yes. Sir, I understood, sir, but I am not able to express my answer. Practice ಮಾಡಿ ಬರುತ್ತೆ expression. So two more things that I want you to remember is there is one question where managing director has appointed his wife as an employee in the company. Managing director is a KMP. His wife is a related party, is a relative to him. ಏನಾಗಬೇಕು ಹೆಂಡತಿ ಆಗಬೇಕು. So that wife is a related party to the entity. Okay, she will quit the job after 6 months. Then during that first 6 months there is related party relationship, no? Am I right? That has to be disclosed separately. You get what I'm trying to tell? ಮತ್ತೆ ಇನ್ನೊಂದೇನೋ ಇದೆ. Next at the end on 31st of March are they related party? 31st of March is their disclosure required? Yes, at any point of time during the year. And there is one company and associate. They've made some purchase sale transactions. Okay, after 3 months that associate and investor relationship is gone. Then they still have purchase sale transaction. It is related party, disclosure is required only for the period during which they are holding subsidiary relationship. Understood? One more question is, one bank has invested 20%, has 20% voting rights in one company, and they've appointed one associate director also, nominee director also in that company. They gave loan to that company. Is it related party transaction? Yes. Why? It is your associate. Last question from the study material is, there is some non-disclosure agreement between two parties. Should they disclose it? Should they still disclose related party transactions? No. If there is a non-disclosure agreement, if the disclosure of such transaction is detrimental to the interest of the company, and by way of a pre-existing contract, it is not okay, it is forbidden to disclose such details, then they should not disclose such related party transactions. They can skip it. You got it? That is accounting standard 18. Shall we do 19 and then take break? Let's now do accounting standard 19, which talks about leases. So lease was not a standard previously. It is simple, no? Whenever you give an asset on lease or rental income needs to be booked whenever given, whenever received. But this became a very interesting thing because at a point of time, people started fabricating sale transactions to look like lease. People started fabricating sale transactions to look like lease. So what they did is, assets useful life is 10 years. I will give you 9 years lease. Assets cost is 10 lakh. I will collect 9,50,000 from you on lease. I will give that asset to you on lease. Only you can use, others cannot use. And at the end of the lease, no, I actually sell that asset to you only. So throughout the useful life, asset is with you. Only you can use the asset and nobody else can use the asset. And you are paying me almost entire money for the sake of that asset. Then don't you think it is actually the asset is sold to you? I am lessor, you are lessee. I have given the asset to you on lease. This lease will be constituted and categorized into two types. One, operating lease. Two, finance lease. You get it? What is lease? Lease agreement. Lease is an agreement between two parties. Who are they? Lessor, lessee, to transfer the asset for a consideration. And this standard is not applicable to exploration of natural resources, licensing of motion films. So, sir, motion films means movies, videos, plays, etc. What you put on these OTT platforms, movies, all of that. For that, it's not applicable. And agreement to use the lands, it's not applicable. Why? There is no useful life for land. No, it's indefinite useful life. So, substantial period of the lease term covers the use. So, agreement for lease of lands is not covered under AS 19. Then I told you, two types of lease: operating lease and finance lease. What is operating lease? What is finance lease? Operating lease is like giving the asset on rent. I give the asset to you, I am the owner, you give me rent. Rent what you give is expense to you, rent what I receive is income to me. I am the owner, I will remain the owner, I will book depreciation. What is it? Operating lease. Finance lease is where I am the owner only on paper. Practically, you have the risk of the asset. You have the reward of the asset. You have the effective control of the asset. But only by legality, I am the owner. In reality, you have the risk, reward, and effective control of the asset. So on the paper, though I am the owner, asset will be recorded in your books, depreciation will be charged in your books. You are lessee, you are user, I am owner. If it is finance lease, you will charge depreciation. If it is operating lease, I will charge depreciation. How do we decide whether a lease is operating lease or finance lease? We check following conditions. Number one, if the lease period covers a substantial part of the useful life of the asset. I repeat, if the lease period covers the substantial part of the useful life of the asset, then what is it? Finance lease. Second one, if the lessee, meaning you, have an option to buy the asset at the end of the lease term. Lease term is over. After lease, you have an option to buy the asset. You have an option to buy the asset. And you don't just have an option to buy the asset, you have an option to buy the asset at a price lesser than the fair value. Then it will become finance lease. One more condition is asset is of specialized nature. It is customized for your needs. If the asset has to be given on lease to somebody else, then I would have to make major changes in the value of the major changes in the structure of the asset to give it on lease to somebody else. Then it will become finance lease. Last one, the consideration that you give to me, excluding interest portion, the consideration that you give to me covers the major part of my cost of the asset. Then it will become finance lease. It is not one of the conditions. It's based on professional judgment. It is based on, sometimes only one condition is satisfied, it will become finance lease. You get it? So we'll check based on professional judgment. Now let's talk about consideration. What money should you give to me in finance lease? So you are lessee, I am lesser. We both signed the agreement. In the agreement, you told that you will pay me money. Lease rental. What do we call it? Over 5 years, over 4 years, or over few months, whatever you pay, no, lease rental. Whatever the period for which you have agreed, multiplied by the number of installments that you told that you will pay, the amount of money that you're going to pay, together will become total lease rental that you promise that you will pay. Along with that, I told you, you have an option to buy the asset at the end of the lease. What price will you pay me at the end of the lease? You will tell one price. You return that price in the agreement. I have signed, you have signed. So you have promised to pay me two things. One, lease rental at the end of each period. Number two, residual value at the end of the lease term. That residual value you have guaranteed, no, you will pay. So that lease rentals plus guaranteed residual value, what you have promised to pay me, will become my minimum lease payment that you should make to me. What is MLP? Minimum lease payment. What does it constitute of? Lease rental plus guaranteed residual value. Guaranteed residual value is what is promised by lessee or someone on behalf of lessee. Let us say there are some parts of the asset what you are not agreeing to take over. I can decide to give it to somebody else. If an outsider gives me guarantee, that will also become guaranteed residual value to me, not to you. That is not part of MLP. Is it part of MLP? Minimum lease payment is only lease rental and guaranteed residual value by lessee. If there is a third party who is giving me guarantee, that is GRV to me, but not from you, but from somebody else. That is not there in any of the questions that we're going to do. Next, you are not taking over the asset at the end of the lease, and no one is giving guarantee also. But I'm expecting to recover some money. That becomes UGRV. What does it become? UGRV is unguaranteed residual value. What does it become? Very simple, yeah. You pay me MLP. That is lease rental plus GRV. What I'm expecting to recover from somebody else. UGRV. To you, liability is MLP. To me, asset is MLP plus UGRV. So that MLP, what you pay, plus UGRV, what I'm expecting to recover from somebody else, together, I will call it as gross investment. The investment that I made on the asset, how much can I recover? Gross investment. What can I recover? Lease rental plus GRV plus UGRV. I am lesser. Who am I? What can I recover? Lease rental and GRV from lessee. UGRV from outsider. Together, how much can I recover? GI. Gross investment. What you need to remember is You are paying lease rental, not all at once. It's in installments. You pay little at the end of this year, little at the end of second year, little at the end of third year. Are you getting it? So there is interest component in it. So in the lease rentals, what you pay and GRV, what you give, I need to discount it to today's date. So present value of GRV is the today's value of my asset. To you, what is today's value of liability? Present value of MLP. What is your liability? So the asset that you get from me should be recorded at what value? Present value of MLP. Usually you should record it in your books. You are lessee. Who are you? You should record that asset in your books at present value of MLP or fair value of the asset, whichever is less. At what value will you record? Present value of MLP or fair value of the asset, whichever is less. At that value, you will record your asset and liability. I will record my asset not at present value of MLP. I'll record it at present value of gross investment. ಯಾಕೆ ನೀವು ಕೊಟ್ರೆ ಮಾತ್ರ ದುಡ್ಡು ಬರೋದಾ ನಂಗೆ? Some assets what you don't take, I can sell it to somebody else and then I can take. No. So present value of MLP plus present value of unguaranteed residual value will become my present value of gross investment. Did you understand? Another name for present value of gross investment is net investment. So you tell me, who are you? Let's see. Who am I? What should you pay me? Lease rental, guaranteed residual value. Together, MLP, present value of MLP. That is the value at which you should recognize your lease asset and lease liability. Compared with fair value, whichever is less. And who am I? Lesser. How much should I record my asset as? Present value of MLP plus present value of UGRV, which is present value of gross investment. Understood? Difference between present value of gross investment and gross investment is my interest income. Got it? We call it unearned because we are computing it at the beginning of the lease. So I'll earn it over the lease period. No. So that becomes unearned finance income. Unearned finance income is present value of gross investment and gross investments difference. You people usually use these formulas. I am telling you, never use these formulas. Without using these formulas only, you can do the entire problem. I can teach all the problems in one single method. If you see material, they do 2 tables, 3 tables solve ಮಾಡ್ತಾರೆ I say statement. We don't have to do 3 tables. Only 1 table is sufficient. 1 table is sufficient. So if you want quickly, let's see one question. Yeah, this is too big a question. Let's see the second question. No, second question. Here I have also drawn 2 tables. We should see some question from the exam paper. Exam paper, it was reverse. Okay, you want to see one question? Oh, not this. This is foundation. I am sorry. Yeah, in every batch it's there. I'm just trying to see whichever is open, ready for disposal. There you go. Leases. See, just one table will have everything in the same. One table is more than sufficient. So first start with all the lease rentals. How many ever years are there? You write lease rentals, and you below that you write GRV. Lease rentals, what you're supposed to collect, plus guaranteed residual value, what you're supposed to collect, will become MLP. To that MLP, illu tabatara ide. It will become MLP. To that MLP, you add unguaranteed residual value. I'll show you. Not here. Yeah. These are slightly different questions. Here. You have it here. See, to lease rentals, if you add GRV, you get MLP. To MLP, if you add unguaranteed residual value, you get GRV, it's gross investment. On you write present value factor in between and then multiply. Here, if you have MLP, this side you have present value of MLP. Here, if you have gross investment, this side you have present value of gross investment. Gross investment and present value of gross investment, if you identify the difference, immediately below that you get unearned finance income. You get it? If in case they ask this unearned finance income split for each year, then what you got to do is you got to start with this present value of gross investment of 28, 30, 920. Go on adding interest. This is, I don't know how much percentage is 10 now, 15. Add 15% interest on that, multiply 15% interest and then go on computing. Then you will get unearned finance income for each accounting. So if that is asked, you need to do one more table. That is what I was trying to show here. I'll show these questions here. One moment. See, first you do lease rental plus GRV MLP. In this question, there is no UGRV. So present value of MLP itself is present value of GI. So you take 1855, 850. Go on adding 10% interest and deduct the lease rentals, whatever is there. You will get the closing liability. Basically, you are trying to find the finance charges for each year in this case. Did you understand? There are questions where they have not given the interest rate and they want you to find it. IRR computation also we've done. So you practice that, you will be able to ace this. Should I do more on this, or did you people understand that part of finance lease? Finance lease is the point where too many questions will come, and in fact that is the most easy part. Got it? Then after that we have operating lease. Operating lease is even more easy. They will never ask question on operating lease. Why? To you, whatever is the rental expense, to me that is rental income. Nimige expense, nanige income based on payment. Ashte. And who will charge depreciation? Lessor, not lessee. Got it? The beauty opens when it is sale and lease back. When it is sale and, what do you mean by sale and lease back? You have purchased one asset. You are the owner of that asset, but now you want money. So what do? You will sell that asset, but you want asset also. What do? You want asset also, you want money also. You will find someone like me, you will sell the asset to me. So you become seller, I become buyer, I will give the asset back to you on lease. So your asset, you will sell it to me, I will buy it from you and give it back to you on lease. Now, when you sell that asset to me, who are you? Seller. Who am I? After you sell that asset to me, I become lessor. You become you the seller. When you sold the asset, you will have profit. You the seller, when you sold the asset, you will make profit. How should you recognize that profit? See, you cannot recognize that profit straight away like any other normal transaction. Why? That is not the end. That sale transaction is continued with lease transaction. No. So the lease transaction following up the sale transaction will decide how you will record that profit. I'll repeat. You are selling the asset. I am buying the asset. I give the asset back to you on lease. What kind of lease transaction are we both having will decide how you should recognize the profit on that sale. Whenever you sell the asset to me, you become seller, I become buyer. The transaction is not ending there. I become lessor, making you lessee. On the sale, when you sell the asset to me, you might make profit, you might make loss. How to recognize that profit? Depends upon the resulting lease. Let us say the resulting lease is finance lease. Let us say the resulting lease is very, very easy. Yake? Previously, you are the owner. You sell the asset to me. I become owner. When I give it back to you on finance lease, it is like substantial risk and reward is transferred back to you. So it is like sale again. Do you agree with me? Any profit you make, any profit, let's say the value of the asset is 10 lakh, you sold it to me for 12 lakh. You made 2 lakh profit, should not be recognized immediately. It should be deferred and amortized. It should be Pakka. So, if a seller sells the asset to a buyer and the buyer becomes lessor and gives the asset back on finance lease, then the seller on the sale of the asset to buyer, any profit or loss made should not be immediately recognized. It should be deferred and then amortized. Got it? Next thing. If in case you are a seller, I am a buyer, you sell the asset to me, I give the asset back to you, but not on finance lease, on operating lease. Then what to do? Then between both of us, I will bring in fair value. Between you and me, whom do I bring? Fair value. Now, you, the seller, I, the buyer, to you, book value or carrying amount is there. To me, selling price is there. You get it? You will not compare book value with carrying amount. You will compare book value with fair value. Book value to fair value difference, immediate recognition. Fair value to selling price difference, defer and amortize. ಅಷ್ಟೇ. ಮೆಟೀರಿಯಲ್ ಅಲ್ಲಿ ಮೂರ್ ಟೇಬಲ್ ಇದೆ, 3x3 ಸಿಚುವೇಶನ್ 1 ಸಿಚುವೇಶನ್ 2, ಒಂದೊಂದು ಸಿಚುವೇಶನ್ ಕಡೆ ಮೂರ್ ಕೇಸು, ಆಮೇಲೆ ಒಂದು 3x4 ಎರಡು ಡಬ್ಬ ಇದೆ. If you've seen the material, you don't have to worry about so much. You are seller, I am buyer, you sell the asset to me, I give it back to you and fine operating lease. So between me and you, what is there? Fair value. You have carrying amount to fair value difference. What to do? Recognize immediately. Fair value to selling price, defer and amortize. Did you understand that? If in case that defer and amortize is there, no fair value to selling price is loss, you recognize immediately. Why? Conservatism. Exception, if they've given very clear information that that loss will be compensated by future payments, if they mention that, then defer and amortize. If they don't mention, immediate recognition. Did you understand? Do you want to do a question on this? Pakka. See this, I'll show you a question. Hegidru open the file. We'll finish it. Last question. There is questions on this in the study material also at the end. Please try this. Easy to do, not very difficult and fun type. But people usually find this irritating. People usually find this irritating. Have a look. When the carrying amount is 50 and selling price is 60, fair value is 60. What to do? First you will compare carrying amount with fair value. Carrying amount 50, fair value 60. 10 lakhs profit, immediate recognition. Okay. Chikkad madla. Is this okay? Fair value 60, selling price 60. There is no profit for deferring and amortizing. Correct? Difference between this is 0. So there is no deferring and amortizing. You got it? So what is the next thing here? Carrying amount 50, fair value 50. What to do? There is no profit for immediate recognition. See? No profit for immediate recognition. Fair value 50 to selling price 45. 5 lakhs loss should be deferred and amortized. Should be deferred and amortized. However, because there is no future lease payments compensating it, and by conservatism, we will recognize it immediately. See, 5 lakh loss will be recognized immediately. Got it? Here, carrying amount 50, fair value 55. What do you do? 5 lakhs immediate recognition. And 55 to 62, 7 lakhs defer and amortize. See here, profit 7 lakh, amortize. Profit 5 lakhs, immediate recognition. Similarly, there is one more. We can do a lot of questions like that. Yeah, there are 2 questions in your material if I'm not wrong. And you can do it. You won't find it difficult. Don't try to read this part theory from the material. It will become very difficult to understand. Simple concept. Remember, if the resulting lease is finance lease, profit or loss, defer and amortize. If the resulting lease is operating lease, then carrying amount and fair value, immediate recognition. Fair value and selling price difference, defer and amortize. However, fair value and selling price difference, if it is loss, check if there is future payments compensating. If the future payments are compensating, then defer and amortize. Otherwise, immediate recognition. Got it? Very good. That's with regard to accounting standard 19, and I hope you understood. Let's start with accounting standard 20, which talks about earnings per share. We know to evaluate the profitability of an entity, the entity will prepare its profit and loss statement and it will be disclosed. However, profit and loss statement gives the profit of the entire organization. You are not worried about the entire profit of the organization. You are worried about how much profit will you get for every share that you hold. So as a matter of better understanding of the financial performance of the entity, the total profit of the entity should be divided by number of shares that is there in the entity to determine earnings per share, earnings available to each shareholder. So this is called EPS. Simple, like we do in our financial management. We will take earnings available to equity shareholder, or what we call as profits available to equity shareholder, divided by number of shares. But in the financial management, what we do is we straightforwardly take number of shares that is there on that date. But Here the difficulty is much higher. See, the number of shares that is there in the entity will not be the same throughout the year. Thank you. So number of shares that's outstanding throughout the year will not always be same. Number of shares at the beginning, number of shares at the end might be different. In the middle of the year, certain number of shares can be issued. In the middle of the year, certain number of shares can be bought back. In the middle of the year, certain debentures can be converted to equity shares, certain preference shares can be converted to equity shares. There might be more than one class of shares involved in the company. Partly paid up shares might become fully paid up during the year, or partly paid up shares might be forfeited during the year. So a lot of other problems will come. So we need to consider all of these and determine weighted average number of equity shares. What should we find? Weighted average number of equity shares. It is not just number of shares in the denominator, it is weighted average number of shares in the denominator. How do we find that weighted average number of equity shares? Very simple. If the shares are fully paid up, simple, take that number of shares in the denominator. There is no problem. What if shares are partly paid up? Certain shares, like there are shares of rupees 10 each, rupees 10 paid up. There are shares of rupees 10 each, rupees 8 paid up. So what do? Those 10 rupees shares will be multiplied by 100% because they are fully paid up. However, shares of rupees 10, rupees 8 paid up are there, no? So 8 rupees out of 10 is like 80% paid up. So when you take those 10 rupees shares fully paid up, you will multiply it by 100%. When you take shares of rupees 10 each, rupees 8 paid up, you will multiply it by 80% to determine the number of shares. You got it? That is for partly paid up shares. What if shares are of different nominal value? Meaning, certain shares are of rupees 10 each fully paid up. Certain shares are of rupees 5 each fully paid up. Company has two different classes of shares. You cannot take the total number as 10 rupees shares plus 5 rupees shares. You need to find equated number of shares. One 10 rupee share is equal to two 5 rupee shares, or two 5 rupee share is equal to one 10 rupee share. You need to find equated. Let's say there are 10,000 shares of rupees 10 each and 10,000 shares of rupees 5 each. What do? 10,000 shares of rupees 10 each will be assumed to be 20,000 shares of rupees 5 each. 10,000 shares of rupees 5 each. Together 30,000 will be taken as denominator to find EPS. Once you find 30,000 in the denominator and identify the EPS, this is for the shares of rupees 5 each. Correct, Alva? For shares of rupees 10 each, we need to do into 2 to find the EPS. Alternatively, we can do ulta. We can take 10,000 shares of 5 each is there, no? That can be equated to find 5,000 shares of rupees 10 each. And there is 10,000 shares of rupees 10 each. Total will take 15,000 in the denominator to find earnings per share. From the total profit, if you take 15,000 shares in the denominator, identify EPS. This is EPS for shares of 10. We should divide it by 2 to find EPS for shares of 5. Basically, if the nominal value of the shares are not same, we need to find equated number of equity shares to find the EPS. That is, if the shares are of different nominal value. If there is bonus issue, share split and consolidation, bonus issue might have happened anytime in the middle of the year, but it doesn't really matter. We need to consider as if the bonus issue has happened at the beginning of the year and compute our EPS. Why are we doing so? Remember, whenever there is bonus issue, there is not even 1 rupee collected freshly from the shareholders. It is free share given to the existing shareholders. Am I right? When it is free share given, it doesn't really matter when the issue has happened. We need to consider it for the entire period because there is no consideration. The capital is same at the beginning, capital is same at the end. It was called as reserves previously, now it is called as equity. It is capitalization of reserves. So for the purpose of bonus issue, we need to take it as if it's happened at the beginning of the year, irrespective on what date the bonus issue has happened. Same we do for consolidation and same we do for stock split. What is stock split? What is consolidation? Split is like this. A company has one share of rupees 10. They convert it into two shares of rupees 5. Shares of 10 are split into shares of rupees 5. That is split. Consolidation is 10 shares of rupees 10 each will be consolidated to form one share of rupees 100. Several shares together you make it into one. Consolidation. One share you break it into several. It will become stock split. They do this to bring more volatility, more frequency in people to trade. Now, if I keep my one share of the company at 50,000 rupees, people can't buy and sell. No, there is less volatility. I'll split it into shares of rupees 2. If you remember this, this company went for stock split. This used to be Eicher Motors used to be a very expensive share. They split it into two to bring in market, I would say, volatility. And certain entities don't want that volatility. For example, MRF, they don't want volatility. They want their shares to be of high premium value that people who want to trade with 500 rupees should not buy their shares. They don't want small people to move the market of that company. So they keep it at a very high price. Then right issue. So whenever the company has made right issue, I told this to you in previously when we discussed accounting standard 13. So right issue is an option given to the existing shareholders to buy the shares of the company. How is right issue different from bonus issue? Bonus issue is free shares. I give the shares to the existing shareholders of the company free. Under right issue, I give shares to the existing shareholders of the company at a price. I charge them a nominal amount. I charge them an amount, but which will be much lesser than the market price. If I issue it at market price, again there is no problem. But I'll collect money, but I won't collect market price. I'll collect the money which is lesser than market price. Do you guys get this? When I collect the money which is lesser than market price, there is a hidden bonus element in it. I am not collecting the market price from them. I'm collecting something less. So total consideration what I receive from them should be divided by number of shares that I would have actually issued for cash. I'll determine that. The elements which are issued for cash element will be taken from the date of issue. Shares which are given for free will be treated as bonus element and treated from beginning. And here when I say right issue and here when I say bonus issue, there is something that we should be very, very careful about. Whenever there is bonus issue, I told you, no, we need to take as if it is from the beginning of the year. Further, we need to restate our previous year EPS also for bonus. I'll teach that to you people now with the help of an example. If the shares are issued on amalgamation, if that amalgamation is in the nature of merger, compute those shares and take them in the denominator from the beginning. If those shares are issued in the process of purchase, then from the date of issue. And if they are converted, then you should take it from the from beginning of the period from which they are the date on which we convert. From that date to the year end, we would have to take for conversion of preference shares or debentures to equity shares. Lastly, ESOP. ESOP again you need to determine whenever the ESOP shares are issued, from that day it will become denominator in basic EPS, but in diluted EPS it's slightly different. Now we'll learn these points whatever we just saw here with the help of some small examples, because that is what will give you better understanding. Now have a look at this. Profit available to equity shareholders is 10 lakh. Number of shares at the beginning is 10,000. On 1st of July, they issued 5,000 shares for cash. On 1st of October, they bought back 500 shares. At the end of the year, there are 14,500 shares. So we will not take 14,500, we will not take 10,000, we will not take 15,000. What should we do? 10,000 shares are there from the beginning till the end. Then I'll take 5,000 shares from 1st of July to 31st of March and this 500 shares minus 500 from 1st of October to 31st of March, and that will give me weighted average. I can find it in multiple ways. First thing is I will take it in the decumulated way. Opening balance of 1st of April is there, no, I'll take it for entire 12 months. That is there for entire 12 months. Fresh issue, I'll take it from 1st of July till 31st of March. April, May, June. I'll eliminate 3 months. I'll take 9 months. For the shares bought back, it is going to be negative. I'll take minus 500 from 1st of October to 31st of March. So that is 6 months. If you find the product, you'll get 13,500. Alternatively, you can take 1st of April to 1st of July, you had 10,000 shares. 1st of July to 1st of October, you had 10,000 plus 5,000 that you issued, 15,000. From 1st of October to 31st of March, opening 10 plus issue of 5 minus buyback of 500, making it 14,500 for 6 by 12. So you do 10,000 into 3 by 12, 15,000 into 3 by 12, 14,500 to 6 by 12. When you do this, you will get same 13,500 as your weighted average number of equity shares. Did you understand this? This weighted average number of equity shares will become part of my denominator. In the numerator, I will take my profit available to equity shareholders 10 lakh. I'll find EPS. Did you understand this? Now let's take a slightly different case. Here shares are of different nominal value. When the shares are of different nominal value, see there are 10,000 shares of rupees 10 each. There are 10,000 shares of rupees 5 each. I can equate them to shares of 5 or I can equate them to shares of 10. I told the same example to you orally. I can show it to you with numbers. What you would have to do is very simple. Take 10,000 into 5 and 10,000 into 10. Together the value becomes 1,50,000. If you divide it by 10, you will get 15,000 shares of rupees 10. If you divide it by 5, you will get 30,000 shares of rupees 5. So total value will remain 1,50,000. Do you agree with me? So it can be 15,000 shares of rupees 10 each, or it can be 30,000 shares of rupees 5 each. Are you understanding, or should I slow it down a point down? Is this speed good? Very good. So then numerator is profit available to equity shareholders 10 lakh. If you divide 10 lakh by 15,000, you will get 66.67. That is considering nominal value of 10. For shares of 5, it will be half. If in case I'll take 10 lakh and divide it by 30,000, EPS will become 33.33. That is for shares of 5. For shares of 10, it will be double, 66.67. Did everyone understand? Should I delete the numbers and then do it from the scratch? Getting it? Very good. Then is, you have it out? No. Okay. Then there is partly paid up shares. Partly paid up shares is here. See, 10,000 shares are of rupees 10 each fully paid up. And there are 10,000 shares of rupees 10 each, rupees 8 paid up. 10,000 shares of rupees 10 each, how much paid up? Rupees 8 paid up. So basically these have to be taken at 80% the value. At what value should I be taking it?
80%.
Very good. And these are issued on 1st of October. So these 10,000 shares, I will take at 100% value for 12 months. These 10,000 shares, I'll take at 80% value for 6 months. So I'll do 10,000 into 12 by 12 into 100%, 10,000 into 6 by 12 into 8 by 12. So that's how I get 14,000. This 14,000 will be taken in the denominator when numerator is 10 lakh to arrive at EPS of 71.43. Did you get it? There is another method of doing it, but the first method is the easier one. Then let's see the bonus shares. Now, this is a very, very tricky part. I want you to pay full attention when we do bonus shares as well as right issue part. So this, if you understand, it will become nice. Now, last year, how much is the profit? This year, how much is the profit? Very good. Last year profit is 8 lakh. Current year profit is 10 lakh. Can I say our profit has increased by 2 lakh? When our profit has increased by 2 lakh, see the percentage of increase in the profit, guys. 2 lakh divided by 8 lakh. 22 by 8 is how much, guys? 1 by 4. Correct, Alva? Yes or no? 1 by 4 is 25%. Do you agree with me? 25% there is increase in the profit. Now, very good. Come on, let's determine our earnings per share. How much is the profits available for equity shareholders in the current year? 10 lakh. Number of shares is 10,000. Do you agree with me? 10,000. But there is bonus issue of how many shares? 2,500. Bonus issue has happened on 1st of July. But we know, no, even if the bonus issue is made during in the middle of the year, we'll take it into consideration as if it is made at the beginning of the year. So take 12,500 in the denominator and 10 lakh in the numerator. Do 10 lakh by 10 lakh by 12,500. 880. Only 80 is your EPS. Check the EPS for previous year. 8 lakh divided by 10,000. Something is wrong, no? See, last year 8 lakh is the profit. Number of shares is 10,000. Bonus issue happened this year. So last year only 10,000 shares, sir. Wow. Last year you do 8 lakh by 10,000, you will get 80. Current year you do 10 lakh divided by 12,500. You got 80. So last year EPS 80. This year EPS 80. Let us say you are an investor. When you look at this, what do you feel? Last year EPS 80. This year EPS 80. Company is not at all growing. Don't you think so? You will think so. But has the company done better? Yeah. Company did 25% extra profit than last year. There is 25% increase in profit. But it's not visible. Why? Company has not collected 1 rupee extra capital. With same capital, they made 25% extra profit. EPS ಅಲ್ಲಿ. This is because the comparison is wrong. Last year denominator is 10. Current year denominator is 12,500. But the capital has not increased. So what should we do? We did this 2,500 shares as if it was issued at the beginning of the year. Beginning on the 1st of April, no. Can be 31st of March also. If it is 31st of March, bonus issue happened last year. Last year also means last year also should take full, no. So basically, reserves have been utilized for the purpose of bonus issue, no. So when you identify EPS for the current year, when you identify EPS for the, by doing 10 lakh divided by 12,500, you get 80. So EPS of the current year is 80. Previous year's EPS is also 80. We need to restate our previous year EPS, assuming the bonus issues happened in the previous year. So previous year's EPS will be computed taking 8 lakh divided not by 10,000, 8 lakh divided by 12,500. So 64 is the EPS which is restated for previous year. So from 64 EPS has become 80. How much is the increase? 16. Do 16 by 64. You get same 25%. Banta. So EPS has also increased by 25%. Do you agree with me? So this is called restating the EPS. Is it because the last year's EPS is wrong? No, 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 no. Last year's EPS is correct. Because we made bonus issue in the current year EPS cannot be compared with previous year EPS. Only to ensure that we can compare the EPS of current year with previous year, we restate our previous year EPS. So in our current year P&L account, we write revenue from operation, other income, all the expenses, total income, profit, extraordinary, exceptional, before tax, after tax. Then you write EPS. EPS, original EPS for current year, original EPS for previous year. And you write restated EPS for previous year. This restated EPS for previous year of 64 is computed only and only for comparison. Only and only for, if you don't do this 64, then the EPS comparison will be incorrect. You will take wrong conclusion. What will you take? Artha ಆಗ್ತಿದ್ಯಾ? So whenever there is bonus issue, what should we do? Restate the EPS for previous year as if the bonus issue happened in, I'll repeat, restate the EPS for previous year as if the bonus issues happened in the, did you understand this? Very good. Pakka? How many of you have never learned this, seeing this for the first time, completely forgotten? No, you remember? I only thought 20 or 20 I only thought. Okay, regular class we did not. Then comes right shares. Right shares means we have issued the shares for a consideration only. Bonus ಏನಲ್ಲ. Free and ಕೊಟ್ಟಿಲ್ಲ. Free ಆಗಿ ಕೊಟ್ಟಿದೀವ, ದುಡ್ಡು ಇಸ್ಕೊಂಡಿದೀವ. ದುಡ್ಡು ಇಸ್ಕೊಂಡಿದೀವಿ. But we have not collected the correct amount of consideration. We have not collected the correct amount of. Please see the question. How much is profit available to equity shareholders? Sugar hit ಆಗ್ತಿದೆ. Number of shares at the beginning. Number of shares issued as right shares? Alva. Now this 2,500 shares, from when do I take? Weighted average. Should I take from April or should I take from 1st of October? After straightforward answer Allah. There is a small trick in that. I'll tell you the reason. What is the cumulative right price? 20. What is the right issue price? No kitapati ide. Find theoretical X right price. What should we find? Quick revision. What do you mean by cumulative right price? We discussed today only in AS13. I'll repeat once again. What do you mean by cumulative right price? It is the price of the share before right issue. It is the price of the share. What is right issue price? Price at which right shares are issued. It is the price at which. What is theoretical X right price? Price of the share after right issue. I'll repeat. Before the right issue, cumulative right price. After the right issue, theoretical X right price. Price at which the shares are issued, right issue price. How do we find it? Very simple. See the ratio given here for right shares. What is the ratio? 1 share for every. If you have 4 shares, I will give you 1 share. If you have 4 shares, I'll give you. That 4 shares that you have will be at what rate? 20. Take your calculator, everyone. 4 shares. Each share is there at 20 rupees. Do 4 into 20. 80. You buy 1 share at what rate? 15. 1 into 15. 15. 80 plus 15. 95. Divided by. Munche 4 ittu. Now you got 1. Together 5. Take in the denominator 5. 19. What is that? 19 is a theoretical X right price. Before right issue, if you had 4 shares, in right issue, you will get 1 share. Together you will have 5 shares. Before right issue, if you have 4 shares, in right issue, you will get 1 share. Together you will have 5 shares. Before right issue, 4 shares were there. They were at the rate 20 rupees. 1 right share was issued at 15 rupees. After that, you will have 5 shares. 4 shares were there at 20. Take your calculator. 4 into 20. Plus 1 into 15. Together 95. 95 is the value of 5 shares divided by 5. Now what is 19? Theoretical X right price. After right issue, this is the price of the share in the market. They should have issued shares at this price. There is another way to arrive at this 19. Shall I teach? Before right issue, how many shares are there? 10,000. Do 10,000 into 20.
290.
Plus. Sorry. I did not have lunch. I could not. Antara ಆಗ್ತಾ ಇತ್ತು. Now, if you people feel like ನಂತರ ಅದು ಏನಂತಾರೆ, what do you call that? ಸರ್ ನಮ್ಮನ್ ಬಿಟ್ಟು ಕುಡಿತಾ ಇದಾರೆ ಅಂತ ಏನಂದ್ರೆ ನಮ್ಗೆ ಹೊಟ್ಟೆನೋ ಬರ್ಬೇಕಲ್ವಾ ಇವತ್ತು ರಾತ್ರಿ, ನಾಳೆ ಎಲ್ಲರಿಗೂ ಹುಡುಕ್ಬಿಟ್ಟು ಹುಡ್ಕೊಂಬಂದು ಹೊಡಿತೀನಿ ನೋಡಿ, ಗ್ಯಾರಂಟಿ. ಹೊಟ್ಟೆನೋ ಬರಬಾರ್ದು ನಾಳೆ ನಂಗೆ. ಫೌಂಡೇಶನ್ ಮ್ಯಾರಥಾನ್ ಇದೆ. ಇವತ್ತು ಬಂದ್ರೆ ಪರವಾಗಿಲ್ಲ, ಇವತ್ತು ಬಂದ್ರೆ ನಿಮ್ ಮ್ಯಾರಥಾನ್ ಹೇಳಾಗುತ್ತೆ ಅಷ್ಟೇ. ಇಫ್ ಮೈ ಸ್ಟಮಕ್ ಸ್ಟಾರ್ಟ್ಸ್ ಪೇನಿಂಗ್ ನೋ, ಐ ವಿಲ್ ಸೇ ಥ್ಯಾಂಕ್ ಯು ಗೈಸ್, ಐ ವಿಲ್ ಡೂ ದ ರಿಮೈನಿಂಗ್ ಕ್ಲಾಸ್ ನೆಕ್ಸ್ಟ್ ವೀಕ್. ಐ ಟೆಲ್ ಯು ಆನ್ ಟೆಲಿಗ್ರಾಮ್ ಅಂತ ಹೇಳಿ ಹೊಟ್ಟೋಗ್ತೀನಿ ಮನೆಗೆ. ಹಿಂಗೆ ಶುಡ್ ಪ್ರೇ. ಸರ್ ಚೆನ್ನಾಗಿರ್ಬೇಕು ಅಂತ ಪ್ರೇ ಮಾಡ್ಬೇಕು ನೀವು ಯಾವತ್ತು. ಸರ್ ಚೆನ್ನಾಗಿದ್ರೆ ಕ್ಲಾಸ್ ಚೆನ್ನಾಗಿರುತ್ತೆ. ಐ ವಿಲ್ ಪ್ರೇ ಫಾರ್ ಯುವರ್ ಸಕ್ಸಸ್. ಓಕೆ, ಸೊ 10,000 into 20, 2,500 into 15.
37.
Okay, divide it by 12,500 shares. Are you getting it? Pakka? Very good. So they should have issued it at 19. If the company had issued the shares to any random person, they should have issued at what price? But they issued at what price? Why did they issue at 15? Is they are our shareholders? No. So we issued them at lesser price. If I issue shares at 19, it is fair value. If I issue it at 15, there is some element of bonus in this. Are you getting it? I cannot say every share may 4 rupees bonus alla. You should find how many shares are bonus, how many shares are cash. Hege, very simple. That shareholder bought how many right shares? Nobody has doubt with 19, no? So he bought 2,500 shares. How much did he pay for each share? Do 2,500 into 15. 37,500 rupees banta. If we would have issued at a fair price, what is the fair price? Divide it by 19. 1,970 alva. We should have given him 1,973.66 shares. We should have given him 1,973.66 shares. But I gave 2,500 shares. 2,500 shares kottidini. But cash ಬಂದಿರೋದು 1,973 shares ಮಾತ್ರ. 2,500 minus 1,973. 526 shares are bonus. 526 shares are for 526 shares bonus. No, I should take from April to March. 12 by 12. 1,973.66 shares. 1st of October to 31st of March. We did not use any formula. We used common sense. Same thing, they don't use common sense in the material. What do? They use adjusting factor. ಏನಕ್ಕೆ ಮಾಡಿದ್ರು ಎತ್ತ ಮಾಡಿದ್ರು ಅಡ್ಜಸ್ಟ್ ಮಾಡ್ತಾರೆ. ಏನಕ್ಕೆ ಏನು ಗೊತ್ತಿಲ್ಲ. But did you understand the logic here? Why we do like this? Common sense. First to find the theoretical X-rate price. 99% of the times theoretical X-rate price will not be given in the question. We should find theoretical X-rate price. How do we find? Now I'll show the same answer. I could have shown, but I wanted you to understand. You remember the question, no? 4 shares 20, 1 share 15. Observe. 4 shares into 20, 1 share into 15 divided by 4 plus 5. Alternatively, 10,000 shares into 20 plus 2,500 shares into 15 divided by 10,000 plus 2,500, 12,500. What do we get? 19 rupees is theoretical X-rate price. They should have issued at 19, but they've issued at 15. Andre, there is some bonus element. How do we find? 2,500 shares are issued at 15, which comes to 37,500. 37,500 rupees is collected. If I would have considered theoretical X-rate price of 19 rupees per share, if I would have considered theoretical X-rate price of 19 rupees per share, how many shares should have I issued? 1,974 shares should be issued. But I issued 2,500 shares. I should have issued 1,974 shares, but I issued 2,500 shares. If I deduct, I'll get bonus shares of 526. This bonus shares of 526 I'll consider 12 months. This 1,974 shares I should consider 6 months. Not just this, sir. this 526 shares should be considered for restating the previous year EPS also. It should be considered for restating the previous year EPS also. You got this? This slightly different presentation. If you see this presentation, you will not find this in any material. RTP, MTP, suggestion answer. This kind of presentation is not there. But whenever the question is there on right issue, follow this approach. You follow the approach, you do the answer. Answer will match. Method will not match. Method will not match. And I'll tell you one more thing. When you see the answer, no, you feel like material answer is much simpler. Why? There, one formula adjusting factor they compute and they straight away multiply. But this is more logical. This looks little bigger, but you don't have to mug up that formula the day before. The probability of doing the error will be more there. Probability of doing the error is less here. You get ಇಲ್ಲಿ ತಪ್ಪು ಮಾಡಕ್ ಚಾನ್ಸೇ ಇಲ್ಲ. ಕಾಮನ್ ಸೆನ್ಸ್ ವರ್ಕ್ ಆಗುತ್ತೆ. If you do something wrong, you like ಇದಂಗ ಆಗಲ್ಲ, ಚಾನ್ಸೇ ಇಲ್ಲ. You get that question. When you do adjusting factor, you might forget to restate previous year CPS. If you do this, you won't. So please do this. Are you getting it? It will not take extra time. Nanu hage kaltiddu. Even I read like that. Later I did not understand. Now class will teach madokar students will ask, no, sir, what is adjusting factor? Why do you multiply? I don't know the answer. So then I went on to try this. You got what I'm trying to tell? So this is same as adjusting factor only. 526 by 1974 only is the adjusting factor. But we present it little more better. And initially I did not know, but later this is become a savior, because once you do this, no, this approach can be used for ESOP also when we do diluted EPS. So one method will save two things. Same box I'll draw for ESOP. Same box I'll draw for ESOP under diluted EPS. Same thing will give same answer. Like that will also become easy. But if you see material, ESOP is treated differently. Right issue is treated differently. So it is two different concepts in the material. But if you learn the logic, it's the same logic for both of them. Did you understand this right issue? This is the tricky part in basic EPS. If you learn this, rest of it is easy. Now shall we go to diluted EPS? Next question is, anybody has doubt? No. Next one is diluted EPS. What do you mean by diluted EPS? See, there is no dilution which is happening in reality, but there is expected dilution. There is, for example, let's say we have a cake of 1000 grams and we are 10 people in the class. We are not 10, just giving you an example. Let's say there is 1000 grams, 1 kg cake, and then 10 of us. How much will each of them get? How much will each of them get? 100 grams of cake. Now suddenly you hear some bike noise, some 10 people parking their bike, and you hear some gate noise, and you hear some people coming up the stairs. Now you are upset. Why? If they come to the room, you would have to share the cake with them also. Correct or not? So they are potential people who will come into the class. If they come, they become denominator, they don't become numerator. The same 1000 grams cake should be now shared not between just 10 of us, but between 10 of us and those 3 or 4 people will come. What if those 10 people, those 3-4 people who come, they also get one cake along? Let's say they get one 250 grams cake and 4 of us have come, 4 of them have come. Then 1000 grams plus 250, it will become 1250 grams of cake shared between 14 people. Do 1250 by 14.
89.9.
ಮುಂಚೆ 100 grams ಬರ್ತಾ ಇತ್ತು, ಈಗ 89 ಆಯ್ತು. So there is decrease in each person's share. This is dilution. What if they get 1 kg cake and 4 of them come? Numerator becomes 2000 grams divided by 14. 2000 by 14, 140. Will you be happy or sad? Happy. Because of their coming, you are getting more. This is anti-dilutive. This is anti-dilutive, need not be disclosed. Dilutive should be disclosed. See, that cake is there, no? That is profit available to equity shareholders. Denominator number of shares are there, no? Sorry, denominator 10 people are there, no? They are existing equity shares. 4 people who are coming are potential equity shareholders. Who are they? They are not equity shareholders, but they will become equity shareholders. And numerator they bring cake, no? That is interest or preference dividend. So they are preference shareholders or convertible debentures. Now, if they are debenture holders, we pay them interest. After we pay them interest, whatever profit is remaining, we share. If they are no longer debenture holders, they become equity shareholders. Debenture interest need not be paid to them. So let's say debenture interest what was paid to them is 250. So 250 will add back to numerator. So profit available to equity shareholders is now not 1000, it is 1250. Denominator will not be 10, denominator will become 14. Our EPS decreased to 89 from 100, so it is still dilutive. What if those debenture holders, if they become equity shareholders, increase in the profit is 1000, denominator is increasing by 4, EPS will become 120 or something, so you will be actually happy. That is anti-dilutive in nature. Dilutive EPS should be disclosed separately, anti-dilutive EPS need not be disclosed separately. Did you understand this? And this is not actually converted, they are outstanding debentures, they are expected to be converted, but they are not converted. If those debentures are converted to equity shares, they come as a part of basic EPS. Here they are potential equity shares but not equity shares. What are potential equity shares? Convertible debentures, convertible preference shares, and ESOPs. Convertible debentures, convertible preference shares, and ESOPs. ESOPs will add nothing to numerator, they'll only sit in denominator. If there is vested options, you add nothing to numerator, you add only to denominator. The second one is debentures and preference shares. Second one debentures, third one preference shares. I'll tell preference shares first. For preference shares, if they are preference shares, you pay them preference share dividend, balance will be shared between equity shareholders. If they are no longer preference shareholders, if they become equity shareholders, then that preference dividend need not be paid, no. So to numerator, I add back preference dividend what I had previously deducted. Denominator, I'll write equity shares plus expected number of equity shares to be issued to those preference shareholders. Understood? It will work for preference shares, but for debentures you need to be cautious. Why? See, after debenture interest, before ETH or PATESH, there is tax. Debenture interest was expense, so tax was less because the profit was less. Now if those debenture holders become equity shareholders, you don't have to pay debenture interest, so you have to pay, your profit will come more and your tax will become more. So whenever you add back to profit available to equity shareholders, preference dividend to easily add back. If it is debentures, you need to add back debenture interest into 1 minus t. Should I tell you why is it into 1 minus t, or straight away will you understand? Everyone, so you will take for diluted EPS computation, you need to identify diluted earnings. You need to identify, how do you find diluted earnings? Very simple, existing earnings plus what do we add? Preference dividend. If it is debenture, existing earnings plus debenture interest into 1 minus t, into 1 minus t. Denominator will be existing shares plus number of shares issued to debenture holders or preference shareholders. You want me to explain that with the help of a problem, or did you understand? Everyone, no need of example there. Fantastic. So remember, debenture interest into 1 minus t. I think that's what you do in financial management day in day out. So straight away do into 1 minus t. There is one simple trick that I want you to know. This people usually forget, and there is a question on this. This is the one. Have a look at this. Net profit is how much? 90 lakh. Tax rate 30%. Interest on convertible debentures 6 lakh. 8% convertible debentures are there, which is 1 crore, which is 1 lakh debentures of 100 each. One equity share will be given for every 10 shares, every 10 debentures. One equity share will be given for every 10 debentures. Equity shares at the beginning is 10 lakh. You got it? So if the question is like this, one simple mistake that everyone do is straight away they take net profit after tax 90 lakh. They add back interest. How much interest? 6 lakh into 1 minus 30%. And in the denominator, they'll take number of equity shares which was there is 10 lakh. And here for 1 crore value, there is 1 lakh debentures of 10 each. No? How many equity shares will you give? 10,000 equity shares. Am I right? For 10 debentures, you give 1 equity share. Correct? So for 1 lakh debentures, you give 10,000. They take 10 lakh 10,000 in the denominator, which is wrong. You know why? Very simple. What is the rate of interest on debentures? But what is the amount of interest? So interest is 6 lakh. Interest rate is 8%. Then there is something missing. You know what? Interest is computed not for entire 12 months, but interest is computed for 9 months. Observe that. Interest is 100 lakh into 8%, no? Which comes to how much? However, interest mentioned in the question is how much? So if I do 6 lakh, interest is equal to P into T into R. Period comes to 9 months. So on this 100 lakh rupees at 8%, for 9 months interest comes to 6 lakh rupees. For how many months? For 9 months the interest comes to 6 lakh. So convertible debentures are there only for 9 months. Artha April, May, June, 3 months is over. After that I've issued debentures. 3 months are over. After that I've issued. So in my diluted EPS denominator, when I take debentures for conversion, 10,000, I should not take 12 by 12, I should take 9 by 12. This is one thing that people usually miss out on. Am I teaching it really fast? Are you getting 20? We will do, however, 23, 24, 25, 26, 27 will get over quick. Don't worry. 23 to 27 will happen quick. 28 will take little time. But otherwise, things will happen fast. Time will be taken only till 22. 20, 21, 22, ಸ್ವಲ್ಪ slow. 23 to 27 again fast. 28, 29 will happen quick. Sorry, 29 will happen quick. 28 will take time. Got it? So that's it. This is with regard to diluted EPS part. Any difficulty? Yes, please.
We assume that the debentures were issued in the previous, but in the current year they'll be converted into equity.
If you assume that you will compute diluted EPS for 9 months for this 10,000, for the last 3 months they have become equity shares. No, in the basic EPS for those 3 months, last 3 months, you would have to take 10,000 extra. You got it? No. So logical assumption will be that the debentures were issued after 3 months. If in case you assume that debentures are existing previously, after 9 months debentures have been converted to equity shares, then in basic EPS denominator 10,000 should come for 3 by 12. Yeah, if that data is given, check with that. Okay, everyone clear?
The debentures do not get converted in this year also. Then in the next year it will be taken for full.
Next year is it converted?
No, it's not.
Next year also will take it in diluted EPS full, because interest will be there entire 8 lakhs. No, that is based on the assumption that debentures are issued after the first 3 months in the current year. So current year in diluted EPS computation for potential equity shares will take debentures for 9 by 12. Next period will take 12 by 12. Next period interest also will be full amount of 8 lakh. Clear? Punita said out. No. Then the last part that I wanted to teach you people is with regard to ESOP, employee stock option plan. So let's say net profit is 12 lakh, weighted average number of shares is 5 lakh, fair value is 20, exercise price is 15. So when we are offering shares to our employees, we are offering at a price lesser than the market price. What is market price? 20. At what price am I offering? 15. So when I'm computing my potential equity shares, some shares I need not compute only. Some shares are like bonus, should take full year. Shall I tell you how? Very simple. How many options are outstanding? 1 lakh. How much am I collecting for one share? Do 1 lakh into 15. 15 lakh is collected. Let's say we had issued at 20 rupees. Do 15 lakh by 20. 75,000 shares should have been issued. But how many we are issuing? So 75,000 shares are issued for cash. 25,000 for bonus. See here. 75,000 cash element. So that will be taken when it is issued. Cash will come, shares will be issued, then it will be recorded. It will come in basic EPS. It will never come in diluted EPS. But 25,000 is non-cash, no. This 25,000 should be considered in diluted EPS computation as potential equity shares. This is because they put their sweat, we are giving them at that price. Why are we giving shares to employees at 15 rupees? Because they are our employees. They put our sweat, no, sorry, their sweat, isn't it? They worked hard for the organization. So for that, I've taken the benefit. They have been vested. They have the right to get equity shares, but they will be given later. So that will be taken in the denominator. Again, remember, it will be taken for entire 12 months. Like bonus. So is this any different from right issue? No. Only point is there we have to find theoretical X-rate price. Here theoretical X-rate price computation is also not required. Got it? Last thing is, we don't have any of these questions in our material. in study, when I say material in the sense, ICA study material doesn't have any of these questions, but still I'll tell this concept to you. In the regular class, we've done this. A single question having more than one variant of potential shares. A single question, same question, there is convertible preference shares, convertible debentures, and ESOP. Then what to do? We need to check it stage wise. We should not take everything together and then identify the diluted EPS. It will be incorrect because we might not know which is dilutive, which is anti-dilutive. So what should we do in that case? Each item like convertible debenture, convertible preference share, ESOP, each of it, we should take the incremental EPS is to be computed. How much change in the numerator will happen, how much change in the denominator will happen. We won't find diluted EPS, we'll find incremental. Existing numerator, how much will you add? Only that. Existing number of shares, how much will you add? Only that in the denominator. We'll take incremental EPS for preference shares, debentures, and ESOP. ESOP will be always numerator 0. ESOP always numerator will be okay. So when you do this, you get incremental EPS. You have to take the higher of these EPSs first. You need to order them in the higher EPS. I'll show you. See, this is the case. See, there is ESOP, there is debenture, there is preferential. What do you do in that case? You need to find the incremental EPS for all of them. Once you find incremental EPS, see for ESOP, numerator 0, denominator 20. So incremental EPS is 0. For debentures, numerator will be 0, numerator will be 84, some amounts are there, 33.6. And here you get 4. I list them in the order. In the ascending order, I will give them numbers. So ESOP will be maximum dilutive. Preference shares is second dilutive. Debentures is least dilutive in the nature. So what we should do is, first we should assume only ESOPs to have been there and compute diluted EPS. Check that after ESOP diluted EPS with basic. Basic EPS is 5. If I consider only options, it became 4.95. From basic of 5, 4.95 is less or more. So it is dilutive in nature. Then to this data, I will add my preference share data and then compute my EPS. EPS became 4.53. Over here it is 5. And in fact from here 4.95 to 4.93. Has it decreased? Yes or no? So preference shares is also dilutive. I will proceed to debentures. What if here we had got more? From here it's becoming anti-dilutive. Stop. You don't have to do the next one only. You stop at here and 4.95 will become our diluted EPS. Why? Anti-dilutive need not be disclosed. It is against conservatism. Are you getting it? Sir, why should we not check debenture? Debenture will be more anti-dilutive. ಅಲ್ಲ ಕಣ್ರಿ 4 incremental EPS ಗೆ anti-dilutive ಆದರೆ 33.6 ಗೆ won't it be more anti-dilutive? So you don't have to do everything in total. Identify incremental EPS, keep them in the ascending order and then check them. This kind of question used to come in CA final FR. But CA intermediate never asked. Not there in study material also. But in a rare worst come scenario, if in case the institute wants to make the paper the most difficult and then ask you a very tricky question on AS20, it will be something like this. Still doable. We've done in the class. In this case, when you take debentures, EPS will become 6.41, meaning it is anti-dilutive in nature. So what should we disclose in our P&L? 4.53, 6.41, 4.95 or 5? Basic EPS of 5, dilutive EPS of 4.53 will be disclosed. Basic EPS of 5 and dilutive EPS of 4.53 will be disclosed in our statement of profit or loss. Everyone understood? Pakka? That's it, guys. We are done with our EPS. Where we don't have to collect money, we still have to give them money, give them those shares. No, they have earned those shares by their hard work. It is like service cost for us. You got it? So even without they giving money, we might have to give those many shares. No, for the balance they would have to give consideration to get those shares. For that they don't have to give consideration. So that is dilutive potential shares. Got it? And that's it. So same thing, whatever is here I explained it to you with the help of numbers. So potential equity shares are convertible preference shares, convertible debentures, employee stock option plans. Share warrants and partly share paid share of shares with dividend rights won't come in the exam. Don't worry. Let's now discuss accounting standard 21, which talks about consolidated financial statements. So this, though it is given as a accounting standard, this is actually a proper accounting chapter. I hope you'll agree. Very good. So this is a little tricky standard to revise given 20-30 minutes time frame, but let's see. I've summarized everything that I usually make you do with by way of an accounting question. I've summarized the one liners for this, so let's try to read that and then try to recapitulate. Okay, so whenever you have a subsidiary, and that in your balance sheet you represent the subsidiary by writing investment in subsidiary, but actually what your asset is not the investment, but the assets of the subsidiary is your assets. So in the place of investment in your balance sheet asset side, you want to replace it with the assets and liabilities of the subsidiary. This process is called consolidation, and this consolidation is mandatory as per section 129 of Companies Act. When we use the word financial statements which are supposed to be prepared by the entity, section 2 subsection 40 definition of financial statements include consolidated financial statements as a part of your financial statements. And section 129 also says that whenever you have a subsidiary, it is mandatory for you to do consolidation. It is mandatory for you to do consolidation. Very good. And there is an exception. As a holding company, you don't have to do consolidation if that holding subsidiary relationship, no, it is not intentional. By mistake, you have more than 50%. Like the share prices dipped, you went on buying. You didn't realize that you bought more than 50% shares in the company. And you don't have any intention of holding those shares in that company for long term. Then you don't have to do consolidation. When is it that you don't have to do consolidation? When you have more than 50% shares in a company, but you don't have intention of holding more than 50%, or you have no long-term intention, you would want to dispose it off in the very near future, then you don't have to do consolidation. The second one is you have more than 50%, you have intention to exercise control, but the restrictions which are laid down by the government are such that you cannot have control. Then again you don't have to do consolidation. So basically consolidation is done not when it is holding subsidiary. Consolidation is done when there is control. When one company has control over the other company, one company has intention to control the other company, then you should do consolidation. Otherwise you don't have to do consolidation. So the control can be established in two ways. One, you have control the composition of the board of directors, or you have more than 50% shares in the company. Either ways it will become your subsidiary company. Are you getting it? Very good. The biggest example is our Tata Sons, which is an holding company for a lot of IT companies, lot of automotive companies, and lot of financial service companies. So they do the biggest consolidation. And consolidation is done not just for balance sheet. Consolidation should happen for entire financial statements. You need to consolidate balance sheets, you need to consolidate P&L statements, you need to consolidate cash flow statements also. Got it? But we have majoritively questions on consolidation of balance sheet, and consolidation of PL also we do about 2 questions. But in general, people do consolidation of the entire financial statements. Now, whenever we do, this is the definition and everything. Now, you must have seen that no control, that company which has more than 50% share or composition of board is called as control. Other than that, the balance shares which are held by somebody else is called as minority interest or non-controlling interest. So what we do is we take over all the assets and liabilities of the what to say subsidiary and write it in our balance sheet. But not all the assets belong to us. A part of the asset, to the extent which we don't hold the shareholding, will belong to somebody else. We represent it by way of minority interest. How do we represent it in our balance sheet? Minority interest. So one moment. Charge illa idralli. Yeah, it's charging. So what exactly do we do? We'll do it this way. I'll make you people revise the points that I've so far discussed. So firstly, before you start consolidation, you would have to ensure that both the balance sheets are on the same date. If the holding company's balance sheet is on 31st of March, subsidiary's balance sheet is on 31st December, can you do consolidation? No. In order to consolidation, both the balance sheet should be on the same date. Accounting policies followed by both the entities should be same. Then what do? You take your share capital to balance sheet. but subsidiary share capital will be split into holding and minority. To the extent it belongs to holding, it will be taken to cost of control as nominal value of investment. To the extent it belongs to minority, will be taken as minority interest. That nominal value of investment will be compared with book value of the investment that is there in the balance sheet asset side. If the nominal value is more and book value is less, nominal value is liability, book value is asset. If nominal value is more, then it will become capital reserve. If book value is more, it will become goodwill. So that book value, whatever is there, has to be adjusted for pre-acquisition reserves. Nominal value has to be adjusted for bonus issue if there is any. Is it becoming too much? Okay. What is pre-acquisition reserves? Reserves of the holding company will become reserves of the holding company. Reserves of the subsidiary company has to be split into pre and post. How much of the reserves was there as on the date of acquisition? How much of the reserves was acquired after the date of acquisition? Whatever pre and post is first split, that will be further divided between holding minority based on the percentage of shareholding, but both of them have. Once you divide it, holdings share in the pre-acquisition profit. I repeat, holdings share in the pre-acquisition profit is to be deducted from the book value of investment. Holdings share in the post-acquisition profit will go to reserves on surplus. For minority, it doesn't really matter. Minority share in the pre and post together will be written to minority interest, and total of minority interest will go to reserves and surplus. I repeat, share capital of the holding will go to consolidated balance sheet. Share capital of the subsidiary will be split into holding and minority. We'll also identify the percentage. Holdings percentage of holding, whatever is there, that will become nominal value of investment, which is representing liability in subsidiary's balance sheet. Cost of investments, what is there in the holding company's balance sheet, will be deducted or adjusted against the nominal value of investment. Nominal value liability, book value or cost of investment is asset. If the book value asset is more and nominal value liability is less, it is goodwill. If book value asset is less and nominal value of investment, which is share capital, is more, it is capital reserve. Nominal value of investment will be adjusted for bonus issue, if any. We will add bonus issue to nominal value to increase the nominal value of investment. Book value of investment, cost of investment in the holding company's balance sheet. From that, we are going to deduct. What will we deduct? Pre-acquisition reserve of the subsidiary company. How do we get pre-acquisition reserve? Very simple. Reserves of holding company will go to balance sheet. Reserves of subsidiary will be split into pre and post. How much was there as on the date of acquisition? Pre. After that, whatever is earned is post. Pre will be split between holding minority. Post will be split between holding minority. Pre-nully holding company share will be deducted from the cost of investment. Post-nully holding company share will go to shares, reserves and surplus. Minority share in pre and post will be written together with share capital of minority to find minority interest, which will go to balance sheet. Did you understand this? Read this. Identify the date of acquisition. Why is identifying the date of acquisition important? For segregating the reserves as pre and post. Then what do? Determine shareholding percentage. How much of the shareholding is there by holding and how much is there by minority. Why is this important? To share the reserves between holding and minority. Got it? After that, what do? Holdings investment in subsidiary is to be adjusted with percentage of holding in subsidiary share capital. Holdings investment in subsidiary is book value of investment. Percentage of holding in subsidiary share capital is nominal value of investment. This will be adjusted, and along with this, pre-acquisition reserves is also taken care. See, and pre-acquisition reserves to determine goodwill or capital reserve. The name given to this is called as cost of control. See, consolidation, there are multiple approaches to do. We don't do step 1, step 2, step 3, step 4 approach. So whoever would have done it in our pattern, these points are giving you the flow of the things. If you have done step 1, step 2, step 3, step 4 approach, this might now can't make any sense to you people. So I am sorry if it's not making any sense. I am sorry, because approach that you have learned, approach that I am teaching is different. It is not at all that what you have learned is wrong. It is different. What is it? Different. So try and see this. Ultimately, concept is same. It should make sense because I'm not teaching you the problem now. I'm only telling the concept. So this is how you find cost of control. Cost of control can be goodwill or cost of control can be capital reserve. such goodwill or capital reserve will be shifted again to consolidated balance sheet. Am I right?
Yes, sir.
Very good. So analysis of reserves. See the next part. Reserves and profits in balance sheet. First adjust for preference dividend, equity dividend and bonus issue. Whatever is there in the question, first adjust it. If there is any revaluation of assets, if the assets of the subsidiary is revalued upward, we will create revaluation reserve which is pre. If the assets of the subsidiary is revalued downward, we write revaluation reserve which is minus. Such revaluation reserve created on upward or downward revaluation of PPE of subsidiary is pre. If you have more than one reserve, if you have reserve number 1, reserve number 2, reserve number 3, all the reserves will take pre-post, 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 pre of all the reserves together, share it between holding minority. Post of all the reserves together, share between holding and minority. Based on that percentage of holding, you should do that. Revaluation reserve is always pre. Revaluation reserve is always if there is revaluation with the debenture with the depreciation adjustment. Remember, depreciation is post, revaluation reserve is pre. Depreciation would have been already computed on the PPE at the pre value, not on the revalued figure. So that revised valuation is there. No, only on that revised valuation you would have to compute depreciation. Such depreciation, if it is upward, it is additional depreciation to be deducted from post acquisition reserves. If in case it is downward revaluation, such amount on that revalued portion, whatever depreciation is there, such amount would have been previously excessively charged. Now we are decreasing the depreciation. By this we add back it to the profit where post. So revaluation is pre, depreciation adjustment is post. Everyone understood this? Very good. Now read this part. So analysis over. Holding company's share in pre-acquisition profit and profit and loss. Adjust cost of investment to determine cost of control. Post-acquisition profit, it is revenue, credited to P&L. Minority share, what do we do? Add it to minority interest, whether it is pre or post. We add it to minority interest to find the total. Easy. Same thing what we've done in AQs is covered by way of points. Bonus issue. Bonus issue will reduce the reserves and surplus of the subsidiary, increase the share capital of the subsidiary. If they've already written the entry, very good. If they have not written, what do? We decrease the reserves of the subsidiary pre, and that bonus, how much ever bonus shares comes, that will be shared between holding and minority. Holding portion we add it to nominal value of investment in cost of control. Minorities portion we add it in minority interest. Am I right? Yeah, I'm giving this disclaimer again for whoever is watching this recorded. This might not make sense to you if you would have learned consolidation differently. We do consolidation not by step 1, step 2, step 3 approach. We have a, I want to say, lot of AQ based, accounting quotient based approach. In that approach, this summary will help. So if you have learned it very differently, then this part of consolidation revision might not help you. I'm not telling will not, might not help you. If this is confusing, please skip to AS22. You can further move the cursor by another 5 to 10 minutes. Yeah, maybe on another day, if time permits, I'll do detailed discussion of AS21 if need be. But here everyone is clear. Should I do those concept capsules now? If I do that, another 1 hour will go just in those questions. You are aware, you did that questions, everyone. Okay, good. But you are confident, no? Consolidation. Next up, talking about dividend. Dividend depends whether it is pre-acquisition or post-acquisition. Subsidiary has given dividend to holding company. If the subsidiary has given dividend out of pre-acquisition profits, holding company should deduct it from the book value of investment. They should not take it to P&L. If it is from post-acquisition profits, it should be added to reserves and surplus in consolidated balance sheet. Usually question will not be on writing entries for dividend. They would have treated dividend incorrectly. They would want you to rectify it. If the question tells that holding company has incorrectly treated pre-acquisition dividend by crediting the P&L, so what do? P&L, reserves and surplus in consolidated balance sheet, already includes this dividend received from subsidiary which is pre-acquisition. It is included, deducted from there, and that should be deducted from the cost of investments, like how we do in AS13. Aware? Then comes cost of control. Same thing, cost of control is cost of book value minus pre-acquisition dividend and pre-acquisition reserves and profit, paid up value plus bonus issue. If you do this difference, you will get cost of control, which is goodwill or capital reserve. Then comes the last two adjustments. Mutual indebtedness ಒಂದು, unrealized profit ಎರಡು. Mutual indebtedness means holding company has sold goods to subsidiary or subsidiary company has sold goods to holding. They owe money to each other mutually. If you are preparing two separate financial statements, they are debtor, creditor, trade payable, trade receivable, absolutely okay. But if you prepare one single consolidated balance sheet, you can no longer treat them as debtor, creditor, trade payable, trade receivable. So what do you do? What do you do in that case? In that case, you eliminate trade payable, you also eliminate trade receivable. If in case someone still wanting to learn consolidation, last 6 months ago when we did marathon revision for old scheme, 6 months ago when we did marathon revision for old scheme, it's also there for new scheme. I have edited it, put it together. In that video, consolidation concept capsules are there. We've done about 15-20 questions. So it's there in the same YouTube Yashas Academy YouTube channel only. If you scroll a little back and then see inter marathon revision, 6 months ago whatever marathon revision is posted in that consolidation AQs are there. So you can watch that and then see this, then you'll pakka understand this. I won't tell this, but I can tell this that the way we do consolidation is by far, I personally feel to be one of the easiest methods, not that step 1, step 2, step 3 base, but it will definitely give you an edge. It will save a lot of time and it will also keep you very confident when it comes to consolidation. Can I say so only? How many of you know both methods? You do step 1, step 2, step 3 method also and this also. But you do this, but you don't hate consolidation. Yeah. But usually people hate consolidation for a reason. So mutual indebtedness, you understood, no? Debtor, creditor relationship, bills receivable, bills payable relationship. Then comes the last part, unrealized profit. If the holding company has sold goods to subsidiary or subsidiary company has sold goods to holding and these goods have been not sold to outsiders, then the stock what is remaining in one of the entities will be at a price slightly higher than the price at which the cost is to be recorded at. So if there are two different entities, it is okay. One entity will book profit, one entity will record the stock at a higher price. But if you see consolidated financial statements, stock should not be recorded at a higher price. It should be recorded at cost. And that profit should not be recorded. So how do we adjust this? We should first check, is it upstream or downstream? Upstream means subsidiary has sold it to holding. Downstream means holding has sold it to subsidiary. If the holding company has sold goods to subsidiary, this is the easiest. Eliminated from the stock of subsidiary, only the profit element. And that profit has to be eliminated from reserves and surplus of the holding. I repeat, from the stock of the subsidiary, eliminate the profit element, and from the holding company's reserves and surplus, eliminate the profit element. However, if it is upstream, subsidiary has sold goods to holding, from the holdings stock we eliminate, from the subsidiary's profit, which profit to eliminate. This depends whether the sale has been made before acquisition or after acquisition. If before, then pre. If after, then post. Got it? You can make a standard assumption and then write that assumption also in the answer. That completes our consolidation of balance sheet. I forgot to tell one more thing. What if there is debentures? Similar to shares, if the subsidiary company's debentures are held by holding company, again write, like cost of control, write nominal value of investment, book value of investments. Book value of investment is from the asset side of holding company's balance sheet. Nominal value of investment is from the liability side of the subsidiary's balance sheet. Compare both. If the book value is more, nominal value is less, goodwill. If the nominal value is more, book value is less, it is capital reserve. This arising goodwill or capital reserve, and in the share capital, that book value of investment and nominal value of investment of share capital we did know, there we would have got goodwill or capital reserve. That and this should be taken net and then posted to balance sheet, because one balance sheet cannot have goodwill and capital reserve. It should have goodwill or capital reserve. So we'll write it as net goodwill or net capital reserve and post it to balance sheet. That is CBS, consolidated balance sheet. Got it? I will share one updated consolidation worksheet with you people if you would want to. So we added AQs on consolidation of PL also. And last time, whatever I told that this is not yet done, this is not yet done, I'll add it next time. I've added it. We've updated it. It's become nice. Okay. Then consolidation of profit and loss statements. Before I come to consolidated PL, one more point. When you identify minority interest, if in case minority interest becomes negative, what to do? Don't write minority interest as negative. That adjusted against that holding company shareholder. It will be borne by holding company's reserves. In the later years, whenever there is enough profit, then it will be reversed. So minority interest in the balance sheet cannot be negative. You got it? It can appear as zero, but it cannot appear as minus. So this can become an MCQ question. Theory question can be asked on this topic. Then consolidation of PL. Very simple. PL of the holding, PL of the subsidiary. We need to consolidate together to prepare consolidated PL of the holding company. But sorry, my God. When we're preparing consolidated PL, we need to be careful to see if there is any sales made by holding to subsidiary or subsidiary to holding. Is there intercompany sales? If there is intercompany sales, that is holding to subsidiary or subsidiary to holding, it will be eliminated from sales, that is revenue from operations from the selling company. It will be eliminated from purchase of stock and trade from the buying company. Sometimes it might not be purchase of stock and trade. It might be there in consumption of raw material, because for the buying company it might be raw material. You eliminate it from there. And the next part is, once you eliminate sale and purchase, there might be some management fee, commission, selling and distribution expenses and other things. Because subsidiary companies' decisions are taken by holding company can charge management fee to subsidiary. For subsidiary it is other expense, for the holding company it is other income. When there are two different entities, subsidiary other expense, holding other income, you will write. When you consolidate it into one single entity, then you cannot write that amount of other income and you cannot write that amount of other expense also. You need to eliminate from both places. Understood? Then comes, if there is any selling and distribution expenses for one and other income for the other, interest expense for one, interest income for the other. If there is a dividend expense for one and dividend income for the other, subsidiary has given dividend to holding. If it is pre-acquisition, it will not come in P&L. It will be adjusted in cost of investments in balance sheet. If it is post-acquisition, it will come in other income of holding. No, eliminate it from the other income of holding. From subsidiary, we can't eliminate it anywhere else. Why? Because it is appropriation of income. It is not charge against income. So if you are preparing appropriation, there when the dividend paid is there you eliminate the amount paid to holding company. Then this is slightly tricky. I want full attention. Unrealized profit. If some amount of inventory is sold by holding to subsidiary or subsidiary to holding, and that inventory is still remaining, we eliminate that unrealized profit from the stock and profit. No, profit is not the point here. Stock is the point here. Stock we eliminated from balance sheet, but stock is also there in P&L statement. Stock in the expense side we write changes in inventory. We do opening minus closing. So remember this, unrealized profit should be eliminated from closing stock. If the closing stock is not available, if they've given only changes in inventory, to changes in inventory, unrealized profit should be added. To changes in inventory, unrealized profit should be by mathematics. Opening minus closing. Opening stock is 10,000. Sorry, let's say opening stock is 12,000. Closing stock is 10,000. Let us assume unrealized profit is 1,000. How much is opening stock? 12. Closing stock 10. Unrealized profit 1. What do you do? 1 will be deducted from closing stock of 10. Closing stock will become 9. Opening stock 12, closing stock 9. 12 minus 9, 3. Alva. What if they've given straight away? They don't give opening closing. They will write changes in inventory 2,000. To 2,000, you should add 1,000 of that unrealized profit. Okay. Closing stock minus alva. From minus of closing stock, if you have to minus unrealized profit, you need to add it to changes in inventory. Changes in inventory is opening stock minus closing stock. Unrealized profit is closing stock minus unrealized profit. So it's nothing but changes in inventory plus unrealized profit. Did you understand this? I repeat, opening stock is 12, closing stock is 10. How much is changes in inventory? 2. What if there is unrealized profit of 1,000? Opening stock 12, closing you will write in inner column 10 minus 1 unrealized profit, closing stock revised value 9. 12 minus 9, 3. Other words, straight away changes in inventory is 12 minus 10, 2. No, 2 you add 1 unrealized profit, it becomes 3. Did you understand this? After this, statement of P&L is over. Intercompany sales should be eliminated. Management fee will be expense for subsidiary, income to holding, that will be eliminated. If there is any other expense income, dividend, which is other income to holding, will be eliminated. Unrealized profit will be added to changes in inventory or deducted from closing inventory. Then you take all the incomes, all the expense, you arrive at consolidated profit. In this consolidated profit, you should give some profit to minority. How much will you give? Don't do consolidated profit into percentage. Consolidated profit nalli percentage hogodilla minority ge. Minority will get percentage of subsidiaries profit, not holdings profit. So what do? Subsidiary standalone P&L before eliminating intercompany transactions. Subsidiaries standalone P&L before eliminating intercompany transactions. That profit multiplied by percentage. We've done last one question. We did consolidated PL. I made you do standalone PL of subsidiary again to determine our subsidiaries PL. We did 2 questions on consolidated PL. Ondralli standalone PL was given in the question. One more at the end we did consolidated PL admele standalone PL of subsidiary once again. So we take standalone profit and loss statement of subsidiary. In that, whatever profit is there, on that minority interest percentage, whatever we get, so much will belong to minority. Balance will be added to balance sheet. That is what you should know when it comes to consolidated PL. Okay? Yes or no? Please do go back home to watch the classes on consolidation once again towards that, and people should get good holding of it. And if not, same channel now then you'll get it. I think you better watch your recent class that has more updated. You have better questions. You have more questions, and some questions have been fine-tuned to be looking much better. Understood, friends? By this, we are done with consolidation, which is accounting standard 21. We did AS21 slightly different. I don't know how many of you found it nice. If you would have done it our way, then you find this useful. If not, you would find this, I don't know what even sir did. Did it help? No, it did not help. Not everyone. Okay. Yeah, got that? Any doubts? Consolidation, please ask. Let's now start with accounting standard 28, which is impairment of assets. So what exactly do we mean by impairment of asset? If at any point of time during the useful life of the asset, if the carrying amount of the asset is stated at a value more than the recoverable amount. I repeat, if at any point of time during the useful life of the asset, if the carrying amount of the asset is recorded at a price more than the recoverable amount, the extent to which carrying amount is more than the recoverable amount is called as impairment loss. Now, what is carrying amount? Carrying amount is book value of the asset. Like how we say, we'll take the original cost of the asset. From that, we deduct the accumulated depreciation till that date. We will also deduct impairment loss, if any, which was deducted in the past. Not this year. In the past, whatever impairment loss is made, we take that. If there is upward revaluation, downward revaluation, all those will take into consideration. Then what we get is the book value, WDV, or carrying. This will be compared with what amount? Recoverable amount. CA, carrying amount, will be compared with RA, recoverable amount. If Ka, recoverable amount, is more than Ra, then there is IL, impairment loss. What is recoverable amount? Recoverable amount is money that will recover from this asset. Money that will recover from this asset. Money that will recover from this asset is UI or NUS, whichever is high. What is UI? Value in use. Whenever I have an asset, I have 2 options. One, use the asset till the end of its useful life, or sell the asset immediately. If I use the asset till the end of its useful life, every year it will generate some cash flow. The cash flow that the asset will generate every year, if I discount it to today's date, if the cash flow that will be generated from this asset at the end of every year, if it is discounted to today's date, whatever value I get, no, that present value of the future cash flow generated from this asset will become value in use. VIU. Got it? Next one is NSP. I don't want to use the asset till the end of its useful life. I want to sell it immediately. I repeat, I don't want to use the value of the asset. I don't want to use the asset till the end of its useful life. I want to sell the asset immediately. If in case I choose to sell the asset immediately, what does it become? NSP. What is NSP? Net selling price. Net selling price is today, right now. If I sell the asset, what money will I get? Selling price minus expenses that I should incur to sell it. Selling price minus selling expenses. What is it? Selling price minus selling expenses. That will give you NSP. So you will see which is better. If using the asset is a better option, you will use the asset till the end of useful life. If selling the asset is going to give you better cash flow, then you will sell the asset immediately. So value in use or net selling price, whichever is high, will become recoverable amount. That recoverable amount should be more than the carrying amount. If in case the recoverable amount from the asset is less than carrying amount, meaning asset is recorded 100 lakhs, if you sell that asset also you will get 80 lakhs, if you use that asset also will get 80 lakhs, then asset is recorded 100 means it is recorded 20 lakhs higher value. No, that 20 lakhs will become impairment loss, and you reduce the value of the asset by doing impairment. Are you getting it? So you compare carrying amount with recoverable amount. You compare carrying amount with recoverable amount. Carrying amount is recoverable amount is value in use or net selling price, whichever is high. So whichever is high becomes recoverable amount. Compare with carrying amount. If carrying amount is more, impairment loss. If carrying amount is less, no impairment loss. Did you understand? Now your question is, sir, for every asset should we identify this? How will we do this? We will not be able to do this for every asset at the end of each year. If you do it, it will become a very big exercise. So what do? There are certain triggers. If the trigger is awoke, only then we'll check impairment. If the trigger is not awoke, then we'll not check impairment. What are the triggers? In the market, the demand for the product is falling. In the market, that machine is available at a cheaper rate. There is adverse market scenario, consumer trends are bad. So these are all the factors. See, or there is obsolescence of the asset. See here, external factors are significant fall in the market value, adverse effect in the environment, market is bad, economic condition is bad, legally the manufacturing of those goods have become illegal. Or let's say that asset, you thought you can use it for 20 years. After 8 years, government has put a restriction saying that that asset should be used only for 10 years. After 10 years, mandatorily you should discard the asset. That is also another reason why the impairment of the asset will happen. Or technologically, there is advancement. There is much better technology available in the market, because of which the old machine has become obsolete. Or it can also happen like there is increase in the market rate of interest. At the old rate of interest, what was there in the market, this business was viable. At the new interest rate, what is prevailing in the market, you cannot do this business. It's not viable any longer. So because of these are all triggers. These are telling that there might be impairment, you check. Internal can be obsolescence. You are planning to discontinue, you are planning to reconstruct the organization, or poor economic performance of the asset. If these are there, then you check the impairment. And when we do impairment, no, when we take carrying amount, we will not take for each asset. We should take for each CGU. What is CGU? Cash generating unit. What is CGU? Cash generating unit. CGU is the smallest identifiable group of assets that generate cash flows. It is the smallest identifiable group of assets that will generate cash flow. For example, to sit on this bench, I will say she's paying 50,000, 60,000 rupees for 6 months. So one bench can accommodate about 4 people. Can I say the cash generated from this bench, like when I say value in use, present value of future cash flows, this bench will generate 2 lakh rupees cash flow for 6 months. For 1 year, this bench will generate 4 lakh rupees cash flows. I'll discount it to today's date and then say present value of future cash flow from this bench is, cash flows are 4 lakh. Present value, can I say it's about 3 lakh 80 or 3 lakh 30. This bench is inside the classroom, so much of cash flow. Keep this bench outside on the road. Will anyone pay 60,000 to sit on the road? That's a mad hour. No. Projector will say 200 people come and sit and then pay fees to watch me do the show. So it's because of me that you're generating so much of. Same projector you keep some in some other room, it's of no use. So bench individually is not a CGU. Projector individually is not a CGU. Mic individually is not a CGU. So this mic, that projector, that TV, that screen, this AC, this entire classroom together will become one CGU. Individually, if I charge 10 rupees for people to sit on the bench, also no one will sit. They'll sit on the floor. Why should I give you 10 rupees to sit on the bench? No one will pay. So individually, bench doesn't have the capability to identify cash flows. So we identify the smallest group of assets that will generate cash flows. That will become CGU. Impairment should be checked for CGU. Impairment should be checked for CGU. You get this? For CGU, we identify carrying amount. For CGU, we take value in use. For CGU, we'll take NSP, whichever is higher. For CGU, we'll find recoverable amount. For CGU, we'll identify impairment loss. Did you get this? Very good. So whenever we find impairment loss for that CGU, that impairment loss will be recorded. And before I go to reversal of impairment loss and other things, I would have to teach you guys this concept of bottom-up test and top-down test. So bottom-up test and top-down test is only theory and example in ICA study material. But that does not mean that question might not come. Question can still come from this topic. So shall I teach you what is the concept of bottom-up test and top-down test? I didn't do anything for the rain to come. Don't look at me like that. Now, why this bottom-up test and why this top-down test? Whenever I buy asset, let's say I have not bought a single asset, but I've got a group of assets. When I buy group of assets, 4 assets or 5 assets together, I should have paid the consideration for 5 assets. No. Individually, the value of 5 assets, whatever is there, if you total, together one value will come. No. I paid more than that for the purchase of all the 5 assets. What is it? Individually, whatever is the value of asset 1, asset 2, asset 3, asset 4, asset 5 is there. No. Total madre one value baratalva, like net assets taken over. My PC is more than net, meaning I paid more money than the cost of those 5 assets together. That will become goodwill. Am I right? So that goodwill is there for 5 assets together. Now when I'm doing impairment, remember that goodwill I paid. No, let's say I bought one restaurant here. When I buy that restaurant, I buy that stove, I buy that cooker, I buy that kitchen slab, I buy everything. I pay them more than the value of those assets. So I paid goodwill. Can that goodwill be allocated to each of the asset in reasonable and consistent basis, or can it be not allocated? Is the question. If that goodwill, whatever is there, can be allocated to those 4 assets on some reasonable basis and consistent, meaning every year you can do it and there is some basis, usually based on the fair value of the assets. Then what do? Take that goodwill, first allocate it to all the 4 assets. Take the value of the asset including goodwill value in it. That will become the carrying amount, which will be compared with recoverable amount to determine your impairment loss. I'll repeat. For carrying amount, we should take the carrying amount of that asset after allocating the goodwill to it. If goodwill is allocable. If you allocate goodwill to it, you get the revised carrying amount. You check the revised recoverable amount. Whatever impairment loss you get should not be debited to P&L. Should not be debited to P&L. Sorry, it should not be charged to asset. What do I do first? First I adjust it against that goodwill. Beyond that, I'll adjust it against the asset. It's like this. I have a gun, loaded gun. I'm trying to shoot towards the asset. Before I shoot the asset, in front of the asset, someone is standing. Who is it? Goodwill. Goodwill is like saying, okay, if you have to touch the asset, you would have to go through me. I'll shoot the goodwill. Let's say goodwill is 2, asset is 10, impairment loss is 3. What do? 2 bullets I'll shoot it to goodwill. Goodwill will become 0. 1 bullet to asset. Asset was 10, asset will become 9. Goodwill was 2, goodwill becomes 0. Impairment loss of 3 will be adjusted against goodwill first, then against that asset. Understood this? And that impairment loss adjusted against asset, okay. It should be transferred to P&L. Am I right? Impairment loss should be deducted from the value of the asset and also transferred to P&L. Before you shoot against the asset, who's standing in front of the asset? Goodwill. If you are going to transfer to P&L, before you transfer to P&L, revaluation reserve will stand. If in case you have to transfer anything to P&L, after me only you can transfer to P&L. I'll shoot it to revaluation reserve. Meaning, during the year or during the useful life, at any point of time, if you revalued this asset upward, you would have created revaluation reserve. No. If there is impairment loss, first reduce this revaluation reserve before transfer to P&L. Only after you reduce this revaluation reserve and make it 0, transfer to P&L. So impairment loss of 3, when you're shooting on both sides, this side, before you shoot to P&L, whom should you shoot? This side, before you shoot the asset, whom should you shoot? Goodwill, if it can be reasonably and consistently allocated. If it cannot be allocated, goodwill will not come, shoot the asset only, Dama. Got it? This is bottom-up test, what we just did now, where the goodwill can be allocated on reasonable and consistent basis. Okay? If goodwill, see here, allocated on reasonable and consistent basis. If goodwill cannot be allocated on reasonable and consistent basis, then what do? You should do bottom up test and a top down test. You should do bottom up test. And what is bottom up test? I'll take the value of the asset, carrying amount. Is it having goodwill in it? No. Can I allocate goodwill? No. Why? There is no reasonable and consistent basis. I'll take the value of the asset without allocating goodwill. Identify impairment loss. Deduct it from this value of the asset only. Artha aitha? This is bottom up test without allocating goodwill. Now what will I do? This asset does not include goodwill. Similarly, there are 3 more assets. All the 4 assets together, there is goodwill. So what will I do? This asset, this asset, this asset, and goodwill together I will take. That is bigger CGU. We call it larger CGU, including goodwill. That goodwill is relating to these 3 assets. If I can allocate it, I'll allocate. If I can't allocate, goodwill belongs to all the 3, but I cannot allocate it to any of them. So I'll take all the 3 assets together, goodwill also will come. Total larger CGU's carrying amount, I know, no. Larger CGU's value in use, larger CGU's NSP, I'll use larger CGU's recoverable amount. Larger CGU's recoverable amount, larger CGU's carrying amount, I'll find larger CGU's impairment loss. That larger CGU's impairment loss will be first deducted from goodwill. Beyond that, if it is still there, no, I will allocate it to all those smaller CGUs which is there in larger CGU in proportion. That is top-down test. I'll repeat. There are 3 assets, 1 goodwill. This goodwill can be allocated to all 3. What do? Allocate it to all 3. Take this 1 asset for which the trigger is pushed and check impairment only for this and adjust impairment. Impairment loss will be first adjusted against goodwill, then against asset. If 3 assets and 1 goodwill is there, goodwill cannot be allocated on reasonable and consistent basis. What to do? This asset you take without goodwill. Check impairment loss. Deduct it from the value of this asset. That is bottom up test. Then this asset, this asset, this asset, take all the 3 assets together with goodwill. That will become larger CGU. For larger CGU, no carrying amount. For larger CGU, find recoverable amount. For larger CGU, check impairment loss. That entire impairment loss will be first adjusted against total goodwill. After that also, if there is some impairment loss, will be charged to these 3 CGUs in proportion. That is top-down test. Sorry, top-down test. You got it? Shall I show you the example? Come on, let's see the example. From the beginning, small examples. See, carrying amount 10, value in use 8, net selling price 9. Recoverable amount will be value in use or net selling price, whichever is high. For the first one 9, second one 11, third one 11. Correct? How much is impairment loss? Impairment loss is, did you understand recoverable amount? Now recoverable amount and carrying amount you see. Recoverable amount is 9, asset is 10, impairment loss is 1. Why? Carrying amount is more than recoverable amount. In case 2 and case 3, recoverable amount is more than carrying amount, so there is no impairment loss. Understood? Come to this case. Carrying amount 100, impairment loss 10, balance in reserve 12. So what do? Now I am trying to shoot my impairment loss to P&L. P&L shoot ಮಾಡಕ್ಕಿಂತ ಮುಂಚೆ ಯಾರು ನಿಂತ್ಕೊಳ್ತಾರೆ? So 10 shoot ಮಾಡಬೇಕಾದ್ರೆ revaluation reserve is standing with 12 lives. I have 10 bullets. I will shoot 10 bullets to revaluation reserve. Still 2 lives of revaluation reserve will be pending. I will charge 0 to P&L. Correct? I will adjust 10 with revaluation reserve. Revaluation reserve will still 2 is pending. Charge to P&L is 0. Carrying amount of the asset will be, I will turn this side to shoot the asset. Goodwill idya? Illa. I will shoot all the 10 to discom asset. Asset was how much? 100. If I charge 10 impairment loss, what will be remaining? Did you understand? When you are shooting, in front of the asset, who will stand? In the front of the P&L, who will stand? In front of the asset stands goodwill, in front of the P&L stands revaluation reserve. After adjusting revaluation reserve, you will transfer it to P&L. After adjusting goodwill, you will transfer it to asset. Here goodwill is not there, so straight away deduct it from the cost of the asset. Got it? Then carrying amount 100, impairment loss 10, balance in reserves 8. So impairment loss, when I shoot it against P&L, I will shoot 8. Still 2 bullets will be remaining. I'll shoot it to P&L. So transfer to P&L will be 2, adjustment with reserve will be 8. but reduction from the asset is same 10. Last one, impairment loss is 10, balance in reserve is 4. So reserve will become 0, 6 will be transferred to P&L. Understood this? Everyone? Very good. Then come to quotient number 3. Here you have goodwill. Now impairment loss of 10. Before I shoot this asset 100, whom do I shoot? Goodwill. So goodwill will become 0. Correct? Goodwill will become 0. Asset will remain at 100. Asset gondu bullet udiyala. Okay. When I'm charging this impairment loss to P&L, revaluation reserve will take all 10. There is nothing transferred to P&L. Am I going very fast? Pakka you guys are getting this? Artha agli? Pakka? Sure? Happy? Fine. See, then second one, impairment loss of 10. Second one, impairment loss of 10. Whom do you shoot? Yeah, before you shooting 100 asset, you shoot against goodwill. Goodwill 8 will become 0. 2 will be deducted from 100. So asset will become 98. Understood that? Then impairment loss is 10. Before I transfer to P&L, I'll make my revaluation reserve 8 as 0. Correct? So 10 minus 8, our revaluation reserve will become 0. I will charge to P&L 2. Are you getting it? So did you understand this concept now? Very good. Then we have one question on determination of value in use, determination of recoverable amount, determination of what to say NSP, and then determining impairment loss. See here, there is one asset, Noddy, who had bought an aircraft for how much? 50 lakh rupees on 1st of April 2023. He follows WDV, depreciation is 15%. Impairment is happening in 2024-25. He bought it in 22-23. So 50 lakh minus 15%. How much is 50 lakh minus 15% depreciation? 42 lakh 50. This 42 lakh 50 will become our carrying amount. This carrying amount has to be compared with recoverable amount. How do I find recoverable? Very simple. Value in use or net selling price, whichever is high. Value in use eno. Next year I'll generate 12 lakh cash flow, 9 lakh cash flow, 8 lakh cash flow. At the end, I will sell it for 5 lakh. 12, 9, 8 and 5. Correct? Cash flows. Discounting rate is 10%. Golden color. I'll write 12, 9, 8 and 5. Discount it at 10%. I'll get present value of future cash flows 28 lakh 10,609. What is this? Value in use. Got it? Then what is NSP? Ajay Mallya has given an offer to buy the aircraft for 30 lakhs. But he has told that you would have to repair it fully, only then I will buy. For that repair, you need to incur 1 lakh. 30 lakh is selling price, 1 lakh is expenditure for selling. So 30 lakh minus 1 lakh, 29 lakh is our NSP. Correct? Recoverable amount is 28,10,609 or 29 lakh, whichever is higher. Recoverable amount is net selling price or value in use, whichever is higher, 29 lakh. You understood 29 lakh? 29 lakh is the recoverable amount. Carrying amount is 42 lakh 50. You tell me, is there impairment loss? 13 lakh 50 is impairment loss for this asset. You understood? All the computations we had to do in this one. However, in the questions that you do in the material, usually NSP will be given or value in use will be given straight away, and you just have to compare to determine the amount. So now you know how to determine impairment loss, and you know that impairment loss should be deducted from asset and also charged to P&L. But before charging from asset, you adjust goodwill. Before charging to P&L, you adjust against revaluation reserve. Correct? Then bottom up test and top down test. Madboda? This one. This one. This one. We did this. How much is impairment loss? No, I'm telling you, I'll do the same. How much is impairment loss? 10. Impairment loss should be adjusted against the asset and transferred to P&L. Before you adjust against the asset, you reduce it from goodwill. Before you transfer it to P&L, you adjust against revaluation reserve. 10. revaluation reserve is 12. So completely adjusted against revaluation reserve. 0 will be charged to P&L. And this 10, before I transfer it to asset, adjust against asset, I should adjust against goodwill. Goodwill of 10 will be adjusted. Adjusted against asset is 0. Carrying amount of the asset will remain 100. Goodwill will become 0. Here 10, what do I do? Before charging to P&L, I'll adjust against this revaluation reserve of 8. Revaluation reserve of 8 will become 0. Further 2 will be charged to P&L. Before charging it against asset of 100, I'll adjust against goodwill of 8. So 10 only if I adjust 8, still 2 will be remaining. 2 will be deducted from carrying amount. So carrying amount will become 98, goodwill will become 0.
First, we have to adjust with balance and revaluation, then again we have to compare with
Two different sides. Before transfer to P&L, revaluation reserve. Before adjustment against the asset, goodwill. Goodwill, debit balance. Revaluation reserve, it will be going to P&L every year. Okay. Last one, 10 is the impairment loss. Before I transfer this 10 to P&L, I'll adjust against this revaluation reserve of 4. Balance 6 will be charged to P&L. This 10, before I adjust with carrying amount, I'll adjust with goodwill. Goodwill is 11. So goodwill will become 1, asset will remain at 100. No part of impairment loss is adjusted against carrying amount of the asset. Shall I do what to say that reasonable and consistent basis and not reasonable and consistent basis, bottom up and then top down? Very good. See, Rahula's kitchen has 3 departments: fine dine, cloud kitchen, food truck. Each of them are CGUs. Food truck is one CGU, cloud kitchen is one CGU, fine dine is one CGU. So the value of the assets is 2400 fair value, but you paid how much to get the value of the business? You paid 3000. So you paid 600 extra. No, why? There is some goodwill. There is some goodwill associated. You purchased it. You purchased all the 3. You purchased fine dine business, you purchased cloud kitchen business, you also purchased food truck business. After 1 year, the value of the goodwill remaining is how much? Fine dine is making significant losses. Fine dine is making significant losses means it's a trigger. Only for fine dine you need to check whether there is impairment loss. You got it? Then goodwill is 120 after 1 year. So the question is, can the goodwill be allocated on reasonable and consistent basis? Case 1 is yes, goodwill can be allocated on reasonable consistent basis. So this 120 of goodwill is there, no? It can be allocated to fine dine. How do we allocate? Percentage. 1200 by 2400 is how much? 50. Correct, alva? 50% of the business is fine dine based on fair value. First I'll determine that percentage here. See, 50, 33.33 and 16.67. So carrying amount is 1300. No. For impairment loss, we take carrying amount and compare it with recoverable amount. So carrying amount 1300. Yeah. How much goodwill will I allocate? 120 into 50%. 60. Correct? 120 plus 6. Sorry, 1300 plus 60. 1360 will become the carrying amount including goodwill. Carrying amount ಗೊತ್ತಾಯ್ತು. Recoverable amount ಎಷ್ಟಿದೆ? For the entire business is 3400. How much is it exclusively for fine dine? ಕೊಟ್ಟಿದ್ದಾರಾ? Recoverable amount for fine dine is 1350. See, 1360 is the carrying amount. 1350 is the recoverable amount. Impairment loss is how much? 10. That 10 will be adjusted first against goodwill. Goodwill ಎಷ್ಟು ಅವ್ರದ್ದು? 60. 60 ಅಲ್ಲಿ 10 minus ಮಾಡಿ goodwill 50 ಮಾಡೋದು. And that entire 10 impairment loss will be transferred to P&L because there is no revaluation reserve. Understood? This is bottom up. What test? Bottom up test. Why? Goodwill can be allocated on reasonable and consistent basis. See the case 2. Goodwill cannot be allocated on reasonable and consistent basis. What do we do in that case? Very simple. The 1300 carrying amount is there, no? Before goodwill, that itself I should take. I cannot take this 60. So what do? I take 1300 is the carrying amount before allocating goodwill. Compare that carrying amount only with recoverable amount of 1350. What do I get? Impairment loss idya ilva? No, recoverable amount is more. Recoverable amount of the asset is more than carrying amount. There is no impairment loss. Is there impairment loss? No impairment loss. Did you understand this? This is bottom up test done. Is this over? No. I should do top down test. Top down test hege? I will take fine dine, cloud kitchen, food truck. and goodwill. This goodwill I cannot add it to any of this. So I'll take it total. This is larger CGU. Fine Dine is one CGU. Cloud Kitchen is one CGU. Food Truck is one CGU. Now all of this together is one big CGU. How much is that bigger CGU's carrying amount? 3,420. I'll check how much is the recoverable amount of that bigger CGU. 3,400. So there is 20 impairment loss. This 20 of impairment loss will be adjusted against this goodwill. What if this impairment loss was 130? 120 will be deducted against goodwill. Balance of 10 will be allocated to Fine Dine, Cloud Kitchen and Food Truck in proportionate basis. This is top-down test. When do we do top-down? When goodwill cannot be allocated on reasonable and consistent basis. When goodwill can be allocated on reasonable and consistent basis, then what do we do? I'll do bottom up, understand. Cannot be allocated, first to bottom up for that asset, then top down for larger CGU. Either ways, impairment loss will be first adjusted against goodwill before adjusting against the cost of the asset. Got it? Say something. Fantastic. Can I go to AS29? Before that, reversal of impairment. What do you mean by reversal of impairment? Like reversal of revaluation type. There are some triggers because of which you did impairment. If those triggers reverse, then what do you do? Impairment loss will be reversed. See, check for reversal on the balance sheet date. Indicators for reversal. Mirror of indicator of impairment. Impairment again trigger is your market demand has fallen. So the market demand has increased. Market condition is unfavorable. So if that changes, then you need to reverse the impairment loss. When you reverse it, what do? Whatever you have done previously, reverse the same thing. Previously you adjusted against goodwill, now increase the goodwill. Previously deducted against the cost of the asset, now add back to the cost of the asset. Previously deducted from the assets in proportionate basis, now add back to the assets in proportionate basis. Whatever you have done in the past, you would have to reverse. Got it? See here, reversal for individual assets. Loss written off to P&L account previously, reversal income in P&L account. Loss adjusted to revaluation previously, add back to revaluation reserve. ಮುಂಚೆ ನಾವು P&L ಟ್ರಾನ್ಸ್ಫರ್ ಮಾಡಿದ್ರೆ P&L ಇಂದ ಬುಲೆಟ್ ರಿಟರ್ನ್ ಬರುತ್ತೆ. Previously if you have short it to revaluation reserve, now bullet will come back from revaluation reserve. You got it? Previously we have 2 bullets were short to revaluation reserve, 1 bullet to P&L. Now 1 you take back from P&L, 2 you take back from revaluation. Revaluation reserve will become more, P&L profit book ಮಾಡಬೇಕು. What about asset? You first add it to the asset first, add it to goodwill first if it was adjusted against goodwill. Sorry, assets other than goodwill on, first you would have short goodwill, then you would have short assets. First adjust against asset, then against goodwill. Ulta. First adjust against assets on pro rata basis, then goodwill. If it was previously charged only against goodwill, then only from goodwill you reverse, goodwill you increase. Did you understand this? Yes or no? Very good. However, one last important point I want you to know. When we do value in use, when you do value in use, we take that present value factor. No, right now I expect cash flow for 4 years. So 4 years I rate cash flow and 4 years discounting rate I take. So I'll get one value in use. That value in use became recoverable amount. There is impairment loss. Next year what happens? 4 years ali 3 years agata. Same 3 years cash flows are there. Same present value factor I put for 3 years. Now value in use has become more because of discounting factor. That is now looking like reversal of impairment loss. Should I do reversal of impairment loss? No. Reversal of impairment loss should happen because of reversal of the factors. Market conditions should become better, interest rate should drop, demand for the product should be generated, the poor economic performance has now been recovered. That should happen. If there is only interest rate differential, that will not be turning into reversal of impairment loss. Did not understand? Let me show it to you with the help of example. This I don't think we did last time. Yeah, observe this. Indicator for impairment was triggered on 31st of March 2021. Carrying amount is how much? 1,75,000. Net selling price is how much? 0. Cash flows expected is 0, 0 and 1,33,156. So now you'll identify value in use. Present value of future cash flows is 0, 0, 133, 156. You do 1 divided by 1.1 to the power 1 to the power 2 to the power 3 ಮಾಡಿದ್ರಿ. Okay, observe here. 1,33,156 and present value factor at 10% for third year you did. It comes to 1 lakh. How much is value in use? 1 lakh. How much is recoverable amount? Another kotidara? Illa. So can I say carrying amount 1,75,000, net selling price 0, value in use 1 lakh. Whichever is higher became 1 lakh. Recoverable amount is 1 lakh, whereas the carrying amount is 1,75,000. Is there impairment loss? 75,000 impairment loss is there. 1,75,000 is the carrying amount. From that I deduct 75 to book the asset at 1 lakh. I did this. Next year ಏನಾಗುತ್ತೆ ಗೊತ್ತಾ? This is gone. It will be only 0 on 133, 156. I'll show what will happen in next year. Observe. 0 on 133, 156. Present value factor is no longer 0.75. It becomes 0.826. How much is present value of cash flow? 1,09,987. Then net selling price is 0. Value in use is 1,09,987. Recoverable amount became 1,09,987. Carrying amount after impairment loss is 1 lakh. Illi reversal ಆಗ್ತಾ ಇದೆ ಅಲ್ವಾ? Do you agree with me? But as the cash flows improved, no, that is reversal because of present value factor. See here, reversal has to be reversal of trigger for impairment. Mere change in the expected cash flows as a reason of PVF, present value factor or discounting factor, is insufficient to reverse impairment loss. For example, this 133, 156 became 1,50,000. Then I agree. Cash flows are becoming better. You are generating higher revenue. But here, present value factor change agedake cash flow barte impairment loss reversal na we won't do. This is too advanced, but that one point was there in the chart. Someone asked, oh, what is that point? So I explained it with an example. But you understood the logic? Yeah. You've done this before, anyone? But but you understood the concept? Pakka? ಅಷ್ಟೇ ಫ್ರೆಂಡ್ಸ್, ಇಷ್ಟ ಹೇಳಕ್ಕೆ ಇಷ್ಟಪಡ್ತೀನಿ. ಏಜ್ 28 ಮುಗೀತು. Can we?
What if there is impairment loss like in a case where goodwill is not cannot be allocated in a reasonable time?
Simple. Charge it against the asset. Impairment loss can be there. If goodwill is there, goodwill is there for that specific asset, you adjust against goodwill. General goodwill for the entire entity will not be adjusted. For purchase of that asset, if you paid excess money more than that value of that asset, then goodwill is there, which is there for that asset, then we adjust. Otherwise, we charge it against that asset only. Impairment loss is reduced from the cost of the asset, always. And it is charged to P&L. Revaluation reserve and goodwill are exceptional scenes. Shall we do S29? Come on, let's do accounting standard 29, provisions, contingent liabilities and contingent asset. So when we start with provisions, contingent liabilities and contingent assets, what is it that I would want you to know before even we go forward? I want you to know what is the meaning of a word liability. What do you mean by the word liability? It is a present obligation arising because of a past event. Today you are supposed to pay money because you have taken service in the past, because you have purchased goods in the past, because you have borrowed money in the past or something. So it's a present obligation arising because of a past event. Whenever we talk about contingent liability, we'll talk contingent liability and then come to provision. It is not present obligation. It is possible obligation arising because of past event. We are not sure that we should pay money, but it might turn out to be a situation where we might have to pay money. It is possible obligation. What do you mean by that word possible obligation? Why does that word possible obligation come into picture? Very simple. Listen to me here. It says that whenever there is an event which is dependent on, whose existence is confirmed only on occurrence or non-occurrence of one or more future uncertain and uncontrollable events, that is called as contingency. What is it? It is its existence will be confirmed on occurrence or non-occurrence of one or more future uncertain uncontrollable events. Then it will be contingent, meaning I might have to pay money in the future if this happens. Someone has sued me saying that because of using my product they have undergone losses, I need to compensate them. Should I pay compensation? No, I might have to. When do I have to? If the court case goes against me. Court case not in my control, future and uncertain. So future uncertain uncontrollable event is court judgment. That will confirm whether I have to pay or I don't have to pay. So it will become a possible obligation. You got it? See, an obligation based on the evidence available existing on the balance sheet date is considered probable. If it is present obligation, it is liability. If it is possible obligation, that is confirmed based on occurrence or non-occurrence of one or more future events which are not wholly within our control, what will it become? Contingent event. That is becoming contingent liability. You get it? If that is very remote possibility, andre the chances of me losing the case and me having to pay money is very rare. So then do I have to record that liability? I won't even record that contingent liability. No disclosure required. Ignore. No disclosure required. Ignore it completely. Completely ignore it. Are you getting it? However, it is not remote. There might be a possibility that I might have to pay. I am not telling you I will have to pay. Might have to. It's not very remote. There is a chance that I might win. There is a chance that I might lose also. What should I do? Will not record it as liability. It is still a possible obligation. Whether it is obligation or not is confirmed by court, which is future uncertain uncontrollable. So disclose it as contingent liability. When it is possible obligation. What if it becomes present obligation? Andre ಇನ್ನೇನು ಕೊಡಬೇಕಷ್ಟೇ. Now I might have to give money. Then what do? For this contingent liability, it has to be possible. If it becomes present obligation, you need to check for two conditions. What are the two conditions? Number one, probable outflow. Number two, reliable estimate. Andre the case is still pending, but there is somewhere there is very high probability that I might have to pay money. What do we do in that case? We will check two conditions. Number one, probable outflow. Probably I might lose this case. Probably I might have to pay money. Probably I might have to lose this case. Probably I might have to pay this money. Condition number one. Condition number two, I might have to pay. How much? We are able to measure in terms of money. Somehow we are able to measure it in terms of money. If we can measure that amount of loss in terms of money, then that will become reliable estimate. So there is probable outflow and there is reliable estimate of that money. Probable outflow and reliable estimate, both the conditions are fulfilled. Then for that contingent liability, I will create provision. Sir, no sir, these conditions are not fulfilled. Then don't create provision. Disclose it as contingent liability. Got it? Sir, this year conditions are not fulfilled. Next year again check whether there is reliable estimate and probable outflow. If reliable estimate and probable outflow conditions are fulfilled, then you create provision. If not, don't create provision. Are you getting it? Very simple. Yeah. If you have a present obligation arising because of a past event, it's a liability. If it is a possible obligation arising because of a past event, it is a contingent liability. Contingent liability is not a liability. It should be only disclosed. If that contingent liability is very remote, don't even have to disclose. If that contingent liability is not remote, then you would have to disclose. If that possible obligation is there, no. If it fulfills two conditions, one, reliable estimate, two, probable outflow, then you create provision. That provision has to be checked at the end of each year because it is accounting estimate. Shall I repeat? Present obligation arising because of a past event, liability. Possible obligation whose existence is confirmed on occurrence or non-occurrence of one or more future uncertain events which are not wholly within control, contingent liability. Contingent liability is very remote. No disclosure required. Contingent liability is not so remote. Disclosure required. Understood? Now this contingent liability will check for two conditions. One, probable outflow. Is there a probability that we'll lose the case? Yeah, very highly probable that we'll lose the case. It is becoming from possible obligation, it's becoming present obligation. Then you can estimate the amount of loss also. There is reliable estimate. Then what to do? Create. Very good. Create provision. This provision has to be rechecked, estimated at the end of each balance sheet date. Got it? This balance sheet date, it is not remote. Next balance sheet date, it becomes remote. Stop disclosure. This balance sheet date, it is remote. Next balance sheet, it becomes not remote. Disclose it as contingent liability. then there is the possible outflow and reliable estimate, then make provision. So this is with regard to our accounting standard 29. Quickly read the definitions. What is provision? It's a present obligation as a result of past event with probable outflow and reliable estimate. If there is no probable outflow, no reliable estimate, then this present obligation will become possible obligation. If it becomes present obligation, it is because probable outflow and there is reliable estimate. Possible andre might be. Present means probably there is an outflow happening and you can estimate it reliably. Got it? Contingent liability, possible obligation, not present. What is it? That arises from past event. Existence is confirmed only by occurrence or non-occurrence of one or more fun. Fun is future, uncertain and uncontrollable events. Or present obligation which is not fulfilling probable outflow and reliable estimate conditions. What is contingent asset? Same thing. Instead of obligation, you will write asset. Possible asset that arises from past event. Existence is confirmed on occurrence or non-occurrence of one or more future, uncertain and uncontrollable events. Everyone understood? That's it with regard to accounting standard 29. Whenever there is contingent liability or something, you need to disclose nature and amount. Contingent asset will not be disclosed against conservatism. Contingent liability will be disclosed. What should you disclose? Should disclose the nature and amount to perceive the impact of this item on P&L. If it is impractical, disclose that impracticality to disclose. If it is impractical to disclose the reason why it is impractical to disclose it. Okay, by this we complete accounting standard 29. So let's now start with branch accounting, and once we finish branch we'll do financial statements overview, and then let's do our topic of internal reconstruction with share surrender. Got it? Let's start branch accounting. So branch is another place of operation from the head office. Instead of you sitting at one place and selling the goods at multiple places, you might open an outlet of yours at multiple places. It's like place of business, that becomes branch. When you talk about branch can be classified into two major classifications. One is domestic branch, other one is foreign branches. And domestic branches, whatever are there, are also called as inland branches. Inland and domestic branches can be dependent and can be independent. In the general layman understanding, when we say dependent, independent, we mean whether the branch has the power to take decisions on its own to sell the goods, to fix the selling price, to appoint people, to buy the goods. That is dependency, independency in general understanding. But in accounting, when we say independent and dependent, what we mean is, does the branch maintain accounts or does the branch not maintain accounts? If in case the branch maintains its books of accounts, then it is called as what branch? Independent branch. If the branch does not maintain its books of accounts, then it is called as dependent branch. That is the only point that we have. So if the branch maintains its own record, it is independent branch. If the branch does not maintain its own records, it is called as dependent branch. Do you get this? So let's first discuss our inland branches, which is dependent, independent, then go to foreign branch. And in our inland branches, to begin with, we are going to discuss for dependent branch, where branch does all operations, but branch does not maintain books of accounts. Books of accounts of the branch are maintained by head office. Books of accounts of the branch are maintained by. Very good. Now accounting for dependent branch. So when you do accounting for dependent branch, head office has multiple options, and it will choose the option based on the value at which the goods are sent to branch. If the goods are sent to branch at cost price or invoice price, head office has the option to follow debtors method, stock debtors method, or final accounts method. If in case the goods are sent by the head office to the branch at wholesale price, then they have only one method called as wholesale price method. I repeat, if the head office is sending the goods to the branch at cost price or invoice price, you can choose between debtors method, stock debtors method, and final accounts method. However, if the dependent branch, if the head office is sending the goods to the branch at a wholesale price, they would have to follow the method called as wholesale price method. Now let's discuss debtors method. What do we mean by debtors method? Under debtors method, head office will treat each branch as a debtor to whom the goods have been sold. For the goods given to the branch, for the assets given to the branch, for the petty cash given to the branch, for cash given to the branch, head office has to recover money from the branch. If the branch sells the goods and gives the money, if the branch sells the goods to customer, customers pays the money directly. It is like recovery of the money from the debtor. If the branch returns the goods also, it is considered as recovery of the money from the debtor. Debtor will have opening balance on the debit, closing balance on the credit. Anything that the head office will give to branch will be debited. Anything that the branch will return to head office will be credited. I repeat, branch is treated like a debtor. Opening balance on the debit, closing balance on the credit. Anything that head office will give to branch, debit. Anything that the branch will give, branch will return because of branch you receive will be credited. And you will identify the closing balance. The balancing figure in that ledger will be considered as profit or loss. This is like trading account. This is like P&L account. This is like debtors account. This is like balance sheet also. Everything in one place, called as branch debtors account. Branch account under debtors system. In this ledger, we record for transactions that happens between branch and head office. We ignore the transactions happening between branch and third party. This is done from the standpoint of head office. So head office records all the transactions, what is happening between head office and branch. Any transaction happening between branch and third party will be ignored. We are not going to record it. You got it? See, every branch is treated like a debtor. Any resource sent or expense paid on behalf of the branch is considered recoverable from the branch and debited to branch account. Any resource received from the branch is considered as recovery from the branch and credited to branch account. Any transactions happening at branch not involving head office is ignored. Opening and closing balances are recorded for resources and obligations at branch. If there is any assets at the branch, furniture, land, building, debtors, cash, all of this will appear in the debit side, to balance brought down. If the closing balances of assets are there, credit side, by balance carried down. If there is any liabilities at branch, credit side, by balance brought down. And closing balance, debit side, to balance carried down. Understood that? And any transactions between head office and branch are recorded, branch and third party are ignored. Got it? For example, if the transaction is the goods being sent to branch, entry will be branch account debit to goods sent to branch. Entry is debtors to sales, no. Debtor name is branch. Sales is replaced with goods sent to branch. And this goods sent to branch will be deducted from my purchases. Because it is actually not sales, no. I have given it out of my purchases. So I'll write the entry branch account debit to purchases is the ultimate entry. But it will be written as 2. Branch to goods sent to branch, goods sent to branch to purchases. Understood? Next one is expenses of the branch are paid by head office. If the expense of the branch is paid by head office will write the entry branch account debit to cash. It is like I have given money to branch and branch has paid that expense. If the expense of the branch is paid by the branch, head office will write no entry. Why? It is a transaction between branch and third party. If goods are sold on credit, then what would be the entry? Usually entry is debtors to sales. Am I right? Here there would be no entry. Why? This transaction is between branch and third party. However, if the goods are sold for cash, again there will be no entry because this transaction between branch and third party. Next, if the money is collected from debtors, again this is transaction between branch and third party. There will be no entry recorded. Got it? Then comes bad debts are discount allowed. You write bad debts to debtors. That is again transaction between branch and third party. We will ignore it. Got it? However, these bad debts, this cash received from debtors, goods sold to debtors, all of it will be considered in determining closing balance of debtors. All of it will be considered in computing closing balance of debtors, what we need to write in our branch account. Understood? Then, if the goods are returned by the branch to the head office, we reverse the entry that we wrote initially. Initially, we wrote no branch to goods sent to branch. I will reverse it by writing goods sent to branch account debit to branch account. Understood? Then, goods sent to another branch. If the goods are sent by one branch to another branch, it is like branch has given to head office and head office given to another branch. So you write the same entry what you write for goods returned by branch to head office. You write goods sent to branch to branch. What if the branch remits cash? Branch gives cash to head office, cash to branch. When I give cash or when I pay expense, I wrote branch to cash. Now when they give cash, I write cash to branch. Then cash paid by customers to head office directly. Cash is paid by customer to head office. What is the entry? Cash account debit to branch. Customer paying directly, customer paying to branch, and branch paying me, everything is same. There is no much of difference in this. Got it? Goods are sent to branch but not reached the branch yet. So if you don't write this entry, it will be part of the stock of the branch. Head office has written the entry branch to goods sent to branch, but branch has not yet received. If the branch has received, it will appear on the credit side in the closing inventory. Because it is not there in the closing inventory, just above that, I would write something called as Gita, goods in transit account. What do you write it as? Very good. It will be written as goods in transit account debit to branch account. Did you understand that we write it as goods in transit to branch? Very good. After that, cash has been sent to branch but not yet received. Then we'll write cash in transit account debit to branch. If not, it will be part of the closing cash balance. Because it is not part of the closing cash balance, because it is not part of the closing inventory balance, we need to write Sita Gita debit to branch. If you don't write this, it should be part of closing balance. ಕೆಳಗಡೆ ಬ್ಯಾಲೆನ್ಸ್ ಕ್ಯಾರಿ ಡೌನ್ ಅಲ್ಲಿ ಬರಿಬೇಕು ಬಿಕಾಸ್ ಇಟ್ಸ್ ನಾಟ್ ಪಾರ್ಟ್ ಆಫ್ ಬ್ಯಾಲೆನ್ಸ್ ಕ್ಯಾರಿ ಡೌನ್ ಜಸ್ಟ್ ಅಬೌವ್ ದಟ್ ಐ ರೇಟ್ ಇಟ್ ಆಸ್ ಸೀತಾ ಆರ್ ಗೀತಾ ಕ್ಯಾಶ್ ಇನ್ ಟ್ರಾನ್ಸಿಟ್ ಆರ್ ಗೂಡ್ಸ್ ಇನ್ ಟ್ರಾನ್ಸಿಟ್ ಗಾಟ್ ಇಟ್ cash in transit and goods in transit is not written by the sending entity. It is written by the entity which should receive it. Are you getting it? Head office is not writing in head office books. Head office is writing in the branch account here. Got that? That's it. And for normal loss, there is no entry. For abnormal loss, what is the entry? No entry. Why? You write what entry for abnormal loss usually? Purchase account credit, P&L account debit. P&L account to illa, purchase account to illa. So there is no entry. But such abnormal loss will be considered in determining the closing balance of the inventory. We'll do one separate working note. Opening balance of stock plus goods received from head office plus minus goods sent back to head office minus goods sold minus goods returned and then minus Gita. Then I'll get the closing balance. Abnormal loss also I'll minus, I'll get stock in hand. Got it? That's what we should do. What if insurance claim is received against this by the head office? If the branch receives it, no entry. If the head office receives it, cash account debit because head office is receiving cash. Credit will be given to branch account. Got it? And if there is profit at the branch, that will be transferred to head office PL. Am I right? So P&L account credit, branch account debit. If there is loss, ulta, P&L account debit to branch account. Got this? This is what we do in the case of our debtor system. The ledger will look somewhat like this. Debit side, you write all the assets. Credit side, you write closing balance of assets. Debtors, asset, cash, stock. If there is any liability like outstanding expense, opening balance on the credit, closing balance on the debit. Anything that is given by head office to branch or paid on behalf of the branch by head office, expense paid by head office on behalf of the branch, cash sent by head office to branch, goods sent by head office to branch, will write on the debit. Whatever the goods which are sold by the branch, whatever the cash collected by the branch, whatever the debtors against which collection is made by the branch, bad debt, debtors, no entry. Whatever is the cash sent by branch to head office, whatever is the goods returned by branch to head office, all of it will come here. Cash remitted by branch to head office, goods returned by branch to head office. And this Gita and Sita, if you don't write it here, this Gita will be included in branch stock. This Sita will be included in petty cash. Because it should not be included in these two, you write them separately here. Did you understand this? This sends our branch account. And if in case the balance figure comes on the debit side, it is profit. If it comes on the credit side, it is loss. It will be returned to P&L account. Like I mentioned, sales made at the branch, whether cash or credit, will not be considered. Expenses paid out of the petty cash by branch, not considered. Depreciation on assets, not considered. Discount allowed to customers, bad debts, no entry. However, you will consider this sales at the branch to identify the closing balance of inventory. You will consider this in computing the cash to be remitted by branch to head office. Expenses paid by the branch using petty cash will not be written anywhere, but that will be considered in computing the closing petty cash balance. Depreciation on assets at the branch will not be recorded. However, it will be considered in computing the closing balance of the assets. discount allowed to customers or bad debts, it will be not entered anywhere in the branch account, but it will be considered in computing the closing balance of debtors. Do you get that? Very good. Then let's go to next method. Next method is stock debtors method. Under stock debtors method, what you do is you prepare separate ledger for each of the thing. Under debtors method, you wrote one account called branch account that will be split into branch stock, branch debtors, branch cash, branch petty cash, branch expense, branch PL. Same entries, but now you will start writing them in detail. And lot of things what we ignored there will be now entered. Yeah, I'll come back to this profit part later. So now let me explain how the accounting is done in the case of stock debtors method. Though stock debtors method is later, if you observe first question, second question, third question, the question was only under debtors method. I made you do under debtors, stock debtors, and final accounts so that you get used to it. If you haven't got access to that, please drop a message. I'll share one link, one single video to you people where one question, same question is solved under multiple methods. Same question is solved under stock debtors method. It is improvised version of debtors method. What do we do under this system? Branch account is split into debtors, stock, expense, cash, petty cash, and PL, and assets also. We write entry for each of those things. Branch stock account, it will work like trading account. The objective is to determine our profit or loss, GP, gross profit, gross loss, but it will be called as surplus. And branch debtors account, objective is to identify the closing debtors balance. Branch cash account is to determine branch closing cash balance. Branch expense account is to determine the total branch expenses which will be transferred from branch expense to branch PL. And the objective of branch PL is to determine the total profit from the branch. Journal entries would look somewhat like this. For goods sent to branch, under debtor system, we write the entry as branch to goods sent to branch. Here, branch will be replaced with branch stock. I'll write branch stock to goods sent to branch. And same goods sent to branch to purchase entry will remain same. For branch expenses paid by head office, first case we wrote branch to cash. Here you will write branch expense to cash. When the stock is involved, I write branch stock. When debtors is involved, I write branch debtors. When cash is involved, I'll write branch cash. Okay. When the expense is paid by branch, previously no entry. Now I'll write entry. Branch expense account debit to branch cash. In debtor system, there is no concept of branch expense. There is no concept of branch cash. Everything is called as only one branch. So it will become branch account debit to branch account. That is the reason we don't write entry in debtors. Under debtors approach, one opening balance will involve asset, cash, stock, everything. No. Here, asset separate ledger, stock separate ledger, debtor separate ledger. So we're able to write this entry branch expense to branch cash. Otherwise, we will not be able to. Got it? Then sale of goods. If it is credit sales, what is the entry? Debtors to stock, debtors to sales. No. Debtors has become branch debtors. Sales has become branch stock. If it is cash sales, previously no entry. Now I'll write branch cash to branch stock. If the cash is received by head office, cash account debit to branch stock. Cash and the main cash of head office. When the money is collected from debtors, you write the entry cash to debtors. No. Here it will become branch cash to branch debtors. Understood this? Then if there is bad debts or discount, that bad debts or discount can be debited to branch expense. From there you can transfer to branch PL, or you can straight away write branch PL account debit to branch debtors also. Expense, no, all the expenses one common name, whether it is postage, stationery, carriage, bad debts, discount, cash, what to say, cash discount, doesn't really matter what it is. You'll write it to only one ledger. What is it? Branch expense. You can write the entry as branch expense to branch debtors. Got it? If the goods are returned, previously we wrote the entry goods sent to branch to branch. Now we'll write goods sent to branch debit. Credit will not be branch, credit will be branch stock account. Then I have goods sent to branch, goods sent to another branch. What if the entry is, what is the entry if the goods are sent to another branch? Same like whatever is the entry when the goods are sent to head office. It will be sent to head office would have to send it to another branch. Got it? Then what do we have? Branch remits cash to head office. When the branch remits cash to head office, what is the entry? Cash account debit to branch in the old case. Now the entry is cash account debit to branch cash. Branch cash is decreasing. Got it? If the cash is paid by debtors directly to head office, then the entry will be same. Only thing is, instead of crediting branch, I will credit branch debtors. Under previous debtors method, you do working note to find closing debtors balance. You do branch debtors ledger to find closing balance. Previous case, you do working note to find branch cash closing balance. Here you prepare branch cash account to determine it. There, everything was there in one ledger. Opening balance, closing balance, everything. Now you break it into multiple ledgers. That will become stock debtors method basically. Got it? When the goods are sent which are not received, same thing. Instead of crediting just branch, you will credit branch stock. Cash also. Instead of creating just branch, we'll create branch cash in Sita. Ultimately, branch expenses and everything will be transferred to branch PL, and you'll find the profit in branch PL and transfer to head office PL. And normal loss. Previously, there was no entry. Now you can write the entry. Branch adjustment to branch stock. Stock is reducing. Abnormal loss. Branch adjustment debit. P&L debit to branch stock. Why branch adjustment? Why branch PL? To the extent money is received. To the extent. Yeah, you can write either branch adjustment or branch PL. You can either write branch adjustment or you can write branch PL. Branch adjustment will come if in case there is that load. If in case there is that load. If there is no load, then you will not write branch adjustment. You can straight away write branch PL to branch stock. Here also branch adjustment to stock only for that load amount. Then ultimately, if the insurance is received, previously we wrote no entry. Now we'll write branch cash to branch PL. And if it is received by head office, cash account will be head office. P&L will be of that of branch. Ultimately, you will close your branch stock account. Gross profit or gross loss kind of item will be determined and it will be transferred to branch PL. Close your branch expense and transfer it to branch PL. Ultimately, in branch PL account, we'll find profit or loss as balancing figure. This is stock debtor system. Under final account system, what do? We treat branch like a separate entity and then prepare its final accounts. We treat branch like a separate entity and then prepare its entire final accounts of that branch will be prepared. Do you get that? That's final accounts approach. If in case the goods are sent at a price higher than the cost price, that is at invoice price. In branch stock account, debit side there is opening stock. On that load will be removed on the credit side by writing stock reserve. Closing stock is on the credit side. On that load will be removed on the debit side by writing stock reserve. On the goods sent to branch, you write opposite side goods sent to branch only. Same is done in debtors account also. You got that? That stock reserve opening and closing difference will be routed through branch adjustment to branch PL. Additional stock reserve that is created during the year. See the same thing. Stock reserve to branch. In branch account, you write credit side. In branch stock account also, you write credit side. That is stock reserve. And goods sent to branch again, same name goods sent to branch and goods sent to branch return, you write the same name. Only on the opening and closing you write stock reserve for removal of the load. Did you get that? That's it. And these questions you will get to know much better only by practice. It is not something that can be discussed theoretically, but I am able to give you just an overview of the same. Next comes wholesale price method. Under wholesale price method, you're treating the branch like a wholesaler and the head office is a wholesale. Under wholesale price method, head office transfers the goods to branch at a wholesale price and branch is a retailer. That's how it is treated. How do you treat the branch? As retailer and head office is the wholesaler. It is very similar to our existing method only. Wait, let me show. Yeah. So head office sends the goods to branch at wholesale price. Branch sells it to customers at retail price. Head office sends the goods to branch at wholesale price. That's the reason it's called wholesale price method. Branch sends the goods to consumers at what price? Retail price. So to the cost to the whole head office, we add the wholesale margin. We get the wholesale price. To the wholesale price, we add retail margin and then we get the retail price or the ultimate sale price by the branch to customers. Are you getting it? Then stock entries will be made in the branch books at wholesale price only. All the entries, opening stock, closing stock, everything, all the stock entries will be made at what price? Wholesale price, except for one thing. Sales at the branch will be recorded at retail price. So in that ledger, opening balance, closing balance, goods sent to branch, everything is at wholesale price. Sales is at retail price. Whatever profit we find, no, it is retail margin. Difference between the wholesale price and retail price. Are you getting it? And difference between cost and wholesale price will be booked by head office, not by branch. Head office will book profit on cost and wholesale price difference, that is wholesale margin. Branch will record everything at wholesale price and sell it at retail price, and at the branch will record only retail margin. Head office will book wholesale margin in their trading account. Branch will book retail margin, which will be transferred to P&L account of head office. Previously, what we're doing, entire profit is booked in branch and transferred to head office. Now we don't do that. We'll book wholesale profit in head office, retail profit in branch, and such retail profit in the branch will be later transferred to head office. Did you understand this? So if you observe, this is how it will look like. Opening stock, goods sent to branch is all at wholesale price. Here the abnormal loss, closing stock will also be at wholesale price. Sales I will write at selling price. When I write sales at selling price, that is retail price. Rest everything is at wholesale price. Whatever GP I find here, this is retail margin. Wholesale price mele margin idella, that amount. Are you getting it? Then you adjust any other indirect expense if it is there, and then transfer the ultimate money to our head office. Head office would have already booked wholesale profit. Now they'll book retail profit also in their books, but wholesale profit would have been booked in their trading. Retail profit will be booked in their P&L. But we do only accounting for branch. We don't do head office accounting in this question. Got that? But if required, we can still do it. We remove that load, automatically in the head office P&L will get that retail profit as well as wholesale profit. Got that? Then comes the questions where we are going to treat branch as an independent branch. If you treat it independently, records are maintained by the branch. At regular intervals, branch will send its trial balance or final accounts to head office. Head office will incorporate such accounts into its books. Are you getting it? There is an accountant at the head office who will prepare it. Now that accountant can prepare two types of accounts. One, he can prepare abridged one or consolidated, a complete ledger accounts he can maintain. So I'll teach you that part. But before that, we have certain accounting entries to be recorded independent branch. Here, we need to remember one thing, that head office will record branch account, branch will record head office account. Whenever head office credits branch, branch will debit head office. Whenever I give goods to you, I write branch account debit to goods sent to branch. I have debited your account. You will credit my account. You will write goods received from head office to head office account. Are you getting what I'm trying to tell? If in case the purchase of goods is other than from head office, branch purchased it separately. Head office will not parse any entry. Branch will write purchase to cash. If in case the money is paid by head office will write branch to cash. Head office is written branch debit. Branch has to write head office credit. Purchase to head office. Andre, branch has purchased the goods, money is paid by head office. So purchase account debit I'll write. Money is paid by head office, I have to pay head office, so branch will credit head office. Head office will write, I have paid cash, cash account credit. Whom did I pay? I paid it to branch, so I'll write branch account debit. Are you getting it? Then if the branch expenses are paid by branch, head office will not write any entry. Branch will write expense to cash. If the expense of the branch is paid by head office, branch will write expense debit, head office will write cash credit. Head office will debit branch, branch will credit head office. Did you understand this? Then if the goods are sold at branch, head office writes no entry. Branch will write normal, cash to sales entry. If it is sold on credit, same, cash to debtors entry. If the cash is collected by head office, then the entry will be cash account debit will be made by head office. Debtors account credit will be made by branch. Cash is collected from the debtors by the head office. So head office will write branch credit, branch will write head office debit. This is the only non-corporate accounting chapter that you have in your syllabus. Rest all the topics are corporate accounting. This is one topic which is not corporate accounting but lengthy. Then we have with us goods returned by branch to head office. If the goods are returned by the branch to the head office, so we'll reverse the initial entry what we had written. In the books of head office, goods are received, no. When we sent, we wrote branch to GSB. Now I'll write GSB to branch. Here, they had written goods received to head office. Now they'll write head office to goods received. Reversal. Are you getting it? Assets. Assets can be maintained by head office, can be maintained by branch. If the branch maintains the assets and branch purchases the assets, branch will write assets to cash. If in case the money is paid by head office, branch will write asset debit, head office will write cash credit. Branch ಅಲ್ಲಿ head office debit to head office, sorry, branch ಅಲ್ಲಿ head office credit to head office ಅಲ್ಲಿ branch debit. Are you understanding what I'm telling, or I'm just telling and you're like, sir is telling something, I'm sitting because it is too impolite to get up and walk out right now. Now you feel like shit, we should have not asked branch. Bitbidi sir ಅಂತ ಹೇಳ್ಬೇಕು. For depreciation, when the accounts are maintained by branch, entry is depreciation to asset. What if the same thing, accounts are maintained by head office? Then when the asset is purchased and payment is made by branch, but asset is maintained by head office, head office will write asset debit, branch will write cash credit. Branch ಅಲ್ಲಿ head office debit, head office ಅಲ್ಲಿ branch credit. What if the asset is maintained by head office, paid by head office, branch will write no entry, head office will write branch asset to cash. For depreciation, asset is maintained by head office, but expense should be booked by branch. Branch will write depreciation debit, head office will write asset account credit. Head office ಅಲ್ಲಿ branch debit, branch ಅಲ್ಲಿ head office credit. Got it? Then remittance of funds. When the money is remitted by branch to head office will receive cash to branch. Sorry, cash to branch. And in the branch will write head office to cash. This is remitted by branch to head office. If head office is giving cash to branch, head office will write branch to cash, branch will write cash to head office. Did you understand this? Lot of these kuti entries are there. These are all Gita Sita entries and lot of small 3 entries, 4 entries, they'll ask for 6 marks, 10 marks. Nice and simple ones. Practice a little more and you will be able to get that. Last variety before we do foreign branches is inter-branch transactions. Lot of branches are there: Delhi, Mumbai, Chennai, Kolkata. One branch has given goods, one branch has received goods, one branch paid expense, one branch purchased asset, one branch paid expense of another branch. All of this, whichever branch is paying will get credit, whichever on behalf of whom it is paid they will get debit. Draw one big table, identify the net amount and pass one journal entry for the entire net amount, one shot. Got it? This is one type of problem that is there. Then we have independent branches, incorporation of books of accounts. That branch has maintained accounts, no, branch will give that accounts to you. They can give it in 2 forms. One, abridged. Second one, detailed. Abridged is transfer of profit and loss method, is the other name. Next one is detailed consolidation method. When you say abridged, no, they prepare profit and loss, balance sheet, everything, and they give it to you. You take their profit, add it to your profit, khatam. Detailed consolidation means accountant in the branch doesn't know how to do balance sheet. He does trial balance and then he gives line by line, item by item, you add it into your books of accounts. That will become consolidated. You get that? One simple big sized entry will come like this: all the assets debit, all the liabilities credit, and then branch will be debit balance in your head office account, you will credit branch, and then implement their assets and liabilities into your books of accounts. See, if it is abridged, what do? Their profit is your profit. They will give profit, no, you will debit the profit and then credit head office. Branch is sending, head office will write branch account debit to P&L. It will go to their P&L. Straight away we take their profit, we don't take expense and income. If it is detailed, what do? Ondonde expense togondu hakobeku, ondonde income should take and then put. Got it? Why? The accountant at the branch doesn't know to prepare P&L. He'll prepare till trial balance. After that he missed the class, he will give detailed trial balance, you adopt it. If in case it is abridged, he will give detailed final accounts is prepared, is given you P&L net profit, you adopt profit from them. You won't adopt individual assets and liabilities. Sorry, you don't adopt individual expenses and incomes. Got it? In both the cases you will adopt their assets and liabilities. That is common entry what is there here as well as here. Their assets, when they send, they will credit asset, debit head office. When we receive, we will debit asset, credit branch. Till now branch is our asset. Now in the place of branch we'll have all the assets coming. When they send liability, they will debit liability, credit head office. When we receive liability, we will credit liability, debit branch. Did I tell wrong? When they send, they debit liability, credit head office. When we receive, we credit liability, debit branch. Got it? That's it. This is the detailed consolidation and then abridged consolidation method. If you want to write more detailed entry, it will come somewhat like this. We discussed it in the class. Finally, what is there? Foreign branch. Foreign branch can be classified into two major classifications. What are they? Integral, non-integral. My God. What is the difference? Translation is different. If it is integral operation, what do we do for opening stock? Priority will be actual. Second priority will be opening. Non-integral, apply opening rate. For closing also, if priority 1 will be actual, priority 2 will be closing. Non-integral, apply closing rate. Integral means extension of internal operations. Non-integral means it is not extension of internal operations, it's separate operations altogether. Got that? Then for revenue items will apply average rate. For monetary items will apply closing rate. For non-monetary items like assets, if it is recorded at historical cost, will apply transaction date rate. If it is recorded at fair value, the date on which you took fair value, that date's rate will write. They'll give trial balance in foreign currency, convert it to Indian currency. If it is integral operation, then what to do? It is like our own foreign operations. Any difference arising in our foreign currency will be transferred to P&L account through foreign exchange difference account. If it is non-integral operation, any difference arising will not be transferred to P&L. It will be written to FCTR, foreign currency translation reserve. It will stay there till the time you have that branch. The day you give up that branch and you close that branch, that day you close that branch account, and then that FCTR balance will be transferred to PL. Got it? Till then it will stay. And this is our branch account. What to do next? Shall we do internal reconstruction or financial statements? Internal reconstruction or financial statements? Financial. Can do. Financial statements better. Internal reconstruction. Financial statements. Okay. With regard to financial statements, it's only basically about the disclosure requirements. I'll tell you what disclosure requirements should you be addressing. This is theory part. Let's quickly. Yeah, you can leave. Yeah. So these are the important disclosure requirements that are supposed to be noted. With regard to financial statements of companies, the question can come separately as only for preparation of financial statements, or in the topic of buyback, or in internal reconstruction, in consolidation and amalgamation, they can ask you to draft a financial statement. But whenever there is a separate question on financial statement, the question is not about tallying the balance sheet. It's about fulfilling the disclosure requirements. My God. The disclosure requirements are like this. Whenever in the share capital there are shares issued for non-cash consideration, that is by way of bonus issue or by way of conversion of debentures or in the process of amalgamation, it has to be disclosed separately, stating that these many shares are given for non-cash consideration. You also need to state your authorized capital separately. When you talk about reserves and surplus, you need to disclose the application of reserves. How much was the reserves in the beginning? How much is the reserves in the end? How much of reserves is utilized? Why did you utilize? Did you use it for dividend? Did you use it for bonus issue? What is the purpose of utilization? Did you use it to write off something? Did you use it to pay premium on redemption or something? That appropriation of reserves have to be disclosed separately. And then comes our borrowings. Borrowings have to be disclosed if in case there is any specific charge. You should mention, are these borrowings arising with specific charge or general charge? If these have specific charge against an asset, next to the borrowing you will mention that they have a charge on this asset. Next to the asset you should mention that this asset is being pledged against this borrowing, and interest outstanding against this borrowing is not to be written along with borrowing. Sometimes borrowing might be long term but interest is always short term, no? It will be written as other current liability. Don't ever include interest along with the borrowing. And borrowings from financial institutions, non-financial institutions and related parties have to be disclosed separately. For tangible assets, we have to disclose the original cost of the asset, accumulated depreciation on that asset, revaluation if any on that asset, and the closing balance. Everything has to be disclosed separately. Talking about trade receivables, you need to give aging schedule. How much is outstanding for greater than 6 months, how much is outstanding for lesser than 6 months, and amount outstanding to SMC, small and MSMEs, and non-MSMEs has to be disclosed again separately. With regard to cash and cash equivalent, the major point is if there is any bank balance in an unscheduled bank, we have to tell that this much money is in unscheduled bank. If there is any deposit which is time based, 3 months fixed deposit, 15 days fixed deposit, that also needs to be disclosed separately, stating that this much money is fixed deposit and not just a simple bank deposit. It is time based deposit, it is not demand deposit. Is there a difference between demand deposit and time deposit? Yeah. Oh my god, this is off. Demand deposit is whenever they ask money, they get it. Savings bank account, current account balance, this is all demand deposit. Timing deposit is it will be withdrawn only at the end of a specific time period. Your recurring deposit and fixed deposit is basically your time deposit. Did you get that? By that, I think we will get one kind of overview on financial statements. One thing that you should also do with regard to financial statements is dividend. In the absence of sufficient profits, how does the company give dividend? That conditions based thing which is there in your law also. And this question had come in May 24 exam. And that playlist that was shared for May 24 exam solution, that question is there. So please do that one question and you get the understanding of your, what do you say, that your financial statements part. Got that? Next, in enadru specifically that you want me to teach in financial statements topic?
If the adjustment that said that they propose the dividend,
Hmm.
should we write it as a contingent liability or should we do it?
Just disclose it separately. That's it. Proposed dividend is just a disclosure. It will not come as an adjustment. You need not deduct it from the profits and keep it aside.
And if there's advanced tax or tax,
You should net off. You should not write both. Okay. Lot of times when you go post CA inter for audit also, you see lot of clients will have advanced tax, provision for tax, and current tax. You need to adjust advanced tax with provision for tax. Then you will identify the current tax expense that should be created. That's an item to be net off. But certain times you will not find it, but it is an item to be net off. Okay. The conditions for that dividend is that whenever the dividend has to be given, it should be given out of profits. If there is inadequate profits, but the company still wants to give dividend, the company would have to give dividend at a rate not exceeding the average of the last 3 years. Understood that? That's the first condition. Second condition is amount of dividend given should be less than or equal to 1/10 of paid up capital plus free reserves. This amount of dividend, not the percentage. Whatever percentage you would want to give, when you multiply it on share capital, you get that amount. That amount should not exceed 1/10 of paid up capital and free reserves of last year. And the next one is amount withdrawn to be utilized to be set off against the current year losses first, and then you can pay the dividend. That 1/10 money what you take, no, from that you first deduct the current year loss and only balance can be given as dividend. Last one is balance in reserves after such withdrawal should be minimum 50% of 15% of paid up capital. Paid up capital into 15% ಮಾಡಿದ್ರೆ ಎಷ್ಟು ಬರುತ್ತೋ at least so much money should be there in reserves and surplus after you deduct. So first you do 15% of PUC, excess whatever is there can be taken. And it is not one of these conditions, it's all of these 4 conditions has to be fulfilled to declare dividend. Got that? Yes? Then is there anything that you would want me to do?
in case of bills receivable,
What?
bills receivable which are maturing after 31st March, but they discounted now, what should we do?
It should be disclosed as a contingent liability because it is not your liability. For example, I am your debtor, I have given you bills, you have bills receivable, you discounted it with the banker. That bill has gone out, no, from you, it's with the banker. Next year banker will come and ask money from me, I would have to pay money to banker. But if in case I default, banker will ask money from you. When the banker asks money from you, you might have to pay the money because you took the money from the bank. To you it is contingent liability. Till the time I pay the money to the banker, it is contingent liability to you. Got it? So bills discounted to be mature, which will mature in the next accounting period, will be disclosed as contingent liability. Then anything else? Nope. Which part are we going to do now? Shall we do that internal reconstruction share surrender part, or what? That will do, huh? On 5 minutes, 10 minutes agate. We'll finish off that internal reconstruction part. You guys have a fair understanding with internal reconstruction, no? Whenever the entity has a very bad financial structure, the financial health of the company is bad, the profits of the company are not there, it is dried out, and they have huge accumulated losses. And with such huge accumulated losses, they are not able to run the business around. Creditors have stopped supplying goods, debtors have stopped paying the money, employees get salary kotila, debenture interest is not paid, preference share dividend is in arrears, net worth is negative. So every form a business is bad. So what do? You go request your preference shareholders to waive off debenture, waive off preference dividend. You will ask your debenture holders to waive off interest. You will promise them higher rate of interest maybe. Then you will ask your creditors to start supplying goods. To give goods, they should pay them money, no? So maybe you will ask your equity shareholders or preference shareholders to subscribe some shares. You will decrease the paid up value of those shares. You free up the authorized capital, freshly issue shares to them only, collect cash from them, give it to creditors, start sending them goods. You start supplying goods to your debtors. Ask your debtors to pay the money to you on time. So you revive the entire business. This entire exercise is done routing through one account called as capital reduction account. Any profit you get by decreasing the value of the by decreasing the value of the liability by writing off some expense will be written to capital reduction. That will be used to write off intangible asset. That will be used to bring down the value of the asset. That will be used to write off the accumulated losses, and the business will revive. So very simple, common sense based chapter. You would be able to handle it. And let me quickly do that one part, which is basically about share surrender. Shall I? Come on. Share surrender. One question. Question number 17 from your material. I'll do this question from share surrender. ಇಲ್ಲಿ ಸ್ವಲ್ಪ ಡಬಲ್ ಎಂಟ್ರಿ ಕಾನ್ಸೆಪ್ಟ್ ವಿಲ್ ಬಿಕಮ್ ಜೂಮ್ ಅನ್ನತ್ತೆ ಒಂದ್ಸತಿ ಹೆಡ್. ಯು ಗೈಸ್ ಶುಡ್ ಬಿ ಸ್ಲೈಟ್ಲಿ ಕೇರ್ಫುಲ್. I'm sorry. So what do you mean by share surrender? You have eaten up your entire authorized capital. You don't have any room in your authorized capital. You have debenture holders to whom you're supposed to give money, or debentures are due for maturity. You don't have money to pay them. So what do? You will ask your equity shareholders to give up some part of the shares. Whatever shares they give, you put it to one box called share surrender. Share capital will decrease. You will debit share capital, credit share surrender. That share surrender may whatever is there, no, that will be utilized to give shares to someone free of cost. For example, your debenture holders are there. Against the debenture holders, we need to give shares. What will you do? Debit debenture, credit share surrender. Debit debenture, credit share surrender. But ಇಲ್ಲಿ share capital ಜಾಸ್ತಿ ಆಗ್ತಾ ಇಲ್ವಲ್ಲ? Let's say your equity share capital is 10 lakh. You ask them to surrender shares of 1 lakh. They surrendered. Equity share capital became 9 lakh. 1 lakh rupees worth of shares are there in share surrender. Share capital has reduced to 9. Debentures are there 1 lakh. Let's say to debenture holders you are going to give shares of 1 lakh. Entry ಏನು ಬರೆಯೋದು? Debenture debit, share surrender credit. By doing this, share surrender will get closed. Am I right? But your equity share capital is not increasing. Actually, share surrender also will not get closed. We'll write equity share capital debit to share surrender credit ಆಯ್ತು. ಇಲ್ಲಿ ಇವ್ರಿಗೆ ಕೊಟ್ಟಾಗ್ಲೂ ಡಿಬೆಂಚರ್ ಅಕೌಂಟ್ ಡೆಬಿಟ್ ಟು ಶೇರ್ ಸರೆಂಡರ್ ಬರೆದ್ರೆ ಹೇಗೆ? ವೆರಿ ಸಿಂಪಲ್. You debit debenture, no, you credit share capital now 1 lakh. Got it? That share surrender will be debited by transferring to capital reduction account 1 lakh. I'll repeat. Equity shareholders surrendered shares worth 1 lakh. What is the entry? Equity share capital account debit to share surrender 1 lakh. Got it? Now you have share surrender credit 1 lakh, share capital has become 9 lakh. Debentures are there to the extent of 1 lakh. To them you are giving equity shares. What is the entry you will write? Debenture account debit to share capital 1 lakh 1 lakh. Share capital became 10. Debentures are out. That share surrender 1 lakh is there. No, that will be closed by transfer to capital reduction. Understood? Share surrender debit, capital reduction credit. You know what's happening by this? Your debentures reduced, but you did not pay any money. Your debentures reduced, no, 1 lakh debentures reduced, it became equity shares. You did not give any money. That will be going to capital reduction as profit. Instead of straight away writing it, you wrote share capital to share surrender, debentures to share capital, share surrender to capital reduction. ಅಷ್ಟೇ ಇದನ್ನೇ ಮಾಡಿ ತೋರಿಸ್ತೀನಿ. Okay, so page number, I don't know page number, this is towards the end. Question number 17. 240. 247 now. 240 up. Okay, I'm sorry. Question number 17 from your material. Observe this question. So Revise Limited. What is happening in Revise Limited? It was decided to reconstruct the company, for which necessary resolution was passed and sanctions were obtained from the appropriate authorities. Accordingly, it was decided that number 1, each share is subdivided into 10 fully paid up equity shares of rupees 10 each. So what are you going to do? You are going to divide the equity share capital. Right now equity shares are of rupees 100 each. Am I right? There are 10,000 shares of rupees 100 each. You will write equity share capital debit, shares of 100, 10 lakh. You will credit equity share capital. But this time shares are of rupees 10 each. How much is 10,000 into, no, sorry, this is 10,000 shares of 100. Now divide 10 lakh by 10. It will become 1 lakh shares of rupees 10 each. Understood this? After this, let me highlight this. Yeah, after subdivision, each shareholder shall surrender to the company 50% of his holding for the purpose of reissue to debenture holders and trade payables as necessary. How much are they giving? 50%. 10 lakh only 50% is how much? 5 lakh. When they surrender, their capital will decrease. Debit equity share capital. Credit share surrender account. How much? 5 lakh, 5 lakh. They have given. We are going to utilize this to pay to 2 people. 1, debenture holders. 2, trade payables. Artha aita? Come to the next part. Out of shares surrendered, how many shares are surrendered? 50,000 shares of rupees 10 each. Correct, Henry? Alva, 1 lakh shares of rupees 10 each, no? 50% of it is come to 50,000 shares of rupees 10 each. Read the next part. Out of the shares surrendered, 10,000 shares of rupees 10 each shall be converted into 12% preference shares of rupees 10 each fully paid up. When you convert, there is no entry. In your hand, there is equity share capital. Now it is converted to preference share capital. No entry. You give it to somebody, then we'll pass entry. Only for conversion, there is no entry. Are you getting it? It's like authorized capital of equity was there. Now you converted it to authorized capital of preference. Here entry. You will not write an entry. When you give it to somebody, then you will write the entry. The claims of debenture holders shall be reduced by 75%. How much is your debenture holders? 2 lakh, you need to pay them for debentures. 24,000, you need to pay them for accrued interest. So there is no journal entry for conversion of equity shares to preference shares. I'll write debentures and accrued interest. 1 lakh 50 and 18,000. Sir, why 1 lakh 50 and 18? 2 lakh and 24 is there. No, in that it is reduced to 75%. 1 lakh 50 into, sorry, 2 lakh into 75%. 1 lakh 50 and 24,000 into 75%. How much is that? This one. So this will be transferred to capital reduction. Yake? This much money will not be given. No, it is reduced by 75%. What do we do for balance 25%? In consideration of the reduction, debenture holders shall receive preference shares of 1 lakh, which are converted out of shares surrender. For the 75% reduction, whatever is happening, no, they are going to get how many equity, how many preference shares? 1 lakh rupees worth preference shares. We are issuing preference shares, no. Credit preference shares 1 lakh. Are we getting cash? Nothing. Debit share surrendered. It is given out of share surrendered. No, share surrendered was 5 lakh. From that 5 lakh, 1 lakh rupees worth shares are given to them. Got this? Is this difficult? Everyone understood? 75% is reduced, transfer to capital reduction, and balance you gave 1 lakh rupees share you gave for that reduction. That is given out of share surrender. You got it? Then next entry, trade payables claim shall be reduced to 50%. How much is trade payables? 72,000. It will be reduced to 50 means 36,000 damar, no? Am I right? I will write trade payables account debit 72,000. In that, capital reduction will be how much? 72. Sir, isn't it 36? Yes, it is 36. But for the balance, it is to be settled by issue of equity shares of rupees 10 each. Andre, out of 72,000, 36,000 will be transferred to capital reduction. They won't get any money. For balance 36,000, they get equity shares. So totally entire trade payables will become 0. I will write here share surrender account debit to equity share capital for 36,000. I gave them equity shares of 36,000. You got it? And they gave up their entire trade payables. 36,000 they gave up. Against that, they did not get anything. For balance 36,000, what they gave up? They got equity shares capital. Are you getting it? Okay. If you want, you can club these two entries and write it together. Either ways is fine. And how much of share surrender did we generate here? 5 lakh. In that 5 lakh, 1 lakh we gave it to our preference shareholders. Still 4 lakh is remaining. In that 4 lakh, 36,000 illa. 4 lakh minus 36. 3 lakh 64,000 is still there. 3 lakh 64,000 is still there. Now observe. Balance of profit and loss account will be written off. This will be written off using capital reduction, not share surrender. So I will write my capital reduction account debit to profit and loss. How much is my profit and loss debit balance? 6 lakh. So I will write 6 lakh, 6 lakh. I am assuming that I have enough balance. I am not checking it because you are too impatient. The shares which are surrendered but not reissued are cancelled. 5 lakh shares were surrendered. We issued 1 lakh 36. Minus is how much? 3 lakh 64. Share surrender is still there, credit. What will I do? I will debit it by crediting capital reduction account. 3 lakh 64, 3 lakh 64. How did I get this? 5 lakh minus 1 lakh minus 36,000. Got this? After I write this, then I would write one simple entry transferring capital reduction to capital reserve. Whatever is the balance in capital reduction after this will be transferred to capital reserve. If you want, I'll check item wise and then show it to you that 4,000 is remaining. Should I? Got this? So only thing to remember is whenever shares are surrendered, debit share capital, credit share surrender. When they put biscuit and all that, equity shares are converted to preference shares in share surrender, don't write it. When those shares surrendered are issued, debit share surrender and credit whatever is given. Let us say there is 10,000 trade payables. For 10,000 trade payables, 10,000 equity shares are issued from share surrender. Entries trade payable to capital reduction 1010. Share surrender to equity share capital 1010. Got it? When you give shares out of share surrender, entry is share surrender to share capital. And that liability, whatever is there, close it by transferring to capital reduction. You see it once again, you will find it easy. It is not that difficult. It's quite simple. Okay. Anything else that you would want me to do? So far in this marathon revision, we've done introduction to accounting standard, framework of financial statements, and one more we did in the beginning. Applicability of accounting standard. 3 chapters in the beginning. Then we started with AS1, 2, 3. We've done it in the series till 21. 22 we did not. We just did little part. 22, 23, 24, 25, 26, 27 we did not. 6 standards were not done. 28, 29 is done. Then we discussed financial statements overview. We've also done branch. We've also done internal reconstruction. So anything that's left, buyback is left. So buyback I'll attach a video to this and then send, or buyback I'll share a separate video with you all. And what is not done is 6 accounting standards and buyback. I think this video is good to go. We'll post it. So those 6 accounting standards, when the time permits, I'll do a short quick revision video and then share it to you people. Is that okay with you all? So how was that 2 days of marathon revision? Draining, very high, or like good? But we did not do too many questions. We did overall conceptual coverage. What I am happy about is that whenever we took any standard, like maybe 7 or maybe 5 or maybe 4 or maybe 14 or 12 or 13, anything, we did not cover only important points in the concept. We did everything that's there in the standard, what which would have anyways done in the regular batch. I hope it was helpful to you people also. And if in case there is any other suggestion, I would be here to hear from you people if you would want to tell. And that's it. All the best from my end for your examination. I don't want you to see in intermediate marathon revision anytime later. If in case you there is a need, we don't tell like okay, sir told barbardo ante vittu. Very unfortunate, sad reason something happened because of which you did not write the exam or you did not clear, which I don't want to happen. If you are coming to the next session, I am not saying don't come, but I would want you to see on the other side of CA intermediate, clearing the CA intermediate and going on the other side. And in the month of December, when we do marathon revision, I would want to tell your juniors that go attend. It's okay. It's useful. I attended last time. I cleared it with 80 marks. I in fact scored AIR. So I would want you to tell them. See, it's a positive thing. I am asking you to promote marathon revision. What will happen in December? But I am asking you to promote stating that you people cleared with this. So I'll be very happy if you clear. I'll be much more happy if I had a small part to play in your success in this term examinations. And that's it, guys. There is nothing that's going to stop you from clearing the exam in the month of September. If there is only thing that's stopping you, it's just the thought that you have in the mind that it's not possible. It's never too late. You might say 20th of August, still 10 days, 11 days in this month and 15 days in the next month. 25 days, whatever you have is very good amount of time, because you have not done average preparation so far. Your classes have gone tremendously well. You people are smart enough. And what I can see most importantly than anyone, than anything else, no. So I believe in this one statement that the wolf which is going up the hill is more hungry than the wolf that is coming down. So you people could sit in this classroom for so long listening to me speaking. If you can listen to me speak for 10 hours, no, sit for those 10 hours every damn day from today for next 35 days, and trust me, there is no reason you can fail. If you sit for 10 hours every day for 35 days, I'm telling 10 is not too much, 10 is very less. You are much competent or beyond that. You can do much more than that. If you can sit for those 10 hours every day from today for next 35 days, no, there is no possibility that you would end up screwing up your entire examination. You will come out victorious. You get what I'm trying to tell? So you have it within you a very golden opportunity and very less time. Too much time is too difficult to handle. Too less time is too nice because you have very less distractions to face. And too less time, no, you don't have to have too much of motivation to sit. Only 10 days, 15 days, 20 days. 20 days alva ಓದ್ ಬಿಡೋಣ ಆಮೇಲೆ full ಮಜಾ ಮಾಡೋಣ. So it will become like easier to focus also because the target is shorter and that excitement will get pumped in and everything's there. That rush will always take you forward for the last 1 week. So use everything to the best possible extent. My prayers are there with you people for your success. And what else do you people need? You have it all what you need. You have the competence, you have the confidence, you have the subject clarity, and also the time that you need. That's it, guys. Did you learn something new today? Did you guys have a little fun? Not much, but yeah, wherever possible, whenever possible, little here and there. So remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you guys are learning something, you're having fun, it's all good. The day you guys stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. For one last time on this day, I have just one simple question for all of you. Are we in the game? Are we in the game? Come on, the top of your voice. Are we in the game? People who are watching it live on YouTube, please do drop in a comment to tell how the entire session was. See you all in the next one. Till then, have a great time and tata. Bye bye. Take care, guys.
Bye, sir.